Alright guys, welcome to BestCAClasses. This is CA Prasanna Kumar over here. Now, in this session, Fatafat will go with revision of Ind AS 102 share-based payment. Now, this is very important in Ind AS. Why? Because it comes on an average 8 to 12 marks in the exam and it is not as difficult and as challenging as your financial instruments or Ind AS 115. Okay, right. Anyways, so therefore, this is an important standard. Now, so what are the things that we're going to cover? Meaning and scope and non-employee based transactions we'll see first. After that, the majority of the chapter, almost 90%, is all about employee based transactions. Under that, you will have equity settled share based payments, cash settled share based payments, and phantom shares, which is a mix of both, where you'll have a ESOP with a choice of cash alternative, where both the options will be available for you. Right, and then we'll see some special cases, group ESOP as well as TDS ESOP, and finally we'll also see first time application of Ind AS 102. Because it's a revision session, anything that is not so important will not be covered, and only those things which are important will be covered eventually. Right, now let's start with the basics. What is share based transaction? Let's try to understand that first. So when an entity acquires goods and services, so you take goods or you get a service from a provider of service and you pay not in the form of cash or something like that, but payment is made based on equity. Okay, either you'll give shares or you'll give cash which is based on shares. So if you give shares, it is equity settled, or cash based on equity. You got the point, which means how much cash you are going to pay, that will be linked with the market price of the share. So ultimately both are linked to shares only. So that's why you call this sort of a payment that you make for the goods or services that you have got in return, we call it as share based transaction, and the payments that you make, we call it as share based payments. Clear? Right, this is a basic idea. Okay, now let's try to understand that in depth. We'll go with some examples. Let's say PK Limited purchased land and building, so that comes under goods and services, right, on 1st April 24, whose payment will be made in 5,500 equity shares. Whenever your payment is either equity settled or cash based on equity, then it comes under share based transaction, obviously, right? Okay, so you're giving how many shares? 5,500 equity shares. On which date? 31st March 25. Okay, is it share based payment? Yes, because you have acquired goods and the payment is in equity, that is equity settled in this case. Next, A Limited acquired assets and liabilities in a business combination. So business you have acquired, and consideration will be paid in the form of 4,500 equity shares. So here also you have acquired the business which consists of assets and liabilities, and your payment is in the form of shares only, but still logically speaking this is share based payment, but this specifically comes under exception to this particular standard. It will not be covered under Ind AS 102. It comes under exception. It will be covered under Ind AS 103. So is it a share based transaction? Yes, but still it comes under exception. It will be covered in Ind AS 103 under business combination. Clear? Now moving on to the next example. PK Limited acquired land whose payment will be made in equity shares of Rohit Limited. So which means I've got the land, okay, I'm making the payment in the form of shares, that is also okay, but I'm not giving the shares of my company, I'm giving the shares of some other company. In that case, is it a share based transaction or share based payment? The answer is no. No, this is not SBP, because Rohit is a different company. But if Rohit is a subsidiary of PK Limited, if it is within the same group, then yes, it is a share based payment. You got the point? If Rohit is a third party and you're giving shares of the third party for the goods that you have received, then it is not a share based payment. But Rohit comes under the same group, it's a subsidiary, and then you're issuing the shares of the subsidiary as consideration for the goods or services that you have received, then yes, it is a share based transaction and the payment that you have done is a share based payment. Done? Clear? Next, PK Limited issued shares in return for cash. Is it SBP? Which means I've issued shares, Nana. I've got in return cash, not goods or services. Cash. I've got cash and I've issued shares. So the answer is no, it is not a share based payment, because you did not get goods or services. What you have got is cash. As financial assets are not included in goods, this cash is a financial asset. You will know it in financial instruments, right? And debtor in the place of cash also, the answer is same as acquired item is a financial asset. Suppose you got your assets and you gave payment not in the form of cash but in the form of debtors. You understand the point? Even in that case also it doesn't work. You got it? Are we done with this? Because debtors and cash both are financial assets, Nana. Therefore, financial assets are specifically excluded from this particular standard. As you can see, acquired financial asset is an exception, not covered under this particular standard. It is covered in Ind AS 109. That is financial instruments. Anyways, Next, PK Limited issued shares to Rohit, who is employee in capacity of shareholder. Is it SBP? Again, the answer is no. See, you're not giving him shares in the capacity of employee. You are giving him shares in the capacity of shareholder, which means because he is a shareholder, you are issuing shares, which means mostly it will be a rights issue or bonus issue. In that case, it is not a share-based payment. If he is an employee and you are giving him shares in the capacity of an employee because employee provided services, then it will be a share-based payment or share-based transaction. You got the point? That we will see later. So finally, the summary is goods and services can be what according to this particular standard, Ind AS 102. It can be PPE, property, plant and equipment, or PP under development. It can be under construction. Similarly, intangible asset or intangible under development will be considered as goods or services. Investment property, of course, it will be considered. Services from employee, of course, that is what major part of this particular standard. Service from general contractor, yes. Service from a director similar to the employee, yes, that will also be considered under services over here. CA as a tax auditor, tax advisor getting shares, yes, that also will be considered under services. What will not be considered? Financial assets, because it is covered under financial instruments. It is not covered in this particular standard. Shares issued to employee in capacity of shareholders, yes, not covered. It is not a share-based transaction. Business combination, yes, it is not covered because these two are exceptions. Clear? I hope you got the basic idea, right? Now, if you look at the beginning, we are trying to cover meaning and scope. That is done already. Non-employee transactions we will also cover. After that, we'll cover employee transactions, which will cover nearly 90% of the syllabus, which will account for 90% of the syllabus. Now, let's look at non-employee based transaction. That will be only a little bit. After that, the major part of this standard will be employee based transaction, which is equity settled, cash settled, and equity with a cash alternative option, which is phantom shares. Okay, shall we start? Nana, this is revision session, so obviously there will be a pace that I'll maintain. Okay, if you guys are not able to get it for the first time, I would want you guys to repeat watch. No matter how many times you want, you can watch it because it's going to stay in the YouTube. Clear? You just subscribe to my channel, CA Prasanna Kumar, and you will get hell lot of videos, Nana. Now you'll be getting FR videos almost like this, another for some time, like 20-30 days, and after that it will be followed by AFM videos. Okay, so a lot of CA final stuff is gonna come to this particular channel, so you keep subscribed to CA Prasanna Kumar, right? All right, shall we start with non-employee transactions? Ready? All right, guys, first let's have a look into non-employee based transactions. Okay, where you try to purchase goods or services from somebody who's other than an employee. Okay, and then obviously we will make them payment in the form of shares or cash which is related to shares, right? Anyways, now in this there are two things that are very important. One is grant date, the other one is measurement date. Now, first question, what do you mean by grant date, sir? It is a date of contract, okay, between the two parties. Who is buying the goods and services is one party, and as well as who is receiving the payment in the form of shares, as well as, cash related to the shares, that is other party, right? So this is the date when all parties agreed and approval is obtained. So both of them, they agree that I'll be, selling you the so-called goods or services, and you'll be making me payment in the form of shares or in the form of cash linked with shares. You got the point? Okay. But most important point is there will be no entry on grant date. Grant date is just a date on which all the parties agree upon that this is how the contract that is going to happen between both of us. Okay, so it's a date of the contract where both the parties will agree upon with each other. That's all, nothing else. Okay, there is no entry on the grant date. This is very, 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 very important. Clear? Okay, coming on to the next date. What is that? Measurement date. This is the date when the goods will be received, or you would have obtained the control over the goods. Maybe it is not physically received, but you would have obtained control. Either way, the risk and reward are transferred to you, so which means you have got the goods. This is the date on which the service is provided. If there are no goods, then probably you have got the service, and the date on which you have got the service is nothing but measurement date. So grant date means it is a date of contract where both the parties agreed upon with each other. There will be no entry on grant date. Measurement date means it is the date where you got the goods or you got the control of the goods, or if it is services, you have received the services. Clear? And therefore invoice generally will be on that particular date. If that date specifically is not available, generally we'll take period end. Period end means mostly year end and stuff like that. Okay, and this is the date on which you will journalize as well, where you'll pass the journal entries. Now the question is, what will be the journal entry? Very easy, Nana. If you get a good, it is an asset basically, so asset will be debited. If you receive a service, you have to make payment for that. It is an expenditure for you. So expenditure also has to be debited. You know that. Okay, asset or expenditure debit. 2, if it is equity settled, means tomorrow you gonna issue shares. Then today you will create share based payment reserve. You got the point? Suppose today itself you are going to issue shares, then you will write 2 equity share capital and 2 securities premium. You understand the point? Today you are not going to issue shares. You're going to issue shares in the future date. Therefore, for that today you will create a reserve, and that reserve will be called as SBP reserve in case tomorrow you are making the payment in the form of shares. Or suppose you are making the payment in the form of cash which is linked with the market price of the share, then it will be called as SBP liability, means share based payment liability. Clear? Right? Why it is liability? Because tomorrow you have to make cash payment, na? So that's a liability. SBP reserve means you are not going to make any cash payment. You are going to just issue shares. So that is not a liability. It is an equity obligation. When you have an obligation to issue shares, it will be referred as equity obligation, not a liability. Whereas when you have an obligation to issue cash, then that is a liability. Therefore, if it is equity settled, where you have a promise to issue shares in the future, it will be SBP reserve. Whereas if you make a promise to issue cash which is linked with the market price of the share in future, then it will be referred as SBP liability or share based payment liability. Clear? There are other names for this. SBP reserve can also be called as equity settled share based payment. SBP liability can also be called as cash settled share based payment. But we will not be using these names, equity settled share based payment or cash settled share based payment. Why? Because your ICI uses SBP reserve, SBP liability, so we will be using them as well. Okay. Next question. Here we need to write the amount column. Na? When you buy goods or when you receive services, you have to write some amount over here, right? What will be that amount? That is the first question. Answer is very simple. Whatever the goods or services that you buy, they will have a fair value in the market. That is for sure. So whatever the fair value of goods or services is available, on which date? The measurement date, not on the grant date, because grant date you will not be making any entries. There will be no journals. You got the point? So the journalizing stuff will happen only on the measurement date. Therefore, whatever the number that you want to put here is nothing but fair value of the goods or services on which date, Nana? Measurement date. Very, very, very important. 99% of the cases you will be able to get your fair value for the goods and services which you have received other than the employees. In other than the employees cases, because we are talking about non-employee transactions now, we are not talking about employee or employee related transactions. Clear? So therefore 99% of the cases when you are buying goods from other than employees or when you are receiving services from somebody other than employees, then in that case 99% you will be able to find out what is the fair value of the goods or services that you have received on the measurement date. Then that fair value will be the amount that you will put here. In exceptional cases, in rare cases, if you are not able to find out your fair value, then fair value with reference to equity will be your alternative choice. This we will discuss later. Right now, this much knowledge is enough for you. Are we done with this? Got it? And don't worry about these things over here. Remeasurement not allowed, remeasurement allowed. These things we'll see later. Right now, it is not the point of discussion. Okay. Right now, it will be heavy. This is not the right time to discuss that. Till here, is it clear? Okay. Non-employee transactions means there will be 2 dates: grant date, measurement date. What you will do on the grant date, what you will do on the measurement date, how will you pass the entry. Okay, based on equity settled, it will be SBP reserve. Based on cash settled, it will be SBP liability. And then the amount will be the fair value of goods and services on the measurement date. That's all. That's all you need to remember. Clear? Till here it's clear? Fantastic. Moving on. This example and all that we'll see later. Okay, let's come back here. So let's see what we have discussed so far. Ready? Alright guys. So let's kind of revise what we have done so far. So basically share based arrangement or transaction or payment, whatever it is, ultimately there will be an entity, our company, and on the other side there will be employee or third party, correct? They will give us goods or services, we receive goods and services, and we will pay in return consideration, not in the form of cash but in the form of equity instruments or cash based on equity instruments. Equity instrument is nothing but equity settled. Cash based on equity instruments is nothing but cash settled. Now equity instruments means what, sir? Only shares? No, it is not only shares. That's why we are trying to refine the information. Initial understanding was like shares, that's easy. Now let's refine, because we already know that na. Issuing equity share is also equity instrument. Issuing options of the entity, I mean to say options to buy a share in future at an exercise price. For example, let's say your market price is 300. I am saying that in future you can buy this share at just 100 rupees only, even though the market price is 300, so that you'll buy it at 100, you'll sell it at 300, you'll get the profit of 200. So this is a kind of option to buy the share at an exercise price. So that is also an equity instrument. And not only that, I need not give equity share of my company or option to buy the share of my company, but also I can give you equity share of another company in my group. I can also give you an option to buy the equity share of another company in my group as well. That will also be considered as equity instrument. Sir, what do you mean by group, sir? The best example I can give is Volkswagen Group. So in Volkswagen Group, what happens basically, Skoda comes under the same group, Bentley comes under the same group, Porsche comes under the same group, Lamborghini comes under the same group. Correct? Right? So say for example, transaction is happening with Skoda, but Skoda promises that I'll give you the shares of Lamborghini or something like that. I'll give you the shares of Volkswagen Group. That also comes under this particular share based arrangement only. Because I gave you the example here itself, in case of Rohit Limited. You remember that? If PK Limited has acquired land whose payment will be made in the equity shares of Rohit Limited, then it is not a share based payment. But if Rohit is subsidiary of PK within the same group, then it is share based payment. So that's what I'm talking about over here. Clear? Within the group, right? Now we know that share based payment can be divided into three. One is equity settled, right? Other one is cash settled, where cash will be linked with the market price of the share, and equity plan with a cash alternative, which is nothing but phantom, where both the options will be available. Anyone can choose any option. Clear? Right. Now the next question is how to pass the entries. Very simple. What can you give me as a counterparty? You can either give me machinery or services or goods. Correct? Means I am the entity. The counterparty maximum you can give me what? Either goods or you can give me services. Correct? Or big assets like machinery. Got the point? So whether it is asset or expenditure, ultimately what will I do? I will debit it. Correct? And I have to make payment to you. I'll make payment to you in what way? Either I'll give you shares, that is equity settled, which is nothing but SBP reserve, or I'll give you cash, which is linked with the market price of the share, then it will be SBP liability. Are we done? I told you SBP reserve means it is an obligation to issue shares in future. It is not a liability. Whereas SBP liability is an obligation to pay cash in futures based on share price. So that is a liability. Okay. When you want to pay cash, it's a liability. When you want to give equity shares, it is not a liability, it's an obligation. Keep that in mind. Are we done with this? Okay. Next question. The above entry should be recorded at what amount? Which means here, whatever the number that you need to put, what number should I put? This we have already discussed. Okay. So it will be fair value of the goods or services on the measurement date. That is the answer. That is what I've written here as well. Say for example, here you have got machinery, na? Okay, in our example, let's say you bought machinery. And the fair value of the machinery on the measurement date is how much, Nana? 13 lakhs. Then at what amount will you recognize? 13 lakhs only. You'll simply put 13 lakhs. Let's say in future I'm going to issue shares. Therefore, I've written SBP reserve, equity obligation. That's it. Entry is done, as simple as that. You got the point? So after 3 months, you'll issue what? 10,000 shares. That's all. Are we done? Now, suppose if the other party is giving you employee kind of services, or the other party is employee itself and he is giving you employee kind of services, then in that case, how will you measure your amount? That is the biggest question. Are you able to get me? Sir, see, please try to understand one thing, Nana. When you are trying to make this transaction of getting goods and services and you are trying to make payment, who will give you goods or services? Either it will be a third party or it will be an employee. Correct? If it is third party, no problem. I'll value it at the fair value, because when third party is giving me something, I know it's fair value. But employee, when he is providing me services, I don't know what is the fair value of the services he is providing. It is very difficult to find out the fair value of the services what the employee is providing. See, I'm receiving, say for example, let's imagine that this is the service, Nana, this particular pen. Okay, I'm receiving the services. Now, if I can't find out what is the fair value of this, how will I put the number over here? See, in this case, when I buy the machinery, I know what is the fair value of the machinery in the market. It is easily available. So therefore, I can put the number over here. But when my employee is providing me services, I can't value those services. It's very difficult. I can't say this services is worth 10 lakhs, 20 lakhs, 30 lakhs, 40 lakhs. I can't say. See here. If counterparty is employee and he is offering employee kind of services, then it is identifying value of the services is very difficult. Okay, therefore we go for an alternative plan. What is that alternative plan? We choose fair value of the shares. We choose fair value of the shares, and that will be put as an amount in the amount column. Sir, what do you mean by this, sir? See here. Listen carefully. If you understand this logic, rest of the chapter will be very easy. You are giving me shares. You are an employee. Remember, I am the entity. You are the employee. You are giving me services. Okay. But it's very difficult for me to find the worth of your services. You understand the point? I can't find the value of your services because in the outside market, I cannot find similar services, or I can't find the fair value. But if it's a missionary, I can easily find what is the fair value in the market. You understand the point? I don't face this difficulty. I face this difficulty only when I receive services from the employee. Clear? So now what I was thinking is, okay, anyway, I can't value the value of the services that I've received from the employee. So instead, what I'll do is that let me see what I'm paying to the employee. When I can't value the services I'm receiving from you, let me see what I'm paying to you. Say for example, I'm paying you this iPad pencil. So when I'm paying you this iPad pencil and I know that the fair value of the iPad pencil is 11,000 in the market, then indirectly the value of services that I've received from you is 11,000 only. Na? Are you able to get my point? Again, I repeat. Nana, suppose it is machinery. Suppose I got machinery from you. I know the value of the machinery, 13 lakhs in the market. I can easily find out. So I'll debit 30 lakhs to SBP reserve 30 lakhs or SBP liability, depending upon whether I give shares or cash in the future. Clear? Now, if I receive services from the employee, I don't know what is the value of the services I've received from the employee. Therefore, what I'll do in an intelligent way, forget about the services that I've received from the employee. Anyway, I can't value it. What is the payment I'm making to the employee? Sir, I'm giving one Apple pencil to the employee. What is the value of the Apple pencil in the market? Sir, 11,000, sir. Then 11,000 is the worth of the services that I've received from the same employee. You got the point? Similarly, here also, in this example, I'm making the payment in the form of Apple pencil, correct? But here, you are making the payment in the form of shares. You understand the point? Therefore, fair value of the shares, just like fair value of the Apple pencil, will be the value of the services that I've received from the employee. Simple, isn't it? You got the point? So finally, the summary is very simple, Nana. When the party who is providing you services is a third party, not an employee, and is either giving you goods or services, then you can easily identify the fair value of that, and therefore that fair value will be the number that will be put here for the entry. Clear? Clear. But if that guy who is providing your services is an employee, in that case, you are not able to identify the value of the services. Then you see what is the payment you are making them. Sir, I'm giving these many shares. What is the fair value of the shares worth? This much. Then that is the value of the services that I've received from the employee. Simple. Game over. Clear? All right. Now see here, one more thing. Same example. Here this missionary example is there now. I have debited the missionary with 13 lakhs and 2 SBP reserve because in future I'm going to issue 10,000 shares. Today's fair value is 120, but today's fair value of the missionary is 13 lakhs. Clear? I'm going to make payment in the form of shares. How many shares? 10,000 shares. After how many months? 3 months. Clear? After 3 months, what is happening? The fair value of the share has increased all the way from 120 to 140. Okay? Face value is 10. Okay? Fair value of the share has increased. Now tell me, in that case, will I increase the value of the machinery? No. You understand the point? Because today I have purchased machinery, Nana. Instead of giving cash, I said after 3 months I'll give you 10,000 shares. That doesn't mean that this value of machinery will increase after 3 months, na? You understand what I'm trying to say? See here. Suppose an employee worked with me. Okay? I have to make payment in the form of cash normally. Let's say 20,000 salary I have to pay to my employee. I don't have cash with me. So what I've done, because I don't have cash with me, I gave my employee an iPhone. Say for example, I gave my employee a phone. I don't have cash worth 20,000. So therefore, this phone, you take it. Okay. Now what happened? After 3 months, this phone value has got increased by 10,000. Now it is 30,000. You understand the point? Does that mean the services that I've received from the employee, value has got increased by 10,000. 3 months back, I received services from the employee. Its value is 20,000. I should have paid 20,000 salary, but I did not have cash. Therefore, I did not pay 20,000 in cash. I gave a phone. On that day, the worth of the phone is 20,000 only. So I gave the phone. But after 3 months, the phone value has got increased by 10,000. Now the phone value is 30,000. Does that mean the value of the services that the employee has provided 3 months back has got increased by 10,000? No, na. You understand the point what I'm trying to say? Same logic here. On that day, the fair value of the machinery is 13 lakhs. I promised to give 10,000 shares after 3 months. Today's share fair value is normal only, na? It is 120 only. It is less than the fair value of the machinery. You understand the point? Just because after 3 months the fair value of the share increases doesn't mean that machinery value will increase. Purinjo, right? Therefore, the machinery will stay at the same value. You got the point, which is 13 lakhs. Okay. And I have created SBP reserve because tomorrow in future I have to issue shares. For that shares I have created reserve. After 3 months, once I issue shares, I will debit the reserve. From that I'll issue the shares. Clear? So 3 months gone. Now I'm debiting the reserve. From this I'm going to issue shares. To equity share capital to the extent of face value. Presume that face value is 10 rupees. Therefore 10 rupees into 10,000 shares. 1 lakh is the face value. The balance will go to securities premium. Simple. Are we done with this? Okay. Now there is a student doubt. A student has asked me, sir, you did not even consider fair value of the share 140 in the above entry. Why? For that already I gave you one logical explanation, that just because the fair value of the consideration that is given to you, which is shares, has increased, does not mean the value of the machinery has got increased. This is one logic. I'll give you another logic also. See here, you take the balance sheet. Okay, you have equity, traditional balance sheet. Okay, T-shaped, equity, liabilities, assets. Now many standards will tell you to value these assets at fair value. So anyway, this will be at fair value indirectly. Same liabilities also, most of the times it will be remeasured at the latest value. Let's not call it as a fair value. It will be at latest value. For example, foreign currency liability will be restated at the closing exchange value provisions at the latest estimates, based on latest estimates, right? Like this, so many rules are there. Let's not get into details. But the logic is, for ease of understanding, let's consider this also as fair value. So indirectly, liabilities will be measured at fair value or latest estimate, and assets also will be measured at fair value. You understand the point? When these two are measured at fair value, whatever the gain or loss due to the fair value valuation of assets or liabilities will by default be reflected in equity, na? So indirectly, your equity will always be at fair value. This is one logic. So therefore, you need not again and again remeasure that at fair value. Clear? Now see here. So therefore, whatever these assets and liabilities, when you're revaluing them, the gain or loss due to such revaluation, okay, will ultimately be recorded in the equity. Therefore, no need to fair value the equity, no need to remeasure the equity again and again. You got it? Okay. So therefore, the logic is you will never ever fair value the equity itself, because it's already done indirectly. Because ultimately all this drama, what drama? This assets being valued at fair value, this liabilities being valued at latest value, all this drama results into other equity only, which means in an implied way, in an indirect way, your equity is always at fair value. Think you will get it. I'm trying to explain the logic so that you will not by heart why this is not valued at fair value. Already I gave you one logic, that machinery value can't be increased, okay, just because the fair value of your shares that has been increased. You got it? One logic I gave you. This is second logic. I hope this is clear, everybody. Chalo, let's continue. Now let's take this example, machinery, goods or services. I'm taking machinery as example. Company promised to pay cash to vendor after 3 months equivalent to the market price of 1000 shares, which means this is cash settled. Okay, so the company promised that I purchase machinery today, after 3 months I'll pay you cash. Just like that, I'll not pay you random cash. I'll pay you cash which is linked to the market price of 1000 equity shares, which means 1000 equity shares, how much will be the market value after 3 months? That much cash I'll pay you. Clear? So this is nothing but cash settled. When it is cash settled, you have to create SBP liability. So therefore, machinery account you will debit. So what you will do, you will find out the fair value. Fair value of the machine on the measurement date is how much? 13 lakhs. You put 13 lakhs to SBP liability, which is the obligation, cash obligation is 13 lakhs. Clear? Are we done with this? Fantastic. Now after 3 months, let's say the market price increased to 145. When you bought this machinery, the market price of your share is only 120. Now the market price has got increased to 145. Now remember one thing, when your obligation is to issue shares, here you will just issue shares, that's all. But here your obligation is to issue cash linked to the market price of the share. When the market price of the share increases, now my cash obligation also increases. Whereas here, your obligation is not changing. Still, you are giving the same 10,000 shares only, irrespective of the fair value of the share. Clear? Huh? Whereas here, because your market price of the share has got increased all the way to 145, what is happening basically? You have to pay more cash. Initially, you thought you'll be paying only 13 lakhs, correct? But now you have to remeasure because your market price of the share has gone to 145. You promised 10,000 shares, which means your liability is 14 lakh 15,000. But you have created liability only to the extent of 13 lakhs, which means you need to increase the liability by 1 lakh 50,000. Therefore, you'll credit the liability and you'll debit profit and loss account. From profit and loss account only, now you'll take money. Logical. Now, finally, you have to make the payment. So, debit the liability, credit cash. That's all there ends the matter. You have to make the payment. So this is called remeasurement of liability. What do you mean by remeasuring your liability? Initially, I thought my liability will be 13 lakhs. Unfortunately, my market price of the share has got increased beyond expectation, and therefore my liability has got increased by 1 lakh 50. Therefore, I have to remeasure my liability and increase the liability. This increasing the liability is nothing but we call it as remeasurement of liability. Decrease also can happen. No worries. Are we done with this? Yes? Chalo. Fantastic. Now this we already seen. What does the standard will not cover? This we have already seen. Okay. Right, now see Anana. So 95% of the standard is all about three things, which is employee related only. Non-employee related is not important in the standard. What are they? ESOPs. ESOPs is nothing but shares that you give to your employees. Okay. SAR, stock appreciation rights, where cash settled plans you will give to your employee, which means you will pay cash here to your employees. Then it will be called as SAR. If you give shares to your employees or options to buy share, it will be called as ESOPs. And ESOPs with a cash alternative means it's a mix. Both the choices are given to your employee. Employee can choose any one option. If employee wants share, employee can choose share. If employee wants cash, employee can choose cash option. Clear? So totally, this is what the standard is all about. Employee related only. And with respect to employee related, you have got three options. You pay shares to the employee, ESOPs. You pay cash to the employee, SAR means what? Stock appreciation rights. Because how much your share price appreciates, increases, based on that you'll pay cash to the employee. Third one is ESOPs with a cash alternative, which means either if employee chooses share, he'll get a share. If employee chooses cash, he'll get cash. Got it? This is your syllabus. Are we done with that? Now let's start with the first one. What is the first one? ESOPs, employee stock option scheme. Very, very, very important. You guys are ready? We'll start. All right, guys. Now let's go with ESOPs. Okay, ready? Now, let's say the total time period in this example is 5 years. Okay, 3 years is the vesting period, 2 years is the exercise period. Okay, now year 0 you have a grant date. You know what is grant date? The date on which both the parties agree upon everything. Okay, and they enter into the contract and all that stuff. So today on the grant date, option to buy share is given to the employee, which means we are giving ESOPs to the employee. Employee stock option scheme, where we give an option for the employee that you can buy share in future at an exercise price of 80 rupees. Not today, in future. In future means when you satisfy all the conditions, which is nothing but we call vesting conditions, and you satisfy all the time period, which is nothing but we call vesting period. After that, the options will get vested. Then you will have right to exercise the option, where you can buy the share at exercise price of 80 rupees, irrespective of whatever the market share, market price of the share on that date is going to be. Clear? Now, okay. What are all the things that we need to learn? The first thing we need to understand is there is something called vesting period. What is vesting period? Which means it is a time period during which you need to satisfy all the conditions, vesting conditions. Okay. All the conditions that you need to satisfy to get this option vested is nothing but vesting conditions. And the time period during which all these conditions need to be satisfied, we call it as a vesting period. In this example, 3 years is the vesting period, and the conditions are called as vesting conditions. Once the vesting period is done at the end of 3rd year, and once you satisfy all the so-called vesting conditions, then options will get vested. Once options get vested, provided if you satisfy all the conditions, then the employee has got chance to exercise the option in the exercise period, which means in this 2-year period, whenever the employee wants, he can exercise the option, which means he can buy the share at exercise price, that is 80 rupees in this example. You got the point? Third year beginning he can do, third year middle he can do, fourth year beginning he can do, fourth year ending also he can do, his wish. During this 2 years of exercise period, at any given period, he can exercise the option to buy the share. But once this exercise period also is gone, then automatically your options will be lapsed. After that, the employee can no more exercise the option. Clear? Fantastic. Now, let's dig deeper. So what are all the basics we have learned? There will be something called grant date. On the grant date, the company will give the option to buy the share to the employee at a price called exercise price, irrespective of the market price. And therefore, in future, after 3 years, you can have an option to buy the share at an exercise price of 80 rupees, provided in these 3 years, which is nothing but vesting period, you satisfy certain conditions, which we call it as a vesting conditions. Clear? Now, this vesting conditions can be divided into two: service condition, performance condition. Sir, what do you mean by service condition, sir? Very simple. Vesting period is 3 years, na? So therefore, your employee should stay in service for 3 years. He should not leave the company. If he stays in service for 3 years, then service condition is satisfied, which means service condition is also one of the vesting condition that is satisfied. Clear? Next, the other type of condition is performance condition. Sir, what do you mean by performance condition, sir? Employee has to perform something to satisfy the company. What do you mean by performing something? The performance condition can be divided into two: non-market condition, market condition. Okay. Non-market condition means the company will say, all your employees put together, you should ensure that the sales of our company should grow by 10% per annum over next 3 years, which means first year it should grow by 10%, second year it should grow by 10%, third year it should grow by 10%. If you can ensure all the employees put together, if you work together and then ensure that our sales grows by this much, okay, then it means that non-market condition is satisfied, then it means that performance condition is satisfied, then it means that vesting condition is satisfied, then it means that the total conditions are satisfied, then it means that option will vest to the employees. Got it? The other type of performance condition is market condition. This is purely illogical, because at least non-market condition to some extent is within the control of the employees. Market condition is purely out of the control of the employees. They will say market price of the share at year 3 should be greater than 500, or simply they will say this is with time limit. This is market condition with time limit, means the market price of the share should cross 500, that too it should cross within 3 years. Okay, this is market condition with time limit. Suppose if the company says the options will get vested when market price crosses 500, that's all. Suppose the company says your options will get vested if the market price of the share of the company crosses 500 without any time limit, then whenever it crosses 500, at that time the options will get vested. That can be third year, fifth year, sixth year, seventh year, eighth year, ninth year, 10th year, we don't know, without time limit. Or the company can put a condition like this: within 3 years the market price of the share of this company should cross 500. If that happens, market condition is satisfied. If that happens, performance condition is satisfied. If that happens, vesting conditions are satisfied. If that happens, options will vest, and then you can exercise within a period of 2 years. Got the point? Done? Everybody? Right. Nana, this is revision, Nana. So in revision also I can't revise. Okay. We don't have time. Fatafat, we need to move. Okay. Now we're gonna find out what is the fair value of the option, because right now we did not discuss about fair value of the option, correct? We discussed exercise price, market price, there is nothing to discuss. It is just market price of the share. Okay. But we did not discuss something called fair value of the option. Now, before we discuss fair value of the option, I'll give you an example. With this, it will be easy for you to understand what is fair value of the option. You guys are ready? Alright guys, now let's have a look at this particular example. Suppose a KFC bucket will cost you 1000 rupees, okay, if you just go directly and buy. But what if I give you a coupon, so that if you have this coupon which has a validity of 2 days, you can buy the same bucket which is priced at 1000 at 600 itself, which means literally you will be saving 400 rupees because of this coupon, because with this coupon you can buy it at 600. Now my question is, what is the worth of this so-called coupon which I gave you? Is it 600? No. Because of this coupon, you are able to buy a bucket which is worth otherwise 1000 at 600, which means because of this coupon you are saving 400, which means what is the worth of this so-called coupon? It is 400. because that much you need not pay if you have the coupon, correct? If you don't have the coupon, you have to pay 1000, which means you'll be paying 400 more, which means that is the value of the coupon. You got the point? Suppose you have lost the coupon, how much extra you have to pay? That is 400. So simple, that 400 is the worth of the coupon. By applying the same logic in the above example, market price of the share is how much? 200. Whereas company gives you a coupon which is excise price through which you can buy the share at how much? 80. Then what is the worth of this so-called excise price, that option given to you by the company? 120 only, na? Because you can buy 200 worth share at 80 only, which means ultimately you can say 120, which means 120 is the value of that particular option, correct? Just basic understanding, right? Correct. Going by this logic, this is exactly correct. Done. Now, however, if we dig deeper, let's go a little bit deeper. This is basic understanding, okay? In reality, you need to compare exercise price of 80 with market price, not today, but on the date of exercising the option. So unfortunately, today you don't know what is the value of the option. Means I should not be comparing this 80 with 200 today, because today I don't have the option to exercise, na? Today I can't buy by paying 80 rupees, and today I can't sell after buying, right? I have to wait for a period of 3 years. After 3 years only I'll have an option to exercise, which means after 3 years only I can purchase at 80 rupees. After 3 years I don't know what is the market price. After 3 years, if I know what is the market price, considering I exercise the option at the beginning of the third year itself, then that market price and the exercise price difference is nothing but value of the option in future. Then you need to discount it all the way to year 0, and then only you will know what is the fair value of the option today. You understand the point? So this initial example I just gave you to understand the basics, that's all. But once we dig deeper, you understand how to calculate the fair value of the option. You understand the point? Today my exercise price is 80. Today I can't exercise this option. I need to wait for 3 years. After 3 years only I can exercise the option. Presuming that at the third year beginning only I'll be exercising the option where I'll be buying the share at 80. That day, let's say market price of the share is 400. Then the value of the option is 320 on that particular day. You understand the point? Then you bring it, you discount it all the way to year 0. Then you will have the value of the option at year 0. Got the point? Right. Now see here. So value of the option has got two ways of doing things. One is fair value of the option, which I explained you right now. Okay, in SFM we will see how to calculate this by following binomial model and all that, Black-Scholes model and all that. Right now in FR you need not worry about that, it will be given in the question. Clear? The other one is intrinsic value of the option. Intrinsic value of the option means, say for example, after 4 years, on 4th year market price is 500 and exercise price is 80, which means you can buy the share at 80 and sell it at 500 immediately, which means your intrinsic value of the option is 420. Difference between exercise price and market price is nothing but intrinsic value. But according to this AS 102 Ind AS, this intrinsic value of the option cannot be used to calculate value of the option, because it is wrong. Why? Because intrinsic value of the option gives you value of the option in future. I don't want value of the option in future. I want value of the option on grant date. You understand the point? Therefore, you can't take intrinsic value of the option, which is a future value of the option, and say that that is the value of the option today on the grant date, which is wrong. You understand the point? Therefore, Ind AS also says this is wrong. You follow this one. You follow this methodology. Okay, there will be a lot of complications in that. We'll see that in AFM or SFM in CA final or CMA final. And then eventually we'll calculate the value of the option. Clear? By following option pricing models like binomial model or Black-Scholes model. Clear? Right. Don't worry, it will always be given in the question. In case of equity settled SBP to employees, fair value of the options or shares at grant date will be considered. In case of cash settled, fair value on every single date of the balance sheet will be considered. Okay, because when you are giving cash, your cash liability will keep on increasing depending upon the market price. If market price keeps on increasing, your cash liability also keeps on increasing. Therefore, you have to keep on remeasuring your cash liability. That's what we have done in the example. Na? Where is the example? Here. Initially, your market price was 120. Once your market price has got increased, then your liability also has to be increased to that extent. Na? Therefore, you will keep on doing remeasurement. That's why if there is cash settlement, you will keep on finding out the fair value of the options at each balance sheet date. But when it is equity settled, you need not remeasure, because ultimately you are going to give same number of shares irrespective of the market price when it is equity settled. Therefore, you will find the fair value of the option on the grant date only. You will not change it. When it comes to equity settled, you will find fair value of the option on the grant date only. You will not change it, because no need to change it, because you're going to issue only fixed number of shares. You understand the point? It will not change. You got it? Anyways, but when it comes to cash settled, your cash liability will be depending upon the market price. So when market price fluctuates, your cash liability also fluctuates. Therefore, you have to keep on remeasuring them at each and every balance sheet date. Got the point? First year ending, you have to remeasure. Second year ending, you have to remeasure. Third year ending, you have to remeasure. Got it? Chalo. Now, okay. Now let's look into the accounting part. Slowly, one by one, example by example, we'll go. See here. Employee stock options, ESOP. ESOP means what? Equity settled, not cash settled. First, we will look into ESOPs only. Then we'll go for SARs. ESOPs. For one employee, there is only one employee. Okay, for that one employee, you give one option to buy a share in future at an exercise price of 80. Okay. Fair value of the option on the grant date is 180. I already gave you a rough idea, not exact idea, on how to calculate fair value. How to calculate fair value? You have an option to buy the share at 80. Let's say on 4th year, you exercise the option to buy the share. Then on 4th year, you will buy the share by paying 80. On that day, let's say the market price is 420. Then let's say 400. Then the difference between these two is 320. That will be the future intrinsic value. Then you discount it and bring it all the way down to year 0. And that will be the fair value of the option. This is rough calculation. Exact calculation will be by following binomial model or what? Black-Scholes model. Clear? That's how you calculate the fair value on the grant date, which is 180. Vesting period is 3 years. Face value of the share is 10. This is the example. Okay. How to pass the entries? Because we are talking about accounting only, na? On grant date, there will be no entry, which we already know, right? But if you see, ultimately, fair value of the option is 180 on the grant date. What do you mean by fair value of the option being 180? For whatever the services employee has provided, the company decided to pay 180. Company decided to pay options to buy the share to the employee. The worth of that option is 180, which means basically company is paying 180 logically, correct? So the expenditure for the company is 180, which means benefit for the employee will be 180. Expenditure for the company will be 180. This 180 expenditure for the company will be over a period of 3 years. Then per year the expenditure for the company will be how much? 60. Therefore, every year how much I need to debit in my P&L? 60 per year only, na? Yeah, 180 for all the 3 years. So 60, 60, 60. Clear? So therefore, at the end of each year, I'll debit 60, 60, 60. How will I pass the entry? This is an expenditure for the company. Related to what? You are paying to the employee. So you are compensating the employee. So you can call it as employee compensation or employee benefit expenses. Whichever name you want, you can go. I use the word employee compensation. Okay. 2. In future, what am I going to pay? Shares. Equity settled. Therefore, for that, today itself I'm not issuing shares. I'm issuing shares in future. Therefore, today I'll create reserve. So what reserve will I create? SBP reserve, share based payment reserve. Clear? That's it. Then ultimately this equity compensation should go to P&L. Therefore, P&L to equity compensation. That's all. Got it? P&L debit, it's an expenditure to equity compensation. To employee compensation. Okay. Now, when we are solving sums, we will not be passing this additional entry. We will only pass single entry and within brackets we'll write P&L. So it is implied that employee compensation or employee benefit expenses will be by default transferred to P&L account. It is implied. Am I clear? Right. 60, 60, 60. Now what will happen to your SBP reserve? First year you have credited 60. Second year also you have created 60, it will become 120. Third year also you have created 60, it will become 180. So after third year, your SBP reserve will be showing a credit balance of 180, correct? From this SBP reserve only, you will be issuing equity shares after third year. Clear? Now. So balance sheet at the end of year 3 ending, SBP reserve will be showing 180. What is this 180? Value of the option on the grant date or imaginary value of the services received. That's what I told you, na? When I can't value the services received from the employee, I see how much I'm making payment to them. I'm making a payment of 180. Then 180 worth of services I've received from the employee. Simple. Got it? Right. Now. So now let's see after year 3 what's gonna happen after the end of vesting period. There are two possibilities. Now, Nana, one possibility is employee will exercise the option, which most probably will happen. But there is another possibility that employee will lapse the option as well. That possibility is also there. Okay, now, if employee exercise the option, it's very easy, Nana. He will exercise the option by buying the share at exercise price. What is the exercise price? 80, which means he will pay you 80. I am the entity. I'll receive the payment of 80, which means I need to debit my bank to the extent of excise price, correct? Already I've created SBP reserve to the extent of 180. From that only I'll be issuing shares. Therefore, this has to be debited to make it 0. So I will debit it 180. 2. Equity share capital will be credited to the extent of face value. What is the face value? 10. Correct? To that extent you credit. Balance will automatically go to securities premium. Kind of a balancing figure. Easy entry. Done. If employee lapses the option, then it means that you basically wait till the excise period. In our example, the excise period was third year to fifth year, which means 2 years you will wait. After that also, if employee does not choose to exercise the option, then it is lapsed. Then it is lapsed means what you will do, whatever that you have got in the SBP reserve is now not so useful. So from there you will be transferring that to retained earnings. Now you can ask me, why retained earnings? Well, the logic is very simple. You cannot transfer it back to P&L. Why? Because employee has already provided you services now. Whatever the services were that you have received, you understand the point? So therefore, to the extent of the benefit of services that you have received, you have debited the P&L in the form of employee compensation. So that is done and dusted. Now, just because employee did not choose to exercise the option does not mean that you did not get services, does not mean that you can reverse it back to P&L. So that's the stupidest accounting. You got the point? So therefore, what basically we do is that we transfer it to retained earnings. So it remains in other equity only. It will not go anywhere. Got it? When employee lapses the option. Clear? Now, one more important thing is this entry is pretty easy, but there was once one problem that was asked by your ICA where he asked you to open up ledger accounts for all this. That's where students got confused. They don't know how to split this entry. So therefore, I'll give you an idea to split this particular entry so that there is one big sum for us. It will come very handy in that particular sum. Now see here. How to split the entry? Very simple. Anyway, you'll be receiving money to your bank in the form of excise price because employees will pay 80. To that extent, you increase the SBP liability first. Sorry, SBP reserve first. Okay. SBP reserve was already how much? 180. Employee is going to pay you how much? 80. To the extent of that, increase this 180 to 260. 180 plus 80. So, bank account debit to SBP reserve. Now, SBP reserve goes to 260. From this, you make the issue of equity shares to equity share capital to securities premium. Equity share capital to the extent of face value. Balancing figure will go to securities premium. Clear? Simple. So this is very important, Anna, for that one particular problem where you have to open up ledger accounts. Keep this in mind. So how to split this entry? First, you receive the money from the employee in the form of excise price. To that extent, increase the SBP reserve. Then debit the SBP reserve to equity share capital to the extent of face value to securities premium as balancing figure. Clear? Done. Now let's understand this. Now see here. Issue price of the share. What is issue price of the share? Company has issued a share and whatever company gets in return is issue price of the share. Correct? Which means I gave you a share, Nana. I gave you a share. Did I give you free? No. Share is a thing, na. I gave you a thing. So whatever I receive from you in return is the consideration for the share that I gave you. Correct? So company gave a share to the employee. What did company receive in return from the employee? One is this much worth of services company has received. That is the reason I calculated fair value of the option on the grant date as 180, which means 180 worth of services I have received from the employee. Plus employee also paid me excise price also na. So totally from employee, what is the consideration that company has received? 180 rupees worth of services, which is nothing but fair value of the option on the grant date, plus 80 rupees excise price. Totally company has received how much from the employee? 260. That 260 is the issue price of the share because I gave you a share, I received 180 worth of services plus 80 rupees worth of cash. Totally 260 is the price at which I sold you the share indirectly. Therefore, equity share capital, if you can see, it totals to 260 exactly. 10 and 250, correct? That's how the great sync has happened. I hope you understood the logic over here. Done? Right. So service value of employee is worth 180 and that is done. Anyway, this we have discussed. Now see here. Entries will be same in all the problems, Nana, whatever the entries that we have done over here. But some masala twist and drama will happen around the calculation of option expense or the option value in the question. The fair value of the option calculation is there, na? That's where all the twist will happen while solving questions. That we will see, don't worry. Now let's look at another example. You guys are ready? Another example. Okay, now see, Nana. You look at this particular example. Ready? 1000 employees, okay. One option per employee, okay. Exercise price is 100, okay. Fair value of the option on the grant date is 120, which means 120 worth of services we are going to receive from the employee, okay. Vesting period is 3 years, fantastic. Now, how will you calculate your option expense? Very easy. Totally 1000 employees are there, into each employee will get one option, which means totally how many options? 1000 options, into each option worth is 120. So 1000 options into 120, that is the total options value, and that is the expenditure for the company for a period of 3 years. You divide it with 3, then you will get expenditure for the company per year, which is nothing but 40,000 per annum. That is the option expenditure for the company. You got it? Right. So 40,000 per annum means what is the entry? Employee compensation or employee benefit expenses to SBP reserve. 40, 40, 40. Then P&L to employee compensation. You will transfer this employee compensation to P&L. We know this. Okay. Now let's look into the actual formula. We are converting this into formulas here. Number of employees into options per employee into fair value of the option on the grant date. So this is based on common sense only. Now we have put here this calculation. We are converting that into formula. That's all. Number of employees, this 1000. Number of options per employee, this one. Fair value of the option on the grant date, this 120, into this you need to understand. Into vesting period completed divided by total vesting period. Here divided by 3 means what? Into 1 by 3 only, na? Why 1 by 3? 1 is nothing but this year, 1 year completed. 3 is nothing but total vesting period is for 3 years. That's why we have put it 1 by 3. Correct? Same logic we have put here. Vesting period completed is 1 year divided by total vesting period is 3 years. In second year, what you will do? 2 by 3. In third year, what you will do? 3 by 3. Simple. Got it? Minus expenditure recognized in earlier years. In first year, this will be 0. But in second year, because you will recognize expenditure in the first year, that has to be reduced. In third year, because you will recognize expenditure in first year and second year, that has to be reduced over here. Clear? Huh? Are we done with this? Chalo. Now, don't do any sort of overthinking. Just follow the formula. Problems will be easy to solve. Now, when you go beyond the formula and start thinking logically, usually if you think logically, it will work provided there is no time problem for us. But when it comes to RCA exams, we have a big problem called time problem. So whenever there is a time problem, if you try to go beyond certain rules and regulations, logics will not work all the time, because to logics work, every single minute, every single second, your brain has to work at optimal efficiency, and that will not happen for any human being. Even we also, when we go for teaching, all of a sudden 10 seconds or 20 seconds or 30 seconds, brain will go off. We call it as brain fog. That will happen for you also, for me also. For any human being, it will happen. You understand the point? Right. Therefore, always stick to rules that will eliminate the possibility or probability of doing mistakes. Clear? Now, so what is the formula, Nana, for option expense? Very simple. Number of employees into number of options per employee into fair value of the option on the grant date into 1 vesting period completed divided by total vesting period. Correct? Minus expenditure recognized in the previous year. That will be applicable for second year and third year. That's all. Chalo, are we done with this? Now let's calculate. Very easy. 1000 employees into 1 option per employee into 120 is the fair value of the option on the grant date into vesting period completed is 1 because it is first year divided by total vesting period is 3 years minus expenditure recognized in the previous year is 0 because this is first year itself. Therefore, you will recognize 40,000. We know that every year it has to be 40,000. That's what we are showing here. See how the formula works. In second year, what happens? 1000 into 1 into 120. This will not change into vesting period completed, now it is 2 divided by total vesting period is 3 minus already last year you have recognized 40,000. So this year how much you need to recognize? Another 40,000. You see, just like 40,000 over here. Third year, same, 1000 into 1 into 120 into 3 by 3 because vesting period completed is 3 divided by total vesting period is 3 minus last 2 years how much you have recognized expenditure? 40 plus 40. You reduce that and you get 40 as well this year. So ultimately 40, 40, 40 you have recognized, just like this one. So now it seems really stupid for you, sir. What is this, sir? So many calculations you are putting over here and eventually you are getting the same number 40, 40, 40. Here we have got it just like that, na, sir. This divided by 3, 40, 40, 40. It seems like that for you because there are no twists and turns over here in this particular sum. When twist and turns comes, you will understand the importance of this particular formula. Got it? Chalo. Anyways, now let's take the same question as case 3, which means I'll be taking this question only, but I will add a twist. What is the twist? 200 employees left in year 2. Okay, so which means for year 1 the formula will be exactly the same and you get 40,000 and you'll put the entry also employee compensation to SBP reserve 40k. But coming on to year 2, now there are no more 1000 employees with you. 200 has left. So how many employees are there with you? 800 only. So 800 into number of options per employee is 1 into 120 is the fair value of the option on the grant date into vesting period completed is 2 divided by total vesting period is 3 minus option expenses recognized in the previous year is 40,000. Therefore 64 minus 40 you get 24,000. You see, greatly the expenditure recognition in the second year has got reduced all the way from 40,000 it has come to 24,000. Why? Because number of employees has got reduced. But this I know only in the second year only. So therefore, had I known this in the first year itself, then here my expenditure recognition would have been reduced. You understand the point? So that effect I am also giving in the second year itself. You will understand it once I finish off third year also. Now see here. Third year, same stuff. 800 only now the employees are. So 800 into one option per employee into fair value of the option on the grant date is 120 into vesting period completed is 3 divided by total vesting period is 3 minus option recognized in the previous year option expense 40 plus 24 which is 64. You got 32,000. Now if you can see 32 plus 24 plus 40, how much you get? 40,000 plus 24,000 plus 32,000. It comes under 96,000. Logically speaking, total option expenditure is 96,000. It should be divided by 3. Tell me how much it comes? 32,000. So every year I should have ideally recognized 32,000. First year what did I do? I have recognized 8,000 more. Therefore, if you can observe, second year exactly I have recognized 8,000 less from 32. You see, that's how this formula helps. Automatically, this formula takes into consideration any over expenditure that you have done. You got the point, and accordingly it will adjust. That's the beauty of this formula. So therefore, follow the formula blindly. Clear? Sorry. Are we done with this? Did you understand the logic over here? Right. Moving on. Now, based on this change which I've done in the first example, now look at the actual formula. This is not number of employees, it is actually number of employees at the end of the vesting period, which means at the end of third year, still how many employees stay within your company. That is the actual formula. So number of employees at the end of the vesting period into number of options per employee into fair value of the option on the grant date into vesting period completed divided by total vesting period minus expenditure recognized in previous periods. This is your actual formula. Done, everybody? Fantastic. Now come to case 4. This is very important, this particular example, because based on this only you'll have so many sums. Okay, with this we'll be almost done with this. Okay, anyways, now let's have a look at this particular example. Now I want you guys to focus 100%. This will be tough if you are listening for the first time, but if you are listening for the second time because of revision, then it's okay. Now see here, year 0, year 1, year 2, year 3. Okay, 1000 employees options are granted at year 0. Okay, now you're standing at the end of year 1, and how many employees actually left your company? 30. You understand the point? Which means how many employees are there with you at the end of first year? 970, because 30 actually gone. Clear? Now if you have to recognize your option expense at the end of first year, according to the formula you need number of employees at the end of the vesting period. But you are at the end of first year, you know only the actual number of employees left in the first year only, but you don't know how many employees will leave in second year, how many employees will leave in third year. Correct? So what you can do, ultimately you can expect how many employees will leave in second year and third year, because you're standing at the end of first year. So what do I do is, 30 employees anyway have left, actual figures that I know because I'm at the end of first year. So I anticipate, I expect, standing at the end of first year, imagine that you're in a time machine and you're at the end of first year. Standing at the end of first year, I'm predicting that second year 40 will leave, third year 50 will leave, already 30 has left. So 30 plus 40 plus 50, totally 120 will leave. Therefore, number of employees at the end of vesting period will be 880. Like that, I will anticipate at the end of first year. Therefore, while recognizing the option expense at the end of first year, I will put 880 employees into number of options per employee into fair value of the option on the grant date into vesting period completed divided by total vesting period minus expenditure recognized in the previous year. We are not concerned about remaining numbers because the focus is on number of employees. Clear? This is where twist will be there when we are solving sums. Now coming on to second year. Now first year expenditure is done. We have already done. We took 880 employees. Ho gaya. Now come to second year. Now you are standing at the end of second year. When you are standing at the end of second year, you already know how many employees left actually in the first year, how many employees actually left in the second year, because logically in the time machine you are at the end of second year na. So therefore you already know second year how many employees have actually left, first year also how many employees have actually left. How many are there? 30, 60. But to recognize the option expense at the end of second year, you should know number of employees at the end of the vesting period, correct? So therefore, to make that happen, you need to expect how many employees will be leaving in third year, and you are expecting that 50 employees will leave. So already 30 left in the first year, which you know because you are at the end of second year standing. 60 employees left in the second year, that also you know, plus 50 employees you are anticipating or expecting that they will leave in the third year. So 60 plus 30, 90, 90 plus 50, 140. So which means the number of employees expected to be at the end of vesting period is 860. That is your thought process, that they will be 860 employees standing at the end of year 2. Therefore here you will take 860 while calculating year 2 option expense. Clear? Now coming on to year 3, when you are at the end of year 3, now there is no problem. Why? Because once you are at the end of year 3, at the end of the vesting period, you know actual number of employees left in the first year, actual number of employees left in the second year, actual number of employees left in the third year. You just add that, you get your number, which is 830. So you put 830, you get your number. That's all. Very, 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 very important. Are we done with this? So this is where in the questions he will play by giving you twist in the English sentence formation. That's where he'll give you twist with respect to the number of employees and all that stuff. Clear? Okay, now see here. The factors for computation of option expense, like number of employees, number of options for employees, fair value of the option on the grant date, total vesting period, ought to be considered using the latest estimates at the end of each year. Okay, and therefore can be changed in each period when they are relating to service conditions and non-market performance conditions. So you take the latest estimate. At the end of first year you will have one estimate. At the end of second year that estimate will change. At the end of third year that estimate also will change and actuals will be different. So there is no rule that estimate should be equal to actuals. Nah, rarely it will happen. Next, how to calculate number of employees. This already I told you. While calculating option expense in the last year of the vesting period, we have to consider only actual number of employees. Why? Because in the last year of the vesting period, you already know the actual employees. Correct? However, there will be no need to estimate when you're in the last year. Whereas, while calculating the option expense for the remaining years, that is not the last year, first year and second year, we have to estimate the number of employees who are expected to present at the end of the service period for future years. That's what we have done here. In first year ending, we have estimated 40 for second year, 50 for third year, and second year ending, we have estimated 50 for third year. Whereas when you are in third year ending, no need to estimate, na, because already you have the actuals of 3 years. You understand the point? That's what he's trying to say here. Got it? Okay. This box you will not understand now. It's not easy to discuss, but once we start solving sums, there you will understand. Okay? Chalo. Now, look at the journal entries. This we already know. On grant date, no entry. For recognizing option expense, employee compensation to SBP reserve, or employee benefit expenses to SBP reserve. Then P&L to employee compensation. Next, if options are exercised, bank account to SBP reserve, you increase the SBP reserve, and then SBP reserve to equity share capital to the extent of face value. Balancing figure will go to securities premium, or this complicated entry that also we have seen. If options are lapsed, whatever that is there in SBP reserve, transfer it to retained earnings. That logic also I've explained. Done? Everybody? That's it. Now one of the student doubt is, sir, suppose if the vesting conditions are not satisfied, vesting conditions itself is not satisfied. See here what is happening. Options are lapsed means what? Vesting conditions are satisfied by the employee, options are vested for the employee, and employee did not choose to exercise the option. Then you will transfer from SBP reserve to retained earnings or general reserve. Clear? Here that is not the case. In third year itself, the vesting conditions are not satisfied. Say for example, service condition is there, employee did not stay in the company, or non-market performance condition is there, that the sales should grow by 10%, it did not grow, or market condition is there, it did not happen. Then it means that vesting condition is not satisfied. It means that options itself are not vested to any of the employees. You understand the point? So which means vesting condition is not satisfied, which means options does not vest to any of the employees. In that case, what you will do? Reverse. Reverse means, so far what you were doing, employee compensation to SBP reserve. Now reverse, SBP reserve to employee compensation. So far what you were doing, P&L account to employee compensation, debit it as an expense. Now reverse, employee compensation to P&L. Got the point? Yes. Okay, now some students have asked me, sir, why there is a difference if the vesting conditions are not satisfied, you are reversing it and taking it back to P&L account. Whereas if vesting conditions are satisfied and the employee choose not to exercise the option, then what you are doing, you are taking SBP reserve to retain earnings. What is the logic behind that? Now see here. Suppose after third year, when the options get vested, okay, for all the employees, because all the vesting conditions are satisfied during the vesting period, then in the balance sheet, what you will do, you will have it in the SBP reserve, credit balance. Okay. If employees chose to exercise the option, once the options are vested, if the employee choose to exercise the option, you will be transferring from SBP reserve to equity share capital to the extent of face value, and the balance will go to securities premium. Or if the employee choose not to exercise the option, from SBP reserve it will go to retain earnings. This is the treatment. Correct? What is the logic? Because once the options got vested, the benefits from the employee are completely received by the company. Correct? See here. Where is it? Yeah, here. SBP reserve is an equity obligation. Okay, any equity obligation you should treat it on par with other equity shareholders. So therefore, it should not go to P&L. It should not go back to P&L. It should go to RE. Not only that, the benefits are received by the company from the employee. So the cost is already booked in P&L. So you should not reserve it. Just sorry. Just because employee did not choose to exercise the option does not mean that he did not provide service. Services has been provided, so benefit has been enjoyed by the company. To that extent, I've booked the expense. That's all. Now, just because employee did not exercise the option, I'll not go back and then reverse. You got the point. That's why it goes to retained earnings or general reserve. It will not go back to P&L. Which one? The SBP reserve. Whereas, if the vesting condition itself is not satisfied, that means the benefit employee did not give to the company. Company did not receive the benefits completely. When company did not receive the benefits completely from the employee, then company cannot debit the expenditure. Therefore, you can reverse it. You understand the point? That is the difference. So please try to understand. There is a difference between vesting condition satisfied and vesting condition not getting satisfied. When vesting condition is satisfied, everything goes into SBP reserve, and if the employee exercises the option, from SBP reserve, it goes to equity share capital to the extent of face value. Balance will go to SBP reserve. If employee did not exercise the option, if he chooses not to exercise the option, then from there it goes to retained earnings. It will not go back to P&L. Why? Because the company has already enjoyed all the benefits. Clear? So therefore, to that extent, they have booked the expenditure in the P&L account in the form of employee compensation. So therefore, they cannot go back. Clear? Whereas in the case of vesting conditions not getting satisfied, the company did not receive all the services, all the benefit from the employee. Therefore, in this case, you can reverse it and take it back to P&L. Clear? Hello, everybody, is this clear? Right, chalo, that's it. So far we are done with vesting conditions. In that we have seen service condition, in that we have seen performance condition, and performance condition under we have seen non-market performance condition. To that extent we have covered. We'll take a short break. After that we'll cover service condition, sorry, performance condition. Under that we'll cover market condition. Okay, right guys, chalo. All right guys, welcome back. So is the audio fine, Nana? Okay, confirm me, Nana. Okay, is there any lag? Fantastic. All right then, shall we move on? Okay guys, in the last session, I think we have totally done 6 sums if I'm not wrong. And the last sum, as you know, it took almost like 1 hour 20 minutes for us to solve that particular sum. Okay, even honestly speaking, I did not expect that it will take that much of time. I thought somewhere near to 1 hour, but then that's okay, because when compared to the ICA solution, we tried to answer it in a more liberal way. We went for entries and all that. Your ICA did not do that. They directly went for ledgers and stuff. That's okay, it takes time. Let's move on. Now that so far what we have done, under vesting conditions, we have service condition and performance condition. Service conditions we have seen. Under performance conditions we have already seen non-market performance condition, and we have also solved problems on that. So what is left over is market condition. So now we're gonna finish off the market condition. Ready? Yeah. So now we have got the fantastic power notes over here. I want you guys to focus upon this and then eventually we'll move on. You guys are ready? Chalo, now. So when it comes to market condition, we have two things, Nana, under that. One is without time limit, the other one is with time limit. So a market condition will be there in the question, sometimes without time limit. Without time limit in the sense, array, this is the condition. Say for example, 500 rupees market price your company has to achieve. When it will achieve, there is no time limit. It can be 4 years, 5 years, 6 years, 7 years, 8 years, 9 years, 10 years also. It doesn't matter. But ultimately, once the company's market price of the share achieves that 500 mark, whenever it achieves, at that time, you will get the options vested. You understand the point? That is without time limit. You get it? So with time limit means they will say like within this much time, say for example, within 4 years or within 5 years, this much market price it has to achieve. If it achieves, the options will get vested. Otherwise, it's lapsed. Game over. Done. That's all. You understand the point? Anyway, so that's the basic idea. Now let's go through this. Without time limit. Let's say this is 0th year and this is your grand date. Okay. You guys know what is grand date is. Okay. So on the grand date, the company has given option to employee. Vesting condition is options will get vested once the market price crosses 400 rupees. Okay. It has to go beyond 400. Then the options will get vested. That's okay. Right. Entity expects. Now look at the word over here. Entity expects, which means company is expecting. So what company is expecting? Market price will cross 400 at the end of 4th year. Clear? So company is expecting that market price will cross 400 at the end of 4th year. Now understand, employee is not expecting all these things. The employee, bichara, he doesn't even know when it will cross 400. You understand the point? He'll keep on waiting when it will cross 400 so that I'll be getting my options vested. You get it? Right. Company is doing all these calculations. Okay. So based on the above assumptions, we will calculate in the sense company here, or he will calculate company. Okay. He will calculate value of the option on the grant date. Let's say the value of the option after the calculation is 160. Okay, sir, how this is calculated, all these things, I've already gave you a basic idea. Right now, that is not the topic under discussion when it comes to FR. We'll see this in detail when we go to AFM. That is one perspective. Right now, let's say the calculations are done by the company, the experts have done it, and finally, they have come to a conclusion that the value of the option on the grant date is how much? 160. This value of the option calculation is based on what? Based on the company's expectation that the market price will cross 400 at the end of 4th year. This is just the expectation of the company. In reality, it may cross or it may not cross. We don't know that. Or it may cross earlier or it may cross late as well. Okay, it may cross in 3rd year itself, or it may not cross in 4th year, it may not cross in 5th year, it may cross in 6th year also. So we don't know that. Are you able to understand? Right now, it is just a expectation of the company. That's all. Now, so based on the above assumptions, the company will calculate value of the option on the grant date, which is 160. Estimated vesting period is how much? 4 years, obviously, because the company is expecting that the market price will be crossed at the end of 4th year. Okay, then what will be option expenses? We know that 160 divided by 4 years, it will be 40 per annum. Now look at the point that I've written here. Company is doing this for its own accounting purpose. Poor employee will not even know this. He will be waiting when the market price will hit what? 400. That's what I've told you, right? Anyways, now, so when the company is valuing the option, the fair value is always an average number. Now this point is very, 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 very important. Okay, you will understand it when we start solving sums. Okay, every single point that I've written, there will be a logic. So here, what am I trying to explain? I am trying to explain the logic behind how this fair value of 160 has been calculated on the grant date. Now, you know that company is expecting that the market price will cross 400 at the end of the 4th year. And you also know that this is a market condition, and this market condition is without time limit, because the company has told employees that the options will get vested to the employees when the market price crosses 400. He did not specify any time limit. If it crosses 400, you will get the options vested. Now, when it will cross 400, I don't know. That was not communicated to the employee. Then what about this 4th year, sir? This is company personally doing it for its own purpose, because it has to do accounting. Na? When it is giving employees the benefit in the form of the options, then company also has to recognize the expenses, because when it is benefit for the employee, it is expenditure for the company. Correct? Right? So therefore, because the company has to do the accounting purpose, for that purpose, company has done this assumptions, expectation, right? Based on this expectation that the market price will be crossing 400 at the end of the fourth year, they have calculated the value of the option on the granted or the fair value of the option, which is how much, Nana? 160. Once they know this fair value of the option, eventually they can do the accounting. In this case, it is 160 by 4, 40 per annum. You got the point? Now the question is, what are we trying to concentrate right now? How this 160 has been calculated. Sir, that we have already seen, na, sir, how that 160 has been calculated. We'll go to the future. Here probably he'll be expecting that at the end of fourth year it will reach 400. Once it reaches 400, on that date what will be the excise price, and after that what will be the intrinsic value that the employee will get benefit, what is the benefit, and then we'll be discounting that, and then we'll be getting it down to what, year 0. After discounting, probably that's the fair value of the option. This is a rough idea that we have got. A rough idea, very, very, very vague idea. Okay. If we go in reality, then it will be a lot more complex. Okay. Anyways, for effort that is not necessary. So let's not waste our time. Let's not touch certain things that is not necessary for us. Clear? Right. Moving on. Now, to understand the questions, to understand the sentences when we are solving problems. Okay, because already I've seen the sum, so I do have an understanding on what kind of twisted sentences the problems have. To understand that, I gave you this particular understanding over here. Sir, what is this understanding, sir? This 160, what the company has calculated, while valuing this particular 160, the fair value is always an average number, which means what I'm trying to say is this 160 is a kind of average number. What is that average number, sir? Which means the company has considered two situations while calculating this 160. Sir, what situation, sir? Or two possibilities. What possibility, sir? The company has considered the possibility of crossing the market price of 400 at the end of fourth year. The company also has considered the possibility of not crossing the market price, which means while calculating this so-called 160, company has considered the possibility of target getting achieved, target not getting achieved as well. Because both are possible, na? You understand that? Sir, 100% target will be achieved, sir. No, sir. Common sense, sir. You understand the point? You are expecting that at the end of fourth year, market price will cross 400. 100% will it cost 400? Then you are like God. That's not the case. Maybe the probability will be high. Let's say 80% is the probability that the target will be achieved. But there is that balance 20%, na? That target will not be achieved. That also should I consider, na? So therefore, probably they would have put some sort of probability like this, 80% and 20%. And then eventually they would have calculated some expected value. Let's not get into the details of exact how the calculations are done. And accordingly, based on this only, they've calculated this value. Now, whatever I'm teaching you right now, this is damn important, especially when solving sums. Therefore, don't take this in a lighter sense. Why is that sir is trying to explain all these logics and all that? Because this is relevant and this is important, especially while solving sums. Am I clear? So therefore, what you have to understand is the company has considered both the options, both the possibilities that either the target will be achieved or the target will not be achieved before calculating the so-called fair value of the option on the grant date. Clear? Now, to give you a simple example, let's say you are my student, Nana, okay, and I'm conducting FR exams, okay. Let's say on the 6th exam, okay, I'll do one thing. I'll just change this a bit. First exam, second exam, third exam, fourth exam. Okay. Now this is main exam. Okay. Now, sir, why did you take this example? I'll tell you the logic behind that as well. Okay. So we also run CMA USA. Okay. In fact, I started teaching for CMA USA long back in 2015 itself. Okay, that's a different thing. Now that we are trying to provide online for certain people from Gulf and all that, okay, let's not get into the details over there. In CMA USA, what we'll do is that this example I've taken from that perspective only, CMA USA. Because the examination fee, you have to pay it in dollars, it's pretty costly. It's around 30K to 40K. Because it is 30,000 to 40,000, once you fail the exams, again you have to repay 30,000 to 40,000. Unlike our CA or CM exams, where eventually it will be around 2K to 3K bucks, right? But that's not the case. Because it is 30K to 40K, what we usually do is that we don't allow the students to straight away write the exam. So what I do personally is that we have a team as well. So what we do is that we start conducting them the simulation of the actual exam. So it is like the actual exam only, but it is not actual exam, okay? And then I'll be looking at their marks, okay? Let's say 70% is the pass marks, okay? Now those exams, they are like that, but still it is easy to crack anyways. Now, if 70% is the pass marks, then in the first exam, you have got 90%. In the second exam, you've got 30%. In the third exam, you've got 90%. In the fourth exam, you've got 25%. You understand the point? Which means literally 2 times you have failed, 2 times you have passed. Clear? Now, next main exam when you're going to write, what will be the expectation? How many marks you'll be getting? I'll take the average of that, na? And then I say that, okay, fine, 90 plus 30 plus 90 plus 25 divided by 4. Okay, we are expecting 60% on an average. So which means most probably you will fail because 70% is the pass marks. Or let's say 50% is the pass marks, then you will pass. You understand the point? But ultimately, when you are calculating this so-called average expectation, this so-called 60%, you did consider the possibility of failing the exam. You did consider the possibility of passing the exam. Correct? On an average, you say that, okay, fine. On an average, I'm expecting that you'll be getting 60%. Did you consider the possibility of passing? Yes. Did you consider the possibility of failing? Yes. Similarly, on an average, the fair value of the option on the grant date is 160. Did you consider the possibility of the market condition getting satisfied, the target getting achieved? Yes. Did you consider the possibility of target not getting achieved? Yes. Just like pass and fail over here. Do you get it? Right. I hope this is clear. Right. Fantastic. Now see it. In determining the fair value of the option, that is 160 over here, the possibility of market condition failing, which means target not getting achieved, passing, which means target getting achieved, is already taken into consideration by the company while calculating the above value of the option, which is 160 on the grant date. On the grant date means time 0 or year 0, which means as of today. That's what we call it as time 0 or year 0. Is that clear? Right. I hope this is clear now. So therefore, we need to book 40, 40, 40, 40 for 4 years. This is important. This is important. Irrespective of whether market condition is satisfied or not at the end of 4th year. Why, sir? If market condition is not satisfied, sir, in the question, there is a sentence that has been given saying that at the end of 4th year, the target of 400 has not been achieved, which means your market price of your company did not cross 400. Then which means options will not be vested. Huh? That's a secondary discussion, first of all. But ultimately, as a company, you will recognize 40, 40, 40, 40 in your financial accounting, in your books, irrespective of whether the market condition is satisfied or not. Why? Because while calculating the so-called fair value, which is 160, already market condition not getting satisfied is also considered. So while calculating this so-called 160, already have reflected the market condition of that so-called 400 not getting satisfied as well. So therefore, now if in reality, if did not get satisfied, it doesn't affect me. I'll still go with 40, 40, 40, 40, 40. That's all. Now you are coming and saying, Ray, company, stupid fellow, market condition is not achieved, Ray. Then I'll say, while calculating this 40, 40, 40, 40, which is 160, already the possibility of market condition not getting satisfied is also considered. So no worries, it is reflected in this by default. You understand what I'm trying to say? Mostly in the way of probability. That's what. Now, so book 40, 40, 40, 40 for 4 years totals to 160, irrespective of whether market condition is satisfied or not at the end of 4th year. Clear? Therefore, any subsequent changes in estimate will not be considered once you arrived at the value of the option. Are you able to understand? Sir, it will achieve in the end of 6th year, 5th year, that, this and all that, nothing will be considered. Any subsequent changes. Once you have arrived at the value of the option, which is 160 in this case, that's all. Okay. Once you commit, there is no going back. It's like that. Got it? Anyways. However, there is an exception to the above rule. Sir, what is the exception, sir? if you could observe, while I was reading this particular sentence, any subsequent changes in the estimate will not be considered once you arrived at the value of the option. What do you mean by subsequent changes in estimates? Means you expected that your market price will cross 400 at the end of 4th year. This you have estimated on the grant date only, which is year 0. Let's say at the end of 2nd year, you are estimating that no, at the end of 4th year, it will not cross 400. I'm thinking that at the end of 5th year, it will cross. I'm thinking that at the end of 6th year, it will cross. In that case, those are subsequent changes in estimates, thinking that at the end of 5th year, it will cross, at the end of 6th year, it will cross, at the end of 7th year, it will cross. So those will not be considered once you have arrived at the option. You understand the point? Once you have arrived at the value of the option. However, if you look at my example, I said greater than 4 years. Like, because your initial estimation is 4 years, I was telling you subsequent changes like 5th year, which is greater than 4th year, 6th year, which is greater than 4th year, 7th year, which is greater than 4th year, 8th year, which is greater than 4th year, correct? But did I say 3rd year? 3rd year also subsequent change in estimate only, na? See, initially you are thinking that once you cross 4th year, your market price will cross 400 according to our example, correct? Subsequent change in estimate means once you have come to 2nd year, you are estimating that, okay, fine, 4th year we may not cross 400, 5th year we may cross 400, or 6th year we may cross 400, or 7th year we may cross 400, or 3rd year itself we may cross 400 is also subsequent change in estimate only, na? It can be late, it can be earlier as well. But while I was explaining you the examples, I was giving only the late examples, I did not give you early examples. You understand the point? Why? Because early example is the exception to the above rule. See here. Acceleration of option expense, that is preponement. When there is postponement, we will ignore it. Only any subsequent changes in estimates will not be considered. Means here specifically we are talking about postponement. I'll write it over here in a different ink. I'll write okay, postponement. Okay, which means instead of 4th year, it can be 5th year, 6th year, 7th year. These are all postponement. In those kind of change in estimates, where the change in estimates will result in postponement, we will ignore it. But if the change in estimates results in preponement, we will not ignore it. Preponement means what, sir? You're expecting that it will cross 400 market price at the end of 4th year. Suppose it crosses at the end of 3rd year itself. Then it is called preponement. In that case, what you also now also will ignore, sir, because you only told me, na, sir, any subsequent changes will not be considered. No. Now you have to consider preponement. You will consider. Okay, and what you will do? Earlier you thought that 40, 40, 40, 40. You wanted to recognize this over a period of 4 years. Now, because of this preponement, because your target, that so-called market condition, is achieved at the end of 3rd year itself, you will prepone your expense recognition and you will recognize the entire 160 at the end of 3rd year itself. This is what we call acceleration. Pressing the foot, pressing the pedal in your car. Acceleration means what? You suddenly want your car to move faster. You'll accelerate, right? You want your bike to move faster. You will accelerate, right? You'll increase the speed. Similarly, earlier you thought that you'll be recognizing this over a period of 4 years, 40, 40, 40, 40. But now, because of the preponement, and you are thinking earlier that at the end of 4th year, your target will be achieved. But now at the end of 3rd year itself, your target is getting achieved. Then you'll accelerate, you'll press your foot on the pedal, and eventually within 3 years, you will recognize the entire 160 expense, which otherwise you would have recognized in 4 years. Clear? Now see here. Normally what you would have done, sir, option expenditure for the year 1, sir. Number of employees into options per employee into fair value of the option into vesting period completed, that is first year means 1 divided by total vesting period is 4. Why 4? Because initially on the grant date we were estimating that the option, the so-called market condition will be satisfied at the end of 4th year. Minus expenditure recognized in the previous year is 0. This is a typical formula, right? 2nd year what you will do? Same. Employee into number of options into fair value of the option into vesting period completed 2 divided by total vesting period minus expenditure recognized in the previous year, which will be 40. Right, 3rd year what you will do? Same stuff. Into vesting period completed is 3 divided by total vesting period is 4 minus expenditure recognized in the 1st year and 2nd year, which is 40 plus 40. Then 4th year what you will do? Same stuff into 4 by 4 minus 1st year 40, 2nd year 40, 3rd year 40. Very simple. This we already know. However, look at the twist. whenever there is a preponement of your market condition getting satisfied, instead of 4th year, in the 3rd year itself, then you will accelerate your option expense recognition as well. Okay. See here, what I'll do. In the 3rd year, you will not put this routine calculation. Instead, one employee, that is number of employees, into options per employee, into fair value of the option, into, look at the change over here. This is where the change is. Normally, it will be 3 by 4. Why? Because you wanted to recognize it over a period of 4 years. So, 40, 40, 40, 40. Correct? Therefore, vesting period completed is 3, divided by total vesting period is 4. And then you'll reduce the expenditure recognized in the previous years, which is 40 plus 40, which is 80. However, if there is preponement of your market condition target getting achieved, and if it is achieved at the end of 3rd year itself, then you will accelerate and you will book entire expense within 3rd year itself. How do you do that? Very simple. Same number of employees into options per employee into fair value of the option into vesting period completed. Right now it is 3rd year only, na? Divided by what is total vesting period right now? Sir, earlier it was 4 years, but right now after the change in the estimate, now it is 3 years only. So therefore into 3 by 3. So indirectly what you will be doing, whatever that you have to recognize in 3rd year and 4th year, you will be recognizing in what, Nana? 3rd year itself. So usually what you will do, if you look at this calculation, it will be 40 in 3rd year. If you look at this calculation, it will be 40 in 4th year. But now what you will be doing, this 40 plus 40, 80 will be recognized in the 3rd year itself. This 40 plus 40, 80 will be recognized in the 3rd year itself. Am I clear? Hello? Confirm me. Till here it's clear. Don't worry. We're gonna do example itself. Immediately though, we have an example. Okay, no worries. Share. Unjid sir. Okay. Manasla everybody. Right. Samja. Did you guys enjoy this concept? It is interesting, sir. I know. Even if it is not interesting, I'll make it interesting. Okay. Chalo. There is always fun in learning, Nana, if you learn it the right way. It's always fun. That is the reason I just love learning all the new things. That's the reason I went for civils. That's the reason I have done my international courses. That's the reason I've learned stock market. That's the reason I've learned Bitcoin and Forex trading as well. I don't know. It's like food, fuel for me. Right? Always it is exciting to learn new things. Are we done with this? Shall we move on? All right, you. Now, look at the example, guys. Number of employees covered in ESOPs, 100. Okay. Totally, we have got 100 employees. Options per employee, 60. Fair value option is 17. You know that while calculating this fair value, the possibility of market condition getting satisfied, market condition not getting satisfied is also considered. Okay. Market price should become 150 is the vesting condition. Okay. Did he give you any time limit? No. He said market condition should become 150. That's all. Within 3 years, it should become 150. Within 5 years, it should become 150. That is not there. Therefore, this is market condition without time limit. Okay. An employee should stay till such period. All right. Expected vesting period on the grant date is 4 years. Okay. So the company is expecting that within 4 years, the market price will touch 150. So at the end of year 1, what has happened? 5 people have left, and in future, 12 people are expected leave, and market price not estimated to cross 150 within 4 years. What did I say? I said this is a trap. Why? Market price not estimated to cross 150 within 4 years, which means it will cross later. Means at the end of year 1, you are doing subsequent change in estimate, because it is after 4 years, na? Postponement. Will I consider? It will not be considered. Postponement will not be considered. Subsequent change in estimate of preponement will be considered. So it is one-sided war. Clear? Sir, what is this, sir? It is not fair enough. It is not fair enough, no, Nana. It is logical. You try to go behind the logic. See, why Ind AS gives you all these kind of rules? Because always you understand, whenever Ind AS feels like, see, this logic is very important. Now, try to understand. In all the standards, I've seen a universal point, which means I try to understand what is the psychological thought process of the guy who has prepared the Ind AS. Okay. The thought process is whenever they feel like companies may use the so-called rule to their advantage to manipulate the profits and to show that whenever their business is not performing so well, they will misuse the so-called rules, and as a result they can enhance the position of their financial statements or the way it looks, the financial statements. Whenever Ind AS feels like that, they'll be against it. Sir, what do you mean by that, sir? Simple logic, Nana. Here, the company, just think from company's point of view. Company is kind of recognizing 40, 40, 40, 40 in 4 years now. When there is a subsequent change in estimate, which is postponement, what will happen generally? Suppose here in this example only, you see at the end of year 1 only they are estimating that it will not cross within 4 years, which means probably they would have estimated that it will cross in 6 years. Then naturally what will happen, this so-called 160 which otherwise they should have recognized in 4 years, the same 160 they'll recognize in 6 years now if it is postponement, which means on an average their average what they have to debit as an employee compensation expenditure in P&L account will get reduced now. Earlier 40 40 40 40 for 4 years, but now once it is 6 years then definitely it will be less than 40 now. 160 divided by 6. You understand what I'm trying to say, right? In that case, naturally what the expenditure they should have otherwise debited will come down, and naturally their profit will go up. So always there is a chance that whenever the company feels like they are not performing well and their profit is going down, immediately they'll say that, okay, we have a subsequent change in estimate. We feel like in 4th year we are not going to achieve this market price target. We'll feel that 8th year it's going to get achieved. Then naturally what they should have recognized, this 40, 40, 40, 40 in 4 years, they'll recognize like this 20, 20, 20, 20, 20, 20, 20, 20. So if Ind AS allows this, then they can simply say that our estimate has got changed. It will be 8 years. Then instead of 40 40 they're debiting in one particular year, their expenditure has come in half na. As a result, their profit will be up na. So there's a chance of misuse. That's why they do not allow the postponement. However, in preponement that will not happen na. In preponement you're debiting more than what it is required. So it's a kind of conservatism logic. In postponement there is a chance of improving the profit of the company, so that is not allowed by Ind AS. In preponement there is no possibility of company doing fraud na. Why would company want to reduce their profit and then show that no, we did not do, say for example the real profit is 100, company would not like to reduce this and show that no no no, our actual profit is only 60. If your actual profit is 60, company would like to increase it to 100. But when your actual profit is 60, company would not like to reduce it and say that no no no, my profit is 30 na. If they try to manipulate profits, only they'll try to increase na. Or if there is loss, they'll try to reduce the loss. Either way it's same, the logic is same, but they would never like to reduce the profit that they've otherwise got na. You understand the point? Therefore in case of preponement, what is happening, what you should have recognized the expense in 4 years, you're recognizing that in 3 years only. You understand the point? So it's a kind of conservatism logic. That is the reason they did not allow postponement, but they have allowed what? Preponement. That's how. Anyways, now at the end of year 2, employees left is 3. Okay, expected to leave in future is 4. Market price will reach the target after 4 years from the, okay, year 0. Oh, from the year 2. All right. What else? At the end of year 3, employees left 7. Okay, 7 people have left. Market price has attained the target level of rupees 150 in this year. Hence the option vested. Okay, which means the target achieved at the end of year 3, not year 4, which means is there a preponement? Yes. Should we accelerate the option recognition? Yes. But that we will do only at the end of 3rd year, because during year 1 and year 2 we don't know that na. You understand the point? Right. So shall we start solving this? Right. All right guys, now what we'll do is that we'll start solving this sum. Okay. All right, this is example sum. Now, one thing is, what is the vesting period estimated on the grant date, Nana? It is 4 years. So once 4 years is estimated on the grant date, when there is subsequent change in estimate of postponement, ignore it. But when there is subsequent change in estimate of preponement, consider that. Clear? Is that clear, everybody? Right. So vesting period estimate on the grant date is 4 years. So only 4 years is relevant for us, okay? While calculating option expense for each year. So we should not re-estimate the vesting period based on when the market price of 150 will be achieved, provided if there is postponement. If there is preponement, yes, we will consider. Okay, chalo. Yes. Now, so let's recognize Nana option expenditure for year 1. This is anyway the example sum. You already have the solution in your power notes. But anyway, now you people tell me, what's the formula? Number of employees, kitna re? 100. But out of that 100, are yaar. Okay. Out of that 100, already 5 has left. Correct? And how many you are expecting to leave? Because what is the formula? Employees that are expected to stay at the end of the vesting period. Your vesting period is totally 4 years. First year ending, you are standing right now. You know that 5 people have left in the first year. And second year, third year, fourth year, put together, how many are going to leave? Is your expectation at the end of first year? 12. So therefore, reduce that 12 as well. Totally, these many employees are going to be at the end of fourth year. That is your expectation while standing at the end of first year. Clear? Into all these things we have already seen. So number of employees, okay, into what? Number of options per employee. What is options per employee? Look at your question. Second sentence only it is there. 60. Should I show everything? 60 into fair value of the option 17. Clear? Into vesting period completed right now is 1 divided by total vesting period right now is 4. 4 years only now you are expecting. Minus expenditure recognized in the previous year is 0. So the expenditure will be 21,165. Let's not focus on the calculation part. Okay. Now year 2. What is the situation? 100 is the gross number of your employees minus already 5 has left in the first year. Now year 2 means you are standing at the end of second year. So when you are standing at the end of second year, first year actual employees left, you know. Second year actual employees left also, you know. First year actual employees left is 5. Second year actual employees left is 3. Reduce that. Now, third year and fourth year, do you know? I don't know. So, is there any expectation given in the question? Yes. At the end of year 2, you're expecting that in third and fourth, 4 people will leave. So, which means reduce that 4. Clear? So, this will be a number of employees into number of options per employee 60 into fair value of the option 17 into vesting period 2. Correct? Divided by still it is 4. Some students will write 6 wrong. Why? Here, as you can see, where is this? MP market price will reach the target after 4 years from year 2. Means what? You are postponing it. From year 2, 4 years means year 2 plus 4, which means 6. You are postponing it. Postponing is allowed or not allowed. This is also subsequent remeasurement only. Sorry. Subsequent re-estimate only. You understand the point? This point only, na? Subsequent changes in your estimate or subsequent re-estimate. Postponement, is it allowed? No. Preponement, yes, allowed. Clear? Right. Therefore, this 6 years, which is nothing but postponement, we will not consider. We will ignore. So, which means we'll stick with 4 years only. So, you should not write by 6. Clear? Into 2 by 4 minus expenditure recognized in the previous year 21,165. So, what will be a number? 23,715. Clear? Next, year 3. Now, see here. In year 3, what is happening? First, number of employees 100 minus actual employees left in the first year 5. Actual employees left in the second year 3. Actual employees left in the third year is how much? 7. That's it. Fourth year is not necessary. Why, sir? Because now preponement has happened. Na? At the end of third year only, your target is achieved. So this is also subsequent change in estimate, na, sir. Yes, sir. But preponement should be considered, sir. Postponement will not be considered, sir. It's one-way traffic, sir. Are we done? Into number of options per employee 60 into fair value of the option 70. Clear? Into vesting period completed 3 divided by total vesting period right now is 3 only. Preponement we will consider. 6 we will not consider. See, from 4 to 6 we will not consider, but 4 to 3 we will consider. That's what Ind AS says. And I've explained you the logic behind this as well. Why Ind AS thinks like that. Okay, postponement will not be considered, but preponement has to be considered. Am I clear? So into 3 by 3 minus, you tell me, 21,165 for the first year plus 23,715 for the second year. These are all the expenditure recognized in the previous year. That's all. That is equal to 41,820. There ends the matter. You got it? Chalo, simple thing. We have done with the calculation. So during year 3, market price of the share crossed 150. Options are actually vested in year 3. Okay. So we have to accelerate the option expense recognition, that is recognize expenditure of year 3 and year 4 in year 3 itself, that is preponement of year 4 to year 3. Okay. Preponement of year 4 expenditure to year 3. Okay. How we done with this? Clear, everybody? Right. Now let's look into the summary, Nana. So what did we see so far? Market condition without any time limit. That is, options will vest whenever market price of share exceeds 500. Example, okay? It can be 400, it can be 600, it can be anything. On grant date, the company will estimate a vesting period. In our example, it was 4 years, by which the market condition is expected to be satisfied. That was the expectation on grant date, which is 4 years. Option expense has to be recognized over the estimated vesting period, which is 4 years. Any further estimates regarding the vesting period shall be ignored, provided if it is postponement. How we ignored in year 2, na? When it became 6 years, we did not consider that. We have ignored it. At the end of the estimated vesting period, option expense to be recognized even if the market condition is not satisfied. That's what we call it as postponement, na? Postponement means not getting satisfied only, na? You are expecting your market condition to be satisfied in 4 years. If it is going to be 5 years, it is postponement, which means by the end of 4th year, it will not be satisfied. But even though it will not be satisfied, in those 4 years, 40, 40, 40, 40, anyway, you'll recognize if the total option value is 160. You got the point? All right. However, if the market condition is actually satisfied before the vesting period, then there will be preponement of option expense. This is called acceleration of the option expense that we have already done in this particular example. Are we clear so far? Everybody? Right. Fantastic, Nana. So with this, we are done with market condition without time limit. ये तो हो गया, पूरा हो गया. Alas. Right. The next one that we'll be looking at is market condition with time limit. Shall we go with that? But before that, you people tell me any doubts with respect to market condition with time limit. I'll wait. Any doubts, Nana? Are we done? No doubts? That's fantastic. Sir, before getting doubt, you yourself is creating the doubt and you're clearing it up as well. Okay. See, when I write my notes, actually, I always think from student perspective. Okay. So if somebody is listening to this for the first time, what they'll be thinking. So mostly I think, hopefully I'm able to cover all your doubts like that. Yeah. Fantastic, Nana. Chalo. All right, guys. Now we'll go with market condition with the time limit. You guys are ready? Okay. Now, listen carefully, Nana. So now, similarly, this is an example. The condition is by the end of year 3, the market price of the company should cross 500. Now, remember, what is that we are seeing right now? Market condition with the time limit. So therefore, it has to cross 500 for sure. There's no doubt in that. Okay. At the end of year 3, the market price should cross 500. Now, so you have year 0, year 1, 2, and 3. Fair value of the option is 90. You know that while calculating fair value, we'll be looking at lots of things, right? So this is with a time condition, right? So which means it has to cross 500 at the end of year 3, right? Because there is time limit right now. Okay. So therefore, this 90 will be recognized over 3 years for sure. 30, 30, 30. Correct? Sorry. 30, 30, 30 for 3 years. So first year 30, you know the entry, employee compensation to SBP reserve. Second year 30, employee compensation to SBP reserve. Third year, either your market price can cross 500 or it cannot cross 500. Correct? If it crosses 500, no worries. Your option is vested. So you will recognize the balance 30 as well because total is 90, na? 30, 30, 30. So you'll put the entry employee compensation to SBP reserve. Everything is fine. Till here, very easy. Correct? No worries whatsoever. However, if market price is 450, it means that the market condition is not satisfied, where market price did not cross what, 500, which means your market condition with time limit is not satisfied. So therefore options will not vest. Even in that scenario, the bomb is still you have to recognize employee compensation to SBP reserve. Sir, what you are trying to say is, in the third year, whether options are vested or not vested, ultimate treatment, accounting treatment will be same. Yes. Yes. Okay. So in balance sheet, what will happen? Your SBP reserve will be 90. Why? First year you have created 30, 30, 30. Even if options did not vest, also 30. So therefore, what will happen? Ultimately 90 will be there. And this will be transferred to what, Nana? Retained earnings. Sir, wait. Options did not vest. And then you're transferring SBP reserve to retained earnings. That is not what we have learned in non-market condition. My dear sir, in non-market condition, what did we learn? If options are vested and if employee chose not to exercise the option, then only from SBP reserve it will be transferred to retained earnings or general reserve. But if options itself did not vest, then we'll be reversing it, na? We'll be transferring it back to what? P&L. That's what we have learned. But here, in market condition with a time limit, options did not vest. Despite options did not getting vested, you are transferring the SBP reserve to retained earnings, whereas ideally you should have reversed it basically. But that's not what we are doing here, isn't it? This is your doubt. I know that you guys will get this doubt. Okay, so that's why I've written here. Why should I book expense in third year when option is not vested? Isn't it? We already know the answer as possibility of option not getting exercised, that is market condition not getting satisfied, is already considered in calculating the value of the option. You understand the point? And that's how this fair value of the option 90 is calculated. I told you the whole story here itself now, right? You have already considered the probability of option getting satisfied and option not getting satisfied as well. You understand the point? So while calculating this 90, by the end of year 3, market condition crossing 500, market condition not crossing 500 is already considered. Therefore, your accounting treatment will not change. You understand the point? See, while calculating this fair value of the option, you have already considered these two possibilities, na? In that case, whichever possibility happens, because already you have considered that while calculating this 90, why would I change my accounting treatment? So my account, that's why whether it is vested or not vested, your entry is exactly the same. Your accounting treatment did not change. And as a result, you're eventually transferring that to retained earnings, because you understand what I'm trying to say. So there is no difference between option getting vested and option not getting vested. That is not the case when it comes to non-market condition. There is a difference. You understand what I'm trying to say? So that is the difference between market condition and non-market condition. That's why we are dealing this separately. Okay. So why did I book expense in the third year when option is not getting vested in this case? Because we already know the answer as possibility of option not getting exercised and the market condition not getting exercised or not getting satisfied is already considered in calculating the so-called fair value of the option. Moreover, another logic is this one logic I've explained. Look at the other angle. Another logic is, moreover, whatever service company expected from the employee, that benefit has been received by the company, na? Which means you should recognize the expense. Logical, na? See, use your common sense. Option did not vest, okay. But employee has given you 3 years service, na? To the company. So as a company, I received the benefits, na? You understand the point? When I received the benefits, okay, then I should recognize expenditure as well. In non-market condition, what happens when the options did not get vested, then the total benefits has not come from the employee. It will be stopped in the middle itself. Either employee will leave the company, so service condition is not satisfied. Therefore, you did not get the benefit. You did not get the complete service from the employee. You understand the point? Or some non-market condition growth rate or something will be there that will not be satisfied. Therefore, things will be stopped in the middle itself. But here that's not the case. One basic point here is you have received the entire service from the employee. You understand the point? Therefore, recognize the expense. This is one logic. The other logic is, of course, this is unique to market condition, where a market condition getting satisfied and not getting satisfied both has been considered while calculating the fair value of the option. Therefore, your accounting will be neutral irrespective of whether your options get vested by satisfying the market condition or see, understand one thing. While calculating the fair value of the option, market condition getting satisfied, not getting satisfied is anyway considered. Therefore, market condition getting satisfied is nothing but options getting vested. Market condition not getting satisfied is nothing but options not getting vested. So, therefore, options getting vested, not getting vested also indirectly considered. Got it? Yes, right? Chalo. Now, this doubt already just now I've explained you. But sir, so students doubt. But sir, earlier when service condition or non-market condition is not satisfied, then we will reverse the entry, na? We will write SBP reserve to employee compensation. We'll credit it back to P&L, right? And effectively taking it back to P&L. That's what we were doing. But here we are talking, we are taking it to retain earnings. Earlier we used to take SBP reserve to retain earnings only if employee does not exercise the option after satisfying both the service and non-market condition. So which means earlier, once everything is satisfied and the options got vested, and after that employee chose not to exercise the option, then only will transfer from SBP reserve to retain earnings, correct? Whereas if the vesting condition itself is not satisfied, whether it is service condition or non-market condition, immediately what we used to do, we should reverse it and take it back to P&L. But here options are not getting vested and the market condition is not satisfied, still we are transferring it to retain earnings or general reserve from SBP reserve, correct? Why? My answer simple. As in this case of market condition, we have already considered the possibility of market condition not getting satisfied at the beginning on the grant date itself when the option value was calculated. Again and again and again and again, it's the same logic. While calculating the fair value of the option, both the possibilities are considered. Therefore, when it comes to accounting treatment, kuch farak nahi padta. Whereas in non-market condition, that we will not do. There both the conditions will not be satisfied. You understand the point? But market condition, that is the speciality. Okay, without time limit or with time limit, both the cases, that is speciality. Both the possibilities are considered. Therefore, there will be no change in accounting treatment. Now, coming on to summary. So, market condition with the time limit, that is options will vest only if the market condition exceeds 65 by the end of year 3. That is just an example, okay? Here, the vesting period is defined in the ESOP contract, that is ESOP contract. Therefore, option expense is to be recognized over this particular vesting period, correct? If the market condition is not satisfied by the end of vesting period, then the options do not vest at all. However, option expense need to be recognized as usual, irrespective of whether option gets vested or not, irrespective of whether market condition gets satisfied or not. This is because the possibility of market condition not getting satisfied is already considered in determining the fair value of the option on the grant date. As the options do not vest, the accumulated balance in SBP reserve is transferred to retain earnings. Very, 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 very important point. Because so far we have already learned that whenever the options are not getting vested and the non-market condition is not getting satisfied, immediately we'll reverse it, we'll take it back to P&L. But here that's not the case. When it comes to market condition, even if the options are not vested, even if the market condition is not satisfied, because we have already considered that possibility at the grant date itself, still you will do normal accounting, still you will take the SBP reserve to retain earnings. You understand the point? Are we done with this? Hello everybody. Any doubts? Already your doubt has been considered and it has been answered as well. But still, is there any doubts which I did not consider? Okay, that you guys have to tell me. कुछ doubts है जो मैंने consider नहीं किया? I'm waiting. Answer. No doubts है? चलो, nice. All right, guys, finished. Shall we continue with the next one? Okay. Now with this, we'll finish off this particular session. Otherwise, things will be very heavy. Now let's get into modification of ESOPs. Okay. Which means whatever the employee stock option plan that you have got, okay, once you have initially had a particular plan, then eventually you as a company plan to modify it. There will be logical reasons behind that, but ultimately the entire whatever there are so many different types of modifications that you can do. Basically, just use your common sense. When you want to change something, you can change anything, right? The permutation and combinations are limitless. But however, if we can just bring it down into two broader areas, then we can say this modification, whatever the company does in future with respect to the ESOPs that they have initially planned, either it will be beneficial to the employee or it will be not so beneficial to the employee. Not so beneficial to the employee means, logically speaking, it will be beneficial to the company. Got the point? Right. Anyways, sir, why did you say not so beneficial to the employee means it will be beneficial to the company? Because this sentence is very important for you to understand the logic behind the treatment what Ind AS says. Okay, you will get it. Wait. Modification of employees can be divided into two. One is favorable to the employee, unfavorable to the employee. Correct? Now, let's come to this part. Unfavorable to the employee. What do you mean by unfavorable to the employee? Say, for example, if you increase your vesting period, not so favorable. Initially, you said employee. You just try to satisfy these conditions in 4 years. If you just satisfy the service condition of 4 years, you will get the options vested. Now, suddenly at the end of second year, I'm saying employee, 4 years is not enough. I want 6 years. Is it unfavorable to the employee? Obviously, because you're gonna ask him to work for 2 years more, na? So change in vesting period. It's not just change in vesting period, it's increase in vesting period. Favorable or unfavorable? You're asking him to work for more time, right? Obviously unfavorable. Next, increase in exercise price of the share. See, I told you so many times, suppose your market price is 100, your exercise price is, say, for example, 20, then the benefit or intrinsic value is 80 to the employee. Once you increase the exercise price to 20, from 20 to, say, for example, 40, then eventually what will happen to your benefit? It will get reduced. So therefore, it is unfavorable only now. Once you increase the exercise price of the share, it will be unfavorable to the employee. Clear? Right. Increase in target conditions, whatever the conditions that you have got, so-called non-market condition. Earlier you said 5% growth is enough for us. If you satisfy that, if all your employees put together, do the hard work and ensure that on an average 5% growth is happening for the company, then that's fine for us. Then suddenly you said that no, 5% growth is not enough. We want 8% growth. Is it unfavorable to the employee? Yes. But in all these cases, giving benefits to the employee is cost for the company. Please try to understand that logic. So therefore, when the modification of ESOPs becomes unfavorable to the employee, it means for employee the benefit is basically reducing. Automatically, it means that cost is also reducing for the company. Yes. When benefit is reducing for the employee, cost is also reducing for the company. So which means it is actually good for the company. So unfavorable to the employee, good for the company. Now, I told you what Ind AS does whenever company does something that is good for the company. So what Ind AS tells is, see, for accounting purpose, Ind AS ignores the above totally. Which means Ind AS says, TK, you karo, you do. You try to modify the ESOP such that it is not so beneficial to the employee, fine. You do. But accounting, you do the same way as if modification did not happen. You understand the point? Accounting, you do the same way as if modification did not happen. Sir, why is this, sir? Why does Ind AS says like this? First, we will read this, then I'll explain the logic. See, actually, I already explained you the logic earlier. It's the same logic. Sir, what is that earlier logic you have explained? I told you now with respect to change in estimates, where postponement and preponement of the market condition, when there is postponement, you should not do anything. But when there is preponement, yes, you should prepone and accelerate your expenditure recognition. There I have explained you the logic, same logic here also. Right, anyways, first let's finish this off and then I'll give you the logic. For accounting purpose, whenever you modify your ESOP, which is unfavorable to the employee, for accounting purpose, Ind AS says you just ignore it. Ignore it means you do accounting as if modification did not happen. Okay. So accounting for ESOP has to be done as if no such modification has taken place. They do not want companies to manipulate ESOP terms and conditions to get the desired effect on P&L. Very simple, Nana. See, I'm a company. I feel like I already gave all the ESOPs, this much benefit will come to the employee, everything has been given. Then I'm looking at my profits. Normally, whatever the business that I have planned, it's not going that well because of some other reason, or maybe something has happened. As a result, my profits are going down. So as a company, I'm thinking, okay, somehow I need to ensure that this profit should not go down further. Something I have to manipulate with respect to accounts. So what you will do? So many things they will do. Not only this, for example, depreciation method they'll change. Okay, such that the on an average the depreciation that you debit will come down drastically, thereby your profit will increase. Here also what they'll do, okay, we have already given ESOPs now, so on an average how much is the debit that we are doing every year? Sir, somewhere around some 50 crores we are doing, sir. Okay, do one thing, let's modify the ESOP this way such that the benefit will be reduced to the employee. That's what you mean by unfavorable to employee, na? Benefits will be reduced to the employee, which means indirectly that is savings for the company. If you increase the vesting period, indirectly employee will give services for more amount of time for the company. That's benefit for the company. If you increase the exercise price of the share, the intrinsic value comes down, which means that is benefit for the company. Benefit for the company means company's costs get reduced. So company will say, okay, you do one thing, you modify this ESOP such that is unfavorable to the employee, so that we'll enjoy that particular benefit and thereby our profit will eventually increase. Now, is it good? Can they do something like that? Ind AS knows this. That is the reason Ind AS says, TK, all your this tricks and all will not work. We have already seen enough real life situations. After that only we framed rules for Ind AS. So therefore what you do is simply, when it is unfavorable to the employee, don't do any accounting change. You do accounting as if no modification has taken place, especially when it is unfavorable to the employee. Is this clear? Right? Okay, sir. Then if it is favorable to the employee, then what we need to do, sir? Logic is very simple, sir. Favorable to employee means not so favorable to the company. You understand the point? Which means company's expenditure will increase. Now you can ask me, sir, why would company do something like that? Is company stupid, sir? Suppose company is already giving some 10 rupees benefit to employee, sir. Why would company increase that to 15? Because that eventually becomes cost for the company and company's cost is increasing. Na? In some situations, companies will be forced to do that. You got it? Why would companies be forced to do something like that? Well, we'll see that. See here. Suppose year 0 you have 1, 2, 3, 4, totally 4 years. Initially, company gave the excise price option as 100 to the employee. Vesting period is 4 years. Fair value of the option is 160. Fair value of the option means that is a benefit ultimately the employee enjoys, or that is a cost for the company as well, which is 160. Clear? When this option was given to the employee, the market price of the share for the company is 200. Then eventually what has happened? Market price dropped to 145 at the end of first year. At the end of second year, it further dropped to 110. You understand the point? And once this drops, naturally, the fair value of the option also keeps on dropping. Correct? However, we should always calculate fair value of the, we should always consider fair value of the option on the grant date only for doing all the accounting purpose. That we know. After that fair value of the option changes, we should not consider that. But what I'm trying to say is, we will not consider that from company's point of view for doing accounting purpose as per Ind AS 102. Correct? But employee will not feel that way. Na? How would employee know about what you are accounting, what you are doing, what Ind AS 102 tells you? All these things employee doesn't know. What employee knows is, my excise price is 100. Market price is 200. As of now, I'm seeing some benefit. In future, I'm expecting this to go even further so that the gap will increase further. Thereby, I'll enjoy more benefit. You understand the point? That's what the employee will be thinking, right? So try to think from employee's perspective. So if something like this is happening and the market price is falling down like this, then definitely employee is not happy. So when he's not happy, what is the problem for the company, sir? Let him be not so happy. We always want him smiling. No, sir. Let him be unhappy. What is there in that? You can't think like that. Why? Because if he's unhappy, he'll not satisfy the service condition of 4 years. He'll leave the company and he'll go. Then it is bad for us only. Again, we have to recruit new people. That will cost the company. In costing, you would have studied in CA Inter. Labor turnover ratio, rate of change of labor. When employees leave your company and go, it's gonna cost you a lot in so many different ways. Again, new people will come, you have to train them. Again, their efficiency will not be on par with the people who have left the company. You understand the point? So many problems you'll have. Correct? Therefore, employee getting demotivated, and if he threatens to leave the company, it's not good for the company. Therefore, so to make them stay, company reduces the excise price from 100 to 60. Now still, now the gap increases because the excise price has been reduced. Thereby, to some extent, your employee is satisfied. So let's say now fair value of the option is 90. Let's say for example, fair value of the option is 90. Ultimately, fair value has got increased na, after modification at the end of year 2. You understand the point? Yes, and therefore employee will be happy. Although this will cost the company, but ultimately employee will be happy and he'll stay in the company. Now, this sort of modification of ESOP, which is beneficial to the employee, is indirectly increasing the cost for the company. So when there is increase in expenditure for the company, naturally that expenditure has to be recognized. Correct? Now, Ind AS 102 says how to recognize that. How to recognize that means Ind AS 102 says treat this so-called modification, listen carefully, treat this so-called modification as a separate ESOP and account it separately. And already existing ESOP anyway you are accounting now, you continue that. You understand the point? Again, I repeat. Treat this so-called modification as a separate ESOP and account it separately. Existing ESOP anyway you're accounting now, continue that. You understand the point? So two things we'll do separately. That's what. See here. Modification will be treated as separate plan and the incremental fair value of the option will be recognized as an expense over the remaining vesting period on straight line method basis. Very simple. Incremented fair value is, say for example, in this case, see here, fair value after is 90. Okay, before is 30, incremental is 60. This will be recognized as an expense over remaining vesting period. When did you do this? In the second year. So remaining vesting period is 2 years. So what you will do? 60 divided by 2. So 30 you will recognize in the remaining 2 years. So what will happen to the already what you're recognizing this 40 that you will continue. 40 will continue. In addition to this 40 30 will come and add in the remaining 2 years. You got the point? See here. And apart from this original option expense, recognition should continue. Apart from this means apart from this new modification which will be treated as separate plan, original options expense should continue. So 40 will continue. In addition to 40 30 will come and add. This is 60 na. This will be recognized over remaining vesting period. This has happened at the end of year 2. Remaining vesting period is 3 and 4. So 30 will come here. So minus 30 minus 30 minus 40 will continue. Clear? Right. Now student doubt. Yeah. Already somebody is asking here. Anyways, why fair value of the option and not excise price? Simple, Nana. If you take excise price, you are indirectly doing accounting based on intrinsic value and not fair value. Ind AS 102 allows accounting based on fair value only. This we have already seen, Nana, long back. So therefore, based on fair value only, you should do this calculation. Not only that, fair value is nothing but the actual benefit that the employee gets. In other words, fair value is nothing but the actual cost for the company. Whenever you do accounting, you should do accounting based on what is the actual cost for the company only, na? You understand the point? Intrinsic value is not the actual cost for the company. It is not the actual benefit for the employee. Either way, it doesn't work. Therefore, everything should be based on fair value only. That logic also works that way. I hope this is clear. So finally, what is the summary with respect to modification of ESOP, Nana? First, you see whether that ESOP is favorable or unfavorable. If it is unfavorable, then the standard says you ignore as if that modification has happened and you just continue with the existing whatever the option plan that you have got. Second, if it is favorable to the employee, then what you do is that treat this as a separate option plan and account it separately for the remaining vesting period, and whatever that your option plan existing is there, that you just continue like that. Got the point? Right. Now, treat this as separate option plan means how much should I take it as an option expense? Very simple. Take the incremental fair value. Okay. Before modification, what is the fair value? After modification, what is the fair value? You take the difference. And then suppose in this case, the difference was 60. 90 minus 30. That 60 will be recognized in the remaining years of the vesting period. What is the remaining years of the vesting period? 2 years, third year and fourth year. So 30 minus 30 minus 30. Okay. Already 40 will be there. So minus 40 separately, which is the existing option plan, that will continue. Minus 30 new plan will come extra. That's all. Clear? Okay, chalo na, fantastic. Okay, it's been heavy this particular session. There's enough. So with this, we are done with modification of ESOPs as well. So next session also we'll continue the concepts, Nana. We'll go with cancellation of ESOPs. We'll go with SARs, and after that we'll go with ESOPs with cash alternative as well. Okay, except for group based ESOPs, we'll finish off everything else, and then we'll go for solving sums. Okay, and we'll finish off the sums. Clear? Now next session, you revise this and then come. Is that clear, guys? Everybody? Yes? Well, I hope you guys have enjoyed the session. Fantabulous. Oh, thank you. Okay, okay, guys. Okay. Yes, it's emotional. Thank you. Right. Let's wind up this session. In the next session, okay, we'll go with the rest of the concepts. Okay. Hi, guys. Welcome back. Right. Is the voice clear, Nana? Confirm me once. Okay. Is there any lag? All right. Chalo, we'll start. No, this is another important session, Nana, because in this session, what we are going to do is that we're going to finish off all the concepts of Ind AS 102, okay? And in the next session, we're going to go with sums, okay? So therefore, this session is going to be very important. I think in the last session, we have completed modification of ESOPs, correct? So this session, we'll go with cancellation of ESOPs and then SARs, okay? So let's go one by one. Ready? Yeah? Okay. We'll be starting with cancellation of ESOPs, right? So what happens if ESOPs are cancelled in the middle of it by the company? So what kind of treatment we should do? That's what we're going to learn right now. Okay. So let's have an example over here. You have a 4 years time period. Fair value of the option was 160. And because it is 4 years, obviously 160 by 4. So you got to go with 40, 40, 40 every single year. But by the time you come to third year, what's happening is the company is cancelling the ESOPs. Now, you can ask me, sir, what is the reason? Why would a company cancel the ESOPs? Why would an entity do that? Okay, what's the logic behind that? When they will do that? Is there any scenario why they would do that? So you'll be having these kind of questions, but we would like to answer that later. Right now, just focus on the procedural part, okay? So what kind of accounting treatment we should do as per Ind AS? So that's important for us, right? So if there is a cancellation by the entity of the ESOPs, then what we'll do is that first step, we will accelerate recognizing the option expense. Okay. I didn't write that. Just a second, guys. Accelerate recognition of option expense, which means usually if there is no cancellation of ESOPs, what you will do? Next third year, another 40. Okay, fourth year, another 40. This is how we'll do. But because you're going to cancel the ESOPs right now, whatever the expenditure that you're going to recognize in fourth year also, whatever the option expense, you got to recognize that in third year itself, which means you have to accelerate that. We have seen this word in the preponement as well. You remember that, right? So we have to accelerate, right? So accelerate means what you will do basically that 40 and 40, which I should have otherwise recognized in 2 years, rather I'll be recognizing in the third year itself. Now immediately you'll get it out, sir. Why would we do that? Why would Ind AS 102 ask us or ask the company to do this kind of a treatment? Why? Because they're basically cancelling the ESOP now, sir. So when you're cancelling the ESOP, nothing is going to be vested eventually because you're cancelling the ESOP itself, right? In between the time period, that too. So logically, sir, what we think is we should be reversing it because so far you have debited the P&L. Logically speaking, you should be reversing it, whatever you have done so far, and take it back to the P&L. That should be the logical treatment, right? Actually, what your thought process is correct, but hold it, okay? Hold on to that particular thought process. I'll clarify it later. Right now, just finish off the procedure first. Then we'll go to the logics, okay? Right. So accelerate recognition of option expense. One thing is quite clear. Okay, fine. In case an entity cancels the ESOPs in the middle of nowhere, okay? Simply what you'll do is that whatever the expense, option expense that you have to recognize in the future period, you will recognize now itself. You will accelerate the recognition of the option expense in this year itself, in the year in which the so-called ESOP has been cancelled by the entity, and then you'll finish it off, right? So there is no escaping from recognition of the expense. That's your step one. Step two. After doing this, what will happen? You will have your SBP reserve now, which has been created. So first year 40 SBP reserve, second year 40, which means by this time SBP reserve was 80. Now another 80. So which means there will be a credit balance of 160 in the SBP reserve, correct? Now what you'll do, you cancel that off, okay? And transfer it to general reserve or retained earnings. Some questions it will be retained earnings, some questions it will be general reserve. Chalta hai, okay? No worries. But one thing is for sure, from SBP reserve, we should be taking it back to retained earnings, or not taking it back, we should take it to retained earnings or general reserve. Clear? This is step 2. Now again, you will be having doubts, sir. Why are you doing this? When we will take it to retain earnings? When the vesting period is completed, when the options are vested, and when employee chose not to exercise the option. Get the point? Only then we'll do that, na sir. Or in market condition, okay, with or without time limit. So there it's an exception. That exception to the rule we have already seen. We have seen the logic as well. But here also, why are we doing like that, sir? That's another doubt, correct? Wait, for that also I'll give you answer. Next. After this, what will happen? Okay, you have accelerated the recognition of the option expense. That your step 1 whenever you cancel the ESOPs. And step 2 is you'll be reversing it out in the sense from SBP reserve, you'll be transferring that to general reserve or retained earnings. Okay, done. Now, because you have cancelled the ESOPs, somebody is going to get hurt. Okay, somebody is going to feel bad. Now you know the answer. Who is it? Obviously employees, because they were anticipating that they're going to get a lot of benefits, and all of a sudden the ESOPs have been cancelled. So they will be feeling bad for sure, or they'll get hurt. Now company has to compensate them, correct? Now, please understand that in all the cases, company or the entity will not compensate the employees in case of cancellation of ESOPs. Only in few cases they will do that. So there is no rule that in all the cases, 100 out of 100 cases, they'll be compensating the employees whenever there is a cancellation of ESOPs. That's not going to happen. Is that clear? It will happen only in rare cases. Cannot say rare cases. Let's say 50-50 probability, right? You understand the point? So now the point that you guys need to understand is that suppose there is no compensation paid to the employees, then you will stop here itself. You will stop with step 2. What is step 2? SBP reserve to general reserve or retained earnings, because the options are lapsed by default. Cancel means that's how you will consider that. You understand the point? Now, suppose if the entity pays compensation to employees. Now, why would they pay compensation to employees? Because employees are hurt. You understand the point? Now the question is how much they will pay compensation. Let's say they have decided that they'll be paying 250, okay, to the employee as compensation. On that day when the ESOPs are cancelled, the fair value of the option is 220. But up and above the fair value of the option, the company or the entity is paying 250. In that case, ultimately the entity will pay 250. Therefore, to bank 250. That is clear. You pay 250, company pays 250. Therefore, to bank 250. Correct? Now, fair value of the option is only 220. Even though you are paying 250, fair value of the option is only 220. To the extent of fair value of the option, you debit the retained earnings. Why, sir? Because all the SBP reserve that you have created went into retained earnings only, na? Right? But you can be thinking, sir, here and here, this did not match, sir. That we will see later when we start solving the sums. Here we are just going with example numbers, okay? So therefore, debit your retained earnings. From that only you'll pay the amount, okay? Why? Because already your SBP reserve which you have created eventually here went into retained earnings only, na? Therefore, you will debit the retained earnings. Simple logic. Clear? Now, but because you are paying up and above the fair value on the cancellation date, even though the fair value of the cancellation date is only 220, you are paying 250. Therefore, that extra you will get it from P&L. But we will write employee compensation. Eventually, it will go back to P&L. You guys know that, correct? Clear? Right. So this we will do only when there is compensation paid by the entity to the employees because the employees are hurt. You understand the point? Now look at the logic over here. Why am I paying 220? Because you are paying it in the capacity of equity shareholder. That is the reason you are debiting what? Retained earnings. Got it? That's the reason you are debiting retained earnings. Now after that, what about this one? Employee compensation. Why are you debiting P&L account? Excess payment over and above the fair value is in the capacity of making employees happy as you have cancelled ESOP. So it is cost for the company. Pretty simple. Because you have hurt them, now you have to make them happy by paying them something up and above whatever the fair value that is there on the cancellation date. Clear? And that is the reason we are paying this 30 rupees extra. Clear? Everybody? Right, Nana. Now what we'll do is that we'll get back to the logic. Now, simple thought process, Nana. See, always Ind AS looks at the entity from kind of a negative perspective, we should say, or you can be a little more elegant and you can say cautious terms or cautious perspective, whatever it is. So, just think for a moment. Why would any company cancel the ESOPs? You know, probably in a particular year, maybe they are not performing well, and as a result, if they cancel the ESOPs, they get back to reverse it down and then eventually credit back the P&L, and eventually their profit will look good and things like that. They can manipulate, right? There is a possibility. There might be genuine cases as well, but all Ind AS tries here is that the rule book is very simple. They always try to be cautious, and there will be good side as well as the bad side of company or entity taking some kind of a decision like canceling the ESOPs in this particular case. But I think the Ind AS always picks up the negative side of it, and they don't want the company to manipulate their profits, and hence they say no, 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 no. Even if you decide to cancel the ESOPs, you can't reverse what you have done so far and credit it back to P&L account and then eventually increase your profit. That we are not going to allow. You run your accounting as if you have not cancelled the ESOPs. If not, the Ind AS goes one step further and says that you accelerate the recognition of the expense and recognize now itself, such that from your P&L the whole thing is debited and eventually it will be transferred to retained earnings. Now, once it is transferred to retained earnings, you guys know that it comes under other equity, and eventually that's why you treat them on par with the capacity of equity shareholders. And eventually, when you're paying them compensation, you debit the retained earnings. And if you're paying up and above the fair value of the option on the cancellation date, then you also need to debit the P&L, and eventually you will credit the bank, obviously, because you're making the payment. As simple as that. I hope this is clear. Okay, so the summary is very simple. Whenever there is a cancellation of ESOP, what you will do, step 1, accelerate the recognition of the option expense. Okay, in this year itself, you recognize the whole thing. Step 2, what you will do after that? You debit the SBP reserve that you have created so far and transfer it to either general reserve or retained earnings, right? And after that, if you decide to pay the compensation, if the entity decides to pay the compensation, then only you should go to step 3. Otherwise, you stop basically at step 2. With this only you will stop. Clear? If entity decides to pay compensation because entity knows that employees are hurt because the ESOP has been cancelled, then in that case what you do is that you look at the fair value of the option on the date of the cancellation, right? And you see whether the entity is paying the compensation equal to the fair value on the cancellation date or up and above that. If it is up and above that, then to the extent of fair value on the cancellation date of the option, you debit the retained earnings. Up and above, you debit the P&L account to obviously how much you are paying, that much you'll be writing to bank. As simple as that. Are we done with this? Hello, everybody. Clear? Any doubts? I hope I explained the logic as well. I hope everything should be clear. Right. Okay. Now what we'll do, let's revise all the important points that we have seen so far. Okay. Now, because while solving sums, you should not be confused. Now, that's why. Let's try to revise. Now, see, Anana. General rule is that before vesting period completed, if options did not vest due to non-satisfaction of service condition or non-market condition for that matter, if the options are lapsed during the vesting period, including the last year, even in the last year also, suppose you are not able to satisfy the service condition like employee leaving out, or you are not able to satisfy the non-market condition, then in that case, reversal should be routed through P&L before vesting period got completed if there is a so-called non-satisfaction of the market condition, and as a result your entire options did not vest. Clear? So you will route it to P&L, correct? But if the vesting period is completed and all the conditions are satisfied, that is so-called vesting conditions, which is service condition as well as non-market condition, non-market performance condition, and the employee chooses not to go for the option, then you can take it to what, Nana? Retained earnings. This is what we have learned at the beginning, right? So before vesting period, if because of non-satisfaction of any condition, whether it is service condition or non-market performance condition, then you will take it back to P&L, exactly reverse. You will do the reverse entry, right? Whereas everything is satisfied, after that employee chooses not to exercise the option, then what we'll do, to that extent, we'll be transferring it to retained earnings. This is what we have learned first. This is the basic rule. But for that rule, we have seen the first exception in case of market condition. So in case of market condition, if it is failed during the vesting period, then you will book it. You will book all the expenditure via employee compensation, and SBP reserve should be routed via retained earnings and not P&L. This is where we have seen the first exception. Correct? Hello, everybody. Exactly. Market condition with or without time limit. With or without time limit. Clear? So even if the market condition failed during the vesting period also, So which means your condition is failed, performance condition is failed. Here if non-market performance condition is failed, then straight away you'll take it back to P&L. But here if the market condition is failed, which comes under performance condition only, na, even if it is failed also, you will take it to retained earnings only. You will not reverse it back to P&L. That's what we have seen. Why? Because I explained you the logic. Because while calculating the fair value of the option at the beginning itself, when there is market condition, both satisfying the market condition, not satisfying the market condition, both has been taken into consideration to calculate the fair value. And that is why whether the market condition gets satisfied or the market condition is not satisfied, your accounting treatment will not change. You understand the point? Yes, all these logics we have already seen in the last session, correct? So therefore, this is the first exception where a market condition which comes under performance condition, even if it is not satisfied, still you will be taking it to retained earnings only. You will not take it back to P&L. This is first exception. Second exception is in case of modification of ESOPs, when that is especially unfavorable to the employee, because we have seen two options now, favorable to employee, unfavorable to employee, correct? If it is unfavorable to the employee, then what Ind AS says is that you try to do accounting as if modification did not happen. So therefore, Ind AS says ignore modification. Okay, ignoring modification. If original condition is satisfied, what is original condition? Before modification, what was the condition? If that is satisfied and not revised condition, then SBP reserve again will be routed through retained earnings. So this is an important point, Nana. We have a sum also based on this. So again, I repeat, listen carefully. When we are doing modification of ESOPs, we have two options, favorable, unfavorable. Favorable or unfavorable to whom? To employees. Okay. If it is unfavorable to the employees, what does standard say? You ignore the modification and do accounting as if there is no modification. Correct? Right. So what Ind AS says is, you ignore modification and do accounting as if there is no modification taken place, which means as if there is no modification taken place means it is the original condition is going on. So you have to consider like that. You understand the point? Although modification has happened, Ind AS says that you do accounting as if no modification has happened. Do accounting as if no modification has happened means original condition is still valid. Like that you have to think and do accounting. Is that clear? So if that so-called original condition is satisfied, in that case also you will be routing it through retained earnings only. You understand the point? Now comes the important point. Once you have done a modification, after that there will be a revised condition. Revised condition means which comes with the modification, correct? If that revised condition is not satisfied, kuch farak nahi padta, because anyway we are doing accounting as if modification has not happened, correct? Which means there is no revised condition. It is there, but we will not consider while doing accounting. That's what Ind AS says. You understand the point? So this particular sentence is very important because we're gonna see this while solving sums. Okay. So my point is, again I'll repeat, when you are doing modification of ESOPs and when it is unfavorable to employee, Ind AS says do accounting as if there is no modification. Okay. Revised condition comes with modification. So because Ind AS says you do accounting as if there is no modification, so even though there is a revised condition, we will ignore it. There is no revised condition, we will not consider it. Even though it is there, we will not consider it. Clear? So we will consider only the original condition, that is before modification. If that original condition is satisfied, it's enough. Even if the revised condition is not satisfied, doesn't matter, because anyway I'm not going to consider that. So if original condition is satisfied, that's enough for me. It's as if everything is satisfied, and therefore it will be routed through RE, retained earnings. It will not come back to P&L. As simple as that. Because usually what is the logic? Whenever a condition is not satisfied, we'll take it back to P&L, na? That's what we have seen here now. If there is non-satisfaction of a condition, we will take it back to P&L now. But here, even though there is non-satisfaction of a condition, okay, as long as original condition is satisfied before modification, you can take it to RE. If original condition is also not satisfied, that is a different case. Every sentence, every word is very important over here. If original condition is not satisfied, that is a different case. So what we are talking, you have done modification. Ind AS says I'm going to ignore the modification, which means I'm going to ignore the revised condition as well, which means I'm going to consider before modification whatever it is there, which means original condition. That is satisfied, okay, take it to RE. If that is also not satisfied, that's a different thing. You understand what I'm trying to say? Clear? Right. Anyways, next, third exception. cancellation of ESOPs. So whenever there is cancellation, you will do acceleration of expense and SBP reserve will be transferred to retained earnings, which we have seen just now. Just now. Clear? Because the standard don't want the companies to manipulate. That is the reason they gave all these exceptions to the exact rule where you can reverse it in case of non-satisfaction of the condition and take it back to P&L. You got the point? Right. This is very, very, very important, Nana, this summary. This will be a lifesaver for us when we are starting to solve, when we do start to solve sums, right? So that is the reason I've put the summary over here. This is very, very, very important. Are we done with this? If we are done with this, then we will go to SARS. That is cash settled plans or stock appreciation rights. Okay. First, I want you guys to finish this off. Any doubts so far? You can ask me. Any doubts still here? All right, guys. So no doubts. Everything is clear. Right. Okay. Fantastic. Chalo, let's go to the next one, Nana. Now, the next one that we're going to cover is SAR, stock appreciation rights. In other words, SBP, which is cash settled. Okay. And we know that if it is SBP reserve, it will be seen as an equity obligation. If it is cash settled or SBP liability, we'll be seeing that as a liability. So that's why within brackets, we're going to write it as a liability, right? And it is no way it's an equity item. So that is the first clarity you should have. All right, let's go with the example. Now, let's say you have 5 years over here where 3 years is the vesting period and 2 years is the exercise period. Okay, right. Now, what are you giving right now? SARS. You are not going with, equity obligation. You are going with cash obligation, liability. Okay, right. Now, so you say that you means entity. So entity says that there is an option right now for the employees where the exercise price is 150 and the fair value option as of today is 120. Okay, and the vesting period will be for 3 years. Okay, after that exercise period will be for 2 years. Okay, right. And in the exercise period, obviously the employees can exercise. And once they exercise, what the entity is going to do is that, now focus here. On that day, whatever is the market price, I will take that. Okay. Suppose employee exercised here, 4th year. Okay. Employee exercised options on this day. On that day, what is the market price? On that day, what is the market price? Which we don't know right now. In year 0, we don't know. On that day, whatever the market price is, take that. And what is the option that is given? You can exercise at 150. Put that 150 over here. So which means on that day, if the market price is 320, which means the worth of the share of the entity is 320, whereas the entity gave the option to the employees under SAR, that is SAR, where they can buy. Excise price means at that price you can buy only, na? So a share that is worth 320 in the market can be bought at 150 itself, which means what is the benefit to the employee? 170. Correct? Therefore, what the entity does is that benefit 170 is there, na? Directly 170 I'll pay it to you in the form of cash. That is the benefit you will enjoy, na? See, if I give you an option to buy it at 150, what you will do basically? What the employee will do? What are you expected to do as an employee? You take the chance of buying the stock at 150. You buy the stock at 150 and then eventually you'll sell it in the market at 320, which means you'll bag a benefit of how much with that transaction? 170. That directly I'll pay you that 170 benefit straight away. Take it, enjoy. Got the point? In other words, now you can ask me, sir, this sounds like intrinsic value only, sir. To the extent of intrinsic value, on the day that employee exercises, that much cash will be paid by the entity to the employee? Yes. Yes. Okay. So what is the intrinsic value? You have an option to buy the share at 150, whereas the market price of the share is 320, which means the intrinsic value is 170. To the extent of intrinsic value, on that day when the employee is exercising the option, cash will be paid by the entity to the employee. Clear? Because you have to pay cash, that's why it is called as an obligation. Sorry, that's why it is called as a liability. Clear? Moving on. Okay, now let's see here. In ESOPs, what we do is we take fair value on the grant date. Okay, right? So year 1, what we'll do? We'll debit 40. Year 2 also will debit 40. Year 3 also will debit 40. This is what we'll do in ESOPs now. Fair value of the option on the grant date is 120. Okay, so which means First year 40 over here, second year 40 over here, third year 40 over here, correct? Yes, because 3 years only, na, vesting period. So minus 40, minus 40, minus 40. What will be your entry? Employee compensation to SBP liability, because right now it is liability only, na? To SBP liability, to SBP liability. Finally, when you try to make the payment, this much of cash you need to pay. So therefore, to bank, and whatever the SBP liability, that the credit balance that you have created will be debited. It will become 0. To bank, you will make the payment. There ends the matter, correct? But the problem is, how much is the SBP liability? Here you would have created 40. Here 40. Here 40. Which means total would have been how much? 120. Which means here how much you would have debited? 120. Whereas how much you are paying here? 170. Where did that extra 50 came from? You understand what I'm trying to say? See, Nana, your fair value of the option on the grant date is 120, Nana. Okay? Which means logically what you will do, like SLM method only, na, right? So 40, 40, 40 here, which means here SBP liability will be 40, 40, 40, which means total will be 120 only. Whereas to bank, how much you are making payment? 170. Where will you go for the difference of 50? 50 only, yeah? Yeah. You will take it from P&L account only. So what will be your entry in this case? It will be SBP liability debit to the extent of credit balance. I have only 120 credit balance. Therefore, I'll debit to the extent of 120. From P&L, I'll get the extra 50. To bank, ultimately, I'll be making a payment of 170 to the exactly employee. Correct? Yes. That's what I've written over here. But is this right or is this wrong? This is wrong. You cannot do like this. You cannot do like this. Okay, some of you those who are listening for the first time, it's fine. Some of you who are listening for the second time, probably you would have thought that initially sir is teaching wrong. No, I'm not teaching wrong. I'm trying to teach you the right way. Okay, anyways, now see here. So which means this treatment is wrong. Why? Because, now listen carefully, I'm trying to give you the logic. Listen carefully. Employee gave services to the entity for these 3 years. Employee gave services to the entity, which means entity received benefits from the employee. So if I received benefits from the employee for a period of 3 years, then that benefits is actually cost for the company, right? Because you have to pay to the employee, and that cost should be recognized in those 3 years itself. You understand the point? Now what is happening if you follow this methodology is that here you have recognized only 40, 40, 40. When employee is providing you services, you thought that your cost will be 40, 40, 40 for whatever the services employee is providing to the entity. Whereas when the employee stopped providing services after 3 years, then you are debiting 50. How does it make sense? When you are getting benefit, you are saying that I'm enjoying this benefit, therefore the cost of enjoying this benefit is 40, 40, 40, and after that all of a sudden I'm not getting any benefit, and then I'm saying the cost right now is 50. By debiting 50, you're debiting P&L only, na? After the vesting period got completed, during exercise period only, na, you will debit. That is the entry over here, which is wrong. Which is wrong. Okay, see here. But the above entry is logically wrong because you are giving employees benefits of SAR for their services during vesting period and not after the vesting period. But in the above case, 120 you booked in the vesting period, which means you have debited the P&L basically. But 50, the major expenditure, when compared to 40, 50 is more, na? The major 50 expenditure you booked in P&L after vesting period, during exercise period, which is wrong. Therefore, what we do in SAR is we don't consider fair value of the option on the grant date like we were doing for equity settled plans. Rather, we will take fair value of the option which is latest. Latest means you have the formula, na? What is the formula? Tell me the formula. Employees at the end of the vesting period into number of options per employee into fair value of the option on grant date. Fair value of the option on grant date. That used to be the formula for equity settled plans, SBP reserve plans. Okay. Right now, no. Fair value of the option at the end of the period. Into vesting period completed divided by total vesting period minus expenditure recognized during the previous year. Everything else in the formula is same. Okay. Nothing is going to change. But what the point you need to note is that I will take for first year ending, I'll take fair value over here, I'll take fair value over here, I'll take fair value over here. I'll not be considering fair value of the option on the grant date like I used to do for equity settled plans. This is a major difference. See here. You will not be taking fair value of the option on the grant date, which we used to take as per equity settled plans. Rather, fair value of the option latest at the year 1 end will take, while doing year 1 calculation, year 2 end will take, year 3 end will take. Are you able to understand? Or if there is average fair value given in the question, that also will take. It depends upon what kind of data is given in the question. You understand the point? Right. So now suppose excise period is 2 years, and after vesting period, the excise period is 2 years and the vesting period is 3 years. So 3 years is the vesting period, 2 years is the excise period, just like this example. Okay, just like this example. Now see here, what we'll be doing, fair value at the end of first year, we'll take that, we'll put it in the formula over here. Where is the formula? Here. Fair value of the option at the end of each year. So while calculating first year, I'll take this fair value. While calculating second year, I'll take this fair value. While calculating third year, I'll take this fair value. You understand the point? And while trying to make the payment on the excise date, when the employee excise the option on fourth year, which means this 2 years is the excise period, na? So employee excise the options over here. On that date also, I'll remeasure my liability, because on that date also fair value further increased, na? From 180 it has got increased to 220. So then also I'll do remeasurement. You understand what I'm trying to say? You will keep on remeasuring it because it's a liability for you. You understand the point? It's a liability. If fair value keeps on increasing, it means on the other hand, your liability is increasing. That is the logic. If your liability is increasing, you should have that much of money with you, na, to make the payment in cash to the employee. Whereas in equity settled plan, it was not a liability for us. It was just an obligation. But here you have to pay cash. For that, you need to have money with you. And therefore, we'll follow this. We'll do lots of remeasurements. First year, okay, fair value increased, remeasure. Second year, okay, based on the latest fair value. Third year, based on the latest fair value. During excise period, based on the latest fair value only. Remeasure your liability, that is SAR, and any loss or gain from remeasurement will be transferred to P&L. Okay. Fair value can go down as well. That also will do. Here it is 180. Here it can become 150 also. That also will do remeasurement. Because anyway, your liability right now has got reduced only now. So how much is my liability? That much cash is there for me. It's fine for me. Because anyway, I have to make to bank, right? The payment. Anyways. Are we done? And this remeasurement, what you do after vesting period. In case if this kind of situation happens where here you can see that clearly the fair value has got increased a lot, then that is absolute loss for the company. Sir, why it is loss for the company? Why is not an expenditure? It will be called as an expenditure provided if company gets any benefit in return. Here it is an expenditure because company gets benefit from the employee. Here it is an expenditure because company gets benefit from the employee. Here it is an expenditure because company gets benefit from the employee. Here it is a loss because company makes the expenditure but does not get any benefit in return from the employee because vesting period is over. Got the point? That's why I've written here loss for company as vesting period is over. I hope this is clear. Right. So therefore the formula is what used to be the usual formula for equity settled plans: number of employees into number of options per employee, of course number of employees at the end of the vesting period, into number of options per employee, into fair value of the option on the grant date. We used to take fair value of the option only on the grant date. Any other date we used to ignore. But here that's not the case. Fair value of the option at the end of each year into vesting period completed divided by total vesting period, of course, minus expenditure recognized in the previous years. Clear? Now, this is also another important point, Nana. If entity grants SAR, that is stock appreciation rights, which is already vested, which means there is no vesting period, instant, then entire expenditure will be fully recorded on the date of the grant itself, which means on the grant date itself. I'll rephrase the sentence: on grant date itself. On grant date itself. Okay. Subsequently, if there is any change in fair value, will be recorded as employee benefit expenses till actual date of exercise. You understand the point? So which means in some cases what happens, this vesting period will not be there. Okay. Year 0, immediately it will get vested, which means this is not there. But excise period will be there. Year 0, immediately company will say, "Arey, your options are vested. Okay, you can choose now. You can exercise now, or I'll give you a time of 2 years to exercise. So exercise period will be there. Vesting period will not be there. In that case, what you will do, immediately you will recognize the entire expenditure. After that, throughout the exercise period, you have to keep on remeasuring. Why? Because one employee will exercise today, Nana. Today, the market price will be 400, Nana. Your exercise price is, say, for example, 150, Nana. So the company has to make payment of cash of 250. 250 is the liability for the company. Correct? Hello? Right? This is today, year 0, when the options are vested. Because the options are immediately vested in this case, right? Yes, so somebody exercise the option, some employees will exercise the option, then this is the liability for the company. But if somebody exercise the option after 1 year, then suppose the market price is 450 at that time, then the liability is 300 right now for the company, because the market price has got increased by 50. So therefore you have to keep on remeasuring again, keep on increasing that liability. You understand what I'm trying to say? That is what the meaning of this sentence is. On the grant date itself, if the entity grants are which is immediately vested, I'm not using the right words here, which is already vested, which is immediately vested would be a better word. Okay, which is immediately vested. Okay, then what happens? Then expense will be fully recorded on the grant date itself. Subsequently, any change in fair value, that is because once market price increases, fair value also will change. It will be recorded as employee benefit expense till actual date of exercise. You'll be keeping on remeasuring. You'll be keeping on increasing. You understand the point? Such that because I have to pay more cash, na? If fair value increases, I have to pay more cash. So you will keep on doing subsequent remeasurement till the end of the exercise date. Till the end of the exercise date. Till the end of exercise date, or till the last date of exercise. Like that also you can write. I hope this is clear. Right? Done. This is also important, Anna. We do have sums based on this. Okay. Right. Okay. Let's look at the summary now with respect to SARS. In SAR, the company agrees to pay cash to the employee after the vesting period to the extent of market price over and above the excise price. Therefore, intrinsic value is nothing but market price minus excise price, which is nothing but cash paid to the employee, right? This is also called as intrinsic value of option on excise rate. Fine. Unlike ESOPs, SAR is a liability. ESOP is a obligation. Since the company has an obligation to pay cash, obligation to pay cash is referred as liability. Okay. Since SAR is a liability, it has to be remeasured each year. This is the important point. Remeasured each year, considering the fair value of the option at the end of each year. Okay. Therefore, what will be the entry? Very simple. Employee compensation to SBP reserve earlier, now SBP liability. Now, in some questions, what they will do, they'll call this employee compensation as employee benefit expenses. You understand the point? Both meaning the same, Nana. Employee compensation means employee is working for me, therefore I'm compensating for the work that employee is doing. Or employee is giving me benefits, therefore you can call it as expenses that I'm incurring because employee is giving me benefits. Me means company. Therefore it can also be called as employee benefit expenses. You understand the point? Whichever name used, chalta hai. Here I say in some problems they'll use employee compensation, in some problems they'll use employee benefit expenses. You got the point? Either way it's fine. Similarly, in some problems, they'll use to SBP liability. In some problems, they'll use to provision for SAR also. So every time it need not be SBP liability, but majorly we'll use SBP liability only. In some sums, they'll be using provision for SAR as well. Chalta hai. Okay. Then obviously this employee compensation or so-called employee benefit expenses will be transferred to P&L. So P&L will be debited every single year. But this is implied. So most of the times we'll not be writing this entry specifically. It is implied. We'll write employee compensation or employee benefit expenses. Within brackets, we'll write PRL. Got the point? Next. On payment of cash to the employee, that's obviously SBP liability will be debited because it will be having a credit balance created so far to bank account to the extent of cash that you will pay. Yes. If it is not sufficient, then we'll be taking the balance from P&L, just like what we have done here. Okay. That's a different thing. But mostly that need will not happen because every single year, anyway, you are trying to take the latest fair value only. So mostly you will be on par with your liability. Got it? Because you are keeping on doing remeasurement. So many remeasurements you are doing. Every single vesting period, you are taking the latest fair value at the end of the year. Plus, during the excess period also, you are doing remeasurement. So therefore, mostly that necessity will not be there. Clear? But if it is there, you have to get it from P&L only. That's obvious. Yes. where you have to pay more than the SBP liability, that kind of situations. Here, you have to pay 170 more than the SBP liability 120, na? That kind of situations I'm talking about, okay? You got it? Somebody was asking me that doubt. I hope that is clear. Right. While calculating option expense each year, we have to consider fair value of the option at the end of the each year. We know that. In case of any excess liability is created or SAR is not exercised, such excess liability shall be reversed by transferring to P&L account. That's it. Which means, say for example, liability is 170, you have to pay only 120. There is an excess liability over here. So in that cases, it will be transferred to what, Nana? P&L account. Got it? Yeah, because it's a liability, na. Therefore, it will be transferred back to P&L account. That is what he's trying to say. Because both the scenarios are possible. See, you have to pay 170, your liability is 120. In that case, you'll be getting from P&L only, na, balance. See, Nana, you have to pay 170. In your SBP liability, you have created so far, let's say 150. Then what you'll do, SBP liability, I have only 150 over here. To bank, I need to pay 170. So that 20 extra where you'll be getting from P&L only, you'll debit, you'll get 20. Similarly, suppose SBP liability is 150, but you have to make payment of 120 only. In that case, what you will do? That difference of 30, you will take it back to P&L only, na? Because here when there is a shortage, you are getting the money from P&L. So when there is excess, you should take it back to P&L only. Simple logic, na? It's fair. That's what he has written here. Okay? Got it? Sorry. Are we done with this? Chalo. Alright guys, let's move on to the next one. Now we'll be getting into ESOPs with cash alternative. Okay. I told you now at the beginning itself, there will be a mix of both. Okay. So this is where you have both. Okay. So you have the options of ESOPs as well as you have the option of SAR. Okay. Here, the first question that you have to ask yourself is, so there is a choice. Now, the choice is with whom? The choice of selecting whether I want ESOP or I want SAR is with the employee, or the choice of selecting whether I should give ESOP or I should give SAR is with the entity. Both the options are possible. You understand the point? The choice can be either with the employee or the choice can be with the entity. Mostly 90% the probability is that the choice will be given to the employee. Okay. But there are rare case scenarios where ESOPs with cash alternative, this kind of the choice will be with the entity as well. So I've written here, as you can see, choice with the entity, choice with the counterparty. Counterparty means obviously we are talking about the employees. Okay, right. So when the choice is with the counterparty, it can also be called as a compound financial instrument, because tomorrow in future the employees can choose whether they want ESOPs or they want what, Nana? SAR. Got the point? Hello everybody. So first, basic funda, did you understand? So when I say ESOPs with a cash alternative, it means either the choice can be with the employee or the choice can be with the entity. Now, 90% will see problems also only based upon this, where the choice of selecting whether they want ESOPs or SARs will be with the employee, okay, rather than the choice being with the company or the entity, okay. So therefore, our main focus will be on this. That doesn't mean that we'll be ignoring this also. We'll be covering this also as well, but this is more important, okay. And this can also be called as what, Nana? Compound financial instruments. Now, use your common sense and think for a moment. When you give two choices, one is ESOPs, the other one is SAR to the employee, where in case of ESOPs, you have to ultimately, you'll have an option to buy the share and stuff like that. Whereas in case of SAR, you're actually getting cash, right? Straight away cash. The difference between the so-called market price and the excise price, the intrinsic value is getting converted into cash, and straight away you're getting cash. So anybody with a common sense, if you think logically, everybody literally will prefer SARs only. So logically, everyone will prefer SARs over ESOPs. So companies will say, employee get to choose. Then why to give an option? Anyway, you can just go with SARs now. And that is not the case. Okay, see here. Generally, what will happen, because people prefer SARs, and there is no restriction with respect to SAR, because directly you are getting cash. But when it comes to ESOPs, it comes with a restriction. Sir, why ESOPs will have a restriction, sir? Simple logic, Nana. If I don't have a restriction, then people, after buying the shares, when all these so-called thousands of employees, once they start selling the shares in the market, that will hurt the company, right? All of a sudden, supply will increase and it will hurt the market, price of the companies. Therefore, whenever ESOPs are given to the employees, it comes with a restriction. There will be a lock-in period. Next 1 year, you can't sell. Next 2 years, you can't sell. Next 3 years, you can't sell. You understand the point? Therefore, whenever you are having such a kind of restriction, employee cannot get to enjoy the benefit immediately. So therefore, when you say you have 1000 SARs, where immediately I'll get the cash and employee will enjoy the benefit immediately, whereas the other option is you have 1000 ESOPs. You understand the point? 1000 SARs where you will enjoy the benefit immediately. 1000 ESOPs where there are restrictions, there is lock-in period, you have to wait for 1 year, 2 years or 3 years. After that only you can enjoy the benefit. Then what people will do? Everybody will go to SARs only. They'll choose this option. Nobody will go to what? ESOP option, right? And that is the reason they give more ESOPs when compared to SARs. Got the point? As you can see, either you get to choose 1300 ESOPs or 1000 SARs. Barabar. Now it is fair. It's a fair game. Because you have restrictions over here. Okay, I have to give you more ESOPs. Because you have no restriction over here, I'll give you lesser number of SARs eventually. Now, okay, barabar. Right. Because there is a restriction over here, the fair value of the ESOPs will be less than the fair value of the SAR. Naturally, definitely fair value of the SAR will be more because there is no restriction and you're directly getting the cash benefit, correct? Right? Here there is a restriction, therefore definitely its fair value on the grant date will be less when compared to SAR. Always fair value of the SAR will be high because no restrictions. Fair value of the ESOP will be less. Ye to clear hai? Now look at the total value of this. 1300 ESOPs into 30, 36,000. 1000 SARs into 32, 32,000, right? So still there is a difference of 4,000, correct? You always need to see who is the higher of these two. Higher of the above is 36,000, correct? Hello? Yes? Even though ESOPs is higher in value over here, still, now this is very important focus, still, we will do accounting as per SARs only. You understand the point? We will do accounting as per SARs only. But the problem is, sir, how can you do accounting as per SAR? Because as per SAR, the value is only 32,000. Whereas as per ESOP, the value is 36,000. Therefore, Ind AS has found a solution for that. What is the solution? Take difference of 4,000 and account it as ESOP, and the remaining you account it as SAR. So we'll take the difference of 4,000 and this 4,000 will be accounted as ESOP and the balance 32,000 will be accounted as SAR. Now you can ask me, sir, why should you do like that? Why? Because there is a high probability that given a choice, people will prefer SARs only. That is why in accounting also, you have to do accounting based on what you are expecting to happen in future. Now, what is your expectation to happen in future tomorrow? Most of the people will get to choose or will choose SARs. So when I expect most of these guys to choose SAR, then naturally I have to do accounting from SAR's perspective only. You understand what I'm trying to say? But suppose suddenly if suddenly something has happened and they went for ESOP option, then all of a sudden I will have an expenditure of 36,000, whereas I've created the liability only for 32,000. That is the reason what Ind AS says is that whichever is higher, you take that. ESOP is higher, okay. To the extent of that 4,000, you try to create a liability from the perspective of what? ESOPs. And the remaining 32,000, you will be accounting it as SARs to the extent of 1,000 options, which is 32,000 in value over here. Okay. Right now, you'll have a mixed bag of understanding. Don't worry. Just stay. Now see here. So what is the essence over here? You have to do higher number of the two above accounting and SAR accounting as well. If SAR is high, then just do SAR accounting. For example, this is 32,000. This is 36,000. Who is high over here? SAR is high. Tomorrow you are expecting majority of the employees will go for which option? SAR only. Then just do SAR accounting. That's all. Forget about ESOPs. But if ESOPs is high and SAR is less, then to the extent of difference, do the ESOP accounting. And for 32,000, do the SAR accounting. For 4,000, you do ESOP accounting. Got the point? But when SAR itself is high, then forget about ESOPs and do only SAR accounting. Clear? Now you might be having doubt. Sir, in future you do SAR accounting, sir. But in future, suddenly if everybody selects ESOPs, then what you will do? Because all the way you have done the accounting based on SAR only. Tomorrow in future, suddenly employees does not go with SAR option. They go with ESOPs option because they can go. Possibility is there. Even though the probability is 1% or mostly people will not choose. But what if they chooses? That we will see later. All those doubts, just keep it with you. Automatically it will get clarified. Okay. Am I clear? Okay, sir. So, sir, what you are trying to say is that calculate the value of both the options. If ESOP option is higher in value, then take the difference. To that extent of difference, you do the accounting from ESOP perspective. And for this 32,000 SAR, you do the accounting from SAR perspective only. However, suppose if SAR has got more value, let's say the value is 40,000, then forget about ESOPs and for this 40,000 straight away do SAR accounting only. Clear? This is what you will do, accounting. Okay. Now let us see what will happen in future when employee get to choose. See, Anna. Ready? Yeah? Okay. The employees will be given a choice to select either SAR or ESOPs after the vesting period. Okay. The plan will be accounted as under. Find out the fair value of the SAR on grant date, that is number of options into fair value of the option without restrictions, because SAR will not have any restrictions. Fair value of the equity obligation also you need to find, which is number of options into fair value of the option after restrictions. That is what we have done here. This is number of options. This is fair value of the option. We got these numbers now. That's what I'm saying here in step 1 and step 2. Clear? Right after that, you see, you take care of the equity component only if step 2 minus step 1 is positive. What is step 2? Fair value of equity obligation. That is this one. Fair value of equity obligation. What is step 1? Fair value of SAR obligation. That is this one. Only if fair value of equity obligation is greater than fair value of SAR obligation, then only equity component will come. Okay. Then only to the extent of difference, you will create what? Equity component, which means you will do accounting from the perspective of ESOPs. And for the balance 32,000 in this example, you will do accounting from SAR perspective only. Okay. The number of options in step 1 should be accounted as SARs and throughout the vesting period, and the equity component in step 3 will be accounted as ESOPs. Okay. After vesting date, now you have to wait. Okay. You have done everything from your side. Now you wait on the vesting date. What's going to happen? In either of the cases, whatever can happen, because there is a choice ultimately with the employees. Suppose if employee opts for cash, very happy, because that is what we are expecting to happen. Now employees will definitely prefer SARs, which means they'll opt for cash. In that case, anyway you have done accounting from SARs perspective only, na? So very easy. So there is a match. I have done the accounting from SARs perspective. Employee is also choosing SAR. Then very easy. Pay cash to the employee from SBP liability. The balance in SBP reserve will be transferred to retained earnings or general reserve. So whatever SBP liability is there, which you have already created, employee also has chosen that only, na? Pay. That's all. Finished. Are you able to understand? Then what I'll do with SBP liability, sorry, SBP reserve to the extent of 4,000 I've created, na sir, this difference. That what you will do, transfer it to retained earnings. Kale khatam, that's all. Very easy. So we are doing accounting from SAR's perspective, and if employee also chooses the SAR, very easy. You have the SBP liability, to bank, done. Whatever SBP reserve, that small amount will be there, na? That 4,000 in our example, take it to retained earnings or general reserve. That's all. Done. So this is very easy. This becomes funny. Suppose employee opts for share, for ESOP. Then it is a confused scenario. Just a second, guys. All right. If they choose the ESOPs, then it is a problematic scenario. Why? Because I've done all the accounting from SAR's perspective. Suddenly this Moku fellow is going for what? ESOPs. But if they choose for ESOPs to the extent of this much, I have only 4,000 in SBP reserve, correct? Because only to the extent of 4,000 only I've done accounting from the ESOPs perspective. Majority of the accounting in this example to the extent of 30,000 has been done from SAR's perspective, which means I have SBP liability. I don't have SBP reserve. I have what? Only SBP liability. I don't have SBP reserve. But all of a sudden this Mukku employees have chosen what? ESOP option. That is shares option and not cash option, right? But मेरे पास तो SBP liability है because I've done all the accounting from SAR's perspective. I did not expect this to happen, but it happened because they have a choice. They are saying that I wanted to give you Jalak, we give you Jalak, that's all. Then what I have to do, very simple. From SBP liability, you transfer it to SBP reserve. Because you'll have huge SBP liability because you have done the accounting from SBP liability perspective or SAR perspective or cash perspective, correct? Whatever the huge SBP liability that you have got, which you have created because you have done accounting from that perspective, transfer it to what? SBP reserve. Now your SBP reserve sounds big, right? What you will do, naturally from SBP reserve, you issue the shares, that's all. You got the point? To equity share capital, that's all. You'll issue the shares, there ends the matter. Are we done with this? So, the choice is very simple, Nana. The summary is very simple. You calculate the fair value of both the options, ESOPs as well as SARs. If ESOPs is more, in our example, like 36,000 and SAR is 32,000, to the extent of difference, create ESOP based accounting, which means SBP reserve you will create. And to the extent of 32,000, you continue with SAR based accounting, which means SBP liability you will create. This is one. Second, if SBP liability itself is high, instead of 32,000, it is 40,000 and your ESOPs is only 36,000, then fully do only SBP liability accounting or SAR based accounting, which means you'll have only SBP liability. Now come to end of the vesting period. Now employee get to choose both the options. Suppose they go with SAR. It's very easy for me because anyway they went with SAR. I also have done the accounting based on SAR. So what will I do? SBP liability I'll debit to bank, that's all. Whatever the small amount that I've got in SBP reserve will be transferred to retained earnings. Very easy. Very easy. But suddenly if employees want to give me Jalak and they chose what? ESOPs. They have chosen shares. मेरे पास तो SBP liability है, but these guys have chosen what? Shares or ESOPs. Then what I have to do? From SBP liability, transfer it to SBP reserve. Now you have SBP reserve. From there, issue shares to equity share capital. There ends the matter. SBP reserve will be debited. Clear? Yes. Right. That's it, Nana. So we are done it from whose perspective? Choice is with the counterparty. So when the choice is with the employees, 90% this is what will happen. What you have to do, we have already seen that. But now we also need to cover in case if the choice is with the entity. If the choice is with the entity, what you'll do? Very simple, Nana. Equity settled accounting treatment is done when there is no obligation to settle in cash. This is from entity's perspective. So if entity chooses, I'll go with equity settled, options. Then what you'll do? You have to create SBP reserve. Simple. If there is a present obligation to settle in cash, then treat it as cash settled. Then create SBP liability. If you have an obligation to pay in cash. Now you can ask me, sir, when will I know that there is an obligation to pay cash from company's perspective? Okay, very simple. There are certain clues. For example, entity cannot issue shares due to some restrictions. In that case, even though the choice is with the entity, even though entity wants to go for ESOPs, they can't go for ESOPs because they can't issue shares because of some restriction, some situation has created, government rule or whatever it is, we don't know, right? But there is a restriction. Therefore, you can't go with ESOPs, which means the only option is to go with cash, which means go with SAR based accounting. Very simple. Create SBP liability. Clear? Hello. Next. There is a stated policy to settle in cash. Because the choice is with the company, and we have a policy that I have to settle in cash. Then you go based on SAR accounting only. Why would you go for ESOP based accounting? Got the point? Simple. And past policy or history of the company is such that in these kind of situations, we will always settle in cash. Whenever there is a choice with the company to go with either ESOPs or SAR, company always chooses SAR. Let us pay them cash. In that case, you do cash based accounting only, which means you'll go with SBP liability creation only and not SBP reserve. Simple. So in these kind of situations, automatically, it will be considered that the obligation for the company is to settle in cash, and therefore automatically it will be treated as cash settle, which means you'll go for SBP liability creation. Clear? Next, if equity settled accounting has been done but settlement needs to be done in cash, then what you have to do? Which means initially you thought that, because the choice is with the company only, initially you thought that you will give them ESOPs. So the accounting also has been done based on ESOPs, which means you have created SBP reserve. But now all of a sudden, because of some other scenario, you have decided to settle in cash. You understand the point? Then what you will do as a company? Very simple. SBP reserve to bank. You got the point? Hello? Why SBP reserve? Because you have done accounting based on equity, Nana. So you will have SBP reserve only. You will not have SBP liability. But now you have to settle in cash. So straight away, whatever the SBP liability, reserve that you have got, debit that credit balance debited, it becomes zero. To bank, there ends the matter. That's all, because you have to make cash payment. Simple. Sometimes what will happen, whatever the SBP reserve that you have got is not sufficient. More than that, you'll be paying cash. In that case, the balance, you will get it from P&L. That's all. Are we done with this? I gave an example over here. You have done the equity settled accounting, therefore SBP reserve is there, 10 lakhs, but you have to make payment in cash all of a sudden because the choice is with the entity, they can change, okay? So they wanted to pay 13 lakhs, but you have got 10 lakhs only over here. So debit to the extent of 10 lakhs, but you have to make payment of 13 lakhs. Where I'll get this balance 3 lakhs? From the P&L only, simple. Are we done with this? But 90% of the cases, you will not see it from the perspective of the entity, Nana. Okay. Choice is with the entity, 90% it will not happen. But even if it happens, this is how you have to do. Okay. So again, I will revise. When there is equity settled accounting treatment is done, when there is no obligation to settle in cash. So because the choice is with the company only, na? If company has got no obligation to settle in cash, they will do equities based accounting. In the sense, they'll create SBP reserve, simple. If there is obligation to settle cash, they'll create SBP liability. When there will be obligation to settle cash in these three cases. Clear? Suppose they have done equity based accounting. Suddenly there is an obligation to settle cash. Very simple. Because you have done equity based accounting, you will have SBP reserve. Now you have to pay cash. So to bank, SBP reserve you debit, to bank. If that is not sufficient, bring the money from P&L. Entry will be like this. I gave you the example as well. Are we done with this? Right, Nana. As I told you, group settled plans concept we'll see later. I hope till here it's clear. You revise this fully mandatorily and then come for the next session because we'll be solving sums. I hope this is clear. Everybody? Yes? Chalo. Right, Nana. Hi, guys. Yeah, welcome to PK classes. This is CA Prasanna Kumar over here. And in this session, we'll be revising Ind AS 23 borrowing cost. Okay. So I hope all you guys have my handwritten power notes. Okay. If you guys have it, it's okay. Otherwise, I'll put the link in the description. You can just go to my website caprasannakumar.com, and from there in the free downloads column, you can download this particular marathon revision, power notes. Now, anyways, you guys are ready? Chalo. So we'll start with the borrowing cost over here. So first basic thing we need to understand is what is borrowing cost. Pretty simple. You take a loan. On that loan, you pay interest. Straight away, we can say interest as borrowing cost. Yes, with a little bit of a twist. So what is that particular twist? Generally, see, when I say loan, it is not just normal loan. You can also raise money by the form of debentures and stuff like that, right? So when you go for debentures, say for example, 8% debentures or 10% debentures, right? Whatever that 8% and 10% that you find on the debentures, we generally call it as a coupon rate, right? So can I say that so-called 8% and 10% coupon rate as the borrowing cost with respect to that particular debentures? Isn't it? Can I say that? Yes, unless there is no other twist or turns. For example, sometimes that coupon rate itself cannot be called as a borrowing cost. There is something called effective interest rate, which includes the interest, whatever the rate that you are paying, also the discount. Sometimes you will issue at discount, you'll issue debentures at discount, and you'll also redeem it at premium. So when you try to issue the debenture, say for example 100 is the face value of debenture, right? You will issue it at 90 only. So even though you'll be paying that coupon rate on 100, actually you've got only 90 rupees. So which means your actual interest is much more than what you're paying as a percentage, right? That is what we call it as a effective interest rate. So that will also come under borrowing cost. Not only that, exchange loss to some extent, whenever you try to borrow the loan from a foreign bank in foreign currency, not only the interest is what you'll be paying, up and above that, whenever your currency depreciates, when Indian rupee depreciates and the foreign currency relatively appreciates, then you will be having exchange loss as well. Sir, entire exchange loss will be considered as a borrowing cost? No, only to some extent. Sir, how much, sir? We'll see that later. Sir, what about effective interest rate in detail, sir? Right now, did you get the basic idea? That's enough. In detail, we'll see it with the help of an example number as well. So all these things put together, apart from the normal interest that you pay, if you have just got the loan, okay, we call it as borrowing cost. Clear? So borrowing cost is not as simple as what you'll be thinking. It is just the interest that we pay on a loan that we have taken. It's not that simple. It has got some twist as well. What is the twist? We have seen it. Basic idea we have seen. We have not seen it in depth. Later, we'll see one by one. Got it? Moving on. Okay, so what we need to do with this borrowing cost? Very simple. If that is incurred on qualifying asset, we will capitalize the borrowing cost. That is, we'll take it into the balance sheet and add it to the cost of the asset. In case if the borrowing cost is not incurred on qualifying asset, we'll just put it in P&L account. We'll expense it. Okay. Now the question is, What is a qualifying asset? Because whether you will capitalize the borrowing cost or you will take it to P&L account depends upon whether it is incurred on qualifying asset or whether it's not incurred on qualifying asset, correct? So in that case, this particular treatment of the borrowing cost purely depends upon the qualifying asset. So we should be able to understand what is a qualifying asset, correct? Quite a bit simple. Qualifying asset means any asset that takes substantial period of time to get it ready for its intended use or sale. Intended use means what is the intention to use it from the perspective of the management, that particular company, that particular management. That is what we call intended use. So intended use can be different for you, can be different for me. You understand the point? For example, company A suppose buys a car. Now the moment the tar is bought, according to company A, they want to use it as it is. In that case, what is the intended use for tar? The moment they buy it, immediately they are able to use it. You got the point? Whereas some other company, they buy the tar, but then they start modifying everything. They modify the tires, they modify the chassis, they modify, say for example, the entire exhaust system. You understand the point? They do a lot of modifications. That will take 6 months of time to arrive the parts from different parts of the world. You understand the point? Now in this case, the intended use for that particular management to buy that particular product, which is a tar, is different. You understand the point? So therefore this word is very important. So when I say qualifying asset, anything that takes substantial period of time for its intended use by the management or sale. Sometimes they'll try to sell it. You understand the point? There is no rule that once they try to buy an asset, they have to use it for sure. They can sell it also. You understand the point? But the keyword here is that particular asset must take substantial period of time. Now the question is, what do you mean by substantial period of time, sir? Long period of time. What do you mean by long period of time? Your Ind AS does not say anything. It says apply judgment. Sir, can I say that more than 12 months is substantial period of time? Unfortunately, that's a general understanding, but Ind AS doesn't say anything. So therefore, there are cases where 3 months is also regarded as substantial period of time. So that management has to decide. 4 months are also regarded as substantial period of time. So it all depends upon the question. Sometimes if the question is silent, we'll presume it to be substantial period of time. If question is not silent, if question says specifically that this is a qualifying asset, even though that period of time is 6 months or 4 months or 3 months, then you just follow the question. Okay, you don't question the question saying that no, substantial period of time means it has to be a long time, it has to be at least 1 year or something like that, blah blah blah. Nothing is necessary. Question is saying even though it is 3 months or 4 months, if question says it is a substantial period of time, it is substantial period of time. Just follow the question. If question is silent, then you presume that it is substantial period of time. You got the point? Chalo. Now, what about example? Manufacturing plants. Is it an example of qualifying asset? Yes, to manufacture a plant, it takes substantial period of time, years altogether. Power generation facilities, that is also a plant basically. It also takes substantial period of time. Intangible asset, of course. You want to develop a particular intangible asset, a patent or something like that. Yes, you have to really struggle hard. There will be something called research and development phase, isn't it? After that, you have to see sometimes there are certain drugs in your pharmaceutical companies where to develop that, okay, the know-how of that particular drug is an intangible asset. It might take 10 years also. You understand the point? Right. So therefore, yes, that is a qualifying asset. Next, investment properties, of course, to build something, you know, the building, or you have taken a land and then you are trying to put the roads and stuff like that, and trying to divide that land into multiple, plots, and then eventually you are planning to sell after 2 years. This is a qualifying asset. Bearer plants, yes. Say for example, vineyard, where you have all those plants having those you know having those grapes, and then eventually you try to convert that into what uh, decent kind of a wine by crushing the grapes and stuff like that, and then eventually it takes substantial period of time. Okay, that vineyard also initially takes substantial period of time to grow. Similarly, mango plants and all those things, it takes substantial period of time for the plant to grow and eventually give you mangoes, right? And once it starts giving mangoes, you will only cut the mangoes. You will not do anything to the plant, just like a mission. So it's a natural mission. That plant stays like that, correct? Okay, those are called bearer plants. Now, anyway, so all these are examples for qualifying asset. Now the next question is, okay, why borrowing cost related to the qualifying asset should be capitalized? That is a basic question. Okay, everything is fine. You said that any borrowing cost that you incur with respect to qualifying asset, it has to be capitalized, which means it has to be added to the cost of the asset. Whereas if any borrowing cost is incurred on something other than the qualifying asset, then it should be expensed out in P&L account. That's what you said. Now the question is why. Well, the answer is very simple. It is matching concept. Any expenditure incurred should be matched with the corresponding benefit from that particular expenditure that you have incurred. You understand the point? For example, say for example, you have done sales. First of all, you would have incurred some cost like cost of goods sold to manufacture that particular product, and eventually you will sell it. So therefore, the cost that you have incurred should be matched with the revenue, right? The logic goes like that only. So therefore, even when you try to construct a qualifying asset, still that asset did not start giving you benefit. Say for example, you're building a building, right? Okay, you're constructing a building. Now the building is getting ready, right? Still it is not giving you any benefit. So therefore you keep on pumping money. So which means you are incurring expenditure, but that you are bringing money by way of loan, and that on that loan you are paying interest. So that borrowing cost is also expenditure indirectly you're incurring on constructing this particular building. You understand the point? Till that particular building gives you benefit, all this cost has to be added to the cost of the asset. It doesn't make any sense in expensing out in P&L. Why? Because if you put that interest with respect to a building that is under construction in the P&L account, it means that from that building corresponding benefit should be coming for you. Only then the concept will match. The matching concept will satisfy. So I have an expenditure that I'm debiting in P&L account and I'm getting benefit from that particular asset. On which asset I'm incurring expenditure. Now you're incurring this so-called interest, that is borrowing cost, on this particular building that you're constructing, and you're not getting any benefit from that particular building. Then how can you debit that expenditure? So it doesn't make any sense, right? So therefore you add it to the cost of the asset. So that's one logic. Another logic also I'll explain. Right now this is one logic, matching concept. Okay, let us look at this case. Instances or situations where you cannot capitalize your interest, that is, you cannot capitalize your borrowing cost. What is that? Let's try to understand. Now, we have already discussed that borrowing cost that you have incurred for a qualifying asset only will be capitalized, and qualifying asset will be called as a qualifying asset only when it is when it takes substantial period of time. For example, here you have taken a loan of 1 lakh at 10%. You have purchased a plant and machinery which is ready to use, which means the moment you purchase it is ready to use. In that case, where it is taking substantial period of time, so in that case it is not a qualifying asset. In that case, you cannot capitalize this borrowing cost. So interest will be transferred to P&L. Why? Because you can immediately use this machine, which means you get the benefit out of that machine. Following the matching concept, whatever the interest that you incur is kind of expenditure with respect to that particular machine which you have purchased. It has to be debited in the P&L. Now interest will be transferred to P&L as you have enjoyed benefit in current year. So interest will be debited in the current year only for that particular machine. Now suppose with respect to the same machine which you have purchased this plant and machinery. It is ready for use. It is ready for use, but you did not use it. You got the point? You kept it idle. So because you kept it idle, now applying the logic, okay, you're saying that no, see, Ind AS, I've kept it idle. I'm not getting any benefit from that. So therefore, because there is no benefit I'm getting from this particular machine because I'm not using it. Therefore, the matching concept will not work. So you cannot debit the interest. Therefore, it should be capitalized. Can you say like that? No. Why? So then you'll be misusing, right? So why? Because once asset is ready for use, irrespective of whether you use it or not, interest cannot be capitalized as it is your mistake of not using it. You understand the point? Also, the other logic goes like this. If you don't have a plan of using a particular plant and machinery, when the moment itself you buy it is ready for use, then why did you buy it? You understand the point? The question is that why did you buy it when you have no intention of using it? So it is wrong from your side. Therefore, for your mistake, standard will not allow you to what? Keep on capitalizing the borrowing cost even though you have purchased the machine and it is ready for use, but you are not able to use it. Got it? Another logic is, if you don't plan to use, why did you buy the asset in the first place? You could have purchased it next year, isn't it? So therefore, you paid interest unnecessarily. So therefore, Ind AS will not allow you to capitalize. You just put it in the P&L account and you face the expense. That's all. Right? Are we done with this? So these are all the instances where you cannot capitalize the interest. Now, let's look at some situations or instances where you can capitalize the borrowing cost. Say for example, you have taken the same amount of loan, 1 lakh at 10% per annum interest. In the year, let's say this is balance sheet, year is 2000, you are constructing a building. WAP means work in progress, okay. 60,000 is the expenditure that you have kept so far and it will take further 2 years to finish, which means substantial period of time, qualifying asset. Now, how much is the interest you are paying on this 1 lakh? 10,000 for this particular year. Can you capitalize this 10,000? Yes, you can. Why? Because it is a qualifying asset as it is taking substantial period of time to get it for its intended use by the management or sale. Okay. Now it becomes 70,000. Now let's go to next year. It will take 2 years to finish. Now 1 year is done. Moving on to next year. So here you will debit interest, right? You make the payment. So to bank 10,000. Now, coming on to the next year, already your WIP asset is 70,000. It is showing 70,000 in the balance sheet. Let's say you have further incurred some cost to build interiors and stuff like that with respect to that particular building, and that for that you have incurred 40,000. You have added that as well. In the next year also, you have incurred interest cost for the year 2, which is 10,000. And total building cost right now is 1,20,000. After this 1,20,000, the building is ready for use. Now, once it is ready for use, hereafter, third year also, can I capitalize the borrowing cost? Can I add the interest to the cost of the asset over here? No. After 2 years, you should stop capitalizing the borrowing cost, that is interest in this case, because building is ready for use. If you say even after that I'll capitalize, it means that you're saying I'm still incurring construction cost even after the construction is completed. So it is illogical and stupid, right? So therefore you should not do it. Got it? I hope this is clear. Moving on to next one. Now let's look at case 3, third example. I told you one logic was, matching concept, why you have to, capitalize the borrowing cost with respect to a qualifying asset which is getting constructed, right? I told you that I'll explain you other logic later. Now I'm going to explain you that. Now look at this other side of the logic. All right, guys. So if you look at this particular example, let's say somebody is building, okay, not us, some third party. For material, he has incurred so much labor, depreciation on plant and machinery, overheads, interest cost on borrowed funds, design cost, interior cost, total cost of that building is 50 lakhs. He has put his profit margin as 30 lakhs and selling price is 80 lakhs. With 80 lakhs, you have purchased the building. Now tell me one thing, if you bought the building, then obviously you'll be putting up this entry, asset account debit, so obviously it's an asset. To bank, you have made the payment. Now in this 80 lakhs which you have made the payment to buy this particular building, this 3 lakhs is included na? In the asset you have purchased. Borrowing cost of previous owner has already been included. So which means if somebody else builds a building, borrowing cost is also one of the costs that he has incurred, and definitely he'll be adding that. Above that he'll have a profit margin, and then only he'll sell it in the market. So therefore, if I construct a building, I'll also be selling in the market. Let's say I'm his competitor, then I'll also sell the building in the same marketplace, correct? Which means logically speaking, I should also be adding all the costs that I've incurred, in which one of the cost is the interest that I have incurred on the loan that I've taken, which is nothing but borrowing cost, correct? That also should be added to the cost of the asset. Then only it's fair play, right? So that way also the logic works, okay? Anyways, so therefore, even if I construct building on my own, whatever the borrowing cost that I incur, it has to be what? Added to the cost of the asset. In other words, capitalized. So that logic also works. This is other side of the game, right? Are we done with this? So try to understand things logically. Therefore, automatically it will be remembered for a longer period of time. It works that way. Moving on. Okay. Now, let's link the connection between borrowing cost and qualifying asset. We know that the borrowing cost that you have incurred on the qualifying asset should be capitalized. Is it that plain? Plain and simple? Okay, borrowing cost incurred on the qualifying asset, immediately it will be allowed to be capitalized. No, there are little bit twists and turns in that. Let's try to understand that. Borrowing cost that are directly attributable, not to the qualifying asset, directly attributable to the acquisition, construction and production of qualifying asset are included in the cost of the asset, that will be capitalized. So these three words are the link between borrowing cost as well as qualifying asset. Straight away, whatever the borrowing cost that you have incurred on the qualifying asset will not be capitalized. The borrowing costs which are directly attributable to three magic words. What are the three magic words? Acquisition, which means you have purchased the qualifying asset. Construction, which means you are building that particular qualifying asset. Third one is production. Production means sometimes it's a kind of goods which will take substantial period of time to get ready. Wine, for example, whiskey, for example. You get the point. So that will also come under picture. Included in the cost of the asset must be capitalized. That's why I've put here vineyard. So now you can ask me, sir, purchase acquisition, the moment you purchase, the asset will be immediately ready for sale, sir. No. What did I say? For its intended use by the management. Many a times the intended use will include modification. So it will take substantial period of time before the asset is ready for use, for the intended use by the management. That is one logic. The second logic is, sometimes you will buy this asset from some other country, Nana. By the time it undergoes all the shipment and stuff like that through the ocean and stuff, by the time you receive it, it will take substantial period of time. You get the point? You would have made payment earlier. For that, you would have taken loan and you did not get the asset. So you are not enjoying the benefit. Therefore, all the borrowing costs that you have incurred on that particular loan that you have taken to buy that particular asset, which is taking years to come to you because you have purchased that from some foreign country. You understand the point? That has to be capitalized. Clear? Now, So therefore, this is the keyword. These three words are very important. And borrowing costs that are directly attributable to acquisition, construction, and production of the qualifying asset will be allowed to be capitalized. All other borrowing costs will be expensed out. Correct? Also, this capitalization you can do when these two conditions are also satisfied. These two are basic conditions for an asset, Nana. Okay. One is that asset should be capable of yielding future economic benefits. The other one is the borrowing cost also you should be able to measure it reliably. Very simple basic points. Okay. Now, finally, there are two words that are important from this whole thing that we have discussed. One is borrowing cost, the other one is qualifying asset. Now, let's try to dig deeper and let's try to understand. Qualifying asset, we already know, which takes substantial period of time for its intended use or sale. These are all the keywords which we have already seen. Now, let's try to learn certain important things here. What are they? Acquisition, construction, and production of a qualifying asset. Acquisition means what? Purchase. Purchase means, say for example, you buy from Germany, it takes 6 months to come, so it is a qualifying asset. It takes a lot of time for delivery and installation. So all this put together, it's a substantial period of time. So therefore, it's a qualifying asset, right? Next. Substantial period of time is not defined as per Ind AS 23. This we have already seen. It will be based on the judgment of the entity. If in the question is silent, then we'll assume that the asset is taking substantial period of time to get ready. Or sometimes in the question he'll say 3 months, 6 months and stuff like that. And immediately he'll say that it is the management considers this 3 months as substantial period of time. Then what you'll do? Whatever question says, yes, Jindabad, you say that and then you follow the question. There ends the matter. Are we done? So qualifying asset is finished. The next one that we want to see is borrowing cost. So what is the actual definition of borrowing cost as per this particular Ind AS? It means cost incurred for borrowing the funds. Okay, not repayment of the funds, borrowing the funds. Okay, when you try to get the funds, raise the money through funds. Okay, including interest cost, not just normal interest cost, effective interest rate. What is that? We'll see here with this example. Amortization of discount premium on borrowings. Okay, exchange difference on foreign currency borrowing to some extent. What is that also? We'll see later. Just wait. Which are regarded as adjustment to interest cost. Fine. All these things comes under borrowing cost. This we have already seen at the beginning itself. Finance charges in case of lease also will come under borrowing cost. For example, you have got crane or dockyard leased. You are constructing a ship and you have got a crane or dockyard to help the process of constructing the ship, and that crane or dockyard you got it in the form of a lease. You understand the point? Then the lease payment what you're doing also comes under borrowing cost. That is the logic. That finance charges. Okay. Right. Are we done with this? Now moving on. Let's try to understand first this one. What is this? Interest cost. It is not just normal interest cost. In some cases, it is called as effective interest rate. That effective interest rate will be considered as borrowing cost, which will be capitalized. Now the question is, what is that effective interest rate? Let's try to take case one and let's try to understand this. Ready? Alright, Nana, we'll take this example and we'll try to understand effective interest rate. Loan that you have taken is 10 lakhs, okay, and 10% interest. Processing fee is 50,000. So this is what it makes this particular example difficult. If there is no processing fee, then your inflow would have been 10 lakhs today and your borrowing cost would have been simple 10% interest, which is 1 lakh, 1 lakh, and the problem would have been very simple. We will not have this concept called EIR. Now, this complication arises because of the processing fee. Because of the processing fee, you're not getting 10 lakhs inflow, rather you're getting only 9,50,000 inflow. Of course, you're paying 10% interest on 10 lakhs, even though you've got only 9,50,000 today. Got the point? You got it? So therefore, now see here. Whatever, these are all outflows, right? Interest payments, first year ending, second year ending, third year ending. Okay, let's say the interest is for 3 years and after that you're repaying the principal as well. That is 10 lakhs over here at the end of third year. Now, all these cash outflows, if you try to discount it at a particular rate, what is that rate? I don't know. You don't know right now. But some rate such that after discounting, the present value of this so-called cash outflows must be is exactly equals to the this so-called inflow which you have received on year 0. You understand the point? Which means this inflow only, na? Because it is today, its present value also will be 9,50,000. Today 1 rupee is equal to 1 rupee. So therefore, present value of cash inflow, which is 9,50,000, should be equals to, once you discount these outflows at a particular rate, after that, the discounted cash outflow should be equals to 9,50,000 such that effectively it should become 0. That particular rate is nothing but IRR. This is what we have learned. But exactly it is not IRR concept, because here we are talking about outflow getting discounted to match it with inflow. In IRR, we'll be discounting the inflows to match it with the outflow at the beginning. Correct? So it is not exactly the same. But why did I take this particular name is because so that you can connect more with your CA Inter or CMA Inter FM, right? Financial management, right? But here it is cost. That's why we will not be calling it as IRR. We'll be calling it as effective interest rate. Now the question is how to calculate this. Okay, how to calculate that so-called rate at which you will be discounting all these outflows such that after discounting it should be exactly equal to 9,50,000. Once it is exactly equals to 9,50,000, that particular rate is nothing but your actual interest that you are paying. That is your real interest rate, not this dabba interest rate, which is 10% over here. That's a fake interest rate. In reality, you're not paying 10%. You are paying much more than 10% because you did not get 10 lakhs. You have got 9,50,000, which is less than the 10 lakhs. You understand the point? Right now. So how to calculate this? The only method that is possible for us is trial and error method. So which means just imagine. Definitely your borrowing cost is more than 10% because you have got less inflow, correct? And you're paying 10% not on 9,50,000 but on 10 lakhs. So therefore, it should be something more than 10%. Initially, let's try with 11%. Presume that the rate is 11%, 1 divided by 1 plus r, 1 divided by 1.11 and discount this and this. Okay, and bring it down to year 0. See whether it matches with 9,50,000. I discounted that because all the cash outflows are same, na? So it is annuity. Therefore, you can just take one cash outflow, you take cumulative discount rate and you multiply with that. You can call it as cumulative discount rate or present value annuity factor. Both are nothing but same. So discount rate of first year, second year, third year, you just add it. 1 divided by 1.11 plus equals to grand total. Got the point? Now, once you do that, you get this particular cumulative discount rate, you multiply with 1 lakh and you're also repaying the principal. Na? So take that principal, you're repaying that after 3 years. So third year discount rate, you multiply with that and you get your present value of cash flows. At 11%, it is 9,75,470. So is it matching with 9,50,000? No. Now you take higher interest rate and see whether it works out. Is it matching? Yes, almost near, but still it is not working out. It is 9,51,000. You go with further higher interest rate, but this time I'm just going with 0.5% up. 12.5% discounted. Did you get it? Yes, 9,40,430. Which means this is not my answer because this is not exactly 9,50,000. But I know that my answer is in between these two, 9,51,980 and 9,40,000, because my 9,50,000 is in between 9,51,980 and 9,40,430. Correct? Which means my answer should be in between 12% and 12.5%. Now you apply interpolation technique, which you have applied in your CA Inter. So at 12%, this is what your value. At 12.5%, this is what your value, which means for a change in 0.5%, the change here is 11,550. But do I need that change? No. I want this 9,51,980 to become 9,50,000, which means I need a change of 1,980. 1,980, it should reduce. That's all. So for 1,980 reduction, how much should be the increase in percentage? So you do the cross multiplication, 0.5% into 1980 divided by 11,550. You get 0.09%. You add it to 12% because the discount has to be increased. Na? Finally, your answer is 12.09%. This 12.09% is borrowing cost as per Ind AS 23, not 10%. I told you it's much more than that, right? So this 12.9%. You got the point? So this 12.9% is the effective interest rate. I hope this is clear. Nana, this is revision session, Nana. Therefore, we cannot be spending too much of time and then get into the details of calculation. I can't do that because there is no time. Okay. Okay, you can just revise it. Anyway, this video will be on the YouTube, so you can revise it and watch it multiple times so that you'll be able to get some sort of an idea. Are we done with this? Now let's move on. These things I'll not be looking at right now because it's a revision session. Okay, let's move on. Okay, now that let's come back to the definition over here. Now we have understood what is this EIR, effective interest rate. Okay, the next thing that we need to understand is exchange difference on foreign currency borrowing. Also, to some extent, that exchange loss which you bear will be considered as borrowing cost. Now let's try to understand this one. Chalo. Understanding the concept of exchange loss as borrowing cost. How does it work? Now listen carefully. I'll be going with example and I want you guys to focus and understand it in the first go itself. Ready? Alright guys. Now let's say Mr. PK goes to the local bank, that is Axis Bank, and says that I need loan for construction. Of course, it's a qualifying asset. Then only there is a topic of discussion of borrowing cost getting capitalized, correct? But this local bank says, yes, the interest is 10%. Mr. PK feels that, yeah, tad bit it is high. So I'll try to find an alternative. He goes to a Europe bank and he gets the same loan at 4% interest, much less than 10%. That is the only reason why you'll go for foreign currency borrowing. Otherwise, why would you go to foreign bank and then get the borrowing? It doesn't make any sense. Now, the dollar rate today is 40 rupees. In that case, this 40 lakhs can be converted into $100,000. For ease of understanding, we have these numbers, okay? It's easy to understand. Now, Year 1 ending, you'll be paying interest, correct? But the dollar rate will not remain the same because of exchange rate fluctuations. So $1 has now become 45, which means logically speaking, you should have paid $1 lakh or $100,000 into 4% into $40 only, right? But you're actually paying $45. Despite this exchange rate fluctuation, still you're paying only 1,80,000, and eventually this 1,80,000 will be capitalized. There is no doubt in that. Suppose you would have taken this 10% loan over here on 40 lakhs, you would have paid 4 lakhs. Despite the exchange loss, still you are paying much less when compared to what otherwise you would have paid in the Indian bank. Had you borrowed from the Indian bank, you would have paid 4 lakhs as interest, correct? But now you're paying much less than that, so no worries. It's still a good deal. And we also know that all monetary items at the end of the year should be restated at the closing exchange rate. So that's a rule which we need to follow. So therefore, exchange loss on remeasurement is equal to, at the end of the year, you should remeasure it always, whatever the foreign currency things that you have done, right? Now, how much is the loan that you have got? $100,000 into, when you got the loan, the exchange rate was 40 rupees per dollar, but now it is 45 rupees per dollar, which means you have lost 5 rupees per dollar. So 5 rupees per dollar into $100,000, you have lost how much? 5 lakhs. According to the borrowing cost definition, what did we see? Exchange loss to some extent will be allowed as borrowing cost, correct? What was the exchange loss that we have faced here? 5 lakhs. Now, to some extent, not the entire 5 lakhs, but some amount of this 5 lakhs will be allowed to be capitalized as the borrowing cost. Now, how much is the biggest question? Very simple, Nana. Tell me one thing. If at all you would have borrowed loan from India, you would have paid how much of loan? I mean, how much of interest? 4 lakhs, correct? How did I get this 4 lakhs? 40 lakhs into 10%, correct? Hello? Yes. Now, because you have borrowed from European bank, how much you have paid? 1,80,000. Still, there is a difference of how much, Nana, here? 4 lakhs and 1,80,000. 2,20,000 is your savings. So what the standard says, see, had you borrowed from the Indian bank, you would have paid 4 lakhs of interest. Therefore, even though you have borrowed from the foreign, even though you have borrowed from the foreign bank, to the extent of 4 lakhs, we will allow you to capitalize, because that's what you would have done had you borrowed from India, right? So therefore, to the extent of 4 lakhs, we will allow you to capitalize the borrowing cost, even though it's an exchange loss. You understand the point? Now, how much you have capitalized this particular year? 1,80,000 only. How much you are allowed to capitalize to the extent of 4 lakhs if there is exchange loss? You understand the point? So therefore, how much is the difference? 2,20,000. What is the exchange loss? 5 lakhs. Can I capitalize the entire 5 lakhs? No, 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 no. To that extent only you can capitalize. What is that? 2,20,000. So divide this 5 lakhs into 2,20,000 and 2,80,000. Why 2,20,000? Because if at all you would have borrowed in Indian currency, you would have paid an interest of 4 lakhs. Because you have borrowed in foreign currency, you have paid actually interest of 1,80,000. Therefore, this much you have saved. You understand the point? Because of foreign borrowing. If at all you would have taken Indian borrowing, you would have paid anyway 4 lakhs, but now you are paying only 1,80,000. So to the extent of 4 lakhs, we will treat it as a borrowing cost, which means this difference between these two, 2,20,000, will be treated as deemed borrowing cost, even though in reality it is exchange loss. Now see here, what is this 1,80,000? This much already capitalized. So balance 2,20,000, even though it is exchange loss, it is allowed to be capitalized as per Ind AS 23. What is this 4 lakhs? You would have capitalized this much interest provided if PK has taken loan from Axis Bank in India, correct? Yes. Now you are capitalizing only 1,80,000. So Ind AS tells you that to the extent of 4 lakhs, which otherwise it would have been the interest payment, because that much you would have capitalized, had you taken the loan from India. If PK would have taken loan from India, he would have capitalized 4 lakhs. Now you are capitalizing only 1,80,000. Why? Because you have taken from foreign bank. So to the extent of 4 lakhs, we will allow. So extra 2,20,000 you can capitalize now. However, provided if there is foreign exchange loss, if there is foreign exchange gain, we will not allow. Only if there is foreign exchange loss, then we will allow. Clear? The balance will be considered as exchange loss only. It goes to P&L, but this exchange loss will be considered as deemed borrowing cost. Even though it's not borrowing cost, we'll deem it to be the borrowing cost, and that will be added to the cost of the asset. Got the point? Hello, everybody. Alright guys, so now I hope the concept is very clear. So whenever But while we are solving sums, we have to follow specific steps because there will be a lot of complications while doing sums. So if you don't follow some rules, the probability of you doing mistake in the exam will be very, very high. So this initial example, what I've told you, is only to make you understand the concept clearly. What is the logic behind that? Why, to some extent, exchange loss is allowed to be capitalized as borrowing cost by the standard. That logic only I've made you understand, right? I hope this is clear. So if at all you would have taken loan from India, you would have paid 4 lakhs interest. Now you are paying only 1,80,000. So to the extent of this difference of 2,20,000, you can capitalize the borrowing cost. However, the condition is you should have exchange loss. If there is exchange gain, this will not be allowed. You understand the point? Only if there is exchange loss, then the maximum ceiling limit is 4 lakhs, which is nothing but what you would have paid as interest if at all you would have taken loan from the Indian bank. And that interest you would have capitalized it because it's a qualifying asset, correct? Right. So this logic is done. Now let us see how you need to present this when it comes to examination. Now this doesn't work in all the problems, Nana, because there will be a lot of twists and turns. Okay, it's better if we follow rules and regulations. Okay, how to present it in the examination? Very simple. Follow these 5 steps. Step 1, interest cost on local borrowing, which is nothing but functional currency. Okay, right. So how much? $100,000, you convert that into local currency into 40 rupees, we'll have 40 lakhs. 40 lakhs into 10%, 4 lakhs. That is the interest in local currency, correct? Actual interest that you paid on the foreign currency, 1,80,000, which is nothing but $100,000 into, here you have the percentage now, 4%, right? Into 45 rupees per dollar, because you pay it at the end of the year, right? That is 1,80,000. Okay. Exchange loss is how much? 5 lakhs. Here we have calculated 5 lakhs. So total loan into difference in the exchange rate between the day you have taken the loan and at the end of the year. Clear? Next. Step 4. Out of the exchange loss, the lower of the following is treated as deemed borrowing cost. What is the lower of the following? The difference between the interest that you would have paid on local currency and the interest that you are actually paying on foreign currency. This difference, which is 2,20,000. I told you, just because this difference is there, you will not be allowed to capitalize this as borrowing cost. If you need to also have what? Exchange loss. In this case, the exchange loss is greater than this. Therefore, to the extent of 2,20,000, it is allowed to be capitalized. Now see here. This step 1 minus step 2 is nothing but 2,20,000, and step 3 is exchange loss. Whichever is lower will be allowed. You understand the point? Now, because in this example, exchange loss is so much, it is 5 lakhs. Therefore, your difference between the interest on local currency and interest on foreign currency is much less when compared to the exchange loss. Therefore, the entire difference is allowed to be capitalized. Suppose, let's say your exchange loss is not 5 lakhs. Let's say your exchange loss is 1,50,000 only. But the difference between your interest on local currency and interest on foreign currency is 2,20,000. Ye to exchange loss 1,50,000 only. Then what will be allowed to be deemed borrowing cost? 1,50,000 only. Now I cannot capitalize 2,20,000 when my exchange loss is only 1,50,000. You understand the point? Got it? Right. Now exchange loss is 5 lakhs. Can I capitalize the entire exchange loss? No. To some extent in exchange loss only you can capitalize as borrowing cost. To some extent means what extent? Difference between your interest on local currency and interest on foreign currency. Clear? I hope this is clear. Finally, what will be your total borrowing cost? The actual interest that you pay in foreign currency plus the deemed borrowing cost, which the standard allows, which is nothing but whichever is less of these two. Correct? So this 2,20,000, here I've written 22,000. Okay, just a second. 2,20,000 plus 1,80,000, that will be allowed as borrowing cost, which will be capitalized eventually. Done with this? So here in this example also, already we have capitalized 1,80,000. In addition to that, we'll be allowed to be capitalized 2,20,000. Total 4 lakhs. Chalo, done. Now moving on to the scenarios, Nana. These are all the 4 scenarios that you will get in problems, Nana. Case number 1. First year there will be exchange loss. Second year also there will be exchange loss. You follow this 5-step procedure. There is no complication. It will be very easy. Okay. First year there is exchange gain, which means previous year, and second year also there is exchange gain. When there is exchange gain, you will just take it to P&L account. I told you, only when there is exchange loss, to some extent of the exchange loss, you can capitalize as borrowing cost. When there is exchange gain, that question itself will not arise. Okay, so straight away you will take the gain to P&L account. Case 3. Last year there is exchange gain, this year there is exchange loss. So last year you would have taken to P&L account. This year you follow this 5-step procedure. And if there is any borrowing cost that you can capitalize, do that. Last year there is exchange loss. Only this case 4 is problematic. Last year there is exchange loss. This year there is exchange gain. Here comes the problem. Why, sir? Why? Because last year when there is exchange loss, you would have capitalized the borrowing cost as deemed borrowing cost. In our example also we have seen the same. And this year if you get exchange gain, then unnecessarily I've allowed you too much money to be capitalized, na. This year you have got exchange gain, na. Sir, how is that possible, sir? I'll give you a simple example. See here. Year 0, $1 is equal to 50 rupees. Say for example, year 1 ending, $1 is equal to 55, which means your dollar has appreciated and rupee has got depreciated, right? So there is an exchange loss of how much? 5 rupees per dollar. So what did Ind AS do? It allowed you to capitalize because there is a lot of exchange loss, correct? You have capitalized it. Now your rupee has got appreciated and dollar has got depreciated. You understand the point? So which means your actual exchange loss is not 5 rupees, na? It is actually 3 rupees only per dollar. You understand the point? Which means you have too much of exchange loss, you are allowed to be capitalized and you have done it already. So therefore what Ind AS will say is that that's a mistake that has happened, because your actual loss from the foreign exchange currency, because of exchange rate fluctuation is only 3 rupees, not 5 rupees. But last year ending, what did you do? You thought that your exchange loss is 5 rupees and accordingly you have calculated a lot of things and then you have capitalized the borrowing cost. Exchange loss also to some extent you have treated it as borrowing cost and you have capitalized. That has been done. It is in the past. It is already added to the cost of the asset. It is there in the balance sheet. Where is this exchange loss? To some extent it is there in the balance sheet. You understand the point? And now you have got exchange gain. So therefore the exchange loss is not 5 rupees. Now it is only 3 rupees. But in year 1 I have capitalized already the loss of 5. So therefore what will happen? This exchange gain, now it will go to the asset in the balance sheet. It will go and will nullify the effect of exchange loss. What do you mean by nullifying the effect of exchange loss? Last year, that exchange loss was treated as borrowing cost and it was added to the cost of the asset. Na? So your cost of the asset value would have got increased in the balance sheet. Now this so-called exchange gain will go to the same balance sheet and it will reduce the cost of the asset, thereby nullifying the effect of adding the exchange loss as borrowing cost. So now it will go and reduce. Okay. We'll try to do an example to understand this better. Okay. On 1/4/16, R Limited made a borrowing of $40,000 at 2% from US Bank. The exchange rate on that particular date is 59 rupees per dollar. The borrowing rate in India is 8%. The closing exchange rate on 31st March 17, that is at the end of the year, is 63 per dollar. That is the first year ending. Second year ending is 61 per dollar. Calculate borrowing cost for both the years 16-17 and 17-18. Ready? Yeah? If you do this sum, you'll get 100% clarity. You guys are ready? Now let's follow this so-called 5-step procedure which I've told you. First step, interest cost on local borrowing. So convert this dollars into Indian rupees. $40,000 into on the date of borrowing. What is the Indian rupees, Nana? 59 per dollar. So 40,000 into 59 per dollar into the rate of borrowing in India is 8%. So $40,000 into 59 per dollar into 8%. How much you get? 1,88,800 is what you would have paid provided you would have taken loan from Indian bank in India in rupees. Now, but you didn't do that. You have taken it from foreign bank, $40,000 at 2%, right? But you'll pay interest at the end of the year. Na? At the end of the year, what is the exchange rate over here? 63. So therefore, $40,000 into 63 into 2%. 2% is the interest rate from foreign bank. How much you are paying actual interest? 50,400. Fantastic. You are paying much less. That was your plan. Everything is good. Now, is there an exchange loss at the end of the year? Yes, because while you are borrowing 59 rupees per dollar, whereas at the end of the year 63 per dollar, the exchange loss is 4 rupees per dollar. 4 rupees per dollar into $40,000. How much will be the loss? 1,60,000 is the exchange loss. Correct? Now, what we'll do? We will allow to that extent, the difference between interest on local borrowing and interest on foreign borrowing. How much is the difference done over here? 1,88,800 and 50,400. Difference between step 1 and step 2, which is 1,38,400. How much is your exchange loss? 1,60,000. Put that. Whichever is less will be allowed, will be deemed as borrowing cost. Whichever is less, 1,38,400 is less. So this 1,38,000 will be allowed to be capitalized as a deemed borrowing cost even though it is exchange loss. So 1,38,400 plus the actual interest cost on foreign currency borrowing is 50,400. You add both of them, you will get 1,88,400 which will be capitalized. Easy peasy, routine, done. Okay, you got it? Right. 2016-17 first year is done. Now come to the next year 17-18. What's gonna happen? Actual interest on foreign currency borrowing, let us see in the next year. How much is that? $40,000 into 2% into the exchange rate at the end of next year is $61 per, 61 rupee per dollar. You multiply that, you get 48,800. This will be capitalized without any doubt because this is the actual interest that you are paying. Actual interest, because you have taken the loan from the foreign bank only, na? So this is the actual interest that you're paying. This will be capitalized for sure. This will be taken and added to the cost of the asset. Okay. Now let's see what's going to happen later. Do we have any exchange loss? No. This time we have exchange gain. You understand the point? $40,000 is the loan. Last year it was 63. Now it is 61. So it has got appreciated. Rupee has got appreciated. Therefore, the exchange gain is 2 rupees. 2 rupees into $40,000, it is 80,000 rupees. This is exchange gain. When there is exchange gain, there is no, normally you will take it to P&L account, but here that's not the case, because last year there was exchange loss. So this falls under fourth case scenario. See, normally if you have exchange gain last year, this year also if you have exchange gain, no worries. This exchange gain will be taken to P&L account, but that is not the case over here. Last year it was exchange loss. This year there is exchange gain. So therefore last year you would have capitalized. That effect has to be nullified now. So therefore this 80,000, keep it like that. We are going to nullify the effect of last year. Now the question is, previous year exchange loss capitalized is how much? Calculate that. How much last year did we capitalized? 1,38,400 of exchange loss was capitalized as borrowing cost. Bring it down over here. This much I have capitalized last year. Okay. What is the exchange gain this year? 80,000. Whichever is low will be capitalized. Will be capitalized means what? What do you mean by capitalizing again? Reducing from the cost of the asset. Capitalization means always not adding. Taking it to the balance sheet is nothing but capitalization. You can plus, you can minus. Clear? Right. 80,000 or 1,38,400. So last year 1,38,400 has been added. Now this year 80,000 will be capitalized. This exchange gain is there, na? So this will go to the cost of the asset. It will reduce to the extent of 80,000. Got the point? So in 2017-18, our unrealized exchange gain is 80,000. It is unrealized only because you did not really gain it, correct? It is unrealized. Okay. Our unrealized exchange gain is 80,000, which means it is on papers. In 2016-17, that is previous year, we have capitalized exchange loss of 1,38,400 as deemed borrowing cost. This 1,38,400 exists in the cost of the qualifying asset. It is added. It is there in the balance sheet. Therefore, exchange gain shall be capitalized. Capitalized means minus also, deducted. So that 80,000 will be deducted from the cost of the asset to reduce the previous unrealized exchange loss capitalization. Amount of exchange gain treated as borrowing cost for capitalization is equal to lower of exchange loss capitalized earlier and existing in qualifying asset or exchange gain itself. Total borrowing cost to be capitalized in 2017-18 is equal to lower of exchange loss capitalized earlier and existing in qualifying asset or exchange gain itself. Now tell me, what is the exchange loss capitalized earlier and existing in qualifying asset? 1,38,400. That is capitalized earlier, which means it has been added to the cost of the asset. It is still in the qualifying asset, right? It is still in the balance sheet. So this one or the lower of exchange gain itself. What is exchange gain? 80,000, whichever is lower. So 80,000 is the lower. So therefore 80,000 will be reduced from the cost of the asset. 48,800 will be added. So therefore 48,800 will be added. 80,000 will be reduced. So the net effect of borrowing cost this year will be minus 31,200 will be reduced from the cost of the asset. That is the total net effect. I have told you here also, a revenue item taken into the balance sheet is capitalization, means it can be plus or minus. Okay, a revenue item taken into the balance sheet as capitalization, it can be plus or minus. Right, moving on. Another important point over here is prepayment of loan, that is prepayment charges, will not form part of the borrowing cost. This is also important point. Are we done with this? Chalo. Now moving on to next one, period of capitalization of borrowing cost. From what time to what time you will keep on adding the borrowing cost to the cost of the asset. That is what you mean by capitalization, that we're gonna find out. So period of capitalization of borrowing cost means, period means what? You'll have a starting date, you'll have an ending date. You understand the point? Starting date is nothing but commencement of capitalization of borrowing cost. Ending date is nothing but cessation. Okay, you understand the point? Permanent stoppage. Meanwhile, in between these two, somebody will be there. In between these two, which we call it as a suspension of borrowing cost. Temporary stoppage. So all the three concepts we're gonna see: commencement, starting, cessation, ultimate end, temporary end, suspension. Got the point? Now, when you will start capitalizing the borrowing cost? Very, very, very important. Now you tell me, the moment you have taken the loan and you have started incurring borrowing costs, that is, you have started paying interest, immediately you will capitalize the borrowing cost? No. The moment you have started constructing a building, you have started incurring expenditure, You understand the point? You have taken some activities with respect to the qualifying asset has got started. You will start capitalizing the borrowing cost? Nope. You have started incurring expenditure on the qualifying asset. That is on building. You have started purchasing the cement. You have started purchasing the bricks. You understand the point? Can you start capitalizing the borrowing cost? No. Individually, you can't decide. Everything put together should happen. Means you should have taken borrowing cost. With respect to the qualifying asset, the work should have started. Plus, you should have started incurring the expenses. All the three must happen. Sir, on 1st Jan, I have taken the borrowing cost. On 10th Jan, my work has started with respect to the qualifying asset. I've started doing some work, laying down the diagram of the building that I'm going to construct. On 30th Jan, I've actually started incurring expenditure with respect to the building. I've started buying the cement. Now there are 3 dates. Which date? From which date onwards I should start capitalizing my borrowing cost? What is the commencement date? The answer is the date where all the conditions are satisfied. What conditions? What conditions? Borrowing cost should be incurred. Work with respect to the capital asset or the qualifying asset, sorry, should be started. And expenditure also should be incurred. Now on 1st Jan, borrowing cost is incurred, but did the work start with respect to the qualifying asset? No. Did you incur expenditure with respect to the qualifying asset? No. So all the 3 conditions are not satisfied. 10th Jan, 2 conditions are satisfied. Borrowing cost is incurred, borrowing cost is incurred, as well as what? The work has started, but expenditure did not incur. On 30th Jan, borrowing cost is incurred, work started, expenditure also incurred, correct? So which means on 30th Jan, from 30th Jan onwards, you can start capitalizing your borrowing cost, which means this is the commencement date. So in some books, they will say later of the 3 dates. Later of the 3 dates or the date where all the 3 conditions are satisfied, both of them are same, right? What are those 3 conditions, Nana? Borrowing cost should be incurred. Development activities on the asset has started, that is the qualifying asset. Expenses incurred on the qualifying asset, which means you should have incurred some expenditure. Clear? If all the 3 are satisfied, from that date onwards, you can start capitalizing your borrowing cost, and that date is called as a commencement date. So you can call it this way, a date where all the 3 conditions are satisfied, or later of the 3 dates. Later of the 3 dates means I gave you 3 dates, first, 10th, 30. What is the later? 30. In 30, all the conditions are satisfied, na? Same logic it comes. Got it? Chalo. Are we done with this? Now one by one we'll see. Borrowing cost incurred, nothing much to explain over here. It's easy peasy. These two we will see in depth. These two we will see in depth. Okay. Development activities on asset has started. Qualifying asset. What do you mean by that? Expenses incurred on the qualifying asset. What do you mean by that? Let's try to understand. First, we'll start with expenses incurred on the qualifying asset. Let's try to understand this. Then we will go for development activities on the qualifying asset has started means what? One by one we'll see. First, we'll start with this one. This, nothing much to discuss over here. We have already seen what is borrowing cost. Okay. Got this? Hello? Right, Nana. Now, expenses incurred on the qualifying asset. What do you mean by that? Those expenses that have resulted in payment of cash. Any payment of cash, whatever that you do, will be regarded as expenditure. No worries. Next, transfer of other assets. So what do you mean by that? That's bringing different assets at the site for work. For example, I've put a star mark over here. A construction company uses its existing equipment like cranes, vehicles in the construction of the building. The cost of those assets, that is cranes and buildings, and their depreciation during their use will be included. That is like an expenditure, transfer of other assets. Clear? Assumption of interest bearing liabilities. Many people, they're not able to understand this point. What do you mean by assumption of interest bearing liabilities? Which means, say for example, you acquire a particular asset from the other guy. The cost of the asset is 10 crore. Okay. You have made a payment of 4 crores because to the extent of 6 crores, the other guy from whom you are buying, he has taken loan. He has taken loan. You understand the point? So now what you do, you don't pay the entire 10 CR. You say you already have a loan of 6 CR. Nah? You want the purchase consideration of 10 CR. You already have a loan of 6 CR. So you keep it like that. That loan, I will take it. I'll take the responsibility of that particular loan. And what is the balance? 4 CR I'll pay. So 4 CR you pay for a 10 CR asset, and 6 CR of the loan you take. You take over the seller's loan. You understand the point? Taking over someone else's debt. This is nothing but we call assumption of interest bearing liabilities. You assume the interest bearing liabilities of somebody else. You understand the point? So that is also counted as expenditure, which is incurred on the qualifying asset. You got the point? Anyways, chalo. Expenditures are reduced by any progress payments received and grants received in connection with the assets. Sometimes what will happen, whatever the expenditure that you have incurred here, it will be reduced by progress payments. Means, suppose you are trying to build an asset, a building for somebody else. That third party, sometimes he will give you some regular payments, saying that you're incurring this much of expenditure and this much it will help you. Take this, something like that. That whatever the inflow that you get, it has to be reduced from the expenditure. Clear? Sometimes government also will give you grants. That also should be reduced from the expenditure, as simple as that. So whenever you get any sort of inflow, whether from a third party in the way of progress payments or from the government in the form of a grant, it should be reduced, as simple as that. Are we done with this? That's all, Nana. Very easy to remember. Expenses incurred on qualifying asset. What are they? Cash expenses. What is the second one? Any different asset that you bring to the site. What is the third one? Assumption of interest bearing liabilities, which I've explained already. What is the next one? Okay, if there is any progress payments that is inflow from a third party, or if there is any government grant, it has to be reduced. Simple, easy peasy. Are we done with this? Moving on. Now, what is the next thing we wanted to understand? Development activities on the qualifying asset should have been started. That is one condition to start the commencement date of capitalization of borrowing cost. Correct? What do you mean by development activities? Is it physical activities or mental activities also will be counted? Now see here. Activities necessary to prepare the asset for its intended use or sale. That is this one, development activities. It includes technical and administrative work as well. Technical and administrative work as well means just architect sits in a room, in an AC room, and starts drawing. Outside, you did not start anything. No construction work has started. You did not dig the land also. You did not level the land also. Even then, your work has started. For that architect, say for example, you would have paid some expense in cash. So which means this condition is satisfied. This condition is satisfied because this includes technical and administration work. Very important point. And loan is already taken. Then all the conditions are satisfied, which means you will start commencement of capitalization of borrowing cost. You got it? Very important. Chalo. So technical and administration work will also be considered for the commencement of physical construction, such as activities associated with obtaining permits. You understand the point? Your respective metro development authority will be there. From there, you have to get the permission. That is also included. You understand the point? Prior to the commencement of physical construction, there is no rule that physically work has to start. No. Administration work is counted. Technical work is counted. Getting permission is also counted. Got it? Counted as what? Counted as development activities started on, asset that has been, development activities on the asset has been started. Okay. What asset? Qualifying asset. But very important point here, excludes. Excludes means doesn't include. Doesn't include what? Holding of an asset where no production or development that changes the asset's condition is taking place. You bought an old building, Nana. You're just keeping it like that. You're doing nothing. Neither technical administration or obtaining permits is happening with respect to that particular building, nor physical work is also happening. So which means you are not doing any work. This particular thing has not yet started. You understand the point? But of course, you have incurred some expenditure. You paid some money to that particular person from whom you have purchased that old building. For that, you have taken loan. So borrowing cost is also incurred. But this condition is not satisfied. Which means, can you commence the calculation of borrowing cost? No, because all the three conditions are not satisfied. Got the point? Chalo. Fantastic. Now see here, for example, for this condition only we are looking at the example. For example, borrowing cost incurred while land is under development or capitalized during the period in which activities related to the development are being undertaken. So you have taken a land and then you are trying to dig it, you are leveling it, there are big rocks, you are trying to bomb it. Okay, and after that you are trying to level it, you are trying to put the roads, you are trying to, divide them into plots. All this work you are doing. So during that period, yes, you can capitalize the borrowing cost, but you have purchased a land, say for example, for building purpose, and it is held without any associated development activity. It is just kept like that. You purchased it and you have kept like that. You are keeping quiet. Nothing is happening. No work related to that particular land has started. Then can you capitalize that so-called borrowing cost? The answer is no. That is what this point is all about. Is that clear? See here. Here I told you with regard to progress payments or grants received from government. For that I gave you one example over here. If it is general borrowing and on 1st June 2001 we have incurred 20 lakhs expenditure. We are thinking to capitalize the interest on 20 lakhs from 1st June to 31st March of that particular year. But if the government grant of 5 lakhs received on 1st June, then capitalize the interest on 15 lakhs only, not on 20 lakhs. Why? Because 5 lakhs you have received progress payments. According to this condition, progress payment should be reduced. In this case, of course, it is government grant. So reduce that government grant on 5 lakhs from 20 lakhs, then it becomes 15 lakhs. On 15 lakhs only, you should capitalize the interest. Same logic goes with part payments from the third party for whom we are constructing the asset. Say, for example, you're constructing the building for somebody else, and if that person also gives you some part payments, that also should be reduced from the expenditure that you're incurring. Got the point? That is the importance of this particular point. Very important point, Nana, because while solving sums, it will come really handy. That's why I've explained you. Got it? Sir, why did you explain you exactly from the wordings of the ICA, sir? This is important. ICA words are important. Otherwise, you will not get any marks in the exam. Many students are doing this mistake only. If you want, I can simplify this into very simple English sentence. I can do that. You understand the point? But if you do that, the problem is if these sentence should be as it is, in some of the questions that your ICA has answered. You understand the point? So if we keep on going with our own sentences, you will not get marks in the exam. Ultimately, after doing all the hard work, if you're not able to get marks, what is the use of studying then? It doesn't make any sense. So therefore, whatever that is important, where the words has to be presented as it is, as ICA has given, we have to stick to that. We can't simplify. Other things I have already simplified, as you can see. Got it? Chalo, moving on. Next. I told you already there are three things, Nana. One is starting of the capitalization of borrowing cost, ending date, and in the middle temporary stoppage. Starting is nothing but commencement of capitalization of borrowing cost. In the middle, suspension, temporary stoppage of capitalization of borrowing cost, and cessation of capitalization of borrowing cost. Clear? Now, starting is done. Capitalization of borrowing cost. What is the condition? You should have incurred borrowing cost. Okay. You should have started some activities or work with respect to the qualifying asset. Third condition, you should have started incurring some expenditure with respect to that particular qualifying asset. If all the three conditions are satisfied, from that date onwards, you can start capitalizing your borrowing cost, which we call it as a commencement date. Clear? Now we have come to suspension of capitalization. Sometimes you have to stop temporarily, not permanently, temporarily the capitalization of borrowing cost. When you will stop it temporarily? Very simple. Say for example, you have started constructing a particular building, Nana, and the construction or toll road, for example, here, or bridge or flyover, whatever it is, okay, and it's suspended or stopped due to hartal, there is sudden band which you did not anticipate, COVID which you did not anticipate, change in government which you also did not anticipate because you can't predict the future, environmental reasons, some environmental activities has come and they have stopped. You understand the point? Exactly. So these are all the reasons which are unexpected. So when you have unexpected reasons, unexpected delay or abnormal delay, then there will be suspension of capitalization of borrowing cost, that is temporary stoppage. However, very important, however, when there are expected delays means what? You have constructed cement roads, and definitely in cement road there will be a temporary delay because you have to pour water on it and you have to keep it like that for so many days. In tar road that will not happen. So it is part and parcel of that asset getting created. That is an expected delay. So expected delay is there, then you will not do suspension of capitalization. You understand the point? For example, you are constructing a bridge on the river. Definitely during the rainy season, you can't, continue the construction. So work is stopped temporarily. Does that mean that you will also suspend the capitalization of borrowing cost? No, in this case, no, because the delay is expected to happen. So whenever the delay, say for example, there is something called cognac, which is Scotch whiskey. Okay, type of brandy made in Scotch whiskey, or cognac, which is a type of brandy made in France. Definitely when you are having these products, it will take so much of time to mature and sell it. That is expected to happen. In that case, you will not stop the capitalization of borrowing costs. There will be no temporary stoppage or suspension. You got the point? Unexpected. Hartal, unexpected. COVID, unexpected. Change in government, unexpected. Environmental reasons, unexpected. Then you do suspension of capitalization of borrowing cost. Expected reasons? No. That is a summary of this entire paragraph. That's what I've given here. Normal or expected delay, no suspension. Abnormal or unexpected delay, suspension of capitalization of borrowing cost. Clear? Fantastic. Moving on. Cessation date on capitalization of borrowing cost. Very simple, and a permanent stoppage. When you will permanently stop? When the qualifying asset is ready for its intended use by the management or sale. Simple. It should stop when the asset gets ready for its intended use or sale, or partly completed and able to provide benefit from that particular part. Sir, what is that, sir? See here. If entity is completing construction of asset in parts and each part can be used individually. For example, there is a gated community. 8 towers are there in the gated community. One tower is completed. Tower 1 is completed. And tower 1 is able to provide benefits. People have started coming in already. And they have started staying in the tower. You understand the point? And builder also has sold all the units of that particular tower 1. Then to the extent of that tower 1, you should stop cessation of capitalization of borrowing cost must happen. Cessation of capitalization of borrowing cost must happen with respect to tower 1. You understand the point? Right. Why? Because if entity is completing construction of asset in parts and each part can be used individually, then entity should stop capitalization of borrowing cost on completed part on the date when the part gets ready for its intended use or sale. Example, building construction project in phases. Instead of phases, I told you towers. If tower 1 is completed, then cessation of capitalization of borrowing cost will happen for tower 1. Still 7 towers are there, na? There nothing will happen. There it will continue till it's ready for its intended use. Clear? In some cases, if the entity paused development work on the asset for any unnecessary reason, then the capitalization of borrowing cost on the asset will be suspended for such period. Unnecessary reason means there is no logic. Just like that, they have stopped. Maybe they have not got funding or something like this, or some issue is happening. So they have unnecessary reason. Then in that case, you have to what? Pause the development work. Got the point? Hello? Yes. And one more important keyword is when I say your project or qualifying asset is complete, it's not 100% complete. What we mean is substantially all the work is complete. What do you mean by substantially? It's enough to stop capitalization. Maybe it is like 95% complete or something like that. Suppose gated community is complete, Nana. Still the exit gate is not designed well. Some of the buildings are not designed well. Some of the nonsense has not been, all the dirt and dust has not been cleaned well. There are certain works, 5% work is still pending. But even in that case, substantially it is complete, then that will be considered as complete, and there will be cessation of capitalization of borrowing cost, permanent stoppage. Clear? However, so what we are trying to say is that when we say we are going to permanently stop capitalization of borrowing cost, it doesn't mean that 100% the project or the qualifying asset should be complete in all aspects. Substantially complete is also enough, somewhere around 90% to 95%. You understand the point? This is what the summary that we have arrived at. But for this summary, there is an exception to the above rule. In some cases, for example, you take this. Okay. Before that, I'll just read this. For a qualifying asset that needs to be complete in its entirety, that is 100%, before any part can be used as intended, it would be appropriate to capitalize related borrowing cost until all the activities necessary to prepare the entire asset for its intended use or sale are substantially complete. You got the point? Which means sometimes if you want to use that particular asset, it has to be 100% complete. Otherwise, you can't use it. An example of this is industrial plant such as steel mill involving several processes which were carried out in sequence at different parts of the plant within the same site. For example, you give your raw metal over here, it has to go through process 1, process 2, process 3, only then you will get your finished goods. So any of this process is slightly incomplete, then this entire asset you can't use it. In that case, what do you mean by substantially complete? 100% should be complete in this case. So it depends upon case to case of the qualifying asset. You have to apply your judgment over there. In case of the so-called building, the so-called towers, gated community, what did I say? 95% is also fine. Little bit of small work idhar udhar chalta hai. You can do permanent stoppage of capitalization, that is cessation, right? But in this case, 100% has to get completed. Even if 1 or 2% is missing somewhere, then the entire project, the entire process of this particular finished good happening will get troubled. You understand the point? You will not get the right product. You got it? Some sort of issue will happen. So therefore, in this case, only if 100% is complete, then only you can use this entire plan, this so-called qualifying asset. In that case, you will wait till it is 100% complete, then only you will do cessation of capitalization of borrowing cost. Clear? Fantastic. Are we done with this? Okay. All right, Nana. Are we done with this? Now that's it. Almost we are done with almost the Ind AS 23, except with this particular concept, specific borrowing and general borrowing. If you are done with this, then almost we are done with this particular Ind AS. Okay. So entity has got two type of borrowings, Nana. It can have, one is specific borrowings, the other one is general. Specific borrowing means name itself will tell you it has been amount actually borrowing or borrowed specifically for the purpose of acquisition or construction of the qualifying asset. For that purpose only you have done the borrowing. General borrowing means you have just had the borrowing, money is available, you are trying to use it for this particular qualifying asset. You understand the point? It has got no direct relationship between the general borrowing and the asset on which you are spending the money. But specific borrowing means for this asset only you have borrowed the money. Otherwise, you would not have borrowed the money. That's how the logic works. Okay. The first important point that you need to understand is always it is presumed that specific borrowings money is used first. Specific borrowing money is used first. Then only you will go for general borrowings money. This rule you have to remember. Clear? That's what the standard assumes. Clear? Because standard feels that specific borrowing is specifically borrowed for the asset purpose only, na qualifying asset purpose. Therefore, it is given priority. Therefore, first that money only will be used. You got the point? But money we can't count now, which money is used for which purpose. So it is presumed that first specific borrowing money is used, then only followed by general borrowing. Clear? Now, let's start with specific borrowing. You guys are ready? Okay, now Nana. How much is the borrowing cost that has to be capitalized when the borrowing has been done through specific borrowing? Very simple. Whatever the interest that you're paying on specific borrowing, from that you reduce any income on temporary investment of borrowed funds. What do you mean by that, sir? Very simple, Nana. We'll try to understand that with the help of this example. See here. On 1st April 2000, that is the commencement date. Why commencement date is important? Because commencement date of calculation of borrowing cost, where three conditions has to be satisfied. Your borrowing cost should be incurred, activities or work with respect to the qualifying asset should have started, expenditure which should be incurred on the qualifying asset, all these three conditions should be satisfied, and that particular date will be called as commencement date of calculation of borrowing cost. Did we see this? Commencement date is important, otherwise where is the question of calculation of borrowing cost? Okay, so 1/4/2000, let's deem it as commencement date. You have specifically borrowed 100 lakhs at 10%. This is specific borrowing, okay? On 1st April, you have spent only 60 lakhs. Why would you spend 100 lakhs on day one itself? No, you have spent some 60 lakhs. And remaining 40 lakhs, why would you keep it as idle? You have invested, okay, at 3% per annum. You got the point? Hello? And after 6 months, yeah, 4th month and 10th month, after 6 months, you have spent the remaining 40 lakhs as well. So by applying logic, common sense logic, how will you do calculation of interest cost? Very simple. What is there? 60 lakhs I've spent. Okay. This 60 lakhs is spent for the whole year, na? Because you have spent on day one, which means you have spent it for the entire year. So 60 lakhs into 10%, right? Because you will pay 10% interest for the entire year, correct? Whereas 40 lakhs you have spent only on 1st October. Which means from 1st October to 31st March, it is only 6 months. So 40 lakhs you have spent only for 6 months. So 40 lakhs into 10% interest, not for the entire year, but only for 6 months, into 6/12 minus this 40 lakhs I've invested at the year beginning and I've got investment return for a period of 6 months. That return should be reduced. And finally, interest to be capitalized is 7,40,000. This is what, sorry, any logical person will do. But although it sounds logical, as per Ind AS 23, it is wrong. What Ind AS 23 says is that you don't apply your Mokku logic here. When it comes to specific borrowing, forget about how much is the actual expenditure that you have done. Forget about how much is the actual expenditure that you have done. Doesn't matter. How much borrowing you have taken, sir, 100 lakhs at 10%, sir. Entire interest should be capitalized, that's all. I am not looking at how much is the expenditure that you have taken. What is the logic behind that? Simple. Because the purpose of this loan is specifically for that qualifying asset only, na? So anyway, you're going to use this money on a priority basis. It is presumed to be used from specific borrowing. So there is no question of money from specific borrowing not getting utilized. You understand the logic, what the standard feels. Therefore, once you have taken borrowing in the form of specific borrowing, even though you did not really spend, in this case you did not really spend 100 lakhs, correct? Only 60 lakhs only you have spent, correct? But standard says I will presume that entire 100 lakhs has been spent. I am not worried about your actual expenditure. This much of borrowing you have taken, I'll presume that the whatever the interest that you're paying on this particular borrowing, entire interest will be capitalized. No, standard, my actual expenditure is different. It doesn't matter. I don't want to see that information. See here, correct interest cost to be capitalized on 100 lakhs, which is your specific borrowing, entire 10% you put it, that's all, irrespective of your actual spending. Minus, of course, the temporary income from the investment of the borrowing funds, that should be reduced. How much is that? 40 lakhs for 3% for 6 months. So 40 lakhs into 3% into 6/12. You reduce that. This 9.4 lakhs will be capitalized, not 7,40,000. You understand the point? Okay, logic anyway, I've explained it already. So after commencement date, you know what is commencement date? Yes. Full borrowing cost of specific borrowing should be capitalized, irrespective of amount actually spent. That's all. This is what you have to remember. Nothing else. As simple as that. After commencement date is also important, guys. Without that, where is the question of capitalization of borrowing cost? You will not be thinking about general borrowing, specific borrowing, when the basic condition itself is not satisfied. So what is the basic condition? Commencement date. Okay. After commencement date, full borrowing cost of specific borrowing should be capitalized, irrespective of what is the actual expenditure that you have spent. Of course, from that, if there is any investment income that you have earned because of the temporary investment, that should be reduced. That we have written anyway here. Where is it? Either. Any income on temporary investment of borrowed funds should be reduced. Chalega? Very easy, very simple. What is the specific borrowing? Chalo. Next, general borrowing. Now this we need to focus a little bit. Okay, chalo. All right, Nana. Now let's come to general borrowings. Okay. Now, very simple, Nana. Other than specific borrowing, whatever the borrowing that you have got in your balance sheet, it all comes under general borrowing. It is assumed. Take your balance sheet. 10% loan from SBI 300 lakhs, 12% redeemable debentures 500 lakhs, 8% working capital loan 200 lakhs. And on the other side, just now you have purchased a plant and machinery. Okay, it's not ready, but work in progress. Okay. In that case, what the standard says is I'll take a presumption, default assumption that this so-called qualifying asset is funded by this or is financed by the existing borrowings. You understand the point? Standard takes a default assumption. That's logical only. See, for this, where did you get the money? From this only, na. You can't create money just like that. You understand the point? So it's a logical presumption by the standard. So standard takes a default presumption that qualifying asset is financed by the existing borrowings. That's it. Pretty simple. So all these three put together, we call it as a pool of general borrowing. Okay, pool of general borrowing. Now, look at the important point over here. If there is any old specific borrowing, very important, try to understand, very important. If there is any old specific borrowing took for qualifying asset few years back, okay, there was a qualifying asset some years back, for that you have taken specific borrowing, okay, and you are paying interest even today. Please try to understand, if you take a specific borrowing loan for 5 years on a qualifying asset, and the qualifying asset gets ready in 2 years for its intended use, then after 2 years it is no more qualifying asset, na. But you have taken loan for 5 years, na. So you have to keep on paying that loan for 3 years extra, even though the qualifying asset is no more qualifying asset, 2 years itself. You understand the point? So just try to understand. You have taken specific borrowing for 5 years for a qualifying asset, which on the date of borrowing, within 2 years, it was ready for its intended use. But you have to pay the specific borrowing loan interest for remaining 2 years only. Na? In fact, you'll be paying the interest for the entire 5 years. But first 2 years, you will capitalize that interest till that qualifying asset is qualifying asset. And once it is no more qualifying asset, then you will be putting that interest in P&L account. You understand the point? You'll try to put it in P&L account. You got it? So that so-called old specific borrowing of the so-called qualifying asset which you have taken in the past, and now the qualifying asset is no more qualifying asset, then that old specific borrowing also comes under general borrowing pool. That's what I'm trying to say. Now see here. If there is any old specific borrowing took for qualifying asset few years back for which you are paying interest today, and the old qualifying asset is not qualifying asset today, so its capitalization stopped long back. Now that the old specific borrowing for which you are paying interest even today will also come into the above pool of general borrowings, which means old SB is now new GB. Old specific borrowing is now general borrowing. Clear? Right. Okay. ये तो ठीक है, sir. Now what is that we need to find? We need to find out borrowing cost in case of general borrowing. How much is the borrowing cost that we need to capitalize? It is a lot more complex here because in case of specific borrowing, it's very easy. One loan, one interest. Easy peasy. But in case of general borrowings, that's not the case. Multiple loans, multiple interest, multiple amounts, correct? That's why it's a little bit complicated. So, how to find borrowing cost in case of specific borrowings? That has to be capitalized. Standard says find out weighted average capitalization rate. What is that weighted average capitalization rate? Very simple. Capitalization rate is equal to total actual interest on all general borrowings divided by total amount of general borrowings weighted average on time basis. What is this, sir? I'm not able to understand. That's okay. It means borrowings are outstanding during the year. What is this, sir? Don't worry. With the help of an example, we'll try to understand it very easily. It's easy concept only. Don't worry. By looking at this English sentences, you might get a little bit intimidated, but because English is not our native language, it feels like that. It's an Indian language for us, right? So obviously it's natural to get intimidated. So don't worry about that. Now let's start with case 1. I'll try to explain what this is and I'll try to make this very easy. Okay. Shall we start? Alright guys, now don't worry about this particular thing. Okay, let's look at this case. Okay, year 0, 12% loan you have taken, which is valuing 10 lakhs loan at 12%. Okay, 6 months later you have taken another 10 lakhs loan at 12% interest. Now how will you calculate capitalization rate, Nana? Forget about the formula, use your common sense. This 10 lakh loan is outstanding for the entire year, correct? So therefore 10 lakh loan into 12% interest into outstanding for the entire year, so 12 by 12, that will be your interest, right? This 10 lakh loan is outstanding only for 6 months, so therefore 10 lakhs into 12% into 6 by 12, ये तो clear है. Divided by, so this is your interest basically, the numerator, and divided by, if you can see here, we have the weights over here. Now what about the weights? Very simple. 10 lakhs is outstanding for the entire year into 12 by 12. This 10 lakhs is outstanding only for 6 months of the year into 6 by 12. So finally, 1,80,000 is the numerator calculation. Denominator is 15 lakhs, weighted average of the loans. So you've got the calculation rate as 12%. So it's pretty easy to calculate. No confusion, nothing doing. Okay. Everybody, you want me to explain the individual logic? Very simple, Nana. See, on 10 lakhs, you'll pay 12% loan for the entire year. Correct? Therefore, 10 lakhs into 12% is the interest calculation, right? Into 12 by 12 means 1 only, na? So basically the interest calculation is 10 lakhs into 12%, simple. Here on 10 lakhs, 12% loan, that is 12% interest, you'll pay only for 6 months. So logically speaking, you'll not be paying 12%, you'll be paying 6% only, na? That's how the logic works. 10 lakhs into 12%, but 12% is per annum interest. 12% is per annum interest into 6 by 12 because you'll be paying the interest only for 6 months. Ye to clear hai? Now coming on to the denominator, this 10 lakhs is outstanding for the entire year. Therefore, the weight will be 10 lakhs. So 10 lakhs into 12 by 12 is nothing but 10 lakhs into 1. This 10 lakhs is outstanding only for 6 months. So 10 lakhs being outstanding for 6 months is nothing but 5 lakhs outstanding for the entire year. Correct? Therefore, you have got 10 lakhs into 6 by 12, which is nothing but 5 lakhs. So 10 lakhs outstanding for 6 months is nothing but 5 lakhs for the entire year outstanding. You got the logic. That's how it has come. So totally 10 lakhs for the entire year. So 10 lakhs is 10 lakhs. 10 lakhs for 6 months. So 10 lakhs for 6 months is nothing but 5 lakhs for the entire year. You've got 5 lakhs. So totally 15 lakhs is the denominator. That's how the logic works. I hope this is clear. Are we done? Right. Okay. Look at this point. Very important point with respect to general borrowings. Unlike specific borrowings, in general borrowings, amount spent is also important to find out the borrowing cost to be capitalized on qualifying asset. That is, capitalization rate which you have calculated here should be applied on expenditure incurred on qualifying asset. In other words, expenditure accumulated on qualifying asset. This point is exactly opposite to what we have learned in specific borrowing. In specific borrowing, what did we see? Forget about the actual expenditure that you have incurred. How much is the loan that you have taken? Straight away you put it. And of course, you reduce if you get any interest because of the investment from the specific borrowing. You get the point? Investment return, that has to be reduced. But you are not at all giving any importance to the actual expenditure that is incurred with respect to specific borrowing. But here, it's exactly opposite. Here, your entire importance goes to actual expenditure incurred. You understand the point? Actual expenditure incurred on what? Qualifying asset. That's why the word is expenditure accumulated on qualifying asset. So based on that expenditure only, you'll multiply with the interest rate, that is capitalization rate in this case, and eventually that will be capitalized. Chalo, now that we know how the capitalization rate has been calculated, let's go to next step. Now case 2. See what is happening over here. 1/4/21 this is. On 1/4/21, that is a commencement date, you have spent 10 lakhs. I told you how much amount you have spent is very important when it comes to general borrowing, correct? You have spent 10 lakhs over here, fine. From specific borrowing, you have taken a loan of 10 lakhs at 10% per annum interest. And general borrowing, you have already calculated capitalization rate over here, which is 12%. Keep it like that, okay? Right? Now see here, amount spent is 10 lakhs on 1st April 21, okay. 1st July 21, you have spent 12 lakhs, okay. 1st Jan 22 next year, you have spent 9 lakhs, okay. On the balance sheet date, that is last date of the financial year, you did not spend anything, okay, fine. First, what we have to do? When there is both specific borrowing and general borrowing, I already told you that we'll presume that the first priority, the first amount that will be spent on the qualifying asset, we'll presume that it has been financed from specific borrowing only. On priority basis, first money from specific borrowing goes into expenditure. You got the point? So which means first we have to use this one, 10 lakhs at 10% interest. You have spent amount of 10 lakhs now here on the qualifying asset. This will go straight away from, we'll presume that this 10 lakhs is financed by specific borrowing only on priority basis. So interest on specific borrowing capitalized, this 10 lakhs into 10%, 1 lakh is straight away capitalized. Simple, plain, done. Now coming on to general borrowing. Usually what we'll do calculation, already we have capitalization rate. Okay, on an average, that is the interest rate on general borrowing. Let's put it that way. You have the capitalization rate over here, 12%. How much you have spent here? 12 lakhs. So 12 lakhs on this 12% interest, but it is not for the entire year because 12% capitalization rate is for the entire year, per annum interest. So what you will do? 12 lakhs into 12%, that is the rate per year, into from July to next month, March. How many? I think 9 months. So therefore into 9 by 12 plus 9 lakhs into 12% into 3 by 12, because from Jan till March it is 3 months. So you got your interest. This is general borrowing interest. You add it to specific borrowing. Total borrowing cost to be capitalized is covered. Okay. However, when compared to this method of calculating interest on general borrowing, I prefer the other method. What is this? See here, sir. Interest on specific borrowing capitalized, we know this. Just take the borrowing, how much? 10 lakhs into 10%. There ends the matter. So because it is on priority basis, this 10 lakhs is financed by specific borrowing. So this 10 lakhs is also gone. Now coming on to this 12 lakhs, what you do? Take that 12 lakhs, how much it has been outstanding, this expenditure, 9 months, into 9 by 12. Okay. Next, this 9 lakhs is outstanding expenditure for 3 months. So 9 lakhs into 3 by 12. You get weighted average expenditure. Now directly multiply this weighted average expenditure with 12%. You get your answer. Interest on general borrowing directly. You add this with the interest on specific borrowing. You get your total borrowing cost to be capitalized. This method I would rather ask you guys to prefer while solving sums, because in this method, the chances of you doing a mistake is much less. Now the next question is, sir, what about ICA? What does ICA do? ICA follows this method in some questions. ICA follows this method in some questions. We prefer this method. We will solve every sum based on this method only. Sir, what is this method, sir? Very simple, sir. First, we will calculate capitalization rate. How to calculate capitalization rate, sir? We have seen this already here. You on denominator, take the loan outstanding into percentage into 12 by 12 or 6 by 12 or 9 by 12, whatever it is. Okay, that is numerator, sorry. In denominator, what you will do, you'll just take the amount and you multiply with 12 by 12 or 6 by 12, depending upon whether it's outstanding. Okay. Once you calculate capitalization rate, then what you do? Simply find out weighted average expenditure on qualifying asset. You have spent expenditure over here. It is outstanding for 9 months. So into 9 by 12 plus this 9 lakhs into 3 by 12. You got the weighted average expenditure. Now you just multiply with the capitalization rate, which you have calculated in the first step. You get your interest on general borrowing. Pretty simple. So totally 3 steps, Nana, for general borrowing. First step is calculation of capitalization rate. Okay. Second step is weighted average expenditure. Third step is multiply step 1 capitalization rate with weighted average expenditure. That's it. These 3 steps, if you can understand, your interest calculation on general borrowing is done. First step, capitalization rate. Already I've shown you multiple times. I've explained the logic as well. Second step, weighted average expenditure. Just now I've shown. You just take the amount that you have spent into 9 by 12 or 8 by 12 or 10 by 12 or 12 by 12. Clear? Third step is step 1 and step 2 multiplication. That's all. Third step is step 1 and step 2 multiplication. That's all. Step 1, capitalization rate calculation. Step 2, weighted average expenditure calculation. Step 3, step 1, step 2 multiplication. That's all. Very easy to remember. Step 1, capitalization rate calculation. Step 2, weighted average expenditure calculation. Step 3, multiplication of step 1 and step 2. That's all. Done. Interest on general borrowing is done. Interest on specific borrowing, anyway, it is easy, na? Are we done with this? Till here it's clear? Right. Let's continue. Now this is very important. Now see here. This example only. This is first year. Now let's continue this. This is first year. We are going to continue to the second year. Continuation. Still in case 2 example only. Very important. Now listen. In year 2, what is happening? This is year 1. Now we have come to year 2. Now listen, Nana, this is very important. It started on 1st April 2022 because this stopped on 31st March 2022. So this started on 1st April 2022. And there is only one expenditure that you have incurred on 1st July, which is 18 lakhs. So how much borrowing cost you need to be capitalized in the next year? Understand one thing. As long as the asset is qualifying asset, you will keep on capitalizing your borrowing cost. Okay. Interest on specific borrowing, what you will do? Last year also it was 10 lakhs into 10%. This year also loan will be outstanding, na? You will stop capitalizing this when the asset is no longer qualifying asset. It doesn't mean that every year you should incur expenditure. That's stupidity. You understand the point? So last year you have incurred 10 lakhs expenditure on the qualifying asset. Okay. For that you have taken a specific borrowing of 10 lakhs loan, on which you have to pay 10%. Okay. Now that loan is outstanding this year also. Yes. This year also you have to pay interest. Yes. This year also your asset is still qualifying asset. Yes. Then you will capitalize it. If your asset is not qualifying asset, you will put it in P&L account. That's all. At the end of the day, in both the cases, you have to pay interest to the bank, Nana, from where you have got the loan. You understand the point? Bank has got nothing to do with whether your qualifying asset is a qualifying asset or it is no more a qualifying asset. It is only we are giving a different treatment. If it is a qualifying asset, we'll capitalize it. If it is not a qualifying asset, we'll put it in P&L account. You got it? Now, so last year you have taken the loan, you have spent 10 lakhs, and that loan is still outstanding this year. You still pay that 10% on 10 lakhs, and there will be 1 lakh. Still, the qualifying asset is qualifying asset only. Therefore, you will capitalize this. Clear? Next, what about borrowing cost on general borrowing this year? Very simple. Last year you have incurred 12 lakhs, right? So which means to the extent of 12 lakhs from the general borrowing pool loan, you would have spent the money, right? So last year you are paying interest. This year also you will continue to pay the interest on this 12 lakhs. Now, here we are paying interest on 12 lakhs. We are not incurring 12 lakhs again. 12 lakhs is an expenditure that we have incurred last year. That's all. For which we have financed from the general borrowing. General borrowing is a big pool of money. From that, we have taken some 12 lakhs and we have incurred that 12 lakhs on the qualifying asset. Once you have used that 12 lakhs, now you have to continue paying interest on the 12 lakhs. Nah? That doesn't mean that again you are incurring 12 lakhs. You understand the point? Many students are getting confused here. Now you are not incurring 12 lakhs here. You are continuing to pay interest on the 12 lakhs. Clear? Now 12 lakhs is outstanding for the entire year this year also. Yes, as long as your qualifying asset is still qualifying asset, your general borrowing also will be outstanding to the extent of expenditure that you have incurred. You understand the point with respect to general borrowing. So 12 lakhs into 12 by 12. Yes. 9 lakhs also last year it was outstanding only for a period of I think 3 months. But this year full year it is outstanding. Clear? And this year also you have incurred 18 lakhs. So this money also you would have got from general borrowing because specific borrowing is no more available. 10 lakhs was specific borrowing and 10 lakhs is done. This year 18 lakhs you have incurred. Only amount that is left over is general borrowing pool only. From general borrowing you have got 18 lakhs and you have paid. And this is outstanding for how many months? 9 months. So into 9 by 12. Clear? What is this one, sir? This is very, very, very important. Last year on general borrowing you have paid interest na, which was capitalized. Correct? Where did you get the money for interest? Last year you have paid total interest that has been capitalized is 2,35,000. Na. Interest on general borrowing, interest on specific borrowing. Total is 2,35,000. Na. This 2,35,000 money, where did you get? 10 lakhs you got from specific borrowing. Okay. 12 lakhs and 9 lakhs you got from general borrowing. Okay. Okay. So 10 lakhs from specific borrowing, general borrowing, general borrowing. So there are logics. Where did you get this money from? You have paid an interest of 2,35,000 last year. Now, where did you get money for 2,35,000? Where did you get this money from? You understand what I'm trying to ask? You have paid interest of 2,35,000, which you have capitalized instead of putting it in P&L account. Okay. Where did you get this money from? 2,35,000 has come from where? It got created, huh? No. Again, you would have pulled it from general borrowings only. You understand the point? This 2,35,000, which is interest that you have paid, you would have pulled it from general borrowings only. To that extent, you will be paying interest now. So it is like interest on interest. Therefore, 2,35,000 also you should take into 12 by 12. That is outstanding for the entire year. Because last year you have incurred expenditure. This year it is outstanding for the entire year. It will be outstanding. You will be paying interest. As long as it is qualifying asset, you will be capitalizing it. Once it is no more qualifying asset, still you will be paying and you will put it in P&L account. That's the only difference. But still you will be paying money. Because this 2,35,000 interest also, where did you get money from? You have pulled it from general borrowings only. Simple logic. That's why it is added in general borrowing. You understand the point? 2,35,000 into 12 by 12. Last year borrowing cost on specific and general borrowing. So last year borrowing cost, what you have incurred, you got that money from general borrowing only. So this year you have to pay interest on that as well, and that will also be capitalized. That also has to be added. So this is very important. Many students don't get this. Okay. Finally, total accumulated expenditure on qualifying asset is 36,85,000. This one into 12%, which is capitalization rate, which we have already calculated. This much is your borrowing cost to be capitalized on general borrowing. Plus specific borrowing is continuing. Total this much you need to capitalize. 5,42,200. Is this clear? This point is very important. Interest on interest. This point is very important. Okay. Are we done with this? Chalo, fantastic. Now, finally, expenditure to which capitalization rate should be applied. This expenditure. In that, we already know these points. Okay, this we have already studied. The amount of expenditure on qualifying asset includes that have resulted in payments of cash. We have seen it. Transfer of other assets. We have seen this. Assumption of interest-bearing liabilities. We have seen this. And that expenditure should be reduced by any progress payments. We have seen. Grants received also we need to reduce. We have seen that. So we all know this. But this is important point. What is this, sir? The average carrying amount of the asset during a period, including borrowing costs previously capitalized, is normally a reasonable approximation of the expenditure to which capitalization rate is applied. So when you try to multiply this so-called capitalization rate, which is 12%, it also includes borrowing costs previously capitalized. 2,35,000 borrowing costs previously capitalized. Previously capitalized. You get the point? And also the carrying amount of the asset, you should be taking average amount. This is also very important. Okay. When you take the carrying amount of the asset, you should be taking average carrying amount of the asset. When problem comes, you will understand the importance of this sentence. Okay. Are we done with this? Hello, everybody. All right, Nana. All right, guys. Okay, welcome back. Now we're gonna see Ind AS 10 events occurring after reporting period. Now this is a literally a small size Ind AS. Okay, so we'll try to finish it off ASAP. Now try to focus more on the name, okay, because the name itself is pretty important. Events occurring after reporting period. Now this entire standard depends upon the word reporting period. So what is reporting period? Okay, that is also pretty much important. Anyways, let's try to understand that. Straight away we'll get into the standard. Let's say 31st March 2025 is your balance sheet date. Okay, so which means this belongs to one particular reporting period, right, which ends on 31st March 2025, right? So let's say after that you are taking sufficient amount of time, you means the company, okay, and on 30th June 2025 your financial statements is approved by board of directors. All right, now there is a time gap between these two. I mean your end of your financial year, right, that is 31st March 2025 and 30th June 2025, where the approval of financial statements is done by your board of directors. Now if any event happens in between this time gap, between your balance sheet date and the date of approval of financial statements by the board of directors, we call this as events occurring after reporting period. You got the point? And for us, the reporting period is this one, okay, where it ended on 31st March 2025. Now let's start with the basics first. Some of you will know this, but anyway, for the benefit of all the students, I'm just trying to explain the basics. Why there is a 3-month time gap period approximately in this particular example which I gave you, almost from 31st March to 30th June, correct? Very simple. It takes time to check whether everything is accounted or not. Obviously, all accounting treatments are correct or not, that also we need to check. On 31st March, there will be so many provisions we need to create, correct? Fair valuations we need to do, of course. Actuarial valuations in case of employee benefits also has to be done by the actuaries, not us, right? And also auditor will be doing his work along with the management. He's be working out, correct? For all these things, it will take time. It's as simple as that, right? And as a result, in this example, it can be 3 months time gap, 2 months or 4 months, whatever. It depends upon the scenario of that particular company. Okay, it changes from situations and circumstances, case to case basis. It will change. In this example, it is 3 months time gap. You got the point? Fantastic. But most of you guys who have done articles by now, because you are the CA final, you know that in reality, based on experience, what will happen, Anna? Before final financial statements is signed, at least 10 to 15 sets of financial statements would have got wasted. Correct or not? We all have experienced that, right? So mostly when auditor says informally okay, then eventually it will be approved by board of directors, then it will go to auditor for signing, and then notice will be given to the shareholders. Correct? You got the point? Once date of approval is over, once it is approved, the financial statements are approved by board of directors, that's it. That is the end card. After that, you can't do any more adjustments to your financial statements. You got the point? So that is why this Ind AS clearly states that the events occurring after reporting period, but before the date of approval by the board of directors. Approval of what? Your financial statements. That's obvious. You got the point? So in between this time, between the balance sheet date and the date of approval of your financial statements by the board of directors, if any event happens, what will be the treatment that we will do for that particular event. Got the point? That's what we're going to discuss. Okay, now that we have seen why it will take so much of time between your balance sheet date and the date of approval of your financial statements by the board of directors. Okay, right. Now the next question is, what is the need of this standard? Is there any logic? Why do we need this standard? The standard name is events occurring after reporting period. Why do we need something like that? Okay, is there a necessity? Let's try to understand. By 31st March 25, our basic financials are ready, correct? Okay, but during 31st March 25 to 30th June 25 period, this particular period, okay, we got some additional info related to previous year, which means related to the last year, April to March is there. Na? In this case, it is 31st March 2025 means 1st April 2024 to 31st March 2025. With respect to that period, we got some additional info, okay, which was not available at that particular point of time. At that particular point of time means we are talking about during that particular period from 1st April 24 to 31st March 25. At that particular point of time, that particular information is not available. After 31st March 2025, after the balance sheet date, during that reporting period, I mean events after reporting period, that date is there, na? From balance sheet date till the date of approval by the board of directors. During that particular period, we got some additional information pertaining to the financial year just now which got completed. Okay, right. Okay, some additional information related to previous year. And had you known this information before 31st March 25, our 31st March 25 financial statements would have been prepared differently. That type of information we need to consider even though information is received subsequent to the financial year but still relates to situations or circumstances of previous year. So now what we'll do, we'll basically adjust our financial statements accordingly, and these kind of events where we are forced to adjust our financial statements, we call it as adjusting events. Don't worry, we'll see the definition of adjusting events in detail later point of time. Right now just try to understand what is the logic behind this particular standard, which is by the name events occurring after reporting period. So the logic of this standard is very simple. Sometimes after your financial year, we get some additional information pertaining to the data or pertaining to some sort of financials of your previous year, which has just got completed on 31st March 25. You got the point? And as a result, sometimes we need to do adjustments. Sometimes we need not do any adjustment, but we just need to do some disclosure to the users of the financial statements such that they can make better decisions of the information available. So because of this particular reason, this standard is relevant. Got the point? Chalo. Are we clear with this? Nana, did you understand the logic of this particular standard? Right. So your 31st March 25 balance sheet date is done, that period is done, but after that you have got some additional information with respect to the period that has got completed, and had this information you would have known before 31st March 2025, then your financial statements on 31st March 2025 would have been different. Your financial position would have been different. In that case, you have to definitely adjust those numbers such that you represent true and fair view. You can understand the point? Anyways, right. Are we done with this? Let's try to understand the same with the help of certain examples. Okay, for example, see here, this is all examples given by your ICA. Okay, in the study material, the financial year of the entity ends on 31st March 2002. Okay, if the board of directors approves the financial statements on 15th May, in this case, after the reporting period will be the period between 31st March 2002 and 15th May 2002. Obvious. So we are focusing on what is after the reporting period. It is between the balance sheet date and the date of approval of your financial statements by the board of directors, which we have already discussed. Okay, and the events occurring during this period, which period? After the reporting period. What is after the reporting period, which we have discussed already, right? And the events occurring during this period, what period? After the reporting period, which is between 31st March 2002 and 15th May 2002, should be considered as events after reporting period. So this example clearly tells you what is events after reporting period. Clear? Which we have already seen with the help of this particular example. All right. Now moving on to example 2. Now see here. The board of directors of ABC Limited in its meeting on 5th May 2001 reviews and approves the financial statements for the year ended 31st March 2001. Fair enough. And issues them to the shareholders. Okay, that's what they do after approving. The financial statements are adopted by the shareholders in the annual general meeting on 23rd June 2001. Fine. The date of approval of the financial statements for the 5th May 2001 is in accordance with this standard. What he's trying to say is that whatever the date on which the board of directors approve the financial statements is called date of approval as per this standard, because many a times as per this particular standard we'll be using a word called date of approval. Now he's trying to explain you what is date of approval as per Ind AS 10. What is date of approval? The date in this example 5th May 2001, where the board of directors of this particular company has approved the financial statements. That particular date is referred as date of approval as per this particular standard. That's what he's trying to explain with the help of this particular example. Clear? Everybody, shall we move on? Right, now moving on to example 3. Let's see what's happening in this example 3. On 18th May 2002, okay, the management of the entity approves financial statements for issue to its supervisory board. Okay, the supervisory board is made up of solely of non-executives and may include representatives of employees and other outside interest. A small example what I can give you with respect to supervisory board is sometimes what happens is that, say for example, you have taken loans from multiple banks, okay, from multiple financial institutions, and these loans are big in number, 100 crore loans, 500 crore loans, 1000 crore loans, stuff like that. So, and then say for example, you're not doing your business properly and things are going sideways, then eventually most of the times what will happen is that those banks, because they have given you, or those financial institutions, they have given your company too much of a loan. Okay, it's too big to lose. You understand the point? So therefore what they will do is that they'll consult your company. They'll say that, see, we are observing your business, your financials, and things are not going good. They're going sideways. So what we do is that we'd like to represent a person on our behalf in your board, so that he will supervise your decisions, so that you will not do business in a hasty way and let things go sideways, because our interest is at stake now, because we gave loan to you, and if you are not able to pay loan to us, then we are going to get affected. So therefore we will send somebody to represent us in your board, so that he will also take some decisions, or give his opinion in taking decisions, or some sort of a control, or at least observe what is happening, and eventually that will be communicated back to the so-called bank or financial institution. You got the point? I hope this is clear, everybody. Right, that's what we mean. Generally, supervisory board is made up of solely of non-executives and may include representatives of employees and other outside interest. I gave you a wonderful example. I hope you will be able to understand from that. Right, the supervisory board approves the financial statements on 26th May 2002. Now there is a confusion. The management of the entity approves financial statements for issue to its supervisory board, and the financial statements are made available to shareholders on others. Okay, fine. So here the point that you got to understand is, two people are approving financial statements, correct? Now immediately the doubt that will come to your mind is that which I should take as date of approval as per Ind AS 10. Right, we will have the answer here itself. The financial statements are made available to shareholders on 1st June 2002. Fine. The shareholders approve the financial statements at their annual meeting on 15th July 2002. Here shareholders are also approving. One more approval. Got it? Next, what else? On 15th July 2002, and the financial statements are then filed with the regulatory body on 17th July 2002. Now, what is date of approval as per Ind AS 10? Well, the keyword is management. Whoever is managing your company, their approval is approval as per Ind AS 10. Now, who is managing your company right now? Is the supervisory board is managing your company? No. Shareholders are managing your company? No. The management of the entity is managing your company. So when did they approve your financial statements for issue? On 18th May. Therefore 18th May is nothing but date of approval as per Ind AS 10. Clear? So no more confusion hereafter. Whoever manages your company, their approval is date of approval as per Ind AS 10. Ho gaya. Khel khatam. Right? Shall we move to the next one? Example 4. Now I'm not gonna focus on example 4. Why? Because we are gonna learn this particular standard in the form of cases. Almost I've got 15 to 16 cases. Each case is an example. So with the help of those cases, we'll be trying to learn this particular standard. Indirectly, each and every case represents one problem given by your ICA. in study material or MTP or RTP. So once we cover all these cases, it's as if we have covered those many sums. Let's say we are covering some 15 to 16 cases. It means at least we would have covered 10 to 12 sums. It's like that. That's how I've designed the cases. So what I've done is that I've gone through your questions. I took the essence of that particular question. I've converted that into a case. You got the point? So indirectly, when we are covering the cases, we are also learning the concepts of this particular Ind AS. At the same time, simultaneously, we are also solving the sums. Got the point? So that's why here I've written same as case 6. So once we see case 6, this example is automatically covered. So let's not cover here. Clear? Right. Fantastic. Okay. Now, guys, in so many other standards also, I told you that in any standard, there will be specific definitions, okay, which we should not mess up with, and we should be able to reproduce it as it is when we are trying to write a particular theoretical answer for a particular theoretical question, where a question will be there, a question will be based on a particular concept, and we know the answer, but straight away we can't apply that particular concept and straight away write the answer. First, we need to write the concept, we need to reproduce the concept, that is the right word, and then apply the concept to the given scenario in the question, and then write your so-called analytical solution. You got the point? So when you try to reproduce the concept, you have to write it as it is. The wordings, the sentence formation should be as it is, the way it is given by your ICA in your study material. Only then you will get marks. Trust me, I've gone through many of the so-called answers written by students, which has been corrected. And if you write your own sentences, the examiner is not providing marks. Clear? Chalo. So what you should do, sir, similarly what we have done in other standards, okay, with respect to the syllabus that I've covered so far, all the standards, I will give you certain important definitions. You got to learn and reproduce that as it is to get marks in the exam, because our target is to get at least 70 to 80 plus, right, in FR. Anyways, now see here. The first definition that is important in this particular standard: events occurring after reporting date. We already learned what is events occurring after reporting date with the help of this particular example. Now let's try to understand the definition as per Ind AS 10. So what is events occurring after reporting date? Those events which are favorable and unfavorable. Very, 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 very important. See, usually we follow conservatism concept now when it comes to accounting. So anything that is not so favorable, definitely we'll try to bring it down into the picture. Our natural accounting mindset is such that unfavorable events means, because conservatism concept immediately comes into picture, we'll immediately try to what? Inculcate that. So it's easy. It's like accustomed to our brain. Okay. But favorable events means generally we'll say, I don't want to account it. Let it happen, then I'll see. Certainly once it happens, then I'll see. But here, this is an exception to that. Please try to understand, because our natural accounting nature is that we tend to avoid favorable events. You understand the point? Unless until it is certain and it has happened, then only we'll bring it into the accounting. Isn't it? Because we follow that so-called conservatism logic. But here, that's not the case. This is kind of an exception where whether the events are favorable or unfavorable doesn't matter. Okay, if it occurs after the balance sheet date and up to the date of approval of financial statements, and then they are approved by the board of directors in case of a company, or by the corresponding approval authority in case of any other entity. You understand the point? So this is defined as events occurring after reporting date. I repeat again, what is events occurring after reporting date? These are those events which are favorable as well as unfavorable that occur after the balance sheet date up to the date of approval of the financial statements by the board of directors in case of a company, or any other appropriate authority in case of other entity. Clear? Easy to remember. Got it? But the key words in this definition are favorable, 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 favorable. I repeat it again. Once we start solving sums, you'll be able to understand what is the importance of the word favorable. Okay, why am I stressing on it so much? Are we done with this? Okay, say along with me, what is events occurring after reporting date? These are all those events which are favorable or unfavorable that occur after the balance sheet date up to the date of approval by the board of directors, or up to the date of approval of financial statements by the board of directors in case of the company, or any other approval authority in case of any other entity. Clear? Done. Moving on to next one. Date of approval means the date on which the board of directors has finalized the financial statements of concluded accounting period. Obviously, date of approval means that is the date on which those financial statements are finalized by the board of directors. Fine. Note, sometimes after approval of financial statements by the board, a further approval may be required from a supervisory body, example audit committee, that we have already seen in this particular example. Here also the supervisory board approves the financial statements again after the management of the entity has already approved. But for us, according to this particular standard, date of approval means date of approval by somebody who is managing the company. That is the keyword. Okay, what else? Even in this case, date of approval by the board of directors is considered as date of approval for the purpose of this standard. That example only has been again repeated here. So, even if somebody further approves your financial statements, but as far as this standard is concerned, the date of approval by the board of directors is considered as a date of approval for the purpose of this standard. Clear? This we have already seen, it is repeated. Now, important point. If there are two dates of approval by board of directors themselves, not two different authorities. Here you got to see in this example also you had three dates of approval, correct? But these dates of approval are done by different authorities. Initially management, then supervisory board, then shareholders. You understand the point? But here I am talking about different dates of approval by the same board of directors, not different authorities. In that case, you always take the latest one. Latest one means the final date of approval. Okay, final date of approval will be the date of approval as per Ind AS 10. Clear? Okay, this is important, Nana. Okay, we are done with it. Now coming on to two important definitions. If you know this, if you can understand the essence of these two, the standard is done. That's all. There is nothing more with respect to this particular standard. Adjusting events, non-adjusting events. If you are able to digest the definition of these two, the standard is literally done. So if you guys are ready, we'll start. Okay, now before we look into adjusting events or non-adjusting events, I already gave you a brief perspective with respect to why do we need this particular standard. There I told you that once our financials are ready, okay, we got some additional information related to the financial year that got completed, and had you known this information before, our 31st March 2025 financial statements would have been prepared differently. That type of information we need to consider even though info is received subsequent to your financial year, which means after March. Either you can receive it in April or May or June, till the time your board of directors approve your financial statements. Okay, but the point is this information is really kind of obtained by the company subsequent to your 31st March 2025, but it relates to the information, it relates to something before 31st March 2025. It relates to a condition existing on 31st March 2025. It relates to a situation existing on 31st March 2025. Are you able to get me? Again, I repeat, this so-called information which you have received subsequently after 31st March 2025, either in April or May or June or till up to the date of approval of financial statements by the board of directors, this information relates to a condition existing on 31st March 2025. This information relates to situation existing on 31st March 2025. You got the point? That is the keyword. So if that is the case, yes, we will adjust our financial statements and those events will be referred as adjusting events. This I've already told you. Now let's look at the official definition now. These are the events that provide additional information relating to conditions or situations that are already existing on balance sheet date, that is 31st March 2025 in our case, okay, in our example. These events will be considered in preparing the financial statements of the concluded period, that is 1/4/2024 to 31st March 2025 according to our example. Okay, it may lead to change in the carrying amount of some assets and some liabilities, or it may impact the classification as well. Therefore, hereafter we'll be representing this as AE in red. AE means adjusting event, where we'll have additional information subsequent to the reporting period, that is after 31st March 2025, and that additional information relates to the condition or situation existing on the balance sheet date, that is on 31st March 2025. Then we will adjust the numbers of a particular asset or a liability, or we may even change the classification as well, and these events are referred as adjusting events. Clear? Right, fantastic. Okay, then what about non-adjusting events, sir? Very simple. Non-adjusting events are those that are indicative of conditions that arise after the reporting period. What is the keyword here? Relating to the conditions or situations existing on the reporting period. Here it relates to conditions that has started or came after the reporting period. Situations existing after the reporting period, not on the reporting period. You got the point? So once it is after the reporting period, then obviously you will not adjust it because it happened after the financial year, after the reporting period. You got the point? After 31st March 2025. Got it? In our example. So these are other than adjusting events. So therefore we will not adjust it. That's why it is called non-adjusting events. However, if they are material in nature, you know what is materiality, right? It will have some sort of effect on your decision making with respect to the financial statement numbers that you see. So if it has got a material effect, then they will be disclosed in notes to accounts and as an estimate of its financial effect if practicable, which means if it is possible. Ultimately, you should disclose. So all non-adjusting events will not be disclosed. Those non-adjusting events which are material in nature, that will be disclosed. All non-adjusting events will not be disclosed. Is that clear? Only those which are material in nature, that will be disclosed. Am I clear? Right, that's it. So non-adjusting events are those that are indicative of conditions that arose after the reporting period. Adjusting events are those which is reflective of the conditions or situations relating to the reporting period. Conditions or situations relating to the reporting period, conditions or situations after the reporting period. Clear? Therefore, we will not adjust with respect to this one. However, if they are material, we will disclose it. And the financial effect also will disclose. Clear? Here, it's not about disclosing. We will go and straight away adjust the numbers of the asset which it is affecting or liability which is affecting or provision or whatever it is with respect to that particular balance sheet date. Clear? I hope this is clear. Okay. I gave you lots of examples over here. These examples by default you'll understand once we are done with all the cases over here. So let's do all the cases, then we'll come back and see. We need not see this also. By default all these things will be covered. Okay, you guys are ready? Shall we start with examples one by one? So we have how many? I think somewhere around 15 should be there. Yeah, we have around 17. It's like in this 17 cases, it's like almost like 12 to 14 sums we have covered indirectly. Okay, not directly, but that essence has been picked up and put it over here. So that once you are done with this, almost all the problems with respect to this particular Ind AS, you should be in a position to solve it very easily. Okay, you got it? And most of the sums are based on either adjusting events or non-adjusting events. You understand the point? So therefore what you will do, adjusting events, you write this definition, then apply the concept, write the answer. Ho gaya. Non-adjusting events, write this definition, apply the concept, write the answer. Ho gaya. If there is any problem where he is discussing about events occurring after reporting date, write this definition, then apply the concept, write the answer. Ho gaya. There ends the matter. That's all. So all you have to do is remember this, this and this. That's all as far as this particular standard is concerned. Okay, no need to go through all these examples, Nana. Let's finish these cases. Automatically that examples will be covered and most of your sums also will be covered. You guys are ready? We'll start. Alright guys, if you look at this example, okay, case 1. 31st March 25, you have balance sheet date or reporting period, okay. 30th June 25, what is happening? Board of Director approval. So this is the date of approval as per Ind AS 10, that we already know. 31st July 25, date of approval by supervisory board. Now we know that if these guys are managing the company, then whoever manages the company, if they approve, that is date of approval as per Ind AS 10. Now, suppose if there is no board of directors, management is done by supervisory board. If these guys are doing management, then their approval is the date of approval. Which means if these guys does not exist and these guys are managing the company, then the date of approval by supervisory board is nothing but date of approval as per Ind AS 10. You got the point? Very important. So the key point that you need to understand is whoever is managing, their approval is required and that will be considered as date of approval as per Ind AS 10. So with this example, is this point very clear? Everybody? Chalo, fantastic. Now coming on to case 2. Now see Nana. 31st March 25, after that April, May and June, you have this first quarter. For that interim financial statements are issued on 31st July 2025. Fine. For this major annual financial statements, the date of approval is 31st August 25. Let's keep it that way. Okay. Now, what these guys' argument is, in the financial statements issued on 31st July 2025, which belongs to quarter 1, which is obviously interim financial statements, we have already disclosed lot of things that is relating to non-adjusting events, which means there are certain events that has happened for which the condition is not existing before the balance sheet date, but the conditions are existing after the balance sheet date. Therefore, you will not adjust. Okay, they are not adjusting events, they are non-adjusting events. So with respect to non-adjusting events, what you should do usually, you should disclose it if it is material. That's what Ind AS 10 says. But here these guys, or argument is that the company guys are arguing, saying that why should we even disclose that? Okay, why? Because anyway in this interim financial statements we have already shown whatever that is required. Then why should we do another separate disclosure relating to the annual financial statements? Now that doesn't really require, but the standard says you should still disclose. Your interim financial statements are different, your annual financial statements are different. Are you able to understand? After your 31st March 2025, after the balance sheet date, before the date of approval by the board of directors with respect to your financial statements, whatever happens in between, if it falls under the definition of either adjusting events or non-adjusting events, irrespective of whether you have shown the same in interim financial report, it doesn't matter. Ultimately, if it is an adjusting event, go and adjust. Okay, if it is a non-adjusting event, see whether it is material or not. If it is material, you disclose. There ends the matter, irrespective of whether you have already given that sort of an effect in the interim financial statements or not. It doesn't matter. Okay, interim financial statement has its own merits and demerits. Financial statements has got his own merits and demerits. There ends the matter. So don't try to club both of them. Just because you have shown something in interim financial statements doesn't mean that you can escape here by not disclosing the so-called non-adjusting event. That's what the standard says. Clear? Are we done with this? Fantastic. Moving on to the next case. Now see here. Let's say this is your 31st March 25. After that you have got 1st July. Okay. So April, May and June your first quarter, and July, August, September your second quarter. And for second quarter there is interim financial statements. Okay. And the date of approval for that so-called interim financial statements by board of directors or audit committee is this particular date, which means let's say it is 5th October. And 15th October your main financial statements are approved and issued. So which means before your main or annual financial statements are approved and issued by board of directors, your second quarter interim financial statements also were approved. You got the point? Now, should I disclose any non-adjusting events with respect to what? The so-called interim financial period as well. Do you understand the question here? Sir, what do you mean by that, sir? I'll tell you. Nana, from 31st March 25 to 15th October is date after reporting period. This is the date after reporting period, and whatever the events that happens here, we call it as events after reporting period. Ye to clear hai? Right? Similarly, if you consider this as a period, interim financial statement, the second quarter, then from here, okay, this is the last date, just like the balance sheet date for annual financial statements. This is the last date, just like this date. Okay, but only difference is this is for interim financial period, this is a quarter, this is whole year. That's the only difference. Clear? So just like this is the last date of the reporting period. Okay, and from here to here, this is just like events after reporting period only, na? This is date after reporting period for the interim financial statement, not the annual financial statement of the financial year. You got the point? So if there is anything happening in between, then if there is any non-adjusting event over there with respect to the so-called interim financial statements, which means there is some event that has happened here whose condition did not exist on this particular second quarter, but it is material enough, therefore you have to do disclose it as non-adjusting event with respect to the so-called interim financial statement. Then should you do that? Yes, because the reporting period is not defined as per Ind AS. You understand the point? Which means reporting period means anything can be a reporting period. This whole year can be a reporting period. This quarter two also can be a reporting period. You understand the point? So whatever that we have learned so far as per Ind AS 10 can be applied for the so-called 1 year, for the main annual financial year. It can also be applied for this quarter two interim financial period as well. And between this last date and the date of approval of the interim financial statement, this will also be a date after reporting period time after reporting period. And if there is any event happening over here, it is events after reporting period as far as this quarter 2 interim financial statements are concerned. Am I clear? So because the keyword for Ind AS 10 is reporting period, any term for which reporting is done by preparing financial statements is a reporting period. So this is also a reporting period. 1st April 24 to 31st March 25 is also a reporting period. This so-called second quarter is also a reporting period. So from 31st March 25 to 5th October is a events after reporting period, this particular time period, if any event happens, right? Similarly, from 30th September to 5th October, this is also a period after reporting period, date after reporting period. And whatever happens here, we can call it as events after reporting period. And if there is any non-adjusting event here, they should be disclosing that in interim financial statements notes. You understand the point? Right. So should I disclose any non-adjusting event? Yes, applies for both annual financial statements and interim financial statements. Also, interim financial statement should be adjusted for adjusting events as well between the end of interim financial report and date of approval of board of directors, that is this period. So if there is non-adjusting event, disclose it if it is material. If there is an adjusting event, you go and adjust it. So this quarter 2 also should be seen equally on par with the so-called annual financial period. You understand the point? Only the time is different. This is for 1 year, this is for 3 months. Everything else is same. How you are looking at this so-called one financial year from 1/4/24 to 31st March 25. Similarly, you should see this period also. This is just 1 year, this is just 3 months. That is the only difference. All the rules apply equally as far as Ind AS 10 is concerned. Nana, very important point, Nana. I hope you guys are able to understand this. Clear? Chalo. Okay. Everybody it is clear? Right. Moving on to case 4. Now see here. This we have already seen. This case 4 basically represents whatever that we have learned so far. 31st March 25 is your balance sheet date. On 18th June, if suppose any event occurs, and because of that you have some additional information relating to situation or condition existing on balance sheet date, okay, then it is an adjusting event. Okay, this we already know, nothing special. Chalo, we have already read in the definition of adjusting events. Case 4. Now let's have a look at this. You guys are ready? Now coming on to case 4, Nana. Right. On 31st March 25, a court case is pending. Okay. So because the court case is pending and you feel like probably things will go against you, so it's a kind of contingent liability, or you have created a provision, either way. So you have created a provision for 10 lakhs thinking that something will go, mostly it will go against you. Okay, that was your thought process on 31st March 2025. In June, the court judgment has come and the court has ordered to pay you 15 lakhs. Got it? Now tell me, is this an adjusting event? Because first of all, this is event after the reporting period, correct? Because this is your reporting period and it is after your reporting period because it is before the date of approval of your financial statements by board of directors. Okay, so this falls under the events after reporting period definition. Fine. So first, that is what you need to check. After checking that, now is it an adjusting event or non-adjusting event? That is the second thing you need to check. Now this so-called payment which you are going to pay right now because of the court judgment going against you, which is around 15 lakhs over here. Now, does this relate to any condition or situation existing on your balance sheet date? Of course, a court case is pending. So this is related to the condition or situation existing on the balance sheet date. I know that it will go against me. That is the reason I've created a provision for 10 lakhs. However, I thought it's going to be 10 lakhs, which eventually I will pay. I ended up paying 15 lakhs. You understand the point? Therefore, is it an adjusting event? Yes. So go back, put a backdate entry and debit your P&L account and increase the provision by, I think it should be 5 lakhs, right? Sorry. All right. Okay. So increase it by 5 lakhs. Now it is done. Okay. 15 lakhs and 15 lakhs. Now, suppose, say for example, here the situation is unfavorable. Even if it is favorable also, the treatment should be same. You should be in a position to what? do the adjustment. For example, let's say here you have created a provision for 10 lakhs. Let's say here he has ordered you to pay only 7 lakhs. Then also you have to adjust it, which means you need to reduce your provision by 3 lakhs. You understand the point? Which means eventually you'll be creating your P&L account. So decrease also same treatment, which means whether it is favorable or unfavorable, same treatment. You got the point? Hello? Alright, Anna, done with this? Yeah, everybody, just give me confirmation. Any doubt with respect to case 4? Shall I move to the next one? Yeah, in case 4, of course, Anna, the most important thing that you need to learn is, here it is unfavorable for us, whatever the example that I gave you. Even if it is favorable, your treatment will be the same. It will be an adjusting event. Okay, let me write here. It is an adjusting event. Here. Okay. Are we done with this? Clear? Chalo, moving on. Case 5. Now in case 5, company said that we will pay 7% of profit as bonus. That's what the company has said. They said it before 31st March 2025. Now, accordingly, they have created a provision for bonus. So they have calculated expected profit, because you don't know what your actual profit is going to be, because a lot of calculations still needs to happen. So they've calculated expected profit and they promised 7% of the profit as bonus. So into 7%, they thought that their expected profit will be 1 CR, into 7% will be 7 lakhs. You got the point? Accordingly, they have created provision for bonus on 31st March 2025. Clear? Right. You don't know the correct profit as financials are not yet ready. So that keep it in mind. Now, after some time, one day, maybe in May or in June, okay, you know your correct profit after all the adjustments and calculations and that, this and everything. How much is your current profit? 1.20 crores. Okay, which means your correct bonus will be how much? 1.20 CR into 7%, which will be 8,40,000. Which means eventually you have to pay 8,40,000 bonus. Whereas you have created provision for how much? 7 lakhs only. Now tell me, first of all, is it an event after reporting period? Yes, because this is your reporting period. After that, before the date of approval, this event has happened. So it is event after reporting period. That definition is satisfied. Next, is it an adjusting event? Okay. Does this belong to the condition that is existing on the balance sheet date? Yes. I know that I have to pay bonus. Only thing is that I have estimated my expected profit as wrong. That's all. So therefore, is it an adjusting event? Of course. So then what you will do, you'll go and adjust. Yes, I go to the backdate entry, I'll put a backdate entry, and eventually I'll increase the provision from 7 lakhs to how much? 8,40,000, which means I have to debit my P&L by 1,40,000 and increase the provision by 1,40,000, such that this 1,40,000 will go and add to 7 lakhs and eventually it will become 8,40,000. Like that, I'll put a backdate entry. You got the point? So is it an adjusting event? Yes, it is. Now, suppose company does not promise any bonus. Here they have promised already. Suppose they did not promise before 31st March 2025, which means before the reporting period or on the reporting period, they did not make any promise. Company is silent. Okay. But after preparing financial statements, it got huge profit. Then suddenly they have announced the bonus. Now tell me, in this case, is it an adjusting event? Okay. First thing is, does it relate to any condition existing on the balance sheet period? Condition means, is there any clue that you are going to announce the bonus? No. The company is silent, which means the condition of announcing bonus arrived or got only after the reporting date, correct? Which is 31st March 2025. In that case, definitely it is a non-adjusting event. Clear? Now, if it is material, you will disclose it, its financial effect and all that. If it is non-material, you will not even disclose it. As simple as that. Are we done with this? Are we done with this case 5 with respect to bonus? Clear? Any doubts? Chalo. Moving on to next one, case 6. Now here on 31st March 2025, that is on the balance sheet date, you have a debtor, okay? And he has to pay you, he has to give you 10 lakhs. But because an earthquake happened, the debtor suffered major loss on 1st March. 1st March means before this balance sheet date. And you thought that something is wrong. Arey, yeah, this guy has suffered earthquake, so something is going to be wrong. I really doubt whether he'll be making the complete payment of 10 lakhs. So therefore, he created a provision of 4 lakhs. You understand the point? And he at least thought that at least 6 lakhs will come from the debtor. But then eventually on 15th June 2025, see, The debtor suffered major loss on 1st March, that is before this so-called balance sheet date. And looking at this on 31st March 2025, I have created a provision, at least thinking that at least 6 lakhs will come. But later on 15th June 25, that is after the reporting period, the debtor has declared insolvency, which means absolutely 0 rupees will come from him. Which means now again, is it an adjusting event? First of all, is it an event after reporting period? Yes, after reporting period, before approval, right? So it is event after reporting period. Next, is it an adjusting event or non-adjusting event? Now tell me, does this so-called declaration of insolvency by this so-called debtor relates to any condition or situation existing on the balance sheet date? Yes, it is. On the balance sheet date, I know that this guy has suffered the so-called earthquake. I know that he has suffered major loss on 1st March itself. That is the reason I've created the provision. Only mistake is I thought at least 6 lakhs will come, but eventually 0 is coming. Therefore, go back, put a backdate entry and debit the P&L by 6 lakhs and increase the provision for debtors for 6 lakhs. You understand the point? Therefore, it is an adjusting event. Are we done? Now, say for example, we'll make a small change in this example. This Mokku fellow debtor did not suffer major loss through earthquake on 1st March, that is before the balance sheet date, which is 31st March 2025. He suffered, let's say, after that. Suppose earthquake happened on 20th April, which means after the so-called 31st March 2025. You understand the point? After the balance sheet date. In that case, what would have happened? Will it be an adjusting event? No, because the earthquake happened after the balance sheet date. So which means on the balance sheet date, there is no condition, there is no situation, which implies that there will be an earthquake. You understand the point? Therefore, it will be a non-adjusting event. Got the point? So definitely, because it is material, it shall be disclosed. But the point is, it will be a non-adjusting event. Because the earthquake has happened before 31st March, and seeing that I've created a provision, therefore the condition is already existing on this balance sheet date. That is the reason I've adjusted. You understand the point? But suppose the earthquake would have happened after 31st March, that is on 20th April in this example, then it will be a non-adjusting event. Clear? So I gave you both the perspectives and both the examples. Is it clear? Everybody? Right. Fantastic. Moving on. Case 7. Let's say on 1st February 2025, cashier embezzled cash. Chalegi. Now, on 31st March 2025, you have closed this is the balance sheet date, you have closed things. And let's say on 1st May 25, the cashier resigned and new cashier appointed. And then once the new cashier has come into picture, the fraud has been identified. Now, first of all, is it event after reporting date? Yes, because still the approval of financial statements by board of directors did not happen, and this is after the balance sheet date. So in between that period, therefore it is event occurring after reporting period. Fine. Second question, is it adjusting event or non-adjusting event? Now tell me, whatever the fraud that you have identified relating to this particular fraud, is there any condition or situation existing on the reporting date? Yes. The fraud did not happen with respect to things on this particular date. The fraud happened before the balance sheet date. Cashier embezzled cash on 1st February. Cashier did not embezzle cash on 1st May 2025. You understand the point? What is the date on which cashier embezzled cash? On 1st February 25. Cashier did not embezzle cash on 1st May 25. You understand the point? Therefore, this so-called fraud which you have identified, has it got any condition or situation pertaining on the balance sheet date? Yes, because he has embezzled cash on 1st February 25. You understand the point? Whether management is aware or not is irrelevant. Fraud condition existed before balance sheet date. Therefore, it is an adjusting event. Therefore, you have to go back and then adjust it. Is this clear? Everybody? Alright guys, so we are done till case 7. Now let's come to case 8. Now this is an interesting one. See here, on 31st March 25, what is happening is you have the balance sheet date and investment in equity shares has already been fair valued at fair value through profit and loss account, which is FETPL, that is 2,50,000. So which means basically you did everything right here. You already did the fair value valuation, right? It's done and dusted. And then eventually after that, if you have sold at a higher value, which is 2,90,000, this doesn't mean that there is an adjustment that you need to do. You understand the point? And go back and then adjust it, which means the fair valuation, what you have done on the balance sheet date is wrong. No, this is a natural increase in value of the investment. You got the point? On that date, whatever the value is there, that anyway you have done it. And then naturally the value keeps on increasing. That's how, investment in equity shares and all those things works. In general sense, investment work that way only. You got the point? So therefore, it is a non-adjusting event. And if it is material, you will disclose it. Otherwise, you will not do that as well. And of course, this is an event after reporting date, because this is after the balance sheet and before the date of approval. Got it? But of course, it is not an adjusting event. It is non-adjusting event. Whether you should disclose it or not depends upon whether it is material or not. If it is material, you will disclose it. Clear? Are we done with this? Chalo, moving on. Case 9. Same logic as case 4. So what is that? We'll see. On 31st March 25, you have valued your inventory. You know how inventory valuation will happen at cost or NRV, whichever is less. NRV is net realizable value. Mostly net realizable value will be based on expected selling price. Okay. Now cost comes around 5 lakhs. Expected selling price based on which you calculate your NRV comes around 4 lakhs. So whichever is less, you have valued your inventory based on 4 lakhs. Clear? However, exactly after 5 days, 31st March 25, exactly after 5 days, on 5th April, you have sold the same inventory which you have valued 5 days back at 4 lakhs at 3 lakhs. So which means, now first of all, is it an event after reporting period? Yes, because it is in between these two dates. So it is event after reporting period. There is no doubt in that. Second, is it an adjusting event? Let's check. Does this so-called selling your inventory at 3 lakhs has got a condition existing on your balance sheet date? Yes, because on balance sheet date, you have measured your inventory at cost or NRV, whichever is less, and NRV was less, and therefore you valued your inventory at 4 lakhs. However, exactly after 5 days, you were able to sell the same inventory which you have valued at 4 lakhs based on the selling price only, like nearly 5 days back, at only 3 lakhs, which means this itself is an evidence that your valuation at 4 lakhs saying that it is NRV of the inventory is wrong, and therefore it is an adjusting event, and you have to go back and adjust the value of the inventory. That is, adjust the value of the asset, current asset. Now, look at the point over here. The sale value of inventory after the reporting period normally provides evidence about NRV at the end of the reporting period. So the sale value being 3 lakhs, which is much lesser when compared to 4 lakhs NRV which you have actually valued, this itself is a proof or evidence that your NRV valuation is not correct, and therefore you have to go back and adjust, and therefore it is an adjusting event. Is that clear? Everybody? Fantastic. Now let's move on to case 10. Now look at the case 10 over here. 31st March 25, okay, investment value is 5 lakhs, fine. And after this, we'll take some other date, let's say 10th May 25. Date of approval, let's say it is 30th June 25. Now, investment value is how much, Nana? 3 lakhs, okay. Now, which means your value of invested actually has got reduced. Now, what should I do? Should I treat it as an adjusting event or non-adjusting event? That is the question. First of all, before finding out whether it is an adjusting event or non-adjusting event, first we need to confirm whether it is an event after reporting period. So it is after the balance sheet date, before the date of approval. It satisfies the conditions of being an event after reporting period. Okay. Next question. Is it an adjusting event or non-adjusting event? Let's see. If conditions of decline with respect to this investment value is existing on the balance sheet date, then yes, we will go and we will adjust it. We will treat it as an adjusting event, which means there must be some sort of a clue, some sort of a condition, some sort of a situation on the balance sheet date, trying to communicate to you, trying to give you a hint that later the investment value will go down. You understand the point? In that case, it will be an adjusting event. But such kind of a condition which gives you a clue saying that investment value will fall down were not present on the balance sheet date. General market changes in the value happened, and as a result your investment value has fallen all the way from 5 lakhs to 3 lakhs. In that case, it is a non-adjusting event, and if it is material, then you disclose it. Otherwise, there is no need of disclosure. Are you able to get my point? So which means in this case, basically what has happened, your investment value has reduced from 5 lakhs to 3 lakhs. Now, should I treat it as non-adjusting event or adjusting event is the question. If there is any condition or any clue or any hint on the balance sheet date that in future the investment value is going to fall down, then it is an adjusting event. You will go back to the back date and then adjust the value of the investment. Clear? If there is no clue, there is no condition, there is no situation on the balance sheet date that in future the investment value is going to drop down all the way from 5 lakhs to 3 lakhs, you got the point, and it is a general change in the market and the investment value has got changed, in that case it is a non-adjusting event, and if the change is material you will disclose it. If it is not material, you will not even disclose it. Clear? I hope this is clear. All right. Moving on to case 11. Okay, look at case 11, Nana. On 10th December 24, you have purchased a machine. Okay. On 15th March 25, that is before the balance sheet date, you have installed and it is ready for use as well. But the problem is the final bills are not submitted by the vendor. Vendor did not give you the final bills. Okay. But it is installed and it is ready for use. But the final bills are not given, which means the vendor did not give you a bill with respect to how much is the cost for installation. And to make it ready for use, you need to use the machine. Now, for that training will be given. That training cost also the vendor did not give you, which means how much is the amount in the form of a bill is not given. So therefore, because you don't have information with respect to installation cost, with respect to training cost, you valued your machinery without that only, and the machinery is showing at that particular value. Let's say it is 10 lakhs. And let's say installation and the training cost is 50,000. But that bill is not given by the vendor, therefore you did not add it to the cost of the asset. Otherwise, you would have done. Clear? Huh? Now, after the balance sheet date on 10th April 25, he has sent you the bill. And in that bill, the cost of installation and training is given, which accounts around 50 lakhs. In that case, what you will do? First question, is it event after the reporting period? Yes, between the balance sheet date and date of approval. Okay. Is it an adjusting event or non-adjusting event? Now, this bill that he has sent, is it relating to a condition that is pertaining on the balance sheet date? Yes. Definitely it belongs to the condition pertaining to the balance sheet date, because before balance sheet date only, long back I've purchased the machine, and exactly 15 days before the balance sheet date he has installed and the machine was ready for use. Training also was given to my employees by the vendor. You got the point? So therefore, do I have a condition on the balance sheet date or situation with respect to this particular bill sent on 10th April 25? Absolutely yes. So which means it is an adjusting event, correct? So what you will do with respect to the bill on installation as well as training cost, it will be taken back and it will be added to the cost of the machine. It will be capitalized. That's what I've written here. Why it will be capitalized? Because it's an adjusting event. Why it is adjusting event? Because condition existed on balance sheet date. Simple. Clear? Done? Chalo, fantastic. Next. Case 12. Now moving on to case 12, Nana. Okay, so let's see what has happened here. This is interesting. This is based on going concern. Okay. So before we finish this case 12, let's finish the going concern. Okay, now see. What is the concept of going concern? Going concern becoming invalid. Let's have a look at it. If an event occurring after balance sheet date makes the going concern invalid, it should be treated as an adjusting event, even though, see, normally what happens when we will treat something as an adjusting event, when there is a condition or a situation or some sort of a clue existing on the balance sheet date, and then after the balance sheet date, subsequently we receive some additional information. That's when we call it as an adjusting event, correct? But when it comes to something that is affecting going concern, even though there is no situation, there is no condition existing on the balance sheet date that will affect the going concern concept. You understand the point? So in that case, logically speaking, if an event subsequently happened after the balance sheet date, that is after the reporting period, and it has got no condition or situation existing on the balance sheet date, typically, logically speaking, from the very definition, we should treat it as a non-adjusting event. However, the only exception for that is going concern. When the so-called event, which happens after the balance sheet date, before the date of approval of the financial statements by the board of directors, but that event is so big, is so damaging that it questions the very basic assumption of accounting, that is going concern, In that case, even though there is no condition or situation existing on the balance sheet date, still you will treat this as adjusting event. Now see here, it should be treated as an adjusting event even though there is no condition, no situation on the balance sheet date. You got it? So going concern may be invalid, which means the company is about to what? Shut down due to reasons like heavy operating losses, ban on particular products which the company is manufacturing, intention of the management, maybe the management wants to sell it off or shut it down or whatever it is, deterioration in operating results, financial position after the report, whatever the reason it may be. Ultimately, the going concern has become a question mark. You got it? So which means that is a basic assumption behind the accounting, right? Fundamental assumption. If that itself is a question mark, you can't continue to prepare your financial statements based on the underlying presumption that it is a going concern. You understand the point? So which means you have to change your accounting and do accounting as if you're undergoing liquidation. That is what the standard tries to say. Is that clear? Right. See here. If the going concern assumption is no longer appropriate, which means you are about to liquidate, you are about to shut down your business, the effect is so pervasive that this standard requires a fundamental change in the basis of accounting. What is the fundamental change that this standard requires in the basis of accounting? Earlier, the basis of accounting, the fundamental assumption is the company is considered to be a going concern, which means for foreseeable future, it is going to operate in business, correct? But that fundamental change has to happen. That fundamental assumption, which the business is going to operate for a near foreseeable future, has to be changed. So rather than an adjustment to the amounts recognized within the original basis of accounting, all the assets shall be presented at realizable value and the liabilities at settlement values. You will do like this only when you are about to go for liquidation. You will do liquidation based accounting only when you know that the going concern assumption does not work right now. It is gone. It is done and dusted. You understand the point? That's what the standard also says. Got it? So finally, Ind AS 1 specifically, ask about this particular disclosure. What is that? The financial statements are not prepared on going concern basis. If you are preparing your financial statements not on going concern basis, that has to be specifically disclosed. Because generally what we'll do, generally whenever we prepare financial statements, the default assumption is it is based on going concern basis, correct? Now when you're doing something exception to that, you're preparing a financial statement not on the basis of going concern, then you have to disclose it. That's what Ind AS 1 says. And management is aware of the material uncertainties related to the events or condition that may cause significant doubt upon the entity's ability to continue as a going concern. The events or condition requiring disclosure may arise after the reporting period. Anyways, ultimately the summary is very simple, Nana. The summary is, normally whenever we have to treat something as adjusting event, whatever the events that is happening after the reporting period, there must be some situation or condition or clue that should have happened on the balance sheet date. But there is an exception for that, that is going concern situation, where some event has happened after the balance sheet date, which questions the going concern of your entity. In that case, you will treat it as an adjusting event even though there is no condition or situation existing on the balance sheet date. And after that, you will start accounting without the assumption of going concern. In other words, you will do accounting, you will prepare your financial statements not with the assumption of going concern, but with liquidation perspective. Therefore, you will value all your assets at realizable value and liabilities will be valued at settlement values. You will do this only when you do accounting based on liquidation. In other words, you will do accounting not on the basis of going concern. Clear? I hope this is clear, right? Now that we have seen the concept, let's come to the example. On 31st March 25, this is your balance sheet date, correct? Now, before the balance sheet date, the company has only one business, that is publishing directories for Pune Circle. Pune Circle is one area. For that particular area, this company has only one business. That business is publishing directories for that particular area. That's all. No other business is there. Okay. Your balance sheet date has come. 31st July is your date of approval. That is also there. Between these two, we call it as period after reporting date, correct? Whatever events happens here, we call it as events after reporting date. We know this. However, on 31st December 25, the contract for publication of Pune directories, which is your only business, will expire. Which means on this day, you know that The contract will expire on 31st December 25. So which means this arises for a going concern issue, which means you can't prepare your financial statements based on going concern. It is not appropriate, which means you should prepare your financial statements based on liquidation. That's all. Got the point? All your liabilities will be at settlement values, all your asset will be at realizable values. That's how you have to show, which means you have to do your financials, prepare your financials based on liquidation, not based on going concern. That's all. Am I clear? Moving on. Case 13. So this is your balance sheet date. On 10th May 25, that is after the balance sheet date, a fire accident has happened and the plant has been damaged and the loss is nearly 40 lakhs. There is insurance that you have taken, but you have received only 27 lakhs insurance. Okay. All right. So is it event occurring after reporting period? Yes, because it is in between balance sheet date as well as date of approval of your financial statements by the board of directors, right? Now the question is, when this fire accident has happened and the loss is pretty big, because 40 lakhs is a pretty big loss. Okay. Now the question is going concern is getting affected over here? If the answer is yes, because of this so-called big loss, if it is affecting your going concern, then you should prepare your financial statements not on the basis of going concern, but on the basis of liquidation, where your assets will be valued at realizable value and liabilities will be valued at settlement value. Clear? If going concern is not affected, that is one possibility. If going concern is not affected, then treat this as a non-adjusting event. Why? Because the fire accident happened on 10th May. Do you have any clue or a condition or situation on 31st March 25 saying that the fire accident will happen in future? No. So there is no condition or situation existing which gives you a clue that fire accident will happen on 10th May. Therefore, this is an isolated incident. Okay. There is no clue or condition existed on the balance sheet date. Therefore, this is non-adjusting event. And because the loss is really big, it is material. Therefore, it has to be disclosed. You will do this provided if it is not affecting your going concern. If it is affecting your going concern, then it becomes an adjusting event because it's an exception to the rule. Correct? Even though condition or situation are not existing on the balance sheet date. And you'll do accounting not on the basis of going concern, but on the basis of liquidation, which we have already discussed. Correct? Right. Fantastic. Moving on. Case 14. 31st March 25, a legal suit with the excise department is there. Already it is existing on 31st March 25. On 15th April 25, court order in favor of the company to reduce excess liability on 31st March 2025. So whatever the legal suit that you have with the excise department, court ruled in your favor. Got the point? Now, is it an adjusting event? Yes, because there is a condition existing on the balance sheet date. Therefore, it is an adjusting event. Whether the court ruled in your favor or court ruled not so in your favor, it doesn't matter. Whether it is favorable or unfavorable doesn't matter. Ultimately, the condition was existing on the balance sheet date. Therefore, it's an adjusting event. There ends the matter. That's all. Clear? Everybody? Fantastic. Now, moving on to case 15. On 1st May 25. Okay. Okay. I should take it as 1st Jan 25. Let me correct the question. 1st Jan 25. Okay. Now, on 1st Jan 25, what has happened, Nana? Negotiation started. Okay. Between two companies, X Limited and Y Limited. One company has to invest in the other company. Okay. And on 31st March 25, that is on the balance sheet date, nothing has been crystallized. Nothing has been finalized. Okay. On 11th April 25, exactly after 11 days after the balance sheet date, X Limited decided to invest 100 crores in Y Limited. You got the point? Now tell me, can you treat this as an adjusting event? Just because negotiations started before the balance sheet date, can these negotiations be termed as conditions or situations existing on the balance sheet date, and as a result, this so-called event after the reporting period, that is investment, happened, can it be treated as an adjusting event? The answer is no. Negotiations do not act as conditions, do not amount to conditions. So this event will be referred as non-adjusting event, and of course it is material, therefore disclosure will happen. Clear? Just because you have done some negotiations, that does not mean it satisfies the rule which is conditions or situations existing on balance sheet date. Negotiations don't amount to conditions. Therefore, there are no conditions existing with respect to this so-called deal. Therefore, it will be treated as non-adjusting event. Therefore, since it is material, it will be disclosed. That's all. Moving on. I think last but one. Case 16. Now see here. On 31st March 25, entity do not have control. See, okay. This we will see later. On 31st March 2025, your balance sheet is done. Okay. Now, on 15th April 25, you have received a check with respect to date, backdated check, 31st March 25. Backdated check. Okay. Not the forward dated check, but backdated. Now tell me, this check is with respect to debtors. Okay. Given by whom? Debtors. Obviously, they have to pay you money. With respect to that, they gave you what? Check. Got it? Now, of course, this check is related to the debtors existing on your balance sheet date. Does that mean that it is a condition existing on the balance sheet date? The answer is no. Again, I repeat, you have received a check dated, backdated. You have received on 15th April only, but it is backdated to 31st March 25, which means immediately they can use the check. Okay, they can encash it. That is given by whom? Debtors, to whom you have done business. Earlier, you have sold the goods, and there are debtors in your balance sheet. Are these debtors or the debtors on your balance sheet date? Yes. But the problem is, just because these debtors have made a payment with respect to the sales that have done in the previous year, that doesn't exist as a condition. Just because they are debtors in your balance sheet, that doesn't satisfy the condition or situation existing on the balance sheet date to treat this as a adjusting event, because this is usual business, Nana. You will have debtors on the balance sheet date because you do business, you do sales, you do have debtors, and eventually at some point of time they'll keep on making you payment. Some debtors will make payment on 15th April, some will make payment on 30th April, some will make payment on 5th May. This is a usual thing that happens in a business. So just because debtors are making payment, that doesn't mean that because debtors are existing on the balance sheet date, that will be considered as a condition or situation as per Ind AS 10, and therefore this check that you have received will be treated as an adjusting event, and therefore I'll go to the balance sheet date and then I'll try to what? Reduce my debtors and increase my cash. Can you do something like that? No. You understand the point, right? Because this is usual business that happens always. So therefore, they do not represent any condition existing on balance sheet date. So therefore, not an adjusting event. It is non-adjusting event. Disclosure also not necessary because it's not going to affect the financial position of your company. Got it? Debtors making payment is a usual part of the business. That's what you need to understand. Unique case. Clear? This gives you a different perspective. I hope this is clear. Everybody. Chalo, moving on to the last one. Case 17. 31st March 2025 is done. This is your balance sheet date. On 15th June 25, you have got a demand notice of additional amount of 15 lakhs from excise department because of higher rate, which means you thought this particular rate of excise duty will be levied for you. You thought, say for example, you thought 8%, but you got a demand notice from the excise department saying that no, 8% is not what you have to actually pay. You have to pay 12%, another slab. You understand the point? With respect to the rate, there was a difference between your calculation and the excise department calculation. Ultimately, excise department gave you a demand notice of additional amount of 15 lakhs from excise department cause of higher rate. Clear? Now, does this demand notice which you have got from the excise department with respect to the goods that you have sold before the balance sheet date? Yes. Which means this is a condition existing on balance sheet date? Yes. Therefore, it's an adjusting event. Now, you can tell me, sir, here you said you have received a check with respect to debtors which you have eventually sold the goods to on the balance sheet date, but you said you should not consider this as an adjusting event, and immediately after that you are getting a demand notice from the additional amount from the excise department with respect to the goods sold on the balance sheet date, and now you are considering this as an adjusting event. Now if you can see, there is a clear-cut difference between these two. Debtors making payment is usual part of the business. Getting a additional notice from the excise department saying that you have to pay 15 lakhs extra is not usual part of your business. You understand the point? This is a rarity. And why did you get this notice? Because of the goods that you have sold on the balance sheet date or before the balance sheet date. Therefore, if at all you have not sold the goods before the balance sheet date, you would have not got this particular notice. Therefore, it pertains to the condition or situation existing on the balance sheet date, and as a result, it is an adjusting event. You have to go and adjust. However, when it comes to the so-called check that you received from the debtors, this is a usual part of business. Once you have debtors in your balance sheet, here and there, you can keep on expecting checks on, say for example, because all the debtors will not pay you at a time, na? So from time to time, you'll keep on getting payments from the debtors. So that is not a unique thing. It is a usual thing for business. Therefore, this is not considered as an adjusting event, whereas this particular thing has been considered as an adjusting event. I hope this is clear. This is where many students get confused. I hope this is clear. Are we done? Chala, fantastic. We are done with this particular chapter. Okay. Okay. There is one point with respect to dividends here. If entity declares dividend after balance sheet date, but before approval of financial statement, that is during that event after reporting period, okay, uh, then such dividend is not recognized as a liability at the balance sheet date because no obligation exists at that time. Dividend declaration has got nothing to do with the obligation on the part of the company, so it's their wish, right? So they have declared the dividend after the balance sheet date, so which means there is no condition existing on the balance sheet date that they will declare dividend. They may declare dividend, they may not declare dividend, because it's a choice not at the end of the day. So therefore it is a non-adjusting event. However, disclosure should be made in the notes in the financial statements. That's all. Got the point? So dividend declaration after the balance sheet date isn't an adjusting event or non-adjusting event. It is non-adjusting event. That's all. Because there is no condition existing on the balance sheet date that gives you a hint that dividend will be declared eventually. Dividend may be declared or may not be declared. Clear? That depends upon the financial position of the company, which you will know logically speaking after you prepare the correct financial statements, after all the adjustments, provision estimations and all that. Clear? I hope this is clear, right? We have already discussed the going concern concept as well. I have just written an example for going concern concept. Let's have a look at it. Now see here. Let's say there is a company called DEF Limited. On 31st March 2024 will be its balance sheet date. Date of approval of the financial statements by Board of Directors is 31st May 24. Okay. As of 31st March 24, DEF is stable. On that particular day, the company is good, healthy, stable. On 10th May 24, that is before the date of approval, which means it satisfies the definition of events happening after the reporting period. Okay, events occurring after reporting date. Now, on 10th May 24, major fraud discovered that wipes out most of its cash. Okay. On 20th May, the management decides to wind up the operations. Okay. So even though the condition did not exist on 31st March 24, that is on the balance sheet date, the DEF is stable, is considered to be stable, which means there is no condition existing that on 31st March 24 that in future you are going to become bankrupt. You understand the point? You are going to shut up your operations, you are going to what? Shut down everything and all those things, right? So even though the condition did not exist on 31st March 24, the event happened entirely after reporting period. Still, the DEF must DEF must not prepare financials on going concern basis, which means you must prepare your financials on liquidation basis. Apply liquidation basis of accounting, of course. Fully disclose the reasons. So treat this as an adjusting event. That I did not write. Treat it as adjusting event. This is exception to the rule. Exception to the rule of adjusting events. That's it. This we have already seen. Anyway, I gave you one more example so that it will be much clear. That's it, guys. With this, we are done with all the concepts of Ind AS 10. We have also almost covered all the problems. Maybe one or two models we would have missed, but apart from that, we did cover everything. Right? Chalo. Let's finish off this session. All right, friends. Come to the next session. Just confirm me whether the audio, everything is clear. Okay. Is there any lag? Once everything is clear, we'll start up, Nana. Right. Let's go on. We'll start with the new Ind AS, Nana, right now. Now, this from examination point of view, I can't say it is important, but at the same time, we cannot ignore it because it is there in the syllabus. We got to learn. That's the first thing. Unlike the earlier Ind AS that we have seen, which is Ind AS 40 and Ind AS 41, they are really important from examination perspective. Now, coming on to this is kind of an average standard, both in terms of importance from examination perspective as well as it will not be that interesting. This is to some extent a dry standard. Okay, it will be dry, it will not be that exciting, but still we have to learn it because it is there in the syllabus. Okay, so if you guys are ready, we're gonna start, shall we? Sure. So Ind AS 8, accounting policies, change in accounting estimates and errors. Now, if you look at the name itself, you can see accounting policies, whereas with respect to errors and accounting estimates, it is change in accounting estimates and errors, which means when it comes to accounting policies, it is broader from perspective what is going to be covered in this particular standard with respect to accounting policies. Okay. Anyways, we'll see that one by one. First of all, what is the purpose of this standard? See, anytime we start with a particular standard, we need to understand the purpose. Very simple. This standard tries to increase the reliability and reliance on financial statements. Okay. So the purpose of this standard to make the financial statements better serve its purpose. What is the purpose of financial statements? I have to show you reliable, relevant information so that you can trust upon the financial statements, as stakeholders, and eventually you can take your decisions accordingly. When I say stakeholders, it involves everybody who is some way or other related with the company. When I say stakeholders, it involves everybody who is some way or other related with the company, maybe directly related or indirectly related. You got the point. Shareholders, the bankers, the financial institutions, the suppliers, everybody comes under stakeholders. Okay. And all these stakeholders will look at the financial statements and they will make one or two decisions, one or more decisions to be precise. And therefore, this Ind AS 8 tries to ultimately make those financial statements more reliable and more relevant and more trustworthy. Got it? Anyways, so that is the objective of this standard. I hope you guys are clear. Chala, fantastic. Let's see what this standard discusses about. We're gonna divide this into two parts. One part is all about accounting policies. Okay, how to select a particular accounting policy, and then how to change a particular accounting policy. In what circumstances you will change an accounting policy? Can you change it by yourself, or you can change it only if Ind AS says? What are all the situations when you can change all those things? Okay. And regarding selecting your accounting policies also, you can just select it on your own, or there are certain conditions which Ind AS 8 says like this only you have to select an accounting policy. You got the point. That is what we're gonna cover over here. This is really important, Anna. Apart from that, we also gonna see accounting treatment, presentation and disclosure. Totally three parts: accounting treatment, presentation and disclosure. Disclosure is also very important, Nana. Of what? Change in accounting estimates, change in accounting policy and correction of prior period errors. Whatever the errors that you have got, when you're going to correct it, you know that omission and commission are the two types of errors, right? So how you're going to treat it, what are all the things that we have to do, all those things we're going to see. Okay, anyways. So as you can see, this standard is meant to increase the qualitative characteristics like the relevance, reliability, and comparability of the entity's financial statements. Okay. Ultimately, it's gonna make financial statements better, to put it in simple words. But while writing answers, we have to write all these wordings. That is important. Okay. Relevance, reliability, comparability. Okay. These words we need to write while writing the answers, because most of the questions anyway are going to be what? Theory based. And of course, there is one important point. It does not deal with the tax effects of corrections of prior period errors. That is dealt by some other standard. Okay, let's not discuss about that. But right now, this Ind AS 18, Ind AS 8 is not gonna deal with this. Okay, tax effects of corrections of prior period errors. So this is the intro part, Nana. Are we clear with this? Okay. What are we going to cover in this particular Ind AS? Selecting an accounting policy, when you can change the accounting policy, and accounting treatment, presentation and disclosure of changes in accounting estimates, changes in accounting policy, as well as changes in what? Errors, prior period errors, obviously. Are we done with this? Okay. So this is the intro. What is the purpose of the standard? What are we going to cover? I hope this is clear. I made it very simple. Now moving on. First, we'll start with what, Nana? Accounting policies. Now, the moment I've written definition over here, you know my style of teaching. You have been listening to so many classes. You know that this you have to memorize. The moment I write something called definition, you need to memorize. Why? Because there are gonna be so many questions which will be based on this particular definition, where you have to apply that definition and eventually write the answer. You got to remember the definition and write it as it is. Repeat it as it is. Same thing we have seen in the last standard also, Ind AS 41 agriculture, where agricultural activity definition I told you very important, and only that definition only how many times we have repeated in how many questions. You understand the point? So therefore, definitions, when I say it is important, it is important. You have to remember as it is. You need to write it as it is. This is based on ICA wordings only. I did not change anything, because if I change anything and make it simplify, right now you'll understand. But if you write it in the examination, you'll not get marks. You understand the point? So We got to make it easy, but we can't make it too easy, because if we make it too easy, then our wordings will not match with the ICA answer. Then we will not pass the exam. You got it? So we need to bring it to some level and stay there such that our answer tallies with the ICA. So my job is to take the ICA wordings, ICA language, and then try to teach it in a easier way possible for you. That's the best that I can do. Beyond that, any human can't do anything. Got it? Chalo. Anyways, let's move on. If you guys are ready, we'll start with accounting policies. Ready? One more thing, Nana. It will not be that interesting, but I'll try to make this particular standard as interesting as possible. But once we go to prior period errors, we'll be solving good sums, numerical sums, not like where you're gonna apply theory, theory-based application-oriented sums, not like that. Uh, Problematic sums will do. That will be interesting for you. We'll be changing a lot of numbers. We'll be doing retrospective effect at times with respect to accounting policy change also. All those things we'll see later anyways. But we'll do some sums. That is a good news in this particular standard. The rest of the things, concept wise, okay. See, that's all. Let's move on. Okay, first we need to learn this definition of accounting policy. Sir, do we need to memorize this? Yes. Do we need to reproduce this while writing questions, theory based questions, or even problematic questions? Yes. Sure. What is an accounting policy? Accounting policies are specific principles, bases, conventions, rules, and practices. Totally 1, 2, 3, 4, 5, which you need to remember. Okay. Principles, bases, conventions, rules, and practices that are applied by the entity in preparing and presenting financial statements. So what are accounting policies, Nana? These are specific principles. What is principles? We'll see later. Specific principles, bases, conventions, rules, and practices which are followed by an entity in preparing and presenting their financial statements. Got it? I don't think it's difficult to remember. I think it should be. You should be comfortable with that. Now, examples of accounting policies. Different inventory methods, Nana, will follow FIFO method to value our inventory, weighted average method to value our inventory, simple average method to value our inventory, LIFO method, base stock method. So many methods are there. Each and every method is an accounting policy. You change the method, it will be called as change in accounting policy. Clear? Valuation of investments at fair value through profit and loss account, fair value through OCI, other comprehensive income. So this also, you are keeping on changing the valuation of investments. Now, every time you change the valuation, that will be referred as change in accounting policy. Treatment of foreign exchange gains or losses, measurement basis for PPE and intangible assets, cost model or revaluation model. Got it? From cost model, you change to revaluation model. From revaluation model, you change to cost model. This we have seen it in Ind AS 16, and that will be counted as accounting policy. Of course, here there is an exception where for the first time when you select a cost model or revaluation model, when you have the asset for the first time, PPE, in that case, even though it's an accounting policy, but the effect will be prospective. That's only an exception. After that, over a period of time, if you are like a jumping jack and again going back from revaluation model to cost model, again changing from cost model to revaluation model, again it will be counted as change in accounting policy, but in those times the effect will be retrospective. That we have already seen anyways. At that time specifically, I've told you in that standard itself. I don't know whether you remember or not, Nana. Whenever there is a change in accounting policy, always it will be retrospective, Nana. But this is an exception where in this case, it will be prospective. This is the only case that is for the first time when you decide whether you got to follow cost model or revaluation model with respect to PPE. That's the only case where the accounting policy is going to be what, Nana? Prospective. Okay. But after that, whatever happens, it's gonna be, you have to give retrospective effect. Got it? Chalo, anyways, that we'll see later. But right now, let's concentrate on the definition itself. Okay, so accounting policy means these are specific principles, bases, convention, rules, and practices that is being followed by an entity in preparation and presentation of its financial statement. This you have to remember, and often rather than not, you have to repeat this when you are writing an answer. Got it? Chalo, we have seen examples as well. Okay, now let's dig deeper. This is what given in your ICA material, but that is not enough for us. So let's dig deeper. We'll try to understand each and every word over here. Principles, bases, conventions, rules, and practices. Got it? So I've written over here with examples. So one by one, let's try to understand. You guys are ready? First, let's start with principle. Principle means what? To put it very simple, ideally what you should do with respect to your accounting, that is nothing but principle. Okay. These principles basically provide the underlying logic for your, it's like a big picture, Nana, for your accounting. What is a big picture? What is a purpose? Ideally, with what mindset you have to do the accounting. That is what principle is all about. For example, you have accrual principle. Cash versus accrual, you guys know that, right? So it gives you overall idea, ideally what you should do. Once it accrues, you have to recognize. You understand the point? Revenue recognition principle, when you have to recognize the revenue, certain revenues you'll recognize this year itself, certain you'll have it recognized over multiple periods of years. You understand the point? Matching principle, you got it? That's what we have been doing with Ind AS 16 on all those things now. Matching principle. Okay, even in borrowing cost also we have done the same. You have to match the expenditure with the benefits that you're going to get from that expenditure. You got the point? And consistency principle, where okay, this year you have applied selected a particular depreciation method, then you better follow the same method. Okay, you applied cost model as an accountancy policy for a particular year, then you better follow the same model for the next year, next year, so that you are in line with the consistency principle. You got the point? So principles means it gives you ideally what you should do. Got the point? I gave you examples as well. Okay, are we done with this? Moving on to the next one, basis. The name itself tells you measurement base. Sir, what do you mean by bases, sir? See here, bases are concrete systems or measurement approaches used to apply the principles in place. Okay, used to apply the principles in place. Example, historical cost basis, fair value basis. For example, you went with a consistency principle, Nana, where you have applied revaluation model. Now, every year you need to apply revaluation model only, na? That is in line with consistency principle. Now, to apply revaluation model every year, you need to value your asset at fair value, compare that with the carrying amount. You understand the point of the asset, and eventually look at revaluation gain or loss, eventually transfer it to revaluation reserve under OCI. All these things we have seen. Na? Now this, you're measuring at fair value and doing all these things. Now that comes under base. That fair value is a base. You got the point? Inventory you're valuing. How to value the inventory? That's an accounting policy. But to value inventory, you need to see NRV or cost basis, whichever is less. Their NRV you're looking at, that's a base. NRV or cost basis, whichever is less, basis, whichever is less. You see that? That is nothing but basis. Are we done with this? So examples are historical cost basis, fair value basis, NRV basis, present value basis, amortized cost basis. All these are basis. Basis or something upon which principle you will apply. I gave you two examples already. Moving on. Conventions. What do you mean by conventions? This is very important, Anna. Accepted customs. Now, many a times people get confused between conventions and practices. Please understand these two are different. Okay. Even I've seen professionals getting confused even in MNC companies, especially with respect to these two, conventions and practices. So please try to understand the difference. Conventions means it is like broad guidelines. Okay. We can say best practices as well, but they're a little bit different when compared to practices, broader, general in nature. For example, there are big companies which has got calculator as a PPE. Company is doing business in thousands of crores of turnover. Calculator is a PPE only. You got the point. Benefit are going to come for multiple years, but then still you will throw it in P&L account. You'll not capitalize it. Why? Because it's a petty expenditure when compared to the size, length, and breadth of the business that a particular company is doing. Now, why are they doing like that? It is a kind of convention that they do. Generally accepted, custom. You got the point. Accepted customs. So conservatism sometimes, materiality concept, which has to be decided as material, which should be decided as immaterial. Even our Ind AS also says this now. See, practices means they are informal in nature. They have got nothing to do with Ind AS. Okay. Conventions means most of the times Ind AS also takes that into consideration. It's a kind of formal thing. Okay. Practices are absolutely informal. That's the difference between best practice and practice. Normal practices, probably in that particular industry, they are doing it. But maybe Ind AS did not recognize that. Maybe International Financial Reporting Standards did not recognize that. IAS board did not recognize that. You understand the point? So there are so many practices, but in that some of them are best practices which are taken inside, absorbed by Ind AS. You understand the point? That comes under conventions. Conservatism, okay, matching, materiality, which is material, which is immaterial. You got the point? Capital expenditure treatment, all those things. Moving on. Rules. Name itself will tell you. More specific, to the point, formal. For example, explicit instructions on how accounting transactions and processes should be carried out. For example, our Ind AS 16 PP specifically tells you how to treat recognition, measurement, depreciation, impairment, and revaluation of that particular PP asset. So you have to do it exactly the same way. So to the point, specific. So we call them as rules. Now remember, we are calling with different names. Now all these things comes under accounting policy only. Accounting policies are principles, bases, convention, rules and practices, which means what is principle? It is something, but what is the other name for that something? Accounting policy. What is basis? It is something. Comes under accounting policy, comes under accounting policy, comes under accounting policy, comes under accounting policy. So don't get confused with accounting policy. So all these things basically come under accounting policy. You understand the point? Chalo. Anyways, are we done with this? Moving on. Last one, practices. So whenever there is no standard, then people will follow some practice. Traditionally, what they are following in that particular industry, in that local area. Got it? In a given industry or company. For example, I already gave you this example. When we are discussing Ind AS 38, intangible assets, in that we discussed in depth about research cost, development cost. Research cost, most probably it will be thrown into P&L because you don't know whether that research is successful or not. Still, it is in a trial phase. But once that line has been crossed, okay, you got the approval, you got the permission, you have got the confirmation that this works, okay. After that, eventually what will happen, you get into development phase, and development phase you need to satisfy some 6 conditions. Once you satisfy that 6 conditions, it can be capitalized. We have seen that. But at that time itself, I've told you that suppose if development goes on for 6 years or 8 years, throughout that 6 or 8 years all those 6 conditions should be satisfied. So your auditor will come or somebody else will come, they'll ask you whether all these 6 conditions are satisfied at any given point of time. You have to convince them, yes, all these 6 conditions are satisfied. You understand what I'm trying to say? Get it? He'll ask you whether there is an intention of the management. You say, yes, we have intention to continue this R&D. But that guy will say, no, I don't see any intention. You're lying. How can you convince? He says whether you have sufficient money to continue this particular R&D. We say, yes, we had. But he says, I'm looking at your financial statement. I don't see any sufficient money you have got. You're again lying. So every time you have to convince a third person. So in reality, the general practice is that people got vexed, about this. And what they're doing in reality, at that time only I've told you this, in most of the pharmaceutical companies, they throw every single development expense into P&L account only. They don't capitalize that. Why to convince all these guys? Why to enter into argument? Unnecessary headache for me. I can't convince all these third parties. Let's put it in the P&L. You understand? So this is a kind of informal practice. You got it? Chalo. Are we done with this? Okay. So with this, we are done with understanding what is accounting policy. Now, again, you got to remember the definition. Accounting policies are specific principles, bases, conventions, rules, and practices that are applied by the entity in preparation and presentation of financial statements. That's it. Are we done with this? Moving on. Now, coming on to the next topic, selection and application of accounting policy, which means how to select what accounting policy we need to apply for our particular company in a given case. You got the point? That is what we're going to see right now. You guys are ready? Okay. This is very important, Anna, from problem solving perspective. Again, there will be a link to other Ind AS also. So therefore, I want you guys to focus on this. Okay. Very simple. There is an order for this, preference order. Like we have seen, whenever you get asset in PP by way of exchange, there is an order, na? First, you should go with the fair value of the asset given up, of course, when there is commercial substance. And after that, you should go with fair value of the asset acquired. Then if both of them are not available, we'll go with the carrying amount. You remember that? Same stuff over here. We have an order. Okay. There also that order is not given by Ind AS, but our IC answers are solved that way. Therefore, we have gone with that order. Actually, the concept is fair value of the asset given up or fair value of the asset acquired. Whichever is more clearly evident, you have to go with that. So it is not like first order should be fair value of asset given up, then fair value of asset acquired, then carrying amount of the asset given up. It's not like that actually. Okay. But our ICA is solving problems in such a way with solutions such that they are following that particular order. Therefore, we have solved the sums in that particular order. That's all. Ind AS actually says whichever fair value is more clearly evident, you go with that. You understand the point? So like that here also we have an order. We need to follow this particular order. I hope you guys are clear. Right. First, if any specific Ind AS is available for a particular transaction, then the entity shall apply accounting policy as determined by that particular Ind AS. This is very easy, na? You have asked me, sir, what is accounting policy that I have to do for this particular transaction, sir? You understand the point? Sir, I have purchased the asset, sir. PP, initial recognition is done, sir. Now 1 year is over. Now I have to choose which model, sir. Now you see Ind AS 16 says you can go for either cost model or evaluation model. That's all. Sir, I've got investment property, sir. Okay. Now I want to go with revaluation model for investment property, sir. Then I'll say, you check the Ind AS 40. It says that you can only go with cost model. There is no revaluation model available. Although in international standard, fair value model is given for investment property as well. But maybe while they're adapting that to Ind AS, they said too many fluctuations in our real estate. Therefore, they did not allow. So only cost model. So which means when a particular Ind AS says something with respect to a particular transaction, you just follow that. You got it? It's very easy, right? So how to select an accounting policy? Very simple. For that particular transaction, if some Ind AS says specifically something, just follow the same. As simple as that. The only problem will arise when the kind of transaction that you have got has got no Ind AS whatsoever. Okay. So if there is any specific Ind AS available for that particular transaction, you just follow that. Very easy, straightforward. Whatever Ind AS say, follow. That's it. There ends the matter. However, if no Ind AS is available, then what you'll do? Very simple. You check any other Ind AS on similar transaction. This is mandated reference, Nana, which means you have to do this for sure. Okay. This particular Ind AS is there, Nana. For example, investment property. In that a particular thing that you want to do, you want to measure it or something like that. Ind AS does not say anything on that, although it is covered under Ind AS 40 investment property. For measurement purposes and depreciation purposes, again you have to go to Ind AS 16. So therefore, any other Ind AS on a similar transaction, Ind AS 16 is saying go there. You understand the point? That will be your second. This mandated reference, you have to do this compulsorily. It is not a choice for you. Sir, here also not available. Specific Ind AS is not available, but that transaction, some other Ind AS is also not available. Then what should I do? Very simple. Go for framework of Ind AS. This is also again mandatory. Ensure that whatever the kind of rules that is being laid out in framework of Ind AS, that is being satisfied. You are not going away from that. So what do you mean by that? For example, definition of asset, liability, income and expense. The kind of transaction that you have got related to asset, income, liability, or expense, whatever, we don't know. But ensure that in framework of Ind AS, there are certain rules. You are not moving away from that. That is the next checking that you have to do. Sir, check, sir. This is also done, sir. So it's like this, sir. With respect to my transaction, there is no specific Ind AS available, sir. I checked for the transaction, similar transaction in any other Ind AS, sir. That is also not available. After that, sir, I went to the framework of Ind AS, which is mandatory. I have to check that. Mine is kind of a liability kind of scenario. I have ensured that I'm not moving away from whatever that has been told by framework of Ind AS. Then what I have to do, sir? Then go for International Accounting Standards Board. This is optional. But this is the order that you have to go. So there any particular thing is ready for you, any pronouncement or something like that. So that is also not available, sir. Then go for any other setting bodies like US GAAP or any other GAAP, China GAAP or whatever gaps. Any other country you can go and refer. Got the point? Yes. Sir, that also is not available, sir. Then as an industry, if you are facing this problem, so many other companies in your industry is facing this problem only, na? You see what they are doing, generally accepted practice in your industry, just follow that. That practice is also an accounting policy only, na? According to the definition. That's why definition is important. You understand the point, sir? In our industry, normally we are doing this only, sir. Everybody is doing the same. Then follow. Follow when? When you have come in this order. This descending order you should satisfy. Then only, sir, straight away, my industry is doing like this only, sir. Let me follow this, sir. Everybody is doing like that. But there is a specific Ind AS on that. You say, sir, everybody is doing like that, sir. I'll also do. Means all of you put together, you'll be penalized. You got the point? You'll become culprit. You'll be punished. Got it? You should come in this order, then come back here. Then you see what your industry guys are doing it. Then you follow. No problem. Got the point? I hope this is clear. Yeah. One important point that you guys need to understand is one specific Ind AS is not available for your transaction. Mandatorily, you need to check for other Ind AS for similar kind of a transaction. After that, mandatorily, you have to check framework of Ind AS so that the definition of asset, liability, income, and expense, you are not moving away from that. It's a basic essence, na? You're not moving away from the essence. Once you are done with that, after that, rest of the things are optional. You can check International Standards Board. You can check any other company's gap, China gap, US gap, whatever. Got it? If that is also not available, you can just go with industry accepted practices. This is where it should end, obviously. When no other option is available and you are doing a business, there is an industry. Unless you are alone in the industry and you're a monopoly. Other than that, most of the cases you should be able to solve your problem. Are we done with this? I hope I tried to present this in an entertaining and easier manner for you. I hope you guys are happy. Chalo. Of course, once an accounting policy is selected, it has to be consistently used for similar transaction. For because consistency should be there, na. For this transaction, you have applied one accounting policy right now. In the next transaction, you cannot change it. Okay, there must be consistency. Are we done? Yes. Okay. Now there is a note 3 on this consistency. Here also, for this particular point, I've given illustration 4. That is a problem that we'll cover later. If there is any note that we'll cover right now, note 3. Let's go and cover what that note 3 is talking about. Okay, see Anana. An entity has grouped its PPE into 4 classes. Land group, so many lands are there. Factory building, so many buildings. Plant, so many plants and machinery. Furniture, so many furnitures. Okay, class of assets, they have grouped. PPE we know na. The entity may propose to apply revaluation model only to land. It need not apply this model to building or plant and machinery. That we know. For a class of assets, you can apply one particular model, right? Ind AS 2 inventories require that inventory to be valued at cost or NRV, whichever is less. That we know. Lower of cost or NRV. In identifying cost, it allows alternative cost formulas. It can go for FIFO, which is an accounting policy. Weighted average is an accounting policy. The same cost formula must be applied to items of inventory having similar nature or use. That's where consistency comes into picture. But a different cost formula can be applied to a different classification of inventory. Here also, one land is there. You have applied one particular model. All the land, same model. Consistency. Plant and machinery, then you can apply another model over there. Again, all plant and machinery, same model. Consistency. That is why I've written this note. Only to explain you what do you mean by consistency. Got the point? Chalo. And you have a pro tip by PK sir. Now this is important for you when you're solving sums, where you have a theory question, where in the question some questions it will really confuse you, Nana, whether it is an accounting policy or it is not an accounting policy and such that it is an accounting estimate or whatever it is. Now for that, the only thought process that needs to run in your mind is anything that is like a kind of a choice in the hands of the company with respect to the treatment of any item, then understand that it is an accounting policy. Again, I repeat, the key word here is choice. When you're reading a question itself, you have to get into the shoes of the company and think like the company. And then you try to understand the scenario and you see that, in this scenario, it is like a choice for me. Either I can go with this, I can go with this. Okay, I'm selecting this. If that is your thought process, then that's an accounting policy by default. You got it? But when we are solving a sum, a theory-based application-oriented question, and you see a scenario over there, and you step into the shoes of the company, and then you are feeling as if you are the company, and from their perspective, you're thinking, and then you look at the scenario, and you kind of feel like you don't have a choice. You understand what I'm trying to say? You don't have a choice, which means given the scenario, this is the only thing I can do. I don't have a choice. Means, for example, you have owner-occupied property. When you have owner-occupied property, it means a land and building which you are using it for business purpose. Okay, production and supply of goods and services or administration purpose. You understand the point? So when you're using a land and building for either business purpose, which means production and supply of goods and services, or administration purpose, you don't have a choice. It has to be treated under Ind AS 16. It's an owner-occupied property. There ends the matter. Do you have a choice here? I can go for treat it as investment property, or I can treat it as owner-occupied property. Do you have a choice? Nope. When you don't have a choice, then that is not accounting policy for you. You understand what I'm trying to say? When you don't have a choice, you have to do only this. Situation is like that. That is not an accounting policy. But when you have a choice, for example, as per Ind AS 2, you need to value your closing inventory. You are seeing, okay, I should be valuing it at cost or NRV, whichever is less. Okay, at cost, how to value the inventory based on cost? Should I go with FIFO method or LIFO method or weighted average method or simple average method or replacement stock method or base stock method, whatever it is? I'm going with FIFO. Are you making a choice right now? Then it's an accounting. Got it? So this, if you remember, all the problems based on accounting policy, you will be in a position to solve. You have a choice, accounting policy. You don't have a choice, given the scenario, this is the only thing that you can do. Don't have a choice, not an accounting policy. What it is, that we'll see later. But first of all, it's not an accounting policy. Questions will be like that only. He'll only ask you whether it's a change in accounting policy or not. I should know whether it is accounting policy or not. That's all. If it is not accounting policy, what is it? That I'm not concerned. Am I clear? I hope this is clear. So that's a pro tip from me. This pro tip I've gave you after solving many sums. Okay, trust me, it will work like a charm. Moving on. Okay, Nana. Now we have understood how to select an accounting policy. We have understood the order as well. Okay, this is the order in which we need to select the accounting policy. Everything is fantastic, sir. Now the next question is, okay, at some given point of time, management thought process will change. Okay, suddenly they want to change the accounting policy. Sir, can I change, sir? Sir, I got bored of this particular FIFO method, sir. I don't want to value my inventory based on FIFO method. Let me change to weighted average. Can I change like that? Nah, it's not in your hands like that. First time when you select, it's a choice. You can select whichever you want. But once it is done, then you're locked up. Now, if you want to change just like that, you can't change. There are rules for that. Okay, sir. Now tell me how to change my accounting policy. So you should be careful when you're selecting it for the first time itself. Okay. But once you are done and dusted, it's like getting into marriage. After that, there is no going out on a lighter sense. Anyways, now the point is, so you have selected the accounting policy. Now, if you want to change it just like that, you can't do it. There are rules. Okay, what are the rules, sir? First, it should be required by an Ind AS. Same stuff. When you're selecting accounting policy also, if there is a transaction, what is the first rule we have seen? If there is any specific Ind AS which is talking about that particular transaction, apply that specific Ind AS there and some matter. Similarly, when you want to change an accounting policy, first thing is it required by an Ind AS? Then you change. Then also you can't change as per your wish. Note 1 I've written here. What is note 1? Definitely there will be transitional provisions. When Ind AS says it's mandatory for you to change the accounting policy, it will also tell you how to change. That's what we call transitional provisions. You just apply the same. So which means two things you need to follow. First, Ind AS says change this accounting policy. Yes, sir. Change like this only. Step 1 do this, step 2 do this, step 3 do this, step 4 do this. Yes, sir. That's what we call transitional provisions. Old Ind AS 16 and new Ind AS 116, that is the situation. Means, just a second, Nana. 116. Which means I'm talking about from lessee point of view. Once upon a time, in finance lease and operating lease, only in finance lease, lessee becomes substantial owner of the, property, right? PPE or whatever it is. So he'll be deemed owner, right? Only in financial lease. But on operating lease, that's not the case. But once Ind AS 116 have come into picture, irrespective of the lease, uh, lessee will be the owner in the form of right of use asset, ROA asset. We have seen that. So it's a change only, right? Yeah. And for this change, you have to apply whatever the Ind AS says. It is not there in your control. You got the point? Anyways, so if you want to change your accounting policy, first, it should be required by Ind AS. And when Ind AS says that, that Ind AS only will tell you what are all the transitional provisions. Follow that. There ends the matter. Now, suppose this is not the case. So this is mandatory. So which means as an entity, you are not willing to change voluntarily. Ind AS is mandating you to do the change. You understand the point? Am I clear? Sometimes what happens, still we are in the first point only. We are not moving away. Listen carefully. Still we are in the first point. Sometimes what happens, Ind AS will say that you have to change this accounting policy, and it will also give you transitional provisions, but it will give you a choice in the sense it need not be immediate. Let's say right now we are in 25, okay, 2025. Now it says like this, from 27 onwards, this is effective. Ind AS says like this, which means this change you have to do mandatorily. Till that time, it is a choice. Now, what you're doing as a company, anyway, 1.5 year time is there. Chalo light le lete hain. Okay. In future, see, in 26 ending, we'll think 27 only, na? It's applicable. 26 ending, we'll try to change. Till that time, will not change. In that case, also, you have to say why you did not make the change. I'll go to the relevant note for that. See here. Note 8. I should write this note 8 here only. Write that. Till we are in the first point. 8. Sir, what is there in this note 8, sir? When an Ind AS has been issued but it is not effective up to the date of the financial statements, the entity shall disclose. It's mandatory. The above fact that from 2025 onwards, yes, I can change my accounting policy. Ind AS said that, but the effective date is from 2027, so therefore I'm not doing it. You say that, the above fact, which means you're not doing it. Next, title of the new Ind AS, which is saying that to do so. The estimated impact of the above mentioned Ind AS on the financial statements of the entity, which means now you're not following, but if you would have followed, if you would have changed now itself instead of waiting for 2027, what would have happened, what would have been the impact, that also you have to show. If the estimated impact of the new Ind AS cannot be reasonably measured, then a statement to that particular effect, which means if you can't show what would have happened if you would have applied that Ind AS today, this much effect would have been made, a difference would have been made in the numbers in your financial statements. If you can't estimate that reasonably, then you say that I can't do that. That also you have to say, sorry, I can't reasonably estimate what kind of impact if I follow this particular Ind AS from today onwards would have made on my financial statements. Hereby I disclose that I can't reasonably find that. You understand the point? Chalo. Now moving back. Okay, sir. So far we are done with only the first point. So what is the first point? Whenever you want to change your accounting policy, first you have to see whether there is any specific Ind AS mandating that. If it is saying that, follow the transitional provisions of that particular Ind AS and then start implementing it. Sometimes if the effective date is at a later point of time, then you also state the fact that the so-called Ind AS is changing the so-called change in accounting policy. But then the effective date is 2 years late. Therefore, I'm not trying to change that. And probably if I change from today itself, this is going to be the effect. If you can't reasonably estimate the effect on your financial statement, then that fact also you mention. Got it? Hello, everybody. Fantastic. Now coming on to the second point. Now second point is a voluntary change in accounting policy. Company wants, I'm the company, I want to voluntarily change my accounting policy. Can I? Can I change? Yes, you can. What Ind AS 8 says is that yes, you can, provided the so-called voluntary change, because how would I know whether you're changing the accounting policy with true positive intention? You might be a fraud, na? You understand what I'm trying to say? See, I'll tell you one thing. You are measuring your inventory as per Ind AS 2 on cost basis. Okay. Suppose you are following FIFO method. In FIFO method, what you'll do, first in, first out. So generally what will happen, your closing stock, closing inventory will be valued based on the latest purchase, right? Because first in will go first out, which means whatever the inventory that you have will be the latest. Let's say price are dropping like anything since last 6 months. Or you are expecting that in another 6 months prices are going to drop crazy. Now you're thinking, okay, I'll do one thing. I'll change it from FIFO to LIFO. If I change the method from FIFO to LIFO, change in inventory method is nothing but change in accounting policy. If you change it from FIFO to LIFO, in LIFO what will happen? Latest in, first out, which means what you buy latest will go out, and whatever you have purchased earlier will stay in your stock. All right. Whatever you purchased earlier, in case of dropping prices, will be valued high, na? It will be at higher price. So means your closing inventory stock valuation will be high. Maybe you are at the end of the year, you want your financial statements to look good. Maybe because of that, you can change your accounting policy. You understand this? Which means here your intention is pretty bad. That's why Ind AS says if you want to do voluntary change of accounting policy, yes, we accept, buddy. That's not a problem. But it should result in providing more relevant and reliable information. This is very important, Nana. Again, you have to memorize this. Okay. Memorize. You got it? So there will be many questions based on voluntary change in accounting policy. So whenever you have to change your accounting policy voluntarily, definitely you can do that, provided that voluntary change results in more relevant and reliable information. These words are extremely important. Exactly, you have to remember and repeat it in the answer. More relevant or reliable information. Now I'm telling you, remember this. In the next session, once we start solving sums, then I'll ask you to remember this. Okay, at that time you should not forget. Moving on. Now here we have note 4. Let's go and see what is that note 4. Hello, with respect to that point only. Here we have note 4. Now, this is an example based on voluntary change in accounting policy. That's what we are discussing now, right now. All these examples are given by your ICA only. That's why I did not change the font. I did not change the color also, so that you will know that your sir is covering everything from Ind AS, from ICA only. Okay, is only to give you that assurance. That's the reason I did not change anything. Anyways, as per Ind AS 27, separate financial statements, investment in subsidiaries, associates, and joint ventures are accounted for in an entity's separate financial statements at cost or in accordance with Ind AS 109. Got the point? The same accounting is required to be applied for each category of investment. Okay. Assume that the entity decides to change its policy of measuring investment in subsidiaries. Changing the policy of measuring investment is a kind of change in accounting policy from cost to fair value. Earlier, they used to measure the investment in cost. Now they're changing it to fair value in accordance with Ind AS 109. Okay. And this will result in financial statements providing more reliable and relevant information. That condition is satisfied now, because you want to change voluntarily, then definitely it has to present, I mean, after changing that particular accounting policy, the result should be the financial statement should be more reliable and more relevant. If that condition is satisfied, yes, this would constitute a voluntary change in accounting policy, and that is acceptable. Why? Because of this change, you are able to make your financial statements more reliable and more relevant. Then it's okay. Got the point? So voluntary change is allowed. Only thing is that it has to be more relevant and reliable after doing that change. Okay, if you are doing it for any fraudulent intention or fraudulent purposes, then definitely that will not be allowed by Ind AS 8. Moving on. Following are not considered as change in accounting policy. Which are not considered as change in accounting policy? Reclassification of PPE from revaluation model to investment model. I think this I've already told you, right? See, uh, now this particular sentence, I hope you guys are with me. Hello. Sir, you said this will be dry Ind AS, sir, but it's a lot more interesting. Uh, maybe I've made it interesting. You should give credit to Mire. Okus. Right. Anyways, now, okay. Let's not get diverted. Reclassification of PPE revaluation model to investment property cost model. This sentence will be given in a question and for you. Okay. The moment you see that I'm telling you, you will be tempted to call it as change in accounting policy. It is not change in accounting policy. Sir, revaluation model to cost model, sir. Change in accounting policy, na, sir. No, sir. You are missing what is there beside that. PPE to investment property, sir. You are missing that, sir. Which means, sir, here it is not a single property where the purpose remains the same, which means the utility of the property, the use of the property is same, which means, sir, I'm using this property for business purpose, sir. Now also I'm using this property for business purpose only, sir. Which means PP is being PP. You understand what I'm trying to say? Sir, I'm using a particular land and building, sir, a property, sir, for business purpose. Means PP, sir. I'm still using it for business purpose only, but still I'm shifting from cost model to revaluation model, or in this case, revaluation model to cost model. Then that is change in accounting policy only. Correct? Your thought process is correct. When suppose the sentence is like that, PPE to PPE, PPE to PPE, revaluation model to cost model. Then it is change in accounting policy. Now that is not the case, Nana. The use of the asset itself is changed. Earlier you are using this asset for business purpose, or maybe administration purpose, or maybe production of goods and services. That's why it is called PPE, owner occupied property. Now you are changing it to what? Maybe you have given it, you have stopped your business and you are giving it on rental purpose. Therefore, now it is changing from PPE to investment property. Now, once it is changed to investment property, it attracts Ind AS 40. Once it attracts Ind AS 40, Ind AS 40 mandates that you have to follow only cost model. You understand what I'm trying to say? So the change in use of the property has got changed, and as a result, you are mandated by Ind AS to follow cost model. How can this be a change in accounting policy? You don't have a choice now here. Again, you apply the pro tip that I've gave you. What did I say, Nana? If you have a choice, it's an accounting policy. If you don't have a choice, it's not an accounting policy, Nana. Here, do I have a choice, Nana? If I change my property because my change in use has happened. Earlier, I was using it for business purpose. Now I've stopped my business. I'm using this property for rental purposes. I gave it on rent or operating lease I gave. Now tell me, the use of the property has got changed now, so automatically it became an investment property. As a result, Ind AS 40 is attracted. As a result, Ind AS 40 says I have to follow cost model. So I'm following cost model. Do I have a choice right now? No, no, no. I don't want to call this as investment property. Do you have a choice? No. I don't want to follow cost model. I'll follow revaluation model. Do you have a choice? No. When you don't have a choice, can I call it as change in accounting policy? No. That is a pro tip I gave you. Correct? Fantastic. I hope you guys are enjoying. Now, moving on. Application of new accounting policy for transaction that did not occur previously or immaterial previously. Which means, for the first time you bought a machinery. Just now you bought a machinery, Nana, PPE, and for the first time you are applying revaluation model. You understand the point? This is a new machinery. You got it? New machinery. For the first time you are applying revaluation model. Can I say change in accounting policy? No. You understand the point? For the first time, it's a fresh transaction. You're doing it for the first time. Or, same transaction last year, it was considered immaterial. Therefore, I left it. This year, it suddenly become material. Are you able to understand? Therefore, I'm trying to apply a particular, thing. And can you call it as change in accounting policy just because you are saying last year you did not do anything for the same transaction? This year you're doing something different for the same transaction. Therefore, I'll say this is change in accounting policy. Are Baba, na re. Because last year, yes, I agree, it's the same transaction only last year and this year. And last year I did not follow something or I followed something different. This year I'm following something different. That doesn't mean that it's a change in accounting policy. Why? Because last year it was immaterial. This year it is material. Got it? Okay. So therefore, whenever there is a new transaction, okay, new accounting policy for the transaction that did not occur previously and you're doing it for the first time, it will not be called as a change in accounting policy. Very important. Nana, that's why I told you these are not considered as accounting policy, means sometimes it will be difficult for you to understand this. That is the reason. What did I tell you? Okay, what did I tell you? I always told you a pro tip. Nana, whenever you feel that company has got a choice, it will be an accounting policy. Whenever you feel that company does not have a choice, then it is not a change in accounting policy. You have note 5 and note 6 over here with respect to following or not considered as change in accounting policy. Let's see that. Here anyway, I gave you an example also. Measuring newly purchased PPE at cost model. That's what I told you. Okay. Chalo, let's look at note 5 and note 6. Okay. Note 5, note 6. Ready? Chalo. A company owns several hotels and provides significant ancillary services to occupants of rooms. Okay. These hotels are therefore treated as owner-occupied property, which means hotel, you are giving ancillary service. We have already read this in, Ind AS 16. If you are running a hotel, Ind AS 40 we have seen actually. If you are running a hotel and if you are providing major services, then the services are significant. Got the point? When services are significant, automatically it will be called as a business property or owner-occupied property, or it will be covered under Ind AS 16. But if you run a normal rooms, you are giving it on rental basis and just you are giving small basic services, then that building will be covered under Ind AS 40, right? Investment property. You got it? This we have already seen. So here the so-called ancillary services are significant. If they are insignificant, it will be investment property. If they are significant, then it will be owner-occupied property. Correct? And it is classified as PPE in accordance with Ind AS 16, which is correct, obviously. We have seen this, right? We have covered this. The company acquires a new hotel but outsources entire management of the same to an outside agency and remains as a passive investor. Now company is not giving all the significant services. It has outsourced it. You understand the point? The selection and application of an accounting policy for this new hotel is in line with Ind AS 40. It is not a change in accounting policy simply because the new hotel rooms are also let out for rent. This is because the way in which the new hotel is managed differs in substance from the way other existing hotels have been managed so far, which means other existing hotels, I'm giving significant services. I'm using the hotels in such a way that where I'm giving significant services, therefore it is owner occupied property under Ind AS 16. But the new hotel, I'm just giving it on rent and the significant services are provided by another entity. So therefore, given the facts and circumstances of the case, it has to be mandatorily treated as investment property as per Ind AS 40. It is not in my choice. I don't have a choice right now to treat it as Ind AS 40 investment property or Ind AS 16 owner occupied property. I don't have a choice, Nana. Given the facts and circumstances of the case, earlier significant services are provided by you, but now you're not doing it, somebody else is doing it. Then in that case, according to you, from your perspective, you're not providing any services. Nah, you're just giving it on rent, therefore it is investment property. Do I have a choice right now to treat this as PPE, as owner occupied property? No, you don't have a choice. You have to follow the same. Got the point? So when you feel that you don't have a choice and this is what you have to follow mandatorily, then that is not a change in accounting policy. You understand the point? Earlier, I was providing significant ancillary services by running the hotel myself, not only giving rooms on rent, but also giving ancillary services. Therefore, it is owner occupied property. But now, same hotel only, another hotel I've purchased, not this hotel, another hotel I've purchased. But then I've changed my way I'm doing my business. I've given all the significant services outsourced and I'm just giving rooms on rent. You understand the point? Therefore, now it is an investment property. It is not a choice. I should treat it like that according to Ind AS 40. You understand the point? It is not a choice. It is mandatory. I have to do like that. So whenever it's not a choice, it is not a change in accounting policy. Are we done with this? I hope this would have given you much more clarity. Now, note 6 also. Let's cover. An entity has classified as investment property. An owner occupied property previously classified as part of PPE, where it was measured after initial recognition applying the revaluation model. You got the point? Ind AS 40 on the investment property permits only cost model. This entity now measures this investment property using cost model. This is not a change in accounting policy. This is what we have seen it as an example, Nana. Again, it is repeated here. Reclassification of PPE from revaluation model to investment property cost model is not a change in accounting policy. Why? Because it is not a choice, Nana. You understand the point? Earlier, you were treating it as PPE because it is used for business purpose. Therefore, Ind AS 16 applies in that you have chosen revaluation model. Now you are not doing business anymore. Therefore, it became, you have gave it on rent. It became Ind AS 40 investment property. Now Ind AS 40 mandates you to follow cost model. Here you don't have a choice to select between cost or revaluation. You understand the point? Only cost model, you have to follow Ind AS and say what Ind AS says. And do what Ind AS says. And therefore, there is no choice. When there is no choice, I can't call it as a change in accounting policy. As simple as that. Are we done with this? Fantastic. Moving on. So I hope we are done with this particular part. Okay. Now, so we have covered how to select an accounting policy. We have covered how to change an accounting policy. Now we need to cover how to apply the change in accounting policy. So once you have decided to change the accounting policy, either voluntarily to provide more relevant and reliable information, or it is required by an Ind AS, whatever the case it is, ultimately you have decided to change your accounting policy. How will you apply that change? Pretty simple, Nana. If it is required for by Ind AS, then you need not worry that Ind AS itself will have transitional provisions and follow that Ind AS, there ends the matter. But if you are going for voluntary change of inventory policy, right? Sorry, voluntary change of accounting policy to provide more reliable and relevant information, in that case, this will apply. Okay, this will not apply when you are changing your accounting policy because it is required by an Ind AS, because in that case, that Ind AS itself will give you transitional provisions. You follow that, it's game over. You understand the point? But if you are going for voluntary change of accounting policy because you are saying that it will result in more reliable and relevant information, in that case, how will you apply the change in accounting policy? Very simple. The change in accounting policy will be retrospective, which means for this particular transaction from the day one, it may be 2 years back, 3 years back, 4 years back, 5 years back, 6 years back, 10 years back. Go back and then make the change. Sir, go back means how many, those many years, how will I go back and make the change? How the change will happen? Very simple, Nana. First change will happen in adjusting the comparative amounts of previous year, which means in the current year financial statement, there will be another column where you will show the numbers of previous year. You go to that particular column and you apply this change. If this change would have applied, what are all the change in numbers that would have happened in that comparative column, and change that comparative column. This is the first thing you will do. Second, you go to the opening balance of previous year, not current year, previous year opening balance. And in that previous year opening balance, which means previous year opening balance, you need to give the effect of previous years, which means, for example, don't worry, I'll go to note 2 and then I'll explain. But right now, just try to understand the idea. Adjust the opening balances of previous year for effects of change in accounting policy relating to all prior periods. Means, suppose we are in 5-6 nana year, 5th 2005 April to 2006 March. For us, previous year will be 4-5. Correct? Now, first, what you have to do, adjust the comparative amounts of previous year. So, in 5-6, with respect to this financial statements, you'll have a separate column which shows the previous year to see the comparison with respect to last year, what you have done. So, in that comparative statements, you will make all the changes. That's the first one. Second, you go to previous year 4-5 and you go to opening balance of previous year 4-5. Okay, which means 1st April 2004. You go to 1st April 2004. And then before that, what will happen? 3-5, 2-3, 1-2. Suppose those 3 years the effect is there because of this change in accounting policy. You understand the point? Those 3 years you calculate the combined effect and then come and change that number in the opening balance of 4-5. That is previous year for 5-6. In the opening balance of 4-5, where you will do the change, mostly the change will be in retained earnings, Nana. You either add something or reduce something, there ends the matter, game over. Or sometimes some changes you need to make it in asset and liability value also. That is rare actually. Most of the times the effect will be there only in retained earnings. You change that retained earnings, some number will be given in the question, Nana, as opening balance of 4-5. We will do some working of the previous years, okay, before 4-5, like 3-4, 2-3, 1-2. You will do some calculations, you will get some number. You will either add it or reduce it. Do that, that's it, game over. Are we done with this? Sir, understood, sir, but still need more clarity. Don't worry, we have note 2. You'll get 100% clarity. Now see here. So retrospective effect means what? Whenever there is a change in accounting policy, especially we are talking about voluntary change in accounting policy, okay? Now let's say 5 years we are in 5th year. So 4th year and 5th year between, this is our current year. Okay, imagine that this is 2004, this is 2005, 2003, 2002, 2001, 2000. Okay, 2000, 2001, 2002, 2003, 2004, 2005. I hope this is clear, right? Now, you are moving from revaluation to cost model for the second time. Already you have chosen revaluation model for the first time for your asset. Then again you are changing after 5 years from revaluation model to cost model. So it's a change in accounting policy. You have to give effect retrospective, which means you need to go back to year 0 when your machine was purchased. Now it's been 5 years since your machine is purchased. Okay, for entire 5 years you need to show the effect. How are you going to show? First I'll start with, this is the current year, na 4-5, 2004 2005 is current year, means 2004 April to 2005 March. This is my current year. Okay, in this current year there is a change in accounting policy from revaluation to cost model. Okay, anyway this year only I made the change, na. So this year financial statement anyway I'll make the change. So therefore there is no need of correction in the current year. This is the first point. Current year I made the new accounting policy change. Now I'm going to follow cost model. So last year I have followed revaluation model. So revaluation model, revaluation model, revaluation model, revaluation model. This year I'll follow current model, cost model. Okay. Anyway, when it comes to balance sheet of the current year at the end of year 5, that is 2005 March, you would have followed cost model only. So there is no need to change any numbers in current year financial statements. But you need to compare the previous year, na 2003-4, that is the last year. You would have followed revaluation model only, old policy. So restate by applying new policy. Now you apply cost model and see what are all the changes that is happening to your asset and show it in the comparative column. This is first change. Then go back to the opening balance of the previous year. For current year 4-5, what is the previous year? 3-4. 3-4, you go to the opening. 3-4 opening means April of 3. Correct? So also opening balance sheet at the beginning of year 4. Year 4 means 3-4. Okay. Year 1, year 2, year 3, year 4. This is year 4, 2003, 2004. You go to beginning of year 4 and reflect the change in first 3 years. So first year, what is the change? Some number. Second year, what is the change? Some number. Third year, what is the change? Some number, because of changing from revaluation to cost model. Put together, add these 3 numbers and then come to third year opening balance, and then you either add it or reduce it with respect to the asset, or in case you have to show the effect on retained earnings, you show the effect on retained earnings. Okay, all changes will go and adjust in retained earnings. That's it, game over. Mostly it will be retained earnings only, Nana. You got the point? And your effect is done. That's all. Are we done with this? Now 100% clarity will not come. I also know that. It will come only when you start solving sums. So you need to wait for it. Okay. Once we start solving sums, you'll have 100% clarity. Right now, just have a basic idea. Okay. Step 1, previous year comparative column, you need to make changes. Step 2, go to the opening balance of the previous year. And then before that, how many years are there? That many years you do the calculations and then give the effect in the retained earnings. There ends the matter. That's all. This you remember. That's enough. Sir, how to exactly, now I'm not asking you to solve the sum straight away. Just have an idea in your brain. That's all. Once we start solving first two problems, you'll do it. You'll get clarity. You'll get confidence. Third problem onwards, you'll do it on your own. Got it? Next. If retrospective application is impracticable, because whenever there is change in accounting policy, Ind AS 8 says you need to apply retrospectively. Go back and restate everything. That's what we have been doing, and we have seen how to do that. But if that is not possible, then entity cannot apply accounting policy retrospectively because it is not possible. After making every reasonable effort to do, I've tried everything, but still I can't do it, then apply prospectively, simply, which means from this year onwards, do the changes. That's all this headache will not be there. When that is allowed as per Ind AS 8, when the effort has been genuine from the side of the company and they have tried everything to do it retrospectively, still they can't do it, then it's okay, do it prospectively. Got the point? Note 7 is there. Let's have a look at note 7. See here, a company has been incorporated 25 years ago, and since then doing the business on the pan India basis. Fine. Now it is supposed to incorporate the changes in accounting policy for last 25 years. Nonsense. Will it be practicable? No. Will it be worth doing? No. Will it be material? Very difficult. Such questions arise when one wants to change the accounting policy, since voluntary change in policy is required to be applied retrospectively. Correct? In this case, can I apply it? It's not practical. Therefore, you don't apply. Therefore, Ind AS says, 8 says you put an effort. 25 years means it is near to impossible. Therefore, you can apply prospectively. Got it? We have seen the example also in note 7. Finally, you have to do disclosure. Once you have changed the accounting policy, definitely you need to disclose it. Because of this change in accounting policy, what are all the things that are happening? First, nature of change in accounting policy. From revaluation model to cost model, that I have done. Okay. Next, effect on current year and previous year due to change in accounting policy. Anyway, you're going to do all those calculations. Because of these calculations, what is the effect? That you should show it in disclosure. Very easy only. Anyway, you will be doing all the calculations. That numbers you take it and disclose it. That's all. If retrospective application is impracticable, then you write the reasons also. These are all the reasons. 25 years before I've done it, therefore it's practically impossible for me. Therefore, I can't do the retrospective application. I'm gonna do it prospectively. Like that, you disclose a fact. Then it's a matter. Are we done with this? That's all. This is not relevant for you. Don't worry. This is enough. So with respect to this, there is note 8. Let's have a look into note 8 as well. This already we have covered now. Note 8 does not belong here. Sorry. I have written note 8 here. Okay, here also same points only, Nana. This and this. Nature of change in accounting policy. Okay. Next, effect. Right? If retrospective application is not possible, that point. These 2 points are new. That will apply only when there is initial adoption of Ind AS. Okay. When you are adopting Ind AS for the first time, then these points will be applicable. Now that there has been so many years since you have adopted Ind AS for the first time, we don't expect all these things to happen. Clear? Right. So with this, we are done with what? All these examples are also covered. Accounting policy. Okay. Nana, disclosed also you have to remember, Nana. This also you have to memorize. Because it will be asked in questions. What are the things that you need to disclose in financial statements with respect to change in accounting policy? Nature of change in accounting policy. Effect with respect to amount on current year and previous year due to change in accounting policy. If retrospective application is not possible, then mention that fact that it is not possible and find out the reason and write the reason. Got it? This is important. You have to remember. That's all. I hope we are done with this. Okay. In the next session, we'll go with accounting estimate, and along with accounting estimate, we'll also complete errors. Okay. With that, we'll be done with all the concepts. That's it. Next session, it will be done. And that following session will be going with sums. Got the point? Right now, let's wind up. Okay. All right, friends. Hi. Welcome back. Okay, this is gonna be a small session because we're gonna finish off this Ind AS. In the last session, we are done with the accounting policy, right? Selection of accounting policy, change of accounting policy, and we have seen a lot of examples as well that is given by your ICA. Okay, and coming on to this particular session, we're gonna finish off the remaining two in this particular Ind AS. One is accounting estimates, the other one is errors. Okay, yeah, prior period errors, obviously. Chalo. Straight away, let's start with accounting estimates. So what do you mean by accounting estimate? Nana, the name itself tells you it's an estimate, right? So many items in your financial statements, basically they can't be measured exactly, okay? They can only be estimated, right? And obviously when you're trying to estimate it, it involves judgment, and that judgment need not be right always. Are you able to understand? So that is where the problem comes. Say for example, 2 years, 3 years back, you might have gone with a particular estimate. You thought that, say for example, let's take depreciation, okay? Now you people tell me, how will I choose a depreciation method? Okay, we have already studied this in Ind AS 16. We have studied this in Ind AS 38. You understand the point? So how will we choose a depreciation method? Very simple. We're gonna look into the future economic benefits, correct? Say for example, the life of the asset is 5 years and future economic benefits are equal in all these 5 years, then probably I will be choosing SLM method, because according to SLM method, what will happen? The depreciation also will be exactly the same over a period of 5 years. Suppose over this period of 5 years, which is the life of the asset, initial years the benefit is going to be pretty high, and later years the benefit is going to be pretty low. In that case, you'll be going with reduced balance method, that is WDV, correct? That method will be chosen, right? Say for example, uh, you have a mission, like suppose, let's say we'll take an equipment like for example projector. How will you give depreciation for projector? You can't go with SLM, you can't go with WDV. Why? Because projector life is based on the main bulb through which it projects, and that bulb can work for fixed number of hours. Say for example, that bulb number of hours is 50,000 hours, that is the life. Then based on this 50,000 hours, say for example, first year you have used it for 5,000 hours. Then 5,000 divided by 50,000 into the cost of the projector. That will be the depreciation in the ratio of number of hours. Got the point? Yes. So like that, you will have one thought process in your mind. Here also, the future economic benefits you are estimating only, na? Say for example, if your estimation goes wrong, then based on that, whatever the depreciation method that you have chosen, that also goes wrong, which means basically your accounting estimate goes wrong. You understand the point? Anyways, so many items in the financial statements cannot be measured but only can be estimated. Estimation involves judgment on the basis of latest available information, whatever the information that I have on that particular year. I'll go with best of my judgments. But after that, when I come across additional information, you understand the point? Then things may change. For example, I'll tell you an interesting thing. How important this particular sentence is. You might not be able to understand it. I'll tell you. See, I think if I'm not wrong, 7 years back, I had UPSC interview in Delhi. Okay. So I got selected for the interview and then I went over there, and there was a particular question where it was an opinion related question, kind of an opinionated question. So they asked me that, then I gave them a particular answer based on my opinion to the UPSC board, and then they said that no, I don't think so. That's the uh, correct way of looking at it. We think this is what it is. So which means they basically disagreed with my answer. And after disagreeing with my answer, they gave me some points, and then they told me that how would you react right now? Then I told them that, sir, whatever the kind of information that I had, that was available to me at the given point of time. Based on that, I've formulated this sort of an opinion. Probably, if I would have come across the same sort of kind of information that you would have come across, maybe my opinion would have matched up with you, is what the kind of answer that I gave. You understand the point? So, therefore, the kind of things that you do, the kind of opinion that you do, the kind of judgment that you take purely depends upon the information that you come across at any given point of time. Same thing goes with accounting estimate as well. You got the point? I hope this is clear. Hello, everybody. Yes, Nana, I went to UPS interview a couple of times. Okay. Anyways, moving on. Provision for bad debts estimation, because you're having a provision, you're estimating that this much will be my bad debts in future. Warranty obligations, you have some sort of an opinion on your product, and then you guess that, okay, out of 100 sales, say for example 5% they can come up for warranty, and accordingly you will be estimating, right? Depreciation method, just now we have discussed. Useful life of the asset, that is also estimation. That is the reason in Ind AS 16 and Ind AS 38, and so many times Ind AS 38 we have not seen, but Ind AS 16, so many times we have to revise the life of the asset, because initially they thought that the life of the asset will be 10 years. After 2 or 3 years they'll come to know that no, it's not 10 years, it's only 8 years, something like that. Anyways, residual value also, it keeps on changing. Anyways, even the decommissioning cost in case of Ind AS 16, provision for decommissioning will create, will add that to the cost of the asset. That also keeps on changing. So all these are accounting estimates, they'll keep on changing most of the times. You got it? Okay, coming on to the next point. Changes in accounting estimate. Entity shall revise an accounting estimate if circumstances change as a result of new information or more experience. That's obvious. You come across new information, then obviously what will happen? Your estimate will change, right? That is why I have highlighted this point over here. Available information. And one more thing, sometimes based on your experience also things will change. Your opinion will change, your judgment will change. Entities shall account for change in accounting estimates. See, obviously whenever, because of experience or because of latest available information, if your judgment changes, okay, you want to revise the accounting estimate, definitely you have to do. Now the biggest question is, in accounting policy, whenever there is change in accounting policy, we used to do retrospective application, correct? Now when it comes to change in accounting estimate, should we do retrospective or prospective? That's the biggest question. Well, the answer is very simple: prospective only. Now you can ask me, why is that, sir? Logic is very simple, Nana. See, coming on to accounting policy, that is a choice that has been taken by an entity. So you had the choice to go for other accounting policy, but you have chosen this particular accounting policy, which means it's a kind of thing that you're free to choose with, okay? But coming on to accounting estimate, that is not the scenario over here. Please try to understand how accounting estimate works. Whatever the information that is available, to the best of my ability, to the best of my judgment, based on the information available, based on my experience, genuinely I go with a particular number as an accounting estimate. Tomorrow in future, if additional information comes into picture, because of that additional information and because of this experience I've gained over a period of time, tomorrow my judgment might change. My accounting estimate might go wrong. That is purely nature, Nana. That is not my mistake. So when it is not my mistake, there is no logic in going for retrospective change. You understand what I'm trying to say? Got it? So therefore, even standard also understands the same, and therefore they say that, okay, you go with prospective change. That's fine. Apply change from the date of change in estimate from today. Do it prospectively. No need to go for retrospective, because you can't do that, because you were right at that given point of time. Today things have got changed. You understand what I'm trying to say? But that is not the case with accounting policy. You had a choice. Okay, that's a clear difference. Moving on, disclosure. Nature of change in accounting estimate. Same stuff here also in disclosure when it comes to accounting policy. Nature of change in accounting policy is the first point. Nature of change in accounting estimate is the first point, right? Second point is effect. Effect on current year and future years due to accounting estimate change. Whereas here, what, Nana, you remember? Effect on current year and previous year due to change in accounting policy. That is the difference. Here, effect is on current year and future years. Their effect is on current year and previous years. If it is not possible to estimate effect on future years, then the fact must be disclosed there also. If it is not possible to provide retrospective application of change in accounting policy, then that fact must be disclosed. Simple. Are we done with this? Easy peasy. Right, other points. What are the other points? Change in accounting estimate cannot be treated as correction of prior period error. Very important. Because 2 years back, based on that data available for me, based on information available, to the best of my judgment, based on my experience at that particular point of time, I made an accounting estimate. Today, more information have come into picture. I got more experience. You understand the point? Therefore, probably you're changing an accounting estimate. That doesn't mean that you were wrong 2 years back. That doesn't mean that you were wrong. You were right 2 years back. Today also you are right. You understand the point? Only the circumstances have changed. The information availability has got changed. So therefore, from your part as an entity, you did not do any mistake. That's why change in accounting estimate cannot be seen as change in error. In the sense, not change in error, correction of error. So you cannot say just because your accounting estimate has got changed because of information availability, change and experience, you can't say that you did a mistake. Therefore, it cannot be considered as an error. Got it? Moving on. If it is difficult to distinguish between change in accounting policy and change in accounting estimate, then by default treat it as change in accounting estimate. So in case in any question, if you have a confusion, you're confused between, sir, this seems like change in accounting policy. This also seems like change in accounting estimate, sir. I'm really confused, sir. I don't know what to do. In that case, very simple. Presume that it is change in accounting estimate and close it off. There ends the matter. Got it? Standard itself says that. So let's follow. Yes. Hello, everybody. Fantastic. Now, certain notes over here. Note 1, change in depreciation method. Obviously, change in accounting estimate. Because depreciation involves judgment, na? It's an estimate basically. So when there is change in depreciation method, your estimate is changing. So therefore, change in accounting estimate. Clear? If change in accounting estimate affects change in assets, liabilities, etc., then adjust the carrying amount of the relevant asset or liability, obviously. And if it does not affect asset or liability value, then recognize it in P&L for the period it affects prospectively from today and in future periods. Very simple, Nana. What I'm trying to say in note 2 is that because of change in accounting policy, wherever you feel change is gonna happen, if it is in a particular asset, change it accordingly. If it is in a particular liability, change it. If there is no effect on asset or liability because of change in that particular accounting estimate, and if you feel that the effect will be on P&L, then you do the same in P&L. It's a simple sentence, that's all. It will be helpful for us in solving sums. Okay, moving on. So you have an example over here, simple example for you. During the financial year 31st March 2019, the management of XYZ Limited performed an operational review of its plant in Gujarat. Okay, so that management has performed operational review of a particular plant in Gujarat, which resulted in changes in expected usage of certain items of PPE, certain machinery which was expected to be used in the production for a period of 7 years from the date of acquisition is now expected to be used in the production for a period of 5 years from the date of acquisition. Initially, they thought that it will be 7 years, but now it is only for 5 years. There are so many reasons for that. Maybe you would have used that machinery too much, or you have exactly not used that machinery the way it was, the way it has to be used. See, you buy car also, Nana. He'll say that, sir, 5 years warranty, sir. But you try to rev it like anything. You try to take it. You try to use it very, you know, in a pretty rough way. Then what will happen naturally? Yeah, you will start having problems. The life of the asset will be depreciated faster. Simple stuff. Okay. Sometimes you'll have bad assurance from the, vendor also. That also can happen. Vendor will assure you like anything. Then accordingly, you thought that the life of the asset will be, in this case, it is 7 years. Then in reality, the quality is pretty bad. Therefore, you came to know that, okay, the reality is it will run only for 5 years. You understand what I'm trying to say? The reality, I think I can sync this with electric cars right now. Most of my students and my friends, whenever they say they're going to switch to electric cars, my advice would be absolutely no. Okay, unnecessarily you'll be losing lot of money, despite in addition to inconvenience and other stuff. Never ever go for electric cars right now. This is not the time. There is still time. Once there is a saturation of technology with respect to electric cars, and that is the time to go for it. Now don't even think about it. You think about it and you take a decision to buy it, you're gonna regret for sure, especially when it comes to drop in value. Okay, moving on. From the date of acquisition, okay, now it is 5 years. Okay, considering the introduction of new technology in the market. Okay, he himself gave the reason. Okay, that's fine. This has resulted in decrease in the useful life of machinery. Okay, which means automatically you need to increase the depreciation, correct? The effect of this change on actual and expected depreciation expense in the current and future years is as follows. Okay, this is current year 2018-19. Increase in depreciation expense. Why? Life has got reduced. Now you have to depreciate the entire PP within lesser number of years. So naturally, per year the depreciation will increase. It has got increased. Got the point? Just to understand, okay, this is how it will happen when it comes to change in accounting estimate. That's all, nothing else. Are we done with this? Okay. What are all the points that you have to remember, Nana? First one is, what is an accounting estimate? Remember that, okay? Then the change has to be given prospectively. That you have to remember. Disclosure, nature of change in accounting estimate, they are similar to nature of change in accounting policy, and the effect on current year and future year. There, the effect on current year and previous years. And if it is not possible for you to show the effect on future years, then the same fact will be mentioned. There also, if you can't show the retrospective of, effect of change in accounting policy, then the same will be mentioned. The fact will be mentioned. Got it? Pretty easy to remember. Moving on. Now coming on to the last part of this particular Ind AS, that is errors. Okay, if we are done with this, we are done with this particular Ind AS. Nana, errors is important, Nana. Accounting policy is important, errors are also important, because based on this only you've got lots of sums. Accounting estimate, not so much. Okay, the standard itself is decent standard. Okay, you guys are ready? We'll start with errors. All right, guys, ready? The last one. Let's finish up these errors. Okay. Nana, I've written definition here, which means from here to here, you got to memorize. Get it? We're gonna get lots of theoretical questions based on this, where you have to apply the concepts as well, and you have to repeat this definition as it is. Then only we can apply our thought process, our answer, and eventually you can apply the concept and eventually solve the sum. But this has to be repeated. Am I clear? So we're gonna focus, we're gonna give some time to understand this definition, okay? And then we'll proceed. You guys are ready? Okay, chalo, let's start, guys. Prior period errors or omissions from and misstatements in the entity's financial statements. Omissions means you did not account. Misstatements means you have accounted but accounted wrong, okay? In the entity's financial statement, which means prior period errors or omissions or misstatements in the entity's financial statements for one or more prior periods. One or more means either it can be last year or last before year or last before year. You got the point. One or more prior period years from failure to use or misuse of reliable information, which means you had reliable information, you did not use it, that is what failure to use, or you did use it but use it in a wrong way, which we call it as a misuse, okay, of reliable information that was available when the financial statements for those periods were approved for use. The reliable information were available, but you did not use it properly, or you have misused it, or the information itself is not available, but you could have reasonably expected to have obtained that information and taken into account in the preparation on presentation of financial statements. Which means both the possibilities the standard is looking at. One, you had information with you, and either you have failed, you have failed to use that information, or you have misused that information. Now, if suppose if the definition ends here, okay, then you know what our people will do. Intelligently, they will say, standard, I don't have information with me. When I don't even have information with me, then how can you expect me to, to be failed to use the information, or I've misused the information? Information itself is not available with me. Standard also thought of this, and therefore standard says, with reasonable expectation, easily you could have obtained the information. If you don't obtain the information, that also will be considered as a mistake, error over here. Could reasonably be expected to have obtained and taken into account the preparation and presentation of those financial statements. Such errors include the effects of mathematical mistakes, mistakes in applying accounting policies, oversights, misinterpretation of facts, and fraud. Got the point? This exactly we have to repeat, Nana. There is no compromising in this. Only then we are going to get marks. Got it? Chalo. We'll repeat it one more time. Prior period errors or omissions and misstatements in the entity's financial statements. You got it? For one or more prior periods, one by one. So what you do is that when you try to remember this, you just chop it off. Okay, what are prior period errors? They are either you don't account it, that is omission, or you have accounted wrong, which is nothing but commission or misstatement. Okay, commission of error we call, or misstatement in the entity's financial statement only. Now you'll do that mistake. So where you'll do that mistake? In entity's financial statement. When did you do that mistake? For one or more prior period years. Got the point? One or more prior period years arising from failure to use or misuse information that is available for you when you were preparing that particular financial statements, or you could be reasonably be expected to have obtained such information and taken into account while preparing, that is presentation and preparation of financial statements. Okay, that's it. Now such errors include mathematical mistakes, mistakes in applying accounting policies, or misinterpretation of facts, or fraud, or oversights. Done. Now second point, errors can arise in respect of recognition, measurement, presentation, or disclose of elements of financial statements. Okay, so when you're recognizing something, there also you can do mistakes. Recognition of initial recognition of assets and stuff like that. Measurement, subsequent measurement we do na of the assets, there also you can do mistake. Presentation, where you have to present that particular item under non-current or current or where, there also you can do mistake. Disclosure, while disclosing certain facts also you can do mistake. Okay, recognition, measurement, presentation, and disclosure of the elements of financial statements. And financial statements will be considered that they don't comply with Ind AS if they contain either material errors. This is very important, concentrate. Either material errors. So if you have material errors, that itself will be considered as your financial statement did not comply with Ind AS. Got it? Or you have immaterial errors, which means the so-called error is not material, which means probably it will not influence the decision of the users of the financial statements. Even then, those immaterial errors will be considered as if you are not complying with Ind AS, provided if they are made intentional. If they are made intentional to achieve a particular presentation of entity's financial position or financial performance or cash flows. You understand the point? Which means when the error is material, irrespective of your intention, I don't want to know about your intention. I'll feel as if your financial statements do not comply with Ind AS. That's what auditor will do. Got the point? On the other hand, if there is immaterial error, then your intention is important. Unintentionally, if there is immaterial error, chalta hai, no worries. I'll not consider that your financial statements do not comply with Ind AS. But if you have immaterial error, but still you made that with an intention, then I'll consider that your financial statements do not comply with Ind AS. You got the point? Are we done with this? Okay. Examples: error of commission, error of omission. Commission means you have accounted wrong. Omission means you did not account. Error of principal, fraud, classification error. Okay. We'll see that. We'll see that clearly once we start solving sums. Are we done with this? Chalo. Okay. So this is what error is. Once you know the error, then how are you going to rectify that? That's what we're going to see next. Treatment of prior period errors. Very simple, Nana. Entity shall correct the prior period errors retrospectively, just like accounting policy. Okay. Correct such errors from the very first day of the past as follows. What did we do in accounting policy? Very simple. We'll go with the previous year numbers. Comparative statement will put na additional column. In those columns, you will rectify when it comes to accounting policy, whatever the change in numbers. Here also, you will do the same. So first change will happen to restating the comparative amounts of previous year. That column will be there in a previous year column. There you will try to restate all the comparative amounts by rectifying this so-called error. Then what you will do, you'll go to the previous year opening balance and then you will restate that opening balance. Mostly the effect will happen with respect to what, Nana? Yeah, exactly. Restating the opening balance of previous year for correction relating to all prior period items. This, in other words, we also call it as third balance sheet. Okay. Suppose you are not able to do that retrospective effect correction with respect to the prior period items, then the entity shall restate prior period items retrospectively after making every reasonable effort to do so. Then entity should restate prior period errors prospectively. Okay, so which means, suppose if you say I can't do retrospective change with respect to the prior period errors. How many years your error is? Say for example, your error is for 5 years. 5 prior period errors. Okay, so these many years you have the error. So what you do, you say that 5 years I can't retrospectively change it. What is practically possible for me is only 3 years, which means latest last 3 years I can do that, correction. of my prior period error. You understand the point? Then in that case, the standard says, okay, those 3 years you do. Then you say, those 3 years also not at all possible. First of all, retrospective is not possible for me. I can do only prospective. Then the standard says, okay, then do prospective. But that has to be genuine. You made every effort from your side to retrospectively correct your error. After that, if you're not able to do that, then standard says you can go prospectively. Got it? That's what this is. Anyways, now the treatment of prior period errors, we have an example. With the help of that example, let's try to understand. Now, this is similar to your accounting policy only. Now, there also the change should be retrospective. Here also the change should be retrospective. In that retrospective change, the first thing that you will do is you will restate the comparative amounts of previous year in that column. Current year column will be there. Besides that, previous year column will be there. Now, there you have to restate the amounts. There also you will do the same. Here also you will do the same. There also you will go to previous year opening balance. Mostly their retained earnings only, the effect will be there. Here, lots of other items also, the effect will be there. But that opening balance of the previous year, we call it as third balance sheet. Okay, moving on. Let's try to take an example. You guys are ready? Chalo. Let's say the current year is here, Nana, 1/4/24 and 31st March 25. 24/25 is the current year. So you are here. This is previous year. Okay. And previous year opening balance sheet will happen here, 1/4/23. Which we call it as third balance sheet. Okay. Now see here, last 3 years you have omitted to record an expenditure of 20,000 per annum. So this is omission. This is not commission, this is omission. Okay. You did not account 20,000 per annum expenditure. How many years? Last 3 years. So what you will do first, you have to restate your previous year. Okay. In current year financial statements, comparative column will be there, na? Right? In that, instead of copy pasting previous year original financial statement, whatever the numbers that are there, you are going to rewrite them, which means restate them, change them according to this particular error. So which means simply what you're going to do, simply put change is going to happen in the comparative column of current year financial statement, that is 20,000, which means that 20,000 probably you will be adding that expenditure because you missed it, na? You're going to add. Where? In the comparative column of the previous year, besides the current year financial statements. Current year financial statements, okay, previous year. In this column will be there, na? Here you will make the change. Probably you will introduce this 20,000, okay? Okay, fine. That year it has been rectified. What about the previous 2 years? Another 40,000 balance still is there, na? If mistake is beyond previous year, then give opening balance sheet of the previous year. The retained earnings will be there, na, in opening balance sheet. This one. Here, what you will do, you will give adjustment to the effect of 40,000. You got the point? It is an expenditure in this case, na? So probably you'll reduce from the retained earnings here in the opening balance of the previous year. This is current year, na? 24/25. Previous year, 23/24. Previous year opening, 23. 1st April 23. Here you will have opening balance of the so-called retained earnings. In that you will show the effect. Similar to your change in accounting policy, Nana. Nothing. So it's exactly the same. You got this? Yes, everybody. Chalo. At last, it's about disclosure. Same stuff, Nana. Nature of prior period error. Earlier, nature of change in accounting estimate. Earlier, nature of change in accounting policy. Same stuff. Effect on the current year as well as on the previous years due to prior period error. There, in accounting estimate, effect on current year and future years. Accounting policy, effect on current year and previous years. You got the point? If retrospective is not possible, disclosure reasons to it. Same as accounting policy, especially when it comes to disclosure with respect to prior period items, it is pretty much same as accounting policy disclosure whenever you change your accounting policy. Okay, that's it. Are we done with this? Chalo, we have few examples. Let's go through that. You guys are ready? Chalo. An entity presents 1 year comparative period in its financial statements. Okay. While preparing the financial statements for the financial year 2004-5, that is current year, if an error has been discovered which occurred in the year 2001-2, okay, so many years back, for the period which was earlier than the earliest period, I mean, for the period which was earlier than earliest prior period presented, what is the immediate prior period? 3-4. 4-5 is your current year, na? So immediate previous year will be 4-5, last year. So which is 2003-4 in this example, then the error should be corrected, which means what he's trying to say is that if your error belongs not to the previous year, but beyond the previous year. For 2004-5, the previous year is 2003-4, immediate preceding year, okay? Your error does not belong to immediate preceding year, it belongs beyond immediate preceding year because backwards of time, okay? Then in that case, the error should be corrected by restating the opening balance of the relevant assets or liabilities or the relevant component of equity, which we are talking about retained earnings for the year ending 2003-4. Simple. That's what we have discussed here. Na? If the mistake is beyond previous year, then give opening balance sheet of the previous year, retained earnings, give adjustment of 40,000. That's what component of equity. That is nothing but retained earnings. Opening balance, that's where you have to give the effect. This will result in consequential restatement of balance as at 1st April 2003, the third balance sheet. That's what we call it as third balance sheet. Why 1st April 2003? 2004-5 is the current year. 2003-4 will be the previous year. In that beginning of the previous year is nothing but 1st April 2003. Just like what we have discussed over here. Got it? Same stuff. I'm just trying to show you ICA example. Moving on. One more example, Nana. A material error in depreciation provision for the preceding year ended 31st March 2002 was discovered when preparing the financial statements for the year ended 31st March 2003. So current year, when we are preparing financial statements, we discovered that in previous year, a depreciation provision, there was a material error. Remember, when it comes to material error, whether it is intentional or not doesn't matter. But when it comes to immaterial error, intention is important. Got it? Chalo. The amount recognized in the statement of P&L for the year ended 31st March 2002 was 1 lakh instead of 50,000. Okay. So which means 50,000 you have debited more. In this case, when presenting the financial statements for the year ended 31st March 2003, that is current year, depreciation for the comparative year will be restated at 50,000. What is the mistake that you have done? It should be 50,000, but instead of that you debited 50,000 more, which means you have debited 1 lakh. Now instead of 1 lakh, you rectify it and you restate it at 50,000. Where are you going to restate? Current year financial statements for 2003. You will be preparing na column. Besides that, you will have previous year, okay, financial statements. Here, you would have put depreciation earlier as 1 lakh. Now remove that 1 lakh. Instead, you put 50,000. That's all. Okay. So in this case, when presenting the financial statements for the year ended 31st March 2003, depreciation for the comparative year, that is previous year 2002 before 2003, will be restated at 50,000. The carrying amount of the net book of value of PPE for the comparative year ending 31st March 2002 will be increased by 50,000 if you are showing your asset not at gross amount but at net carrying amount. Only then you will do this. Suppose you are showing your asset at gross amount, then only accumulated depreciation only, na, you have to change. Then you will not change the value of the asset. You will not disturb the value of the asset in the balance sheet. Asset value also will be changed provided if you are carrying your asset at net carrying amount. I hope you guys are able to understand this. Okay. Net carrying amount means every year whenever there is depreciation, you will also reduce the value of the asset in the balance sheet. If that is happening, then only you will do this. Okay, because when you put 1 lakh instead of 50,000 depreciation, you would have reduced the value of the asset by 1 lakh instead of reducing the value of the asset by 50,000. You got the point? Therefore, now you will be adding back the 50,000. That you will do. Got it? This will result in consequential restatement of the opening balance of retained earnings and PP for the year ended 2002 2003. Now, remember, in this particular example, the mistake happened only in the previous year. Therefore, in the comparative column, while preparing current year's financial statement, in comparative column, we gave the effect. There ends the matter. Okay, we need not go to prior years. You find out what is the effect in prior years and then show the effect on the opening balance of the previous year, which is nothing but we call it as third balance sheet. All those things not necessary. Nana, when the mistake happens only in the previous year, third balance sheet is not necessary, Nana. When mistake happens beyond previous year, okay, like 3, 4, 5 years back, then you have to prepare third balance sheet, which is nothing but opening balance of the previous year. Clear? Moving on to next example. Continuing with the aforesaid example, that is this one continuation, assume that the error relates to year ended 31st March 2001. That's what exactly. Just now we have discussed that the error belongs to only previous year. Therefore, comparative statement of the previous year is enough where you restate it. Okay. But now itself he is telling you, okay, error relates to what? Year ended 31st March 2001, which means your previous year will be 31st March 2002. Na? 2001 means beyond previous year. And 2000, 2001 is not the earliest period. for which the comparative information is presented, which means it is not previous year, okay, where comparative column will be presented in current year financial statements, okay. In this case, the error will be corrected by restating the opening balance of the retained earnings and carrying amount, that is net book value of the PPE for the year ended 2001-2. This will result in restatement of balances on 1st April 2001. You got the point? Because right now it is 2003, 31st March on a current year, which means 2002, 2003 is current year. Means 2001, 2002 is previous year. And 2001 means 2001 April is nothing but previous year opening. That's what he has done here. April 2001. Got it? I hope this is clear. Right, Nana, that's it. We are done with this particular standard. Now, before I close this off, okay, I want you guys to again go through the definition of prior period errors, okay, or errors. Chalo, this is important, Nana, because we have to repeat it as it is, okay, while writing the answers. Whenever I say something to memorize, you have to memorize it. Okay, let's see one more time. What are prior period errors, Nana? These are commissions or omissions. Omissions and commissions. Here, omissions is there. Commissions, you can also call it as misstatements. Okay, omissions and misstatements in the entity's financial statements for one or more prior period arising from failure to use or misuse of reliable information which was available when the financial statements for those periods were approved for issue or could reasonably be expected to have obtained. Okay, if you would have put some reasonable effort, you would have obtained it and taken into account in presentation and preparation of financial statements. Till here, you have to remember, Nana. Compulsory. Got it? Chalo. Are we done with this? And this also you have to remember, errors can arise in respect of recognition, measurement, presentation, and disclosure. Recognition, measurement, presentation, and disclosure. This also you have to remember. Why I'm telling you this is that, see, anyway, we are going to solve the problems correctly. That's not the problem. But while solving the sums, even theory-based application-oriented questions, you know that this is the answer. You'll write the answer, you'll write the numbers, and everything is fine. You'll prepare comparative previous year statement, you'll restate it. Okay, if necessary, you'll prepare third balance sheet also, opening balance of the previous year, retained earnings, everything you'll do that, rectify. You'll write all the numbers correctly, but you have to write the definition, then only you have to do rest of the things. Otherwise, you are not going to get the marks. Ultimately, what is important for us is to get the marks and pass the exams. Okay, exactly the same sentence forming should be there. You can't change that also. Am I clear? So prior period errors or omissions from and misstatements in the entity's financial statements for one or more prior period years with respect to failure to use or misuse of the information which was available at the time of preparation and presentation of financial statements, or which could be reasonably expected to have obtained and used means taken into account while preparation and presentation of financial statements. At least to this extent you have to remember. Am I clear? Yes. Chal, fantastic. Are we done with this? Chalo, guys. Yeah, we'll see the problems in the next session. Okay. All right. Hi, guys. Welcome back. Just confirm me that the audio is fine. Yeah. Is it fine? Okay. Any lag in the relay? Okay. Confirm me that. Once you guys have confirmed me, we'll start. Ready? All right, Nana. Chalo, guys. In the last session, we are done with all the concepts. Correct? Yeah? So I think this is where, with example 17 is where I've closed the last session. Okay. Okay. Chalo. So with this, we are done with the concepts. Now, before we go with this particular, problems of this particular standard, Ind AS 8, I want you guys to memorize certain things. Okay. If you guys are ready, we'll just get through that. Okay. Accounting policies definition, you got to memorize. There are specific principles, bases, convention, rules, and practices which are applied by the entity in preparing and presenting financial statements. Okay. One thing. Moving on. when you will select and apply accounting policy, especially this order, you have to remember. First, if any specific Ind AS is available, you'll go with that. If that is not there, for similar transaction, any other Ind AS is available. If that is also not there, you'll go with the framework where you'll ensure that you don't deviate from the definition of asset, liability, expense, and income and all those things. After that, you'll go with Ind AS, International Accounting Standards Board. Then you can go with any other company's AS. You got it? If that is also not available, then probably you'll go with accepted industry practices. Now, this you have to remember. Chalo, after that, voluntary change in accounting policy. This also you have to remember, which means if at all you want to change your accounting policy, first, it has to be required specifically by an Ind AS. Then you will follow that Ind AS. In that Ind AS only transitional provisions will be there. We'll just follow it and then we'll try to change our accounting policy. You got it? If that is not there, if you voluntarily want to change an accounting policy, you can do it only if and only if you are able to provide more relevant and reliable information. So this sentence is very important. Okay. And then this, you need not memorize any of these things because this will be applying while solving sums. So that should be fine. Okay. Disclosure also you have to remember, Nana. What else? Yeah, you know that the effect is going to be retrospective. That everybody knows, okay, when it comes to accounting policy. These are all concepts. Concepts you have to remember. I'm only focusing on sentences that you need to reproduce when you are, writing a solution. This also you have to remember, notate, which means whenever a particular Ind AS has been issued, but it is not effective, and because it is not effective, you are not following that particular Ind AS. You are waiting for the time till it becomes effective. In that case, you need to do some disclosure. There is one question based on this. Okay, what else? Yeah, accounting statements. Okay, when you will change the accounting statement, that also you have to remember. What else? This is more important. This entire thing you have to remember, Nana, starting from here, the prior period errors definition. Okay, right? These are omissions or misstatements in entities' financial statements for one or more periods from failure to use or misuse of reliable information. Okay, and these A and B sentence also you have to remember as it is. You got to memorize it. Okay, information that was available when the financial statements for those periods were approved or could reasonably be expected to have obtained. Either information was available or you could have easily got it. Okay, in both the cases, it's gonna be considered as an error. After that, this also you have to remember. This exactly. Errors can arise with respect to recognition, measurement, disclosure, and meanwhile presentation as well. In these four aspects, you can get what? Error. This you have to write it. Okay. And also, financial statements do not comply with Ind AS. We'll consider that your financial statements have not complied with Ind AS provided this sentence you have to write. They either contain material error or immaterial error intentionally done. When it comes to material error, intention or non, there is no intention, it doesn't matter for us. But when it comes to immaterial error, yes, intention is important, which means if there is an immaterial error and there is no intention behind that, which means intentionally you have not done that, it was by mistake, then in that case, no problems. We will not consider that your financial statements are not complying with Ind AS. We'll not consider that, okay? Which means we'll consider that you are complying with the Ind AS. You understand the point? When it comes to material error, we don't want to get into the intention behind that, whether you intended to do that or you don't have any intention, doesn't matter. Either case, we will come to a conclusion that your financial statements are not complying with Ind AS. Got it? Now, when it comes to immaterial error, we'll look at the intention. If intentionally you have done it to present your financial statements in a particular way, a particular number to be presented in a particular way, then in that case, it will be considered that you have not complied with Ind AS. If there is no intention, then chalta hai, TK. Will not be taking that into consideration. So, this and this you got to remember. You got it? You have to memorize it. When we are solving sums, we'll be reproducing this. So whenever I say, when I'm solving the sum, I'll be saying like this, Nana, concept copy paste. When I say concept copy paste, it means we have already studied it and then we have to reproduce it as it is. Got it? What else? That's it, Nana. So this is what you have to memorize. This is most important out of all. So many times this will come. This paragraph and this paragraph. You got it? I hope this is clear. Now, if this is clear, then we'll go for solving sums. Are we ready? All right, guys, we'll start with the first one, illustration 1 in your ICA study material. You guys are ready? Give me confirmation. Chalo. Can an entity voluntarily change one or more of its accounting policies? This straight away, it's a theory question, right? So we know that as per Ind AS 8, an entity can change accounting policy only when it is required by an Ind AS. Or, yes, you can voluntarily change accounting policy provided if it results in more relevant and reliable information. That's all. That is the answer. That's all. We know the concept. So concept copy paste. This is the answer. But you see how your ICA has stretched the answer. If you can see, again and again they've repeated the same sentence. See here. Already here we have the concept. With this, literally the answer is done. Next paragraph, you'll write the conclusion, your answer is done. But look at what your ICA has done. Paragraph 14b lays down two requirements. Of course, you need not remember the paragraph numbers. I'm just reading. Okay. That must be compiled within order to make a voluntary change in accounting policy. So repetition of what has been written over here. First, the information resulting from application of the change, which is the voluntary change of the new accounting policy, it must be reliable. So this particular information has been cut into a separate sentence. Then, second, the changed accounting policy must result in more relevant information being presented in the financial statements. This has been cut into another sentence. Got it? So now already this has been repeated twice. Okay, next. Whether a changed accounting policy results in reliable or more relevant information is a matter of assessment in the particular facts and circumstances of each case. Because how will you finally decide whether really it has been, see, I say that I want to change from, say, for example, weighted average method of valuing the inventory to FIFO method. I say, then you ask me, why are you changing? I say, it's a voluntary change. Of course, it's a change in accounting policy, obviously, because you're changing the methodology of weighing your inventory. I say that because of this, my information is going to be more reliable and more relevant. Then you ask me how? I say it's my judgment. Or maybe you have to prove also this is how the numbers are going to change and all those things. That's what we are trying to say over here, right? Changed accounting policy results in reliable and more relevant information. It is a matter of assessment in a particular facts and circumstances of each case. In order to ensure that such assessment is made judiciously, which means you have done it correctly, Ind AS requires an entity to judiciously, such that the voluntary change in an accounting policy does not effectively become a matter of free choice. Got it? Paragraph 29 of Ind AS 8 requires an entity to make a voluntary change in accounting policy to disclose the reasons why applying the new accounting policy provides reliable and relevant information. So, which means, logically speaking, actually the answer is like this, Nana. First, you will copy paste the concept where you can change an accounting policy provided if it is required by a specific Ind AS or if it results in giving more relevant and reliable information. This is the actual answer. There ends the matter. After that, he's just stretching the answer, saying that, what do you mean by more reliable and relevant information? How can you decide? You got the point. So it is purely based on judgment. Then the Ind AS says, how can we come to the conclusion that the management's judgment is done correct, which means judicially they've done it? How can you come to a conclusion? So therefore, what we do is that because that judgment depends upon individual facts and circumstances of the case, which will change from case to case. Therefore, smartly what Ind AS has done is, okay, fine, you have taken a judgment. You think that this will give you a more reliable and relevant information. We trust you. But to ensure that you don't do any kind of fraud because of the free choice of changing the accounting policy, which is a voluntary change, we will simply ask you to disclose it. That's all. So that once you have disclosed it, the other people also will come to a conclusion whether the reason behind the disclosure, which means when you disclose it, what you will say, I've just changed the accounting policy, like that you will not say. You will also say the reason. And the other people who are using the financial statement, they will know that you have changed this accounting policy and they will make the decision themselves, saying that this guy has changed accounting policy. Did he give a proper reason? If that proper reason seems fine, they'll be okay with it. Otherwise, they'll raise their own concerns. So ultimately, Ind AS has left this ball in the court of, the kind of situation between the company as well as the users of the financial statement. That's how the answer goes, which means ultimately this answer can be divided into three parts, which I've explained you just now. Is that clear? But honestly speaking, from here to here, plus three sentences or three lines should be enough for this particular answer, but they have stretched it a lot. But that's okay. I say being, I say J, I say. Are we done with this? If you're done with this, we'll move on to the next one. You guys are ready? It's a simple question only. What is there in this? But see, Nana, see, sometimes I've seen students, what they'll do is that they'll just read this question, I know the answer, because they remember this, and then they'll move on to the next one. That's not important, Nana. See, in case, of course, it's a kind of rarity that this question comes in the examination as it is, but the kind of answer, the kind of presentation is very important, Nana, because we need to get the marks now. That is more important. That's the reason I'm stressing on entire solution of your ICA, so that you and me put together, we'll try to understand how the ICA has presented, so that our presentation tomorrow in the examination is on par with the ICA searched answers. You understand the point? Only then we are going to get marks. That's more important for us. Are we clear with this? Chalo, fantastic. Moving on. Now coming on to illustration 2. Everybody, come to illustration 2. Ready? Ready, guys? Chalo, fantastic. Entity ABC acquired a building for its administrative purpose and presented the same as PPE in the financial year 2001-2002. Okay, that's good. During the financial year 2002-2003, okay, it relocated the office to new building and leased the said building, which means the first building, to a third party. The first building, which was initially used for administration purpose, therefore it comes under PP because it becomes owner occupied property. But then they shifted that business to a new building, that is administration stuff. And the first building, they have leased it to a third party. What kind of lease, we don't know. Following the change in the usage of the building, entity ABC reclassified it from PPE to investment property. So definitely it has to be operating lease. It can't be financing lease. We know that because we are done with Ind AS 40. Okay. So obviously it has to be operating lease. Okay, so therefore it becomes kind of rental property, so it comes under investment property, right? Therefore they've changed it from PPE to investment property in the year 2002-2003. Should entity ABC account for change as change in accounting policy? Awesome. So what's the answer, Nana? You guys can give the answer yourself. I'll wait. Okay. See, first thing, let's try to understand. I told you a pro tip I've given you. What did I say? Nana, if you're confused with respect to something as an accounting policy or not, you just try to understand, given the facts and circumstances of the case, whether there is a choice within the hands of the company. Now, here, initially ABC acquired a particular building for administration purpose, and therefore it treated that particular building as PPE as per Ind AS 16 or owner occupied property. Now tell me, at this particular moment, stop here. At this particular moment, does AB, sorry, does ABC has a choice? No. It has to simply just follow what Ind AS 16 says. You are using this so-called building for administration purpose, therefore it will be treated as PPE as per Ind AS 16 or owner occupied property. There ends the matter. It's not a matter of choice. You don't have a choice to treat that particular building which you are using it for administration purpose as investment property or PPE. Do you have a choice? No. You just need to follow what Ind AS 16 says. So when there is no question of choice, obviously it is not an accounting policy. Got the point? Moving on to the second one. Now, the change in use of your building has happened, which means the purpose of your building has got changed. Earlier it was used for administration purpose. Now you have changed it to what? You have gave it on an operating lease, obviously, and therefore it becomes kind of a rental property, and therefore obviously it will be treated as investment property as per Ind AS 40. Got the point? Now the question is, here also you don't have a choice because you gave your building on operating lease, and therefore it falls under Ind AS 40. And Ind AS 40 says that you have to treat it as an investment property. And once you treat it as an investment property, you have to follow cost model. So this is what Ind AS 40 says, and it's not a choice for the company. So therefore, this so-called shift from PPE to investment property or owner occupied property to investment property is not a matter of choice. Therefore, automatically it is not an accounting policy change. It is just a change in use of the property. Clear? That will be your answer. But whatever I've discussed so far with reasons is the application of the concept. But I told you so many times, when you start presenting your answer as per your ICA, you cannot straight away write the application of the answer, right? Direct concept application, if you write, you are not going to get marks. What I have to do initially, write the concept as it is. You got to write the definition, which means now in this question, we are talking about two things. One is PPE, the other one is investment property, correct? Ind AS 16 and Ind AS 40. So first write the definition of PPE, then write the definition of investment property. So you write the concept. Then you apply the concept and then you say it is just a change in use. Okay, it's not a kind of policy. Sorry, it's not a kind of choice that is available with the hands of the management. Therefore, it is just a change in use. And as a result, management is forced to recognize as per the respective accounting standard. You understand the point? Yeah. Therefore, it is not a change in accounting policy. That will be your answer. So let's have a look into the answer. So first, definition of PPE. Clear? As per Ind AS 16. Okay. Yeah, we know this. Do we know this or not? Huh? Now, chalo, you guys repeat. Let me see once. As per Ind AS 16, PPE are tangible items which is used for what? Production or supply of goods and services or rental purposes except for land and building or administration purpose and which are held for more than one accounting period. This is PPE as per Ind AS 16. We know this, right? Similarly, what is investment property as per Ind AS 40? Which is given on rental purposes or capital appreciation purpose or any undetermined use. There ends the matter. That's all. You remember this, that you have to write there ends the matter. Chalo, are we done with this? Yes, moving on. So you have written the definition. Now you apply the concept over here. So you see here, as per the above definitions, whether a building is an item of PPE or investment property depends on the purpose for which it is held by the entity. It is thus possible that due to change in the purpose or change in use, a building that was previously classified as PPE now reclassified as IP, that is investment property. Whether a building is in the nature of PPE or investment property is determined by applying the definition of these terms from the perspective of that particular entity. Thus, the classification of a building as an PPE or investment property is not a matter of accounting policy choice. Accordingly, a change in classification of a building from PPE to investment property due to change in purpose or change in use for which it is held by the entity is not a change in accounting policy. Again, he has repeated. Here itself, he could have cut it. Got it? Now, did you understand how to present this in the exam? Definition of the concept, application of the concept, and answer straight away. Got it? Hello, everybody. Are we done with this? Shall we move on? Fantastic. Coming on to illustration 3. Whether change in functional currency of an entity represents a change in accounting policy. Again, whenever you have a confusion like this, what did I say? If it is like a choice, entity has got a choice of 2 to 3 choices are there for the entity. And the entity can choose any of this. If entity is such a kind of situation, then it is an accounting policy for sure. But if entity does not have any choice and it has to follow only one thing given the situation, either as per Ind AS, you understand the point? Ind AS says do this, entity also does that, then that's not an accounting policy. You got the point? Accounting policy will come into picture only if there is a choice for the entity to choose between multiple options. Got it? Now, whether change in functional currency of an entity represents a change in accounting policy. Now, to answer this, we need knowledge of a particular Ind AS which we have not covered so far. That is Ind AS 21. Okay. Did we cover Ind AS 21 as of now? Nope. So do we have knowledge of Ind AS 21? Nope. In that case, are we expected to solve this particular question? Nope. With Ind AS 8 knowledge, you can't solve it. So therefore, what will I do? Whatever that is necessary for you to understand from Ind AS 21, to that extent we will cover, and then we'll solve this particular question and then we'll move on. Got it? Now, coming on to Ind AS 21, you have 3 types of currency as per Ind AS 21. Okay. First one is presentation currency. Now, what do you mean by presentation currency? The currency with which you will present your financial statements. The next one is functional currency. Okay. And the next one is foreign currency. Now, first you need to understand these 3 currencies. What are they, Nana? As per Ind AS 21, presentation currency, functional currency, foreign currency. Clear? Now this will be very tricky. I'll give you one good example. Try to understand. Suppose you have an Indian company, okay, in Chennai. Indian company in Chennai. The office is there in Nungambakam, say for example. Okay. But majority of your clients are foreign clients. Majority of your business transaction happens in only dollar. Literally everything. All are US clients, say for example. So everything happens in dollar. Now tell me, what is the currency that you are predominantly doing business with? Dollar. Therefore, what is the functional currency for your particular company? Dollar. Now, suppose in your office in Nungambakam, Okay, let's say your office is beside Ayakar Bhavan in Nungambakam, where the income tax office is there. One of your managing directors comes out, and then he just had a tea, right? For that he pays in rupees. Now this rupee payment, what he has done, is a foreign currency now, because your functional currency is dollar, even though you're an Indian company working in India, in Chennai. Still, your functional currency is dollar, and the payment that you've made in rupees becomes a foreign currency. You come back and convert that chai rupee into dollars, and then only you can present it. You understand the point? At the same time, when you have to present this in the form of financial statements, because you are in India, you're probably listed here, and therefore there will be users of financial statements who wants to look at your financial statement from rupee perspective. Therefore, your presentation currency will be in rupee. So rupee becomes presentation currency for the purpose of government documents, taxation purpose, or whatever it is. So I hope now you have understood the difference between functional currency, foreign currency, and presentation currency. Now you tell me, in this given scenario, that particular company in Chennai, Nungambakam, has to use dollar as functional currency. Why? Because predominantly its transaction is based on dollars only. Now tell me, do that company have a choice? Can it say, no, 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 I have a choice. I can either choose dollar as my functional currency, or rupee as my functional currency, or euro, for example, or pound, for example. Does it have a choice? Nope. As per Ind AS 21, if majority of your transactions, literally, you're doing it based on dollars, then dollar is your functional currency. There ends the matter. That's all. You just need to follow what Ind AS 21 says. It is not a choice for you. Therefore, when there is a change in functional currency happens, say for example, majority of clients have shifted. Now you have got majority of your clients from India itself, and as a result, majority of your transactions slowly have started, converting from dollar to rupees, and now majority of your transactions are happening in rupees. Then probably your functional currency has to change because of the change of circumstance in your business. Now again, this is not a choice. You just need to follow what Ind AS 21 says, because now majority of your transactions is in rupees. Then you have to take rupee as your functional currency. It's not a matter of choice. You got it? Yes? Sure. Let's look at the answer over here. So this anyway I've explained you. Functional currency is the currency of the primary economic environment in which the entity operates. That's the exact wording in your Ind AS 21. Okay, primary economic environment. What do you mean by primary economic environment? I already explained you through the example. Okay, shall I gave you that example here itself. So Ind AS 21 lists factors to be considered by an entity in determining its functional currency. It is recognized that there may be cases where functional currency is not obvious. In such cases, Ind AS 21 requires the management to use your judgment. Means what? Sometimes 50% of your transactions in dollar, 50% of your transactions in rupees. Then you are confused. Which one is my functional currency? 50% dollar, 50% rupees. You understand the point? In those kind of situations, Ind AS 21 requires the management to use its judgment to determine the functional currency that most faithfully represents the economic effects of underlying transactions, events, and conditions. Next, Ind AS 21 specifically notes that an entity's functional currency reflects the underlying transactions, events, and conditions that are relevant to it. Okay, we know that. Accordingly, once determined, functional currency is not changed unless there is a change in those underlying transactions, events, and conditions. That's what I told you. When most of the transactions has converted from US clients to what Indian clients, say for example, in that case, you have to change your functional currency, because right now, majority of your transactions are in Indian rupees. Clear? Thus, functional currency of an entity is not a matter of accounting policy choice. It is not a choice. You have to follow mandatorily what Ind AS 21 says. In view of the above, a change in functional currency of an entity does not represent a change in accounting policy as per Ind AS 8. Therefore, does not apply to such a change. Ind AS 21 requires that when there is a change in entity's functional currency, the entity shall apply the translation procedures applicable to new functional currency prospectively from the date of the change, because it's not a change in accounting policy. So therefore, the change will happen prospectively. Who says that? Ind AS 21. Therefore, we don't know that. We are yet to cover Ind AS 21. I hope this is clear. So whatever the knowledge that is required for you to solve and understand this particular theory question, to that extent I've covered. I hope this is clear. Any other doubts, Nana, for you guys? See, we are spending good amount of time in each and every questions, because see, straight away these three questions we can easily finish it off in just like that 2 minutes, Nana. But then see, that's not how we write the answer in the exam. And even despite knowing answer also, you will not get marks in the exam. That's a problem. Therefore, we need to understand the presentation. Now, in this question, I know you guys can't repeat this. You are not expected to write this. Why? Because Ind AS 21 we did not cover. So therefore, you don't know what these paragraphs are. You understand the point? Yes. So therefore, don't worry about that. Once we are done with Ind AS 21, then automatically these kind of questions you should be able to answer comfortably. Right now, you don't know it, so don't worry. Are we done with this? Yeah. Shall we move on to the next one? Okay. Give me confirmation, Ray. Then I'll move on. Okay. Shall we? All right. Fantastic. Illustration 4. An entity developed one of its accounting policies by considering a pronouncement of overseas national standard setting body in accordance with Ind AS 8. Fantastic. Okay. Would it be permissible for an entity to change the set policy to reflect a subsequent amendment in that particular pronouncement? So what has happened is that this particular company has followed a pronouncement by a foreign accounting body. Okay. And in that subsequent amendment has come by the foreign accounting body. Now he's asking you whether I can follow that as well. Okay. First of all, for this, we know the answer. But before we can write the answer, first we have to write the concept. What is the concept? First of all, whenever there is a change in accounting policy, what do you have to do? You tell me first. You already seen the concept, na? You have to follow specific Ind AS. Correct. If that specific Ind AS is not available, then what you have to do? With respect to that particular transaction, see whether it is covered by any other Ind AS. We'll follow that. If that is also not there, then what you will do? Framework of accounting that you have to see. Don't beat the definition of asset, liability, expense, and income. Don't beat the definition means don't. It's like you should follow the definition basically, to put it very simple. Okay, next. Then check the pronouncement of International Accounting Standards Board. Fine. After that, any other country standards. If that is also not available, then you'll go for industry accepted industry practices. Correct? That's the last one. But before that, any other country standards. Fine. That is where this guy is in. Now he's asking you. Already he has applied that, presuming that he has followed this descending order. Now he's saying that I have an amendment made by that particular accounting body, foreign accounting body. Should I follow this or not? Yes, you can follow, provided it helps in or it results in more relevant and reliable information with respect to preparation and presentation of financial statements. That is the answer. That's all. Are we done with this? Yeah, because this is a voluntary change in accounting policy only, na? Because there is no Ind AS for you to say. If there is Ind AS, we'll follow the Ind AS. You understand the point? So if there is no Ind AS, then definitely there is a voluntary change in accounting policy. You understand the point? Therefore, voluntary change in accounting policy, you will do it only if it results in more reliable and relevant information. At the same time, it also depends upon the judgment of the company with respect to that particular facts and circumstances of the case, where you have to judge whether this change in accounting policy results in more reliable and relevant information. At the same time, Ind AS also says you disclose the same, that you have changed the so-called accounting policy. You thought that this change will bring so and so, better reliability and relevance of the information. And accordingly, financial statements users, they will take care of it. Whether they will also decide whether the so-called accounting policy that you have done judiciously is bringing more relevant and reliable information. There ends the matter. That's all. We already done a sum now. Chalo, that's it. Whatever I've highlighted here, that is what you have to remember. Pretty simple. If you're done with this, we'll move on to the next one. Yeah, the questions are simple. This standard is not that tough, Nana. It's decent standard only. Okay. Next standard will be good. All right. Are we done with this? Shall we move on? Everybody? All right, Nana. Fantastic. Now, next is an example, Nana. This is not a question. It is a good example. So, because it's a good example given by your ICA, I've taken it. Because this can be converted into question also. That's why. Now, this is like a story. Let's read the story and then we'll go to next illustration 5. Okay. You guys are with me? Chalo. In 2006, an entity changes its accounting policy with respect to determination of cost of its inventory from FIFO to weighted average. Now, you know that change in inventory method is a change in accounting policy. Why? Because it's a choice. You can choose weighted average method, you can choose FIFO method. So, it's a matter of choice for you. So, therefore, it's a change in accounting policy. This change is made because obviously why there will be an accounting policy change voluntarily. It will result in more reliable and relevant information. That's what. The management believes that weighted average cost formula results in better matching of cost with revenue. Okay. Further, weighted average cost formula is generally used by other entities who whose business is similar to that of entity. So when the kind of industry in which you are doing business, if other entities are following weighted average method and you are following FIFO method, then your users of your financial statements cannot compare your financial statements with the others because you are following different accounting policies. Now, therefore, in that case, to make better comparability of financial statements, because the others in your industry is following weighted average method, you also voluntarily change your accounting policy from FIFO to weighted average method, then that satisfies the condition of doing the voluntary change of accounting policy in order to provide more relevant and reliable information, because better comparability of financial statements also satisfies the condition that it is more reliable and relevant. You understand what I'm trying to say? I hope it is clear. Moving on. Hence, provides reliable and more relevant information to the users of financial statements. Exactly, next sentence. This being a voluntary change, it has to be applied retrospectively, obviously. The entity had commenced operation in 2001. No records of the earlier years are available, as virus attack on server in 2006 has wiped off all past records. So therefore, even if you have to do retrospective application of this change in accounting policy, you can't do it because it's impossible. So when it's impracticable, what the standard says, you disclose the same. You disclose the reason also. This so-called virus attack reason, we will disclose it. And as a result, I'm not able to apply retrospectively. Therefore, I'll apply from whenever it's possible, I'll apply. From last year, it's possible, I'll apply. From this year, it's possible, I'll apply prospectively. So it is not possible to recreate the records. It is therefore impracticable to determine the cumulative effect of change in policy at the beginning of 2006. The entity will apply the change in accounting policy prospectively because it is impracticable, as simple as that. We will disclose it off, so there is no problem. Since the change in accounting policy is applied prospectively from 2006, the question of adjusting comparative information for any prior period presented does not arise at all because you are doing prospectively. Cost of closing inventories of 2006 alone will be determined using weighted average cost formula. Prior to that, it's already based on FIFO. The carrying amount of closing inventories for 2005 will simply be carried as carrying amount of opening inventories for 2006. We are not going to do any changes because it is prospective. Cost of closing inventories for 2005 determined on FIFO basis will be the starting point for applying weighted average cost formula during 2006. That's all. So this is just a story, Nana, only to tell you a story, only to understand how the change in so-called accounting policy will happen, even though the standard says you have to apply retrospectively. But these kind of situations like virus attack on your servers where it is impracticable for you to apply retrospectively, in that case you will apply prospectively. There it's a matter. That's all this story is all about. Nothing special. Clear? Shall we move on? Shall we move on to the next one, Anna? We're done with this? Yeah. Moving on. Illustration 5. You guys are ready? Whether an entity can change its accounting policy of subsequent measurement of property, plant and equipment from revaluation model to cost model. Nana, this is subsequent measurement. Okay. So which means already they have chosen one particular model. Okay. For the first time, even that is also an accounting policy only. So we want to change from revaluation model to cost model. Definitely, this is like a choice because you have two choices with you. Either you can follow revaluation model or you can follow cost model. So this is like an accounting policy choice. When it is a choice, definitely it's an accounting policy change. When it is an accounting policy change, you have to apply it retrospectively. Point number one. Point number two, you are allowed to change only when it is specifically required by an Ind AS. Here, that's not the case. You're doing it voluntarily, and voluntary change is allowed only when your resultant change will give more relevant and reliable information, will result in giving more relevant and reliable information. You got the point when it comes to your financial statements. Now, is that is going to happen in this case? Yes, because I gave you an exception. Just now I've explained where if you are in a particular industry and then say for example you are following revaluation model for your PPE, but in your industry everybody else is following cost model, in that case, to enhance the comparability of your financial statements with your peers in the industry, you can change your accounting policy from revaluation model to cost model, and this will make comparison better of your financial statements for the users of financial statements, and that satisfies the condition of giving more reliable and relevant information. Therefore, in that case, you are allowed to do this so-called voluntary change of accounting policy as per Ind AS 8. That's your answer over here. Shall we read? Chalo, now see. Ind AS 16 gives you the choice. Either you can choose cost model or what, Nana? Revaluation model. A change from revaluation to cost model for a class of PP, of course, when you do this, you have to apply for the entire class of assets that we know. In Ind AS 16, we have learned. Can be made only if it meets the conditions specified in Ind AS 6. What is that? The change results in financial statements providing more reliable and relevant information. For whom? For the users of financial statements. Fine. How can you prove that? For example, I just gave you an example. An unlisted entity, you have not yet listed, unlisted, but you're planning IPO, which means you're about to get listed, may change its accounting policy from revaluation model to cost model for some or all classes of its PPE provided to align with the entity's accounting policy with that of the listed market participants within that industry, so as to enhance the comparability of its financial statements with those of the other listed market participants, which means your peers, guys who are doing same business like you, okay, other companies. Such a change from revaluation model to cost model is not expected to be frequent. Frequently, this will not happen. Rarely it will happen. But where the change in accounting policy from revaluation to cost model is considered permissible in accordance with Ind AS 8, it shall be accounted for retrospectively. Okay, fine. In this kind of situation, it is permissible. So once it is permissible as voluntary change as per Ind AS 8, obviously you have to apply it retrospectively unless it is impracticable, as we have seen in the earlier case, this case, because of the virus attack. You got the point? Are we done? Yeah, it's a simple question. Let's move on. Next, illustration 6, guys. Whether an entity is required to disclose the impact of any new Ind AS which is issued but not yet effective in the financial statements as per Ind AS 8, which means it is issued but not yet effective, therefore you are not following that particular Ind AS. Very simple, you have to disclose the same name of that Ind AS, how much is the effect, if at all you would have started implementing that particular Ind AS and all those things. You got the point? Yes. This is the concept copy paste only, Nana. We have already seen it as a note. You remember? While revising also I told you, Nana, there is one particular note. Yeah, note 8. Where a Ind AS has been issued but it is not effective up to the date of the financial statements. Then the entity shall disclose the above fact, title of the new Ind AS, what is the impact, as well as if the estimated impact of the new Ind AS cannot be reasonably calculated, then that fact also you should mention. This we have already discussed. So this note 8 concept exactly you have to copy paste over here. Here. That's why I've written concept copy paste. When I write concept copy paste, it means that we have already covered it in our concepts. All you have to do is that just try to recollect the memory and then write the answer as it is. Are we done with this? Shall we move on to the next one? Done. Finished. Illustration 7. This you already know, Nana. Very simple. Whether a change in inventory cost formula is a change in accounting policy or change in accounting estimate. Inventory cost formula. Weighted average method, FIFO method. It's an accounting policy only. It's a choice for you. So therefore, it's an accounting policy. So therefore, it's change in accounting policy. Just now, I think we have seen one question also where he has changed from FIFO to, now weighted average to FIFO, I think so. Just now we have seen a question. Here only. FIFO to weighted average. Right? It's a change in accounting policy where retrospectively you need to apply. So this question is kind of continuation. Okay. So accordingly, a change in cost formula is a change in accounting policy, which has to be applied retrospectively unless it is impracticable to do so. Right, we are done with this. Next, before we go to illustration 8, we have few examples. Again, I told you examples are like stories. It is not a question. Then why are we covering it? Because it can be asked as a question. Okay, let's start with example 11. If you guys are ready, we'll start. Ready? Okay, chalo nana. A change in estimate of the amount of bad debts affects only the current period's profit or loss, and therefore it is recognized in the current period. Okay. However, a change in estimated useful life or the expected pattern of consumption of the future economic benefits embodied in a depreciable asset affects depreciation expense for the current period as well as for the future during the asset's remaining useful life. Correct only. If there is any estimation change in bad debts, Nana, provision or whatever it is, it affects only the current year, from hereafter. But when it comes to any change in useful life of an asset or residual value change of an asset, it affects all the future years of the asset. That's what he's trying to say. In both cases, the effect of change relating to the current period is recognized as expense. Income or expense in the current period. The effect, if any, on the future periods is to be recognized as income or expense in those future periods. That's all. This is like a change in accounting estimate only. That is the reason, because the effect is going to be either on current period or on future periods. That's why when it comes to change in accounting estimate, the standard says prospectively you can apply the change. There is no need of retrospective application. Clear? Why? Because mostly the effect is going to be either from today or in future. Therefore, prospective change is enough. So when it comes to accounting estimate, Nana, retrospective application is not necessary. Nana, there are three things in this particular Ind AS. One is accounting policy, accounting estimate, and errors. Accounting policy, retrospective. Accounting estimate, prospective. Errors, retrospective. So first one, accounting policy and errors, retrospective. Only accounting estimate, prospective. Clear? I hope this is clear. Moving on. Okay, now look at this example, example 12. Nana, this is like a story only, Nana. Just some facts, some numbers, and it will be like a story. So we are going to read the story, that's all. You need not memorize it, you need not remember anything. Just understand the essence of the story, that's all. Am I clear? Confirm me, everybody. We'll start with the story. Shall we? Alright, Nana, let's read this story. Example 12, okay? During the financial year ended 31st March 2002, an entity ABC introduced a new range of electric motors, okay? It sold the motors with a standard warranty of 2 years. So standard warranty of 2 years means for whatever the sales that he has done till 31st March 2002, the warranty period will be 2002-2003, which means 1st April 2002 to 31st March 2003 and 2003 and 2004. That's why I've written these 2 years. That's where the warranty will be. Okay. 2002 and 2003, 2003 and 2004. Warranty provides assurance that the product will function as expected and in accordance with certain specifications, and it has been assessed that it is not a separate performance obligation under Ind AS 115. Now, this we will see when we go to the so-called the biggest, toughest, and meanest standard of your entire syllabus, that is Ind AS 115, revenue from contracts with customers. Okay, so there we will see what is a performance obligation, because that is important for us to decide when to recognize the revenue. Okay, so right now that's a really complicated concept. Right now, don't worry. What is the meaning of this sentence is it has been assessed that it is not a separate performance obligation means therefore they have recognized the revenue already. That's all. That's all you need to know. Nothing else. Okay, let's not get it. I mean, let's not make it complicated right now. When we go to 115, which is a world in itself, then we will see. Okay, moving on. Based on the results of testing of the motors during trials prior to commercial production, entity ABC made a provision for warranty cost amounting to 1 lakh for motors sold during the year 31st March, during the year ended 31st March 2002, which means 2001, 2002 they have sold. Okay, 2001, 2002 financial year they have sold. Okay, for whatever the sales that they have done that particular year 2001 2002, which means 1st April 2001 to 31st March 2002, they have made provision. They have anticipated that there will be warranty claims for these sales in future, and they have made a provision of how much? 1 lakh. They have done that during the financial year 2002 2003, that is the next year after the sales has happened. A defect was discovered in the motors that had not come to light during the trials. So during the trials, when they have created a warranty provision of 1 lakh, they did not come across this particular defect, okay, which they have come across now in the next year, 2002-3, and it resulted in entity incurring an amount of 2 lakhs during the financial year on repairs of the motor sold during the financial year 2001-2002. So in 2001-2002, whatever they have sold, for which they have created 1 lakh of provision, which was not sufficient because the actual expenses related to the warranty were 2 lakhs because they did not identify a particular defect during the trial. You got the point? Now, so during the financial year 2002-2003 on repairs of motors sold, okay, fine. Besides, the entity expects to incur 1,50,000 as cost during the year 2003-2004. You got it? So which means for the sales in 2001-2002, they have created a warranty provision of only 1 lakh, for which in the next year after 2001-2002, in the next year, that is 2002-2003, they have already incurred 2 lakhs, which is 1 lakh more. Plus the next year 2003-2004, they are expecting another 1,50,000 we will incur, with respect to its warranty obligations with respect to the motors sold during 2001-2 only. 2001-2 has got a warranty of 2 years, na 2002-3 and 2003-4. 2002-3 already they have incurred 2 lakhs. So 2003-4 also they'll incur another 1,50,000, which means totally they are incurring 2 lakhs plus 1,50,000, which means how much? 3,50,000 of warranty related expenditure, for which they have created a provision of only 1 lakh. Where is 3,50,000 actual expenditure with respect to warranty, and where is 1 lakh provision that they have created, which means literally 2,50,000 more expenditure they are incurring than the warranty provision which they have created. Okay, chalo. In preparing its financial statements for the year ended 31st March 2003, okay, that is the next year, okay, the entity would carry forward a warranty provision of 1,50,000 in respect of motors sold during the financial year 2001-2. That is the first year sales. Okay, it would recognize an amount of 2,50,000, which is 2 lakh plus 1,50,000 minus 1 lakh. So, which means in 2001-2 they have created a provision of 1 lakh. In 2002-3 they have incurred an expenditure of 2 lakhs. This is actual expenditure. Next year in 2002-3 only they are anticipating that in 2003-4 another 1,50,000 I have to incur. So, which means for that I have to create provision now itself. So, which means last year 1 lakh provision was created. This year 2 lakhs is the expenditure. So, that 1 lakh is gone. Still 1 lakh extra expenditure I need to debit in current year P&L account. Plus next year I'm anticipating another 1,50,000. That also have to be debited in current year P&L account. Total will be 1,50,000 plus 1 lakh, 2,50,000 extra, additional in respect to this 1 lakh. I mean, besides this 1 lakh. That's why you have 2,50,000 in respect of the motors sold during the financial year 2001-2 as an expense in the P&L for the financial year 2002-3. The warranty provision included in the comparatives for the financial year ended 31st March 2002 would not be adjusted. The provision for warranty costs in respect of the motors sold during the financial year would be made by considering the information concerning the defect in the motors that came into light during the financial year 2002-2003. Now, some of you might be confused with this. Why it would not be adjusted, Nana, with respect to the comparatives of the financial year? Because what is the problem over here? Is this an accounting policy mistake? No. Is this an error? No. It's an accounting estimate mistake. Why? Because it is not an error. Because they have done the trials. Okay, but they were not able to find any defect. So they were right on their part. In the next year, what has happened? They were able to do this. So therefore, what he's trying to say is that he's not going to adjust the previous year. Got the point? Because they did not see this particular defect, their estimate went wrong with respect to the provision. Are you able to understand? That's why it has to be prospective. Anyways, that's it. Are we done with this 12th question story? Shall we move on to the next one? Are we done with this, guys? So this example is based on provision for warranty cost, which is an accounting estimate, obviously. Are we done with this? Moving on. Illustration 8. An entity has presented certain material liabilities as non-correct in its financial statements for periods up to 31st March 2001. Up to means till that time they have done that mistake. Okay. Certain material liabilities, they have presented it as non-current, it seems. Okay. Right. While preparing annual financial statements for the year ended 31st March 2002, that is the next year, the management discovers that these liabilities should have been classified as current. So current liabilities, they have classified as non-current, which means it is a kind of an error, right? What error? Presentation error. Correct. It is not a recognition error. It is not a measurement error. It is not a disclosure error. What is the only error that is left over? Presentation error. You got the point. The management intends to restate the comparative amounts for the prior period presented as at 31st March 2001. Would this reclassification of liabilities from non-current to current in the comparative amounts to be considered to be the correction of an error under Ind AS 8? Would the entity need to present a third balance sheet? Yes, because up to 31st March 2001 means mistake happened last as well as before last as well. Which means not only you have to rectify the prior period financial statements in the comparative column where you will be restating the numbers, that is correcting the last years, plus last before years also you have to rectify. How will rectify? By correcting the opening balances, by restating the opening balances of the previous year. That restatement of the opening balances of the previous year is nothing but preparing third balance sheet. Therefore, we know that when it comes to errors, we have to show the effect retrospectively. Got the point? So when you are going to do that retrospectively, if the mistake only belongs to the last year, then only comparative column restatement is enough. of the previous year. But if it belongs to last year and before last year, then you have to correct the opening balances of the previous year as well, where mostly the correction will happen with respect to retained earnings of the opening balance of the previous year. Yes. Hello. In that case, that restatement of the opening balance of the retained earnings of the previous year is nothing but third balance sheet. So should we prepare the third balance sheet in this case? Yes. Yes. And it is a presentation error. Okay. Now look how the answer goes. First, you have to copy paste the concept. This is an error. Now, I told you with respect to error, I told you to remember two paragraphs. This is second paragraph. See here. An error can arise as per Ind AS 8 with respect to recognition, measurement, presentation, or disclosure. Financial statements do not comply with Ind AS if they contain either material errors or immaterial errors that are made intentionally to achieve a particular presentation of an entity's financial position or performance or cash flows. Potential current period errors discovered in that period are corrected before the financial year. Financial statements are approved for use. That's obvious. If you detect any errors this year and your financial statements are yet to be approved, then you can rectify now itself. However, there are certain errors which are sometimes not discovered until a subsequent period. So last year's error, if you discover in this period, then they will be called as a prior period errors, and that cannot be corrected right now because that financial statements are approved and it is done and dusted. Therefore, what you will do, you will rectify the comparative financial statements of the previous year. Those numbers will be restated. Plus, if the error belongs to prior period far back in time, then what you will do, you will correct the opening balances of the last year's financial statements, where mostly retained earnings will be rectified, and that we call it as a third balance sheet. Are we done with this? Finish it off. You can just read it on your own. Whatever I've discussed, the same sentence or there, Nana. You want me to read? Do you want me to read? Yeah, see here. Yes, reclassification of liabilities from non-current to current would be considered as an error as per Ind AS. Okay. Accordingly, financial statements for the year ended 31st March 2002, the comparative amounts of the previous year would be restated. That is the first thing. In addition to that, you have to present third balance sheet at the beginning of the previous year. There also you have to rectify the numbers, correct? That's all. That's all he has written. Got it? Only this one you need to get it out from the memory. Okay, this first paragraph, concept and then application of the concept. That's all. Are we done with this? Shall we move to the next one? Right, next question. So this is your study material questions only, Nana. Test your knowledge questions. Let's look at the first one. A carpet retail outlet sells and fits carpet to the general public. Okay. It recognizes revenue when the carpet is fitted, which is on an average 6 weeks after the purchase of the carpet. So what he will do, he'll sell the carpet. After that, he'll take nearly 6 weeks time, and then he goes and fits the carpet. When he fits the carpet, he's actually recognizing the revenue right now, correct? Okay. Then he's deciding that why should I fit the carpet? I'll go for subcontract to self-employed fitters. So they will fit the carpet. So hereafter, I'll just do the selling part. Fitting, somebody else will take care of it. That is a subcontracting. It now recognizes revenue at the point of sale of the carpet itself, because right now I'm selling it and my job is done. Fitting is done by somebody else. Whether this change in recognizing the revenue is a change in accounting policy? Obviously not, because the carpet retailer has changed the way the carpets are fitted. You understand the point? Therefore, there is no need for any accounting policy change. Therefore, there is no need for any retrospective change over here. It's just he changed the way he is doing business. That's all. This is not a change in accounting policy, as the carpet retailer has changed the way the carpets are fitted. He has given it to subcontract. That's all. He's not doing it now. Where's the question of accounting policy here? Therefore, there would not be any need of retrospective change with respect to prior period figures for the revenue which is already recognized. Simple. Next question. Under what circumstances an entity is required to present a third balance sheet at the beginning of the preceding period? This we already know, Nana. If there is retrospective application with respect to accounting policy, and that not only affects the previous year but it affects the previous prior period years as well, then those effects, the restatement has to be rectified in the opening balance of the previous year. That is nothing but we call it as a third balance sheet. Chalo. Are we done? presentation of financial statements, an entity shall present a third balance sheet as the beginning of the preceding period in addition to the minimum comparative financial statements required by, okay, paragraph numbers, let's forget. That's not important for us. It applies an accounting policy retrospectively, makes a retrospective statement of the items in its financial statements and reclassifies items in its financial statements. And this so-called retrospective application, retrospective statement or the reclassification has a material effect on the information of the balance sheet at the beginning of the preceding period. That's it. Routine nonsense. Are we done with this? Chala guys. We have almost done all the theory questions with respect to this particular standard. Hereafter, from question number 3 onwards, we have problematic questions. More of a problem, okay? Less of a theory. So that will be done in the next session, okay? So this session till here it's done. We have covered all the theory based questions, or we can say theory based application oriented questions. In the next session, we will finish off all the problematic stuff and we'll be done with all the problems of this particular Ind AS 8. Okay? Chalo.